US President Donald Trump tells a New York Post that Iran has agreed to not have nuclear weapons, but they can change their mind. This even as Iran Foreign Minister said no progress has been made in talks with the United States. Israel Prime Minister tells CNBC that Iran is an existential threat to both US as well as Israel. Also, Israel and Lebanon agreed to implement a ceasefire following US-mediated talks in Washington. Stocks on Wall Street closed Wednesday's trading session lower. The S&P 500 snaps a 9-day winning streak. This is as the oil prices and treasury yields moved higher amid worries of US-Iran conflict could keep lifting inflation. Markets in Asia Pacific opened with cuts on renewed tensions in West Asia. The GIFT Nifty is indicating a gap down start for the Indian market. And Brent crude prices fall towards $97 per barrel as investors assess escalating tensions between US and Iran that continue to cloud the prospects for a peace agreement and the normalization of West Asia's energy flows. Gold trades around $4,450 an ounce, weighed down by the growing expectations that central banks may need to raise interest rates to counter an energy-driven inflation shock. The high-level India-US trade negotiations in New Delhi conclude today, but both countries push to hammer out the final details of a major interim bilateral trade pact. US Ambassador to India Sergio Gore says that 99% of the deal is in place. Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. While the uncertainty on the US-Iran war, that still continues, we have a lot of cues that we pick up from there as well. Israel, Lebanon, we have an update coming in on that front as well. But what's Asian market doing this morning, right? US wasn't that exciting. Asia has also opened up on the red start and red note today. Taiwan index down 0.8%. We have Hang Seng that's down 0.8 to 0.9% as well. ASX 200, that's the Australian index, that's trading with cuts. You have Shanghai that's trading with cuts. You have Nikkei that's trading with cuts. So most of the Asian markets have opened up in the red, mainly obviously because of these West Asia tensions that continue. Now let's look at the Indian markets. What is it looking like? 200-point downtick. We're again looking at a gap down start. Yesterday also we did see that down start and the gap down start. Then we recovered to the second half of the trading session and closed almost near the day's highest point. Not a full recovery, but we did manage to see a very good recovery. Is that going to be the case today? That's what we'll keep an eye out on. But as of now, we're seeing a red start for the Indian markets, a gap down start. 200-point downtick is what the Nifty implied open is indicating. So that's the update that we have coming in from the Asia front as well as the Indian markets. But onto that West Asia update that I was talking about, right? Iran's Foreign Minister Abbas Araghchi said that no progress has been made in talks with the United States, though channels of communication remain open. Araghchi also said that and defended Tehran's attack on US allies in the Gulf region as self-defense and warned that what sanctions and war failed to achieve won't be won with more war. Meanwhile, US President Donald Trump says that the progress in talks with Iran could come within days and that the Washington expects to secure Tehran's enriched uranium stockpiles under a potential deal. Listen in.
Because we took a strong action for a different reason. So they were reciprocating it.
Mr. President, can you explain why
the negotiation itself has gone very well, actually. Very well.
Mr. President,
It could happen. I mean, if it happens, and it might not happen, who knows? But if it happens, it could happen like over the weekend. When it's over, as of this moment, it's agreed that we will go in with them. We will get it and we will destroy it. It will be destroyed.
Okay, that's the word coming in there. Meanwhile, following Washington-mediated negotiations, the U.S. said that Israel and Lebanon have agreed to a ceasefire. The deal requires Hezbollah to halt attacks and withdraw from the southern Lebanon. Both sides also agreed to hold direct negotiations to resolve the outstanding issue and prevent renewed hostilities. Last evening, before the ceasefire announcement was made, Israeli Prime Minister Benjamin Netanyahu spoke to CNBC on the need to disarm Hezbollah. Listen to what he had to say.
I think he understands that Lebanon has been taken hostage by Hezbollah. It's basically taken over the country. It's an Iranian proxy that puts all the citizens of Lebanon at gunpoint and uses Lebanon as a platform to launch terror missiles into our cities, to launch killer drones against our civilians. And so if we want to save Lebanon, and if we want to get a Lebanese-Israeli peace, as I do, we have to disarm Hezbollah, and we have to demilitarize Lebanon. And I think that's a goal that, it's not I think, I know that this is a goal that the President and I share. And that's what we have to do. So we're trying to, how shall I say this, degrade Hezbollah so that a free and independent Lebanon can emerge. We're still working on it, but we're en route.
But did you tell him that you would stop in order to get the peace talks going?
No, I think what we discussed is something else. They were firing, Hezbollah was firing these terror missiles into our cities. You know, they hide behind their civilians and they fire at our civilians. Like Hamas in Gaza, they commit double war crimes. And we are responding, we're targeting the terrorists themselves. The terrorist chieftains, many of them are in Beirut. So they're giving orders to target our cities from Beirut. And we said, if you keep on targeting Israeli territory and our cities and our communities, then we'll take out these terror chieftains in Beirut with surgical strikes. And an understanding seemed to have evolved two days ago, really, that they will not target Israeli territory and we will not target the terrorists in Beirut.
Has that helped?
I'm not sure, because it looks like we're checking this, that they fired into our territory. In this case, if that happens, we'll obviously respond. But I think that on the whole, that's a beginning of a change. But ultimately, the change has to be the disarm Hezbollah. You know, you can't have these genocidal terrorists taking over this poor country of Lebanon, using it to try to invade Israel the way that Hamas invaded us, murder our civilians.
And just before the ceasefire agreement between Israel and Lebanon was announced, a reporter asked the US president whether it was possible to get to a deal with Iran and open the Strait of Hormuz, even if Israel did not stop hostilities in Lebanon. This is what Trump had to say.
We're trying to separate it. I mean, you look, it's a very different kind of a thing. We actually spoke with Hezbollah for the first time ever. We didn't know they spoke. And they agreed yesterday they're not going to shoot. Israel's not going to shoot. We're just going to see. But I'd like to separate it. I'd like to have a separate thing because it is separate.
Okay, now we've heard everything that's coming overnight, right? From US, Iran, Israel, Lebanon front, Strait of Hormuz, what's happening there? How does that impact the world of commodities? We have Manisha Gupta to take us through all of that. Good morning, Manisha.
Morning, Vinny. Thank you for that. And I'll start with the crude oil prices itself, because yesterday was a 2% of a gain, but prices have seen a decline of nearly a percentage point in the Asian markets right now. This is all purely because of the kind of statement that we are hearing about a ceasefire agreement between Israel and Lebanon, and hopes for a broader deal now to end the U.S.-Israeli war with Iran as well. Apart from that, it also is about the U.S. House approving a resolution seeking to curb President Donald Trump's war powers. The resolution, of course, will need to have a Senate approval and a two-thirds majority in both the chambers, but that's something that the markets also are looking at. In the meanwhile, it is the U.S. crude stockpiles which have continued to decline for a seventh straight week, and this time around by 8 million barrels. So there are both factors still working in, but more positive news is what is weighing onto the markets and is the reason that we are continuing to trade below $100 a barrel for the crude prices. But it is also declines for the precious metal prices. Gold and silver both have seen sharp declines. Gold fell 1% overnight, silver 3%, platinum fell 4%, palladium fell 5% as well, on expectations that the central banks may increase interest rates going forward. Overall, the markets will now focus on the Friday's U.S. non-farm payroll data. That is what would give you further direction coming in for prices.
Okay, thank you so much for that, Manisha. But on that note, we're going to slip into a very short break. And after the break, we'll tell you how these overnight cues are going to be impacting our Indian market. Stay tuned in. Thanks for staying tuned into Power Breakfast in CNBC TV 18. Now let's move on and talk about the US markets. The major indices in the US market ended lower as US-Iran war tensions continue to weigh on the markets. We have CNBC's Mackenzie Siegelers, who's here to give us a wrap on what happened on Wall Street.
U.S. markets were down across the major indexes in Wednesday trading as oil prices rise over Iran war tensions and the S&P breaks a 9-day winning streak. The Dow fell more than 1%, down 621 points. The S&P 500 dropped by 56, and the tech-heavy Nasdaq lost 240 points. After President Trump confirmed that he cursed at Israeli Prime Minister Benjamin Netanyahu in a phone call over Israeli incursions into Lebanon and their effect on the Iran talks, CNBC's Sarah Eisen sat down today in Jerusalem with the Prime Minister in an exclusive interview where he insisted that he and the president may have tactical disagreements over the war, but agree on the main priorities.
We've always found a way. We have so many agreements. We agree on the main things. We want to get Iran, the nuclear program in Iran, finished. We want to make sure that Iran doesn't pose a threat to Israel, to the Middle East, to America.
You can watch the entire interview at cnbc.com. And people are pulling their homes off the market at the fastest pace since April of 2020, when the pandemic shutdown was in full swing. And it's happening right in the middle of the peak spring selling season now. According to real estate brokerage firm Redfin, Wednesday, nationwide, nearly 6% of all home listings were taken off the market. Atlanta saw the biggest impact, with 1 in 10 homes delisted, as high mortgage rates, gas, and grocery prices continue to weigh on the market. That's what's happening here in the U.S. Back to you, Mumbai.
Thank you so much for that. On that note, staying with Wall Street, let's listen into market experts and their views on U.S. market and the Fed's trajectory going ahead.
Would argue basically, move from overweight to neutral. Market can overshoot for sure. We can go higher, and that's basically, the very, very strong earnings story. But what I would also caution on the earnings story is some of that's coming from pricing, and pricing is about demand exceeding supply. And, there is the possibility that supply responds, and at least the pace of price increases, which is going into revenues and earnings, is likely to slow. So I would argue, several things suggest, take a break for now.
Okay, now let's move on and bring on board a team of research who's joining us to tell us the trade setup for today, what are the stocks that we're keeping an eye out on, as well as the updates in the world of F&O. First up, Hormuz, important market cues we're keeping an eye out on today.
Morning, Vinny. And of course, we're almost getting used to now seeing the GIFT Nifty down almost 200 points every single day. But then, of course, then comes 12:30 and then the entire scenario changes. And that is what the bulls would be hoping for today as well, just as we plan on opening gap down of almost 215 points in today's session. Now, the oil prices, well, they had gone up to around 98-ish. Now they're back at around 96, 97. But of course, they are still higher than what they had fallen to earlier in the week. Now, today being, of course, the Sensex weekly expiry, so need to keep that in mind as well. The market has been anticipating some reforms, something on the bond market front or even on the equities front. There were multiple reports suggesting that they will keep an eye out on those developments as well if there is any such announcement, and therefore an impact on the currency and the bond yields. The currency had recovered from the day's low yesterday, as did the bond yields as well on some news reports that had come in. So keep that on your radar as well. And of course, watch out for IT. The Nifty IT was down almost 6% in yesterday's session. Yesterday was on Wall Street was no different either. The Infosys ADR down almost 5%. The Wipro ADR down almost 4% as well. And of course, the Nifty IT that was down almost 6% in yesterday's trading session, wiping out well over 1.5 lakh crore in a market cap. The Nifty has a bit of a problem, even though if it is recovering from the lows of the day, the texture still remains a sell on rallies one, because over the last 6 sessions, the index is continuing to make lower lows. That streak first needs to be arrested, and then we move on to higher levels, which is 23,500, of course, being the first level to watch on the upside. That is the first hurdle, and then we go on to 23,700, 800, but that's, of course, that's a distant one. The bulls, of course, yesterday's low, 23,151, that remains the important one to watch to arrest that lower low streak. But for now, the 215 point gap down, we again open near that 23,150 mark yet again. It remains to be seen whether there is yet another reversal at 12:30 today.
Okay, we'll wait out for that. Hormuz, thanks so much for that, though. Let's move on and talk about the stocks that you should keep on your radar this morning. We have Ananya to take us through that. Good morning, Ananya.
Good morning. So several stocks are likely to remain in focus today on back of their corporate development. So starting with Rajesh Exports, SEBI has restrained the company's chairman from trading in company's share and ordered a detailed investigation after flagging discrepancies in customer-wise sales data. Now coming to BHEL, will also be on investors' radar after securing a 2,500 crore contract from refinery and petrochemicals in Nigeria. Now Hero MotoCorp has unveiled its first flex fuel motorcycles, while Idea Forge Technologies board has approved a fundraising plan of up to 500 crore. Now Tax Macro Rail announced a landmark partnership with France-based group and US-based Trinity Rail to create India's first global rail car leasing platform. Now, JBM Auto reported sales of 157 electric buses in May and retained leadership in the segment with a 49% market share. Now, NBCC has received fresh work orders worth about 83 crores, while LTM launched a managed secure service edge solution partnership with Cisco Live 2026. Now, these will be the key stocks to watch in today's trading session going forward.
Okay, thank you so much for that, Ananya. But let's move on and talk about the updates in the world of F&O as well. What are we keeping an eye out on in terms of cues? We have Sudarshan to take us through that. Good morning, Sudarshan.
Good morning, Vinny. So nothing has changed. Like over the last 3 days, similar pattern has been playing out every day. We open with sharp gap down and come afternoon, we see a sharp recovery following certain announcements or certain news flows. Will we see the similar pattern today? That depends on the announcements, if any, that we get to see. But as far as FI's actions are concerned, just one action, that's they remain sellers and they remain heavily on the sell side. Talk about index futures, talk about the cash market, everywhere they're adding positions on the short side. So index futures yesterday, they have sold more than 4,400 crore. Even the stock futures, they have sold more than 1,700 crore. They have added long positions of 1,300 contracts. But look at the short side. Addition is more than 30,000 contracts. Now short side exposure has increased to 92%, while on the long side, it's come down further to 8%. On the options data front, 23,000 and 23,300 on the put side remained most active put options with a sharp increase in the open interest, while on the call side 23,500 and 24,000 were the most active ones. So it tells you the range for Nifty remains from 23,000 to 24,000. So first support for Nifty 23,250, next support comes around 23,000 and first resistance will be 23,500. Two stocks remain in the band, and those are Amber Enterprise and Keynes. Some of the stocks that I'll keep an eye on. First one is Vodafone Idea has seen a sharp short covering. Dixon Technologies continues to add fresh short positions. Canara Bank, amongst all the PSU banks, was the one which has seen fresh longs.
Okay, thank you so much for that, Sudarshan. But let's focus on Rajesh Exports. Market regulator SEBI passes an interim order following its investigation on the company for a period of nearly 4 years. Yash is joining us to give us details on this one. Morning, Yash.
Morning. So it's an interim order which market regulator SEBI has passed, and the order essentially stretches across 109 pages. Interim order because market regulator says that it felt that it is very important for the regulator to step in at this point of time and put some order, put some restriction, put some stoppage, and then continue its investigation. That shows the seriousness of the matter as well. As far as the notices in the order are concerned, one is the entity itself, that is Rajesh Exports, and the second entity is Rajesh Mehta, who's the promoter of the company. The period of investigation for market regulator SEBI has been between April 2020 to March 2024. Now there are a series of allegations which SEBI has investigated and found material in them. About 10 to 12 allegations is what SEBI has put forward. But if I have to divide these into 4 large allegations against the company and the promoter, they would go like this. The first one is with respect to systemic failure on the part of Rajesh Exports to substantiate its financial figures. The second one, non-availability of financials of Rajesh Exports subsidiaries and the step-down subsidiaries. These subsidiaries actually contribute more than 95% of the consolidated revenue, and a misappropriation or misreporting of financials is what market regulator SEBI seems to be suggesting in these subsidiaries. The third one is selective and incomplete disclosures by Rajesh Exports, and the fourth one, elimination of intra-group transactions to mark entity-specific risks cash flows, related party exposure. So these are the 4 to 5 large sections under which all the allegations really branch out. SEBI is given with exact numbers, figures in terms of what has been the size of misappropriation. As far as order is concerned, Rajesh Mehta has been restrained from buying, selling or dealing in securities of Rajesh Exports, and Rajesh Exports will have to make true and fair disclosure of its financial statements and related party transactions.
Okay, Yash, thank you so much for the latest update here. But on that note, we're going to slip into a very short break. After the break, we'll get you the updates from the world of tech and AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech in our special segment AI Pulse. We have Rachana joining us as always to take us through all of that. Good morning, Rachana.
Well, first up is Broadcom that posted record quarterly numbers, but Wall Street may have wanted more. The chip giant reported Q2 revenue of $22.2 billion. That's up 48% year on year. But AI semiconductor revenue more than doubled to $10.8 billion. CEO Hock Tan said that the number hits $16 billion next quarter. But the stock fell in extended trading after Tan held the full year AI chip target at over $100 billion for fiscal 2027. Cybersecurity giant CrowdStrike also beat expectations on both revenue and earnings, but the stock still fell around 9% after hours. Q1 revenue came in at $1.39 billion, up 26% year on year, with adjusted earnings per share at $1.10 against estimates of 1.07. CEO George Kurtz called it the mythos moment, saying the worlds of cybersecurity and AI have now collided. The company also announced its first ever 4-for-1 stock split, with split adjusted trading set to begin July 2nd. Speaking of OpenAI, CEO Sam Altman was in Washington on Wednesday, the day after President Donald Trump signed a new AI executive order asking companies to voluntarily share advanced models with the government 30 days before public release. Altman met White House officials and congressional leaders from both the parties, backing the order as one that gets the balance right. Separately, as we know, Anthropic this week filed a confidential S1 with the SEC for their upcoming IPO. Then there's Mark Zuckerberg, who also traveled to London with a product push of his own. Meta has launched the Meta Business Agent across WhatsApp, Messenger and Instagram, handling customer queries, product recommendations and appointments. It sits inside Meta's new subscription tier, Meta One. Meta piloted an earlier version in India and Mexico. Advertising still accounts for 98% of revenue, but then there's Elon Musk. As we know, SpaceX is on a track for its IPO that could make Musk the world's first trillionaire. But his AI company XAI is now facing legal action in the UK. Labour MP Jess Asato has filed a High Court claim against XAI over fake sexualized images generated by Grok, calling the capability a design choice by its creators. Ofcom is already investigating this under the Online Safety Act, and we're yet to know what happens from here. And finally, Amazon engineers spoke at Seattle City Hall Wednesday in support of a one-year pause on new mega data centers, pointing out that Amazon is spending $200 billion on AI this year while cutting more than 30,000 corporate jobs since October. The council passed a moratorium unanimously to pause construction of new data centers. That's all we have for now from the world of AI, but more news and updates as we go through the day.
Okay, thank you so much for that, Rachna. But with that, we're absolutely out of time on this edition of Power Breakfast. Nifty implied open is still indicating a red start, a gap down start for the Indian market. So keep an eye out on that. But your Bazaar morning call up next to take you through all the action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Reema and Nigel. Guys, hi, morning.
Hi, morning.
Hi, morning. Once again, we've got that two-track market. On one hand, on Middle East, there seems to be some fragile ceasefire or truce. But on the other hand, so much happening on OpenAI. For one, software is pulling back and pulling back hard. And even the numbers that came out of Broadcom post-market hours. It's a miss, and the stock has fallen close to about 14%. So that's the added overhang. And SpaceX IPO, big blockbuster one.
Well, that's right. Plenty of cues, both globally as well as domestically. And last few sessions have been rather rough for the bulls, though yesterday there was a glimmer of hope. So we'll have to see whether or not, there's more pullback in store, or are we headed lower? Prashant, let's get straight to the action.
Absolutely. Remember when you said that software is in a pullback, you mean pullback?
Back of the rebound.
Pullback of the pullback.
Yeah.
It was a rebound in that sense. And yesterday was a case in point. Well, let's just take it from the top and tell you what's happening. So oil prices moved up 2% last night. And I just wanted to mention that, I mean, prices are down below 97 now. But, while US was trading, it was reacting to oil at 98. And that's the context. But this morning, as you can see, we're under 97 now. So, the Associated Press is reporting that Israel and Lebanon have agreed to a ceasefire. But both sides essentially saying that, well, this requires complete cessation of Israel is saying incoming fire by Hezbollah. And of course, Hezbollah is saying that Israel needs to stop. It's funny. I don't think we really had a ceasefire. There was a ceasefire, but I mean, both parties were fighting. And, Israel was sort of going into Lebanon and talking about sort of, going deeper and deeper. And there were, of course, attacks in North Israel from Hezbollah missiles, etc. So I'm not sure what this would amount to. But the reason, of course, this is important, of course, is that Iran has made it clear that any agreement with the US cannot be in isolation. It has to include what Israel is doing and what it should not be doing as far as Lebanon is concerned. And that's the reason why this all sort of, ties in. Now, Iran's foreign minister also has made some comments. I mean, actually, lots of commentary back and forth. But the point is, as they say, talk is cheap, right? You got to see activity, you got to see real action. Iran's foreign minister saying our contact with the US hasn't been cut off, but no progress has been made with regards to negotiations. So that is from the Iranian side. And of course, I mean, we'll play out some sound bites from President Trump, and there was, all that happening, which we will look at as well. Now, the EIA reported a sixth weekly drop in US commercial crude supplies. So that came through. Strategic reserve stocks dropped by 8 million barrels. And US reserves, by the way, are now at their lowest, at least in the last few years or so. We've had company CEO, and these are large global companies. I think Exxon CEO came on record, and this is all in the last 3 days. There was a Shell CEO came on record, and I think there was one more, which is day before yesterday, who said, well, the world kind of is sleepwalking into a real oil shortage kind of a situation. Prices, all kinds of prices being thrown about. I think the Shell or the Exxon, one of the two, basically said, well, we could be looking, if this continues, the stalemate continues, you're looking at $140, $150 a barrel. Now, US equities, as I said, they were trading with oil at 98, maybe a little higher. So they were down and they ended their 9-day winning streak. NASDAQ was down almost about 0.9%, 9 days, right? I mean, non-stop, up and up and up. Of course, I mean, the day before yesterday was small up. It was kind of flattish, but it was up nevertheless. 10-year yields were up 5 basis points. We're at about 4.5%. NVIDIA was down 4%. Microsoft was down about 3%. And Broadcom, the chip maker, fell 13%. This is, of course, the price action in the after-hours trading. For that one, and we'll perhaps get you more commentary around it. Let's just tie in the levels here now. The market is falling, but it is also not collapsing, right? And that's the point which we made yesterday morning as well. So if you look at, for example, Monday's price action or Tuesday's price action, yesterday was Wednesday. Again, I mean, the market fell, but it didn't get to the gap area. Now, when I say the gap area, I mean the gap which was made between the 7th of April and the 8th of April. That's the gap which is the gap to be filled. So yesterday, we've filled that gap in that sense. So we fell below 23,270, but we didn't close below it. That is point number one. And let's just go back to the first, let's just stay with this plate for a bit. We didn't, we didn't stay below it. And Nifty has now filled the early April gap, the 7th, 8th April. So that if you look at the low yesterday, 23,151, that is the high on the 7th of April. Now you can ask the question, and it's a legit question to ask, what does this mean? Is this bullish? Is this bearish? But maybe it is nothing. I mean, that gap, if that gap had not been filled, it was a pretty strong, robust area for support. But I think it still is the support in that sense. So the high of 7th of April and the low of the 8th of April, that's basically the support zone. 23,151 to 23,270 is the support area for the Nifty. And of course, I mean, on the way up, there's lots of resistances, but we'll just go with 23,800 which the Nifty needs to close above for any amount of enthusiasm to come back. Flows, etc. I think it was a matching number, but very large numbers. And Nigel will talk more about this in just a bit. And tomorrow, of course, is the Reserve Bank of India policy. It's a pretty consequential policy with regards to what the Reserve Bank does and says. And it's got implications for yields. It's got implications for the rupee as well. GIFT Nifty will give you a quick sense of how we're likely to start. Oh boy, 200 points lower. So we'll see if this is going to be 200 lower straight away at start, which basically means that, then you're looking at lower levels, or this is going to hold and maybe turn around a little bit in the next hour or so. Nigel has walked across to the wall with the F&O data and positioning. Nigel.
Well, crude oil prices have cooled off a little bit, though the geopolitical risk continues to be alive. And the GIFT Nifty is suggesting a pullback of around 200, 250 points odd. If you're a brave trader, probably, that dip could be providing you a bit of an entry opportunity just because crude oil prices have cooled off. But there are some statements that are coming from Mr. Trump as well. And this war appears, maybe it gets prolonged a little bit. So we'll have to keep an eye out on that. However, this dip could be an interesting entry just for today's trading session, going by the kind of fall that we've seen. The FIs, they continue their selling waves. Well, in yesterday's trading session as well, the FI selling was matched by the DI buying. However, what stood out yesterday was a bit of a short covering bounce that we saw on the Nifty Bank. And that was evident, right? Because the Nifty Bank open interest was down, while on the Nifty itself, you had some open interest build up. So there are shorts that are getting built onto the Nifty, but there was clearly covering that we saw on the Nifty Bank. And, that perfectly tallies with what the FIs did. Yesterday, they added 30,000 contracts again on the short side. In percentage terms, it's at around 92%, which is the highest in percentage terms all the way since January. So this market is aggressively net short and is bracing for some kind of bad news. Now, importantly, just in a matter of a week, the FI net short positions have gone up by 1 lakh contracts. That's right. Since the start of this contract, we were at around 1.5 lakh contracts on the short side. Just take a look at where we are because of the kind of addition we've seen. We're at around 2.5 lakh contracts on the short side, which is telling you the kind of addition we've seen on the short side just in the last couple of sessions. The problem is the India VIX, it had cooled off last week. It had in fact breached that 15-odd mark. Now that's perking up a little bit. It's still pretty much well behaved. At around 16.5, it's okay. You don't want it to get past the 20-odd mark. Remember, the recent high is at around 29-odd. That gives you a sense in terms of fear in the system, volatility in the system as well. So this one perking up is not great news, but it's still far from that 20-odd mark, which is a bit of a risk level. In terms of the options data, the PCR is holding at around 1. Remember the other session, we had aggressive shorts in the system, and you had the PCR that came down to around 0.65, 0.7 odd. You want the PCR to come down, and then in fact, that triggers a bit of a technical factor when we see a short covering bounce. But fair bit of action, 23,300 call, 23,300 put as well. Good amount of open risk built up out there. And there appears there were some signs of writing even on the put side. That's around 23,300 put just in yesterday's trading session. The problem is the Nifty needs to break this trend that we've been seeing for the last few trading sessions. We have been making lower highs and we've been making lower lows. So for today, you want to get past this mark on the upside from a bullish perspective, and the bears will cite a break of this particular level. So that's the crucial range that you're looking at for today's trading session itself. Important that the Nifty gets past the 23,500 to give you some hope, because then we go on to challenge the 50 as well as the 20 DMA, which comes in out here. So that's a 50 DMA, above the 23,500 mark. And yesterday's low becomes a bit of a reference point. The Nifty Bank, you'll have to bet on that one. Yesterday it saw a big recovery from the lows of the day. And it's very, very close to its 20 as well as its 50 DMA. So it's going to be important. Was that just a flash in the pan yesterday? Or is the Nifty Bank actually going to take some kind of leadership from here on? We'll have to keep an eye on. But I think that's the one that could in fact fight back from a bullish perspective.
Thank you very much for that. Let's get to the ongoing tensions in West Asia then. US President Donald Trump said that progress in talks with Iran could come within days, and said that Washington expects to secure Tehran's enriched uranium stockpile under a potential deal. Listen in.
Because we took a strong action for a different reason. So they were reciprocating it.
Mr. President, can you explain why...
The negotiation itself has gone very well, actually. Very well.
Mr. President...
It could happen. I mean, if it happens, and it might not happen, who knows? But if it happens, it could happen like over the weekend. When it's over, as of this moment, it's agreed that we will go in with them. We will get it and we will destroy it. It will be destroyed.
Well, he has been saying that negotiations are going on pretty well, but we just haven't had a final deal come through. But there was a ceasefire agreement between Israel and Lebanon that happened a couple of hours back. And just before that, a reporter asked the U.S. president whether it was possible to get a deal with Iran and open up the Strait of Hormuz, even if Israel did not stop its hostilities in Lebanon. This is what he had to say.
We're trying to separate it. I mean, you look, it's a very different kind of a thing. We actually spoke with Hezbollah for the first time ever. We didn't know they spoke. And they agreed yesterday they're not going to shoot. Israel's not going to shoot. We're just going to see. But I'd like to separate it. I'd like to have a separate thing because it is separate.
Well, it is separate, but I guess Iran would disagree, right? Well, it's been, they're saying, well, it's not separate. I mean, they've said it so in so many words, and that's the problem with regards to arriving at a sort of a MOU to end this thing now. William Lee is Chief Economist and Managing Director at Global Economic Advisors. William, good to have you with us here. Good morning. Thanks for joining in. I want to talk about US, Iran, etc. in just a bit, but just want to start with, you wrote something around the Marco Rubio visit to India, right? And by the way, Sergio Gore yesterday was speaking, and the big one is the trade deal between the US and India, like a framework agreement. And what we've been hearing is, we've heard it a few times from the Indian side and of course from the US side as well, that 99 is done, 1% is left. That's it, and it's going to get done soon. So just quickly, your thoughts there, William, and then we'll move on.
I think it's important for the U.S.-India relations not to look at these trade deals in isolation. Look at the trend. And I like to say, ignore the weather reports and look at the climate reports. The climate is one where the U.S. is clearly strengthening its strategic relationships with India. The technology transfer for the production of jet engines, fighter jet engines, as well as the small modular reactors, I think is a very clear indication that if you follow the money, the strategic asset transfers from the United States to India is leading the way for further private sector investments into India. That's the full story. And I think that was the gist of my report. Is I wrote something for our clients, many of whom were expressing interest in investing in Asia and trying to decide between China and India. And I wrote a very pro-India piece because I think when the choice comes to setting up long-term investment facilities, India is got a lot of things going for it, and the deals that the Rubio was talking about are the hallmarks of the growing strategic relationship. Like I said, the weather report changes day by day, and you can have tariffs, you can have all sorts of trade problems. But when you follow the money, follow where the strategic assets are going, I think that's a very clear sign the U.S.-India relations are getting better.
William, hi. So the weather is hot when it comes to long-term FDI strategic money coming into India. But the problem is that the weather is very cold when it comes to capital markets and the outflows that we're seeing from the Indian markets. And we're losing out to all our Asian peers. So what's the weather climate check on that? And is there any sign of it changing?
That's why the building of infrastructure in India is so important. You're right. And in this show, in fact, I have advocated to many of your investors, if you want to put money to work, put it to work in the most efficient place, United States. Emerging markets are not the place that I tend to favor. But if you do want to see where in emerging markets you do want to diversify, India has all the attributes. And I think the losing out to other investors, I think it partly comes from the AI trade that we're in. And I think Jensen Huang just turned the page on the AI trade when he talked about how local computing, where smaller language models and the ability to do more of the computing locally takes a lot of the pressure off of having to have these hyperscalers. And I think that's a very important shift in how to perceive and understand the AI revolution. It to me means there's a wider spread of the technology, an ability for companies in India, for example, to be able to make use of much more of the AI technologies without having to have these humongous hyperscaler computing facilities.
Hi, William. Good morning. Good to see you, Ben. William, I wanted your take with regard to this entire currency move globally. The Indian rupee, well, that's weakened a little bit, and there's a lot of yuan cry out there, and it's hurting sentiment as well. However, the Chinese yuan, well, that's seen some strength, and that could possibly place India's exports as a bit of an advantage in comparison to China. Do you see this playing out? Do you see India getting a larger pie globally?
Nigel, that's part of the weather report I'm asking you to not pay so much attention to. The currency fluctuations will affect portfolio investments for sure. If you're a bond investor and you want to do swaps and engage in derivative trades, absolutely focus on what the currency is doing. But if you're interested in making longer term strategic investments, fixed investments of the sort that will mature in a 3 to 5 year, maybe 10-year horizon, then you want to look at the fundamentals. And when you compare the strengths that China offers and the uncertainty that China offers compared to the democracy and the kind of forces that are gathering in favor of India, I think the balance of investment positions is going to slowly shift toward India as people continue to discover how difficult it is to do the adequate due diligence in China and to be able to find the kind of information you need to make a clear decision.
Yeah, got that. By the way, it didn't sound like advocacy for India when you said I would advise investors to invest in the US, not in emerging markets.
Short-term money. But as I said, if you choose to diversify into emerging markets, India is certainly at the top of the list.
No, I'm just pulling your leg. But William, Bitcoin, right? While everything is ripping higher, so we don't. India's. Lots of Indians invest, I guess, but there's been there's a big gap, black hole, in terms of whether it's, how to think about it. I don't think the Reserve Bank or the central bank has changed its mind about crypto, etc. But just as a signal, I thought this could be used as a signal, as a risk sentiment indicator. Bitcoin up means, lots of retail coming in, enthusiasm is looking up, and just as a signaling indicator, what does it represent, if anything?
Bitcoin is well off of its historic highs. It's nowhere near the 90,000 plus that it was back, a few months ago. And I think that rightly so. The bubble in Bitcoin, I think, has moved on. The technology behind Bitcoin is being implemented as we speak by almost every bank I know of to try to effect transfers across border in a more efficient and a cost-efficient manner. So the technology clearly is being implemented. And that's where Ether really comes into its own. But again, the infrastructure isn't there, and I think the acceptance hasn't been spread wide enough outside of the confines of established institutions like the banks, global banks that are using that kind of crypto technology to do their transfer. So I would say Bitcoin right now is still a case that yet to be decided. And if you want to be speculative about it, yeah, buy some Ether. But I would invest in some shares in India before I buy Ether.
All right. Thank you, William, for joining in. Moving on now, let's tell our viewers the interactions lined up on the show. 8:35, the management of Happiest Minds will talk about their outlook for FY27, AI, and all things related to that. At 9 a.m., Ajit Kumar of JM Financial will put the spotlight on banks. 9:20, Manishi Ray Chaudhary of Emma Capital will be our market master for the day. 9:30, we bring you a discussion around the cabinet nod for old trucks and bus replacement in Delhi NCR. Following that, the management of D Development will be chatting with us at 9:40 to talk about their fundraise. And the management of SIAT will also be speaking with us at 9:50 to talk about the road ahead. Towards the end of the show, Lata will speak to economist Geeta Gopinath on India's current account deficit bank, the rupee, West Asia conflict, and more.
Well, time to slip in a short break. We've got a lot of stock-specific action to track for you in our special top 10 segment. For the time being, I'll run you through the list. Hero MotoCorp, JBM Auto, IEX, BHEL, Skipper, all of them will be reacting to positive news flow. Idea Forge as well as Bharat Forge. While on the flip side, Lenskart, JMR Airports, and Angel One will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. It's a Thursday morning. It's time now to talk about stocks. This is CNBC TV 18's list of top stocks for the day. But let me begin with Sudarshan, who joins in with a whole host of news today. Sudarshan, hi, good morning.
Good morning. So I'll start with Hero MotoCorp flexing with flex fuel vehicles. Company is launching 2 bikes in 100cc segment, and that would run on flex fuels. Basically, that would be compatible to run on alternative fuel, and that would be combination of ethanol and gasoline. And ethanol part can go up to E85, basically 85% of ethanol and remaining part of gasoline. So company has launched HF Deluxe flex fuel. So HF Deluxe would be priced at rupees 72,792. And second one is the most run bike, that is Splendor. So they have launched Splendor plus flex fuel, and that will be priced at 82,710. So going with green for Hero MotoCorp. Next one is JBM Auto, which has given the update for the month of May. Company is saying that it has 49% market share in electric bus segment in May 2026 and recorded 157 electric bus registrations during the month, and that's the highest that company has seen, basically amongst all the industry peers. Next one is IEX. I'm going with green because May traded volume was at 12,983 million units. That was up almost 19%. And average market clearing price in DAM was rupees 4.88 per unit. That's up 18%. And RTM clearing price at rupees 4.16 per unit. That's up 21%. And remember, this price increase is basically backed by the strong demand. That's the reason I'm going with green for IEX. Lenskart, SoftBank Vision Fund has sold 5.7 crore shares for rupees 2,873 crore, and Societe Generale has bought 1.4 crore shares, but just 1.4 crore shares have been bought via block day. That's the reason I'm going with red. Next one, GMR Airports. GQG Partners has sold 16.3 crore shares. That's 1.5% equity for rupees 1,600 crore. And FMRC Fidelity Advisor has bought 14.93 crore shares. But here also I'm going with red because GQG was the seller.
All right. So thanks very much for that. Well, more stocks with news flow. Winnie's joining us with that list. Winnie, morning.
Hi, good morning. So first up, let's talk about BHEL. They've received an order of around 2,000 to 2,500 crores rupees from Dangote, Nigeria. And this is for mainly a contract and agreement for supply of 8 gas turbine generator packages. Now, obviously, this is going to be over a period of 26 months. This is for designing, manufacturing and supply testing. All of that will be included in the scope of work. While this is a positive news that's coming, we have a note that's coming from UBS on BHEL where they're downgrading the stock to neutral from a previous buy rating, though they've raised the target price to 460 rupees versus previous target price of 375 rupees. The main reason is that obviously we've seen an outperformance that's coming from BHEL in terms of a run-up for the stock as well. And that is why they believe that there could be some bit of a correction that could come in here for the stock. So maybe we could see it open in the green and then a bit of a red on the screen. Next one, we have Skipper Limited that's in focus. The board has approved raising of up to around 433 crore rupees through equity shares on a preferential basis. And in that, the preferential allottees who are going to be there, small cap world funds name is there. We have Bandhan small cap funds name also, and other institutional investors. 92 lakh shares will be given on a preferential basis. So keep an eye out on that. Green could be seen here. Idea Forge, they've received a board approval to raise 500 crore rupees. This could be through various ways, methods. That could be equity shares, preference shares, convertible debentures. That has to still be decided. But there is a fundraising plan of 500 crore that they have. Lastly, we have Bharat Forge. We have the Class 8 numbers that have come in. May Class 8 truck orders have come in, and we're seeing a rise both on a month-on-month as well as on a year-on-year basis. Month-on-month increase is seen after 2 months of decline. We're finally seeing an increase coming in, and May orders are up around 124% YOY and 4% on a month-on-month basis. So green could be seen here as well.
Thank you very much for that. Back to Sudarshan on Angel One.
So after so much of confusion, our colleague Devyani suggested that we should go with green for Angel One after May month update because it was a strong month of April that company had reported, and there was a sharp increase in the client base. Now on that strong base, company has reported an increase of 1% in the client base even in the month of May, while gross additions have declined 9.7% month on month. Another positive part is average client funding book has surged by almost 19% month on month to record high of 63.1 billion rupees, and even F&O market share has seen a further improvement that's up 11 basis points month on month to 22.5%, and this is done despite lower trading volumes. So overall, looking green for Angel One.
Thank you very much for that. We'll keep coming back to you for more. For now, let's do a quick recap on the top stocks. Stocks with positive news flow are Hero MotoCorp, JBM Auto, IEX, BHEL, Skipper, Idea Forge, Angel One, Bharat Forge. Stocks with negative news flow are Lenskart and GMR airports following those big block deals. But let's move on and talk about commodities now. Manisha Gupta joins in for a complete roundup. Manisha, good morning.
Morning, and thank you for that. And I'll start with the crude oil prices, where we did see a gain of 2% in the overnight market. This was after U.S. strike on an empty oil tanker bound for Iran, and Iran launch attacks on U.S. naval bases in Bahrain and Kuwait. But today morning, the crude prices have seen a bit of a turnaround. We've seen a 1% decline in the Asian markets right now. This is as the street is looking at a ceasefire agreement conversation between Israel and Lebanon. This has increased hopes for a broader deal to end the U.S.-Israel war with Iran. In the meanwhile, you also have the U.S. House approving a resolution seeking to curb President Donald Trump's war powers. Now, this resolution needs Senate approval and two-thirds majority in both chambers. So this is something that the street will watch out for. In the meanwhile, it also is about the U.S. crude stockpiles, which have declined for a 7th straight week, this time around by 8 million barrels to just about 433.7 million barrels. So global inventories have continued to decline, and that would in turn continue to support prices as well. So while the crude has seen a bit of a decline, you have seen declines continue for gold. That fell 1% overnight. Silver was down 3%, platinum 4%, palladium 5%. So metal prices overall, precious and base metals, are slightly under pressure in Asia right now.
Okay, all right. Thanks very much, Manisha, for that. Well, that's commodities, and we'll do more commodities with Manisha a little later after markets open. But, you know, there's a scathing, damning SEBI order on Rajesh Exports. It's a listed company. It's been, I guess, listed 20, 30 years now. And it's a company you don't see very often on cnbc TV 18. I don't remember talking about it or ever coming up. Always a ring of suspicion that maybe things were not all right. The SEBI order, of course, confirms it in really blistering detail. So this is an interim order following SEBI's investigation of the company for a period of nearly 4 years. Yash is joining in with details of what SEBI found. Yash, take it away.
Well, Prashant, as you rightly pointed out, it's quite a scathing order which stretches across 109 pages. The period of assessment which SEBI has done is merely 4 years, but the kind of allegations in terms of the kind of numbers and the size of numbers is quite huge that SEBI has put forth in its order. As far as the notices or the people accused in the order are concerned, the first one is the entity itself, that is Rajesh Exports, and the second one is Rajesh Mehta, the promoter of the company. The period of investigation, as I said, 4 years, April 2020 to March 2024. And as far as allegations are concerned against the promoter, against the company, there are about 12 to 14 very, very serious allegations which SEBI has put forth in its order. It has substantiated these allegations with exact numbers that were involved behind the misappropriations which SEBI has pointed out, and those numbers are large as far as getting any kind of attention is concerned. As far as large brackets under which the allegations get divided, I'll put them into 4 or 5 large brackets. The first one is systemic failure on the part of Rajesh Exports to substantiate its financial figures. Second one, non-availability of financials of Rajesh Exports subsidiaries and the step-down subsidiaries. This is very crucial because the subsidiaries and the step-down subsidiaries overall contribute more than 95% of the consolidated revenue, where the details of the financials were absolutely absent for the last many years. Third one, selective and incomplete disclosures by Rajesh Exports. And the fourth one, elimination of intra-group transactions to mask specific entity risks, cash flows, related party exposure. As far as Rajesh Mehta is concerned, as I said, he's the promoter, executive chairman, director and audit committee member of Rajesh Exports. What market regulator SEBI says is that Rajesh Mehta had substantial control over the company's financial. He was a key decision-making authority, and the alleged violation which SEBI has put could not have occurred without his knowledge, consent, involvement as far as Rajesh Exports is concerned. What is SEBI's order? Essentially, market regulator SEBI has restrained Rajesh Mehta from buying, selling or dealing in securities of Rajesh Exports directly or indirectly. And the second one, Rajesh Exports will have to make true and fair disclosure of its financial statements and related party transactions to market regulator SEBI. Do remember, this is an interim order, right? So there is no penalty or any further action which has been provided at this point of time. But market regulator felt that it is a very serious case and it merits an interim order to stop things at this point of time. Right now, the investigations will continue, but a stop has to be put here, and then the investigation continues and the final order will be awaited.
All right. Yash, thank you very much. That's a detailed explanation of what the order says, and we'll do more. We'll get you more because just crazy stuff out there, and it's a well-written order. I urge you to go and read it on the SEBI website. We'll take a quick commercial break here. We'll come back. The management of Happiest Minds will be with us to discuss their outlook for F527 and the road ahead. Stay tuned.
Welcome back. Hope you're having a good morning. The GIFT 50 suggesting a bit of a downtick to kickstart trade. But Hormuz joins us to tell us what's going on from the broader market. Some stocks, they moved on very heavy volumes. Morning, Hormuz.
Good morning, Nigel. And heavy volumes indeed seen on TCS in yesterday's session. Of course, the entire IT segment saw a very, very sharp sell-off yesterday, wiping out close to 1.5 crore worth of market cap. But look at TCS, down 8.5% yesterday, the biggest single day fall in 6 years for the stock. And it gave up all the gains that it saw on Monday and Tuesday and a little more of that as well. And both the 2300 call and put options were very active in yesterday's trading session. The call option premiums were down 72%. The put option premiums on that 2300 strike were up 7x in yesterday's trading session. The volumes were the highest in nearly 2 years as well. Over 1.5 crore shares were traded. The 20-day average is 52 lakh shares, so 3x of that. The 70 lakh shares, or 45% of that, was marked for delivery, and the 20-day average here too is just around 28.5 lakh shares. Unsurprisingly, TCS was the most traded stock on the Nifty 500 in yesterday's trading session. And of course, now the next important level for TCS is 2210, because if it slips below that level, its market cap will be now below 8 lakh crore rupees. The stock that bucked the trend in an otherwise volatile market yesterday was Car Trade Tech, and of course that came on the back of an upgrade from Kotak. The stock ended with gains of close to 10%, the biggest single day gain and volumes in over a month. It was the 5th straight day of gains for the stock yesterday, and the stock is up 15% during this 5-day period. The volumes that were seen in Wednesday's trading session were the third highest in 2026. Over 30 lakh shares were traded. It's the 4x of its 20-day average. Around about 20% of those shares were marked for delivery. So around about 7 lakh shares. The 20-day average here is close to 3 lakh shares. And the stock has had a very, very wild ride. At one point, from a 1600 rupee IPO price, the stock fell to 300 rupees, then went to 3300 rupees, which is its peak, and now has corrected all the way back down to around 1800 or 1900 rupees. Now, the one stock that has seen significant selling pressure has been PB Fintech. Was among the top non-IT losers on the Nifty 500 yesterday. It was the 9th straight day of losses for the stock. The stock is down 14% during this period. The 1600 put option saw a 75% increase in its premiums yesterday. 60% of those shares were marked for delivery, and 33 lakh shares were traded overall. 60% of those were marked for delivery, so around about 19 lakh shares. And from its 52-week high, the stock is down 20%. And as a result of this 9-day losing streak, the stock has also turned negative on a year-to-date basis.
Okay, all right. Thanks very much for that. PB has come off quite sharply, as almost points out. And 1578, I think closer to 1800. I mean, just what, a fortnight ago. We'll take a break. Deepan Mehta of Elixir Equities will be with us for some fundamental stock conversation on the other side. Stay tuned.
Welcome back. Let's invite the management of Happiest Minds on the show. Joseph Anantaraju, co-chairman and CEO of the company, is now joining in. Thank you very much for joining in. So much happening in the world of AI, Joseph. But before I get to that, just a few things on your numbers, since we didn't speak to you post the Q4 announcement and the outlook for FY27. Now, after reporting a 9.2% revenue growth last year, you are guiding for 12.5% for FY27, but the aspiration is 15%. So what do you expect? What can get you from 12.5% to 15%?
Yeah, the 12.5% plan or growth was predicated on a grounds-up approach that we did, looking at each business unit accounts. And so we built it grounds up, which gives us much more confidence, and we've stress tested it. But the 12.5 to 15% growth, Rima, will need 3-4 things to work out for us. And, I'm hopeful it will happen. The first is, I think we need to see more conversions of some of our GenAI deals from POCs into, larger projects or larger deals, right? That's one. Second is the revenues we get from our solutions and from our products, whether it's Artha or whether it's Insurance in a Box, which we introduced this year, or EduWeave. I think that will help because these are all lumpy and they contribute to the top line in a big way, right? The third thing is we have quite a few large deals in our pipeline. And even if a couple of them, these are like cutting across quarters and across years, If a few of them close, I think that will help us get over the line. And the last I would say is, we're getting good traction with some of our P partners. If we can get a few more deal or wins out of these channels, I think that would help.
And on that point about how, we were listening to the Emphasis Analyst Day a couple of days back, and they too are talking about how the entire business model is moving towards outcome-based from time and material. And you've also spoken about it as the way for happiest minds. What percentage of your book today is outcome-based, and what will that number look like 2 or 3 years down the line?
Sure. So if you look at a non-TNM based percentage of revenue, it's at around 25%, Rima. And, my expectation is that we will move this to 30 or 35% at the least, if not 40%, in the next 2 to 3 years. There are 2-3 ways we can do this. And I'm going to give you examples of what we're doing with customers right now. With one of our customers, we are looking at their platform, which has been around for some time, and we're saying that, hey, we're going to modernize this whole thing. This is what it's going to cost you. We're going to take over and do it and deliver with functionality, scalability, security, etc. Right? That's one. Second thing is, with one of our customers, we are saying that you have your platform being handled by a team size of X, using our Rely platform for using AI in the SDLC process, we will be able to reduce 30-35% of the overall cost, and we will be able to do this for you, ongoing basis. And for one of our other customers, what we've done is saying that you have this platform. It's in the healthcare radiology space, and what you're saying is that we will be able to deliver this outcome based on per X-ray that you would be transacting through the platform that we have, which is more of a AI-driven image recognition analysis platform. So that's the approach we're taking. And the last one is on our EduV platform. And what we're doing out here is we have a bunch of components. So we're going to the customer and saying, you can take a few of these components, whether it's classroom analytics or retention, and the rest you can figure out how you want to do it, and that will again give us license revenue plus the ability to use some of our inbuilt capabilities.
So just that point about non-TNM, that's non-time and material, simply put, outcome-based. As it moves from the current 25% to 30, 35, max 40% in the next 2-3 years, directionally, what does this mean for margins? Will margins be higher than it is today? And if yes, to what extent?
Our expectation is that we should be able to get an uplift of 2 to 3% on our margins. But a lot of it also, Rima, would depend on, and this is an evolving space, right? How you manage your tokens and how do you manage your AI tools, and how is the costing for the AI tools done, and how can you incorporate that cost and into your pricing and present it to the customer. So there are a few unknowns, I would say, out here. But our hope is that we'll get a couple of percent of uptake in our margins. But it's a lot of it is evolving. It's a fast evolving space.
You spoke about the cost of AI. There is a lot of reportage about how companies are blowing up their AI budget. Have you experienced something like this?
Rima, so far with our customers, I think they've been investing in AI, but in the last month or 2 months, we've started having conversation, and some of it is proactive, where we've gone back and we're also developing a methodology around metering for token consumption, around optimization of token usage, and internally, to our teams, sharing some best practices on what to do, what not to do, to make sure that your token usage is optimized. Again, this is a space that's evolving, but I think this is going to become a big question in my mind, at least. And I've been, when I meet with customers and we discuss the agentic AI way of approach and overall usage of AI tools in the SDLC. And even outside of SDLC, if you're doing some kind of, if you're using it in some business process or in some automation, you have to, I think, weigh it off against what is the overall TCO of manual plus technology versus using an agentic AI approach, because there are two elements out here, right? One is the usage of tokens, and the other one is the costing of tokens. Right now, if you look at the cloud, 10 years back, there was, I think maybe 10 or 8 years back was when it was the lowest. And then you saw increase in the overall costing of cloud. And same thing could happen with, the AI tools and your tokens. So I think this is something that, customers also have to be cognizant of, because once you replace your knowledge and your knowledge workers with agents, then your dependency is much higher. It's not easy to move back. I think industry will have to take a little bit of a studied view into this.
There is the term, right? AI boomerang. When companies lay off employees on account of artificial intelligence only to rehire them once again because maybe on account of operational costs or the service quality. So AI boomerang is the next big term after AI-led layoffs. Joseph, thank you very much. It's a short conversation, but we look forward to the next one. Thank you for joining
Thank you, Rima. See you. Bye-bye.
All right, let's get in Dipan Mehta, Director, Elixir Equities, now on the show. Dipan, a quick comment on Happiest Minds?
I think the results, first of all, good morning, Rima. I think results were pretty decent. And I've been tracking Happiest Minds since its listing. And it's another few, I would say, very flexible and very agile software companies. It's a new generation software company, so it doesn't have some of the legacy issues of the likes of Infosys, TCS. And I would say that it would be one of the winners in this entire AI disruption space. Because now what is becoming clear is that these software services companies, there'll be a few winners and a lot of losers because of AI. And I think Happiest Mind, Coforge, Persistent Systems, Fractal are, in our opinion, the companies which will be able to use AI to their advantage and grow their business significantly. So very positive on Happiest Minds, reasonable valuations as well. And only thing is, I think next 2-3 quarters are critical for the revenue growth rate to improve. And if that happens, then I think the stock can really give excellent returns.
Yeah, can give good returns. Deepan, morning. It just feels like a tough last few days, right? At least at the index level. It's not. While there's general feeling, at least I feel it, that the sentiment is just too overdone on the negative side, right? That it's almost as if, and it's as they say, when regions or your neighbor is doing very well and you're not doing well, you feel doubly bad.
Yeah, that's true.
There is that element of that element there, but price action is not turning up, right? We are now closer to 23,000 than we are to 24,000 once again. So it's a range broadly. So any thoughts, Deepan?
Prashant, I think what you said can be summarized in one word, that is FOMO. And if you look at it,
but this is envy, jealousy, whatever you want to say. But it's a real thing as well, right? It is that. But you think it'll turn, and what will it take? By the way, yesterday we were all anticipating that the government perhaps will do something on this on withholding tax and bonds. Nothing came in that cabinet briefing which happened at 3 o'clock. But there are newspapers reporting this morning that perhaps it'll come through an ordinance. We don't know exactly what will be part of the ordinance, but the cabinet has cleared the government to be able to sort of do a ordinance in that sense, and whether it'll be the withholding tax and bonds being cut, and we'll see. But just your thoughts, Deepan.
Prashant, I think one thing is very clear, that we are the biggest losers in this Iran war. I think whether it's America, whether it's the other Asian countries, I think it's business as usual over there. In fact, the Chinese markets or the Japanese markets, South Korean markets are just, going ahead, giving great returns. And we are stuck in this particular narrow range. And I think that even the sentiment is slowly getting impacted, and our patience is wearing out as people who have been a lot of conviction in stock. So all I can say is that this war has to end quickly. Oil prices need to come down to below $80 or so or I'm sorry that I think this market may go down even further. It may test the earlier lows and break that as well. I mean, already we are seeing trickles of bad news flow. I was very disappointed to learn that for the month of May, the actual commercial vehicle sales were lower by 20% or thereabout. And that's not a very good sign. And the reason ascribed for that is higher diesel prices. So if these things start to, get into more, I would say, mainstream, and we see more slowdown, then I'm not sure that our markets can sustain even these levels. So I remain hopeful. But as I said, I think patience is wearing out, and our ability to absorb the shock also, whatever reserves we had as in the company, at the company level, at the economy level, that is now fast getting used up.
All right. Hi, Deepan. Good to see you. And Deepan, what's your view on some of these, NBFCs? Yesterday, you had IIFL Finance. The stock moved up. It was one of those loan stocks that were up, I think, 4% or thereabouts. It's been a big underperformer post that income tax, notice that they got. The stock, I think, is still down close to 30% from the recent top itself. I was looking at some selling, a small fund, I think they have been gradually selling, and it appears from 5% it's down to less than 1%. Any view on this name at around 500 rupees?
See, Nigel, it's very attractively valued. They have really scaled up the gold loan business very well. And some of the risks which were there with IIFL Finance earlier, I think those are now, they've addressed it very well. A large portion of their loan portfolio is well secured. And I think it's just a matter of time. Once the consistency comes through in the earnings, then markets will start to pay at a higher premium. And as regards your question on NBFCs, I think the best way to play the lending lending theme is to the NBFCs. I'm not that positive on banks. I think it's a red ocean over there, and competition is severe in that segment. But NBFCs have certain flexibility, and they have certain advantages, and therefore I think they may do pretty well. And within the NBFC space also, our focus is for multi-product NBFCs, like say Bajaj Finance or L&T Finance, Cholamandalam, there's Tata Capital, there's HDB also. So these are the companies where I feel that investors can expect steady growth. I don't expect extraordinary returns like say in what you get in the defense or railways or shipbuilders, but they can provide certain amount of steadiness to their portfolio and deliver that typical 15-17% type of investment returns, which will be linked to their profit growth. Having said that, all of these companies, we and our clients may have investments as a measure of disclosure.
Okay. All right, Deepan. Deepan, I want to ask you also about the cookware companies, TTK, Hawkins, and Stovecraft on the other side. But for the time being, we'll slip into a short break. We'll continue our chat with Deepan. We'll also get Rohit Srivastava of India Charts, who will be joining in to tell us how does he see market shape up. And our technical experts, Sudarshan as well as Shilpa, will be joining in. Welcome back. This is Open Exchange, and we're coming to you live from the CNBC TV 18 Motilal Oswal studio. As promised, we continue our chat with Deepan. Deepan, I wanted your view on all these names. You know, TTK Prestige, Hawkins, Stovecraft. They have seen a sharp correction from the top. You know, I was reading a couple of reports, and some of these managements were in town as well over the past week for various conferences. And the point they were making is that in 2020, 2021, in COVID period, there were a lot of fresh purchases. Now, in fact, the life cycle normally is around 5 years or thereabouts. So you'll see that, replacement that takes place. And that's why they're guiding for better growth in this year. Keep in mind, these are stocks that are nearly half from the top. Your view on any of these names?
I think it's a good story, but you have to consider the fact that their costs have gone up significantly. And these are consumer-facing businesses in very competitive industries. So passing on cost increases is going to be very challenging. So I would be a bit circumspect. Base effect and overall, I think, slowdown in consumer spending may affect these companies. And right now, I think investors are chasing very different themes. They could be in defense, they could be in export, they could be pharma, specialty chemicals. So consumer-oriented businesses are under a bit of a negative radar as far as I look at it. And even the correction has taken place. I'm not sure that this is the optimal level to get into these companies. I've been disappointed by their growth rates last 3-4 years or so. I thought they could do much better, but that's not happening the way at least we expected.
Okay, got it. All right, Deepan, also I wanted to ask you about a couple of other names then. You know, some of these metal-related names, they're doing quite well. And I understand that the ferrous names, they're still trying to push through some price increases. But NMDC, that's the one getting into a monsoon season and they have hike prices. They're also guiding for 60 million tons of volume this year compared with 50 million tons. Your view on the stock, at around 75, 80 rupees, there was a lot of interest. Now it's more than 95 rupees. Your take?
Nigel, I think that the mining companies per se, there's good scope over there. NMDC, you can say, even look at Hindustan Copper, the way they have scaled up their production this year and what their expansion plans are. There's Lloyd Metal also, that's also sounding very, very ambitious when it comes to raising their output. And I think that these are great stories because end of the day, we do want self-sufficiency in critical minerals. And to that extent, government policies and opportunities will be there for these mining companies to exploit mining opportunities within India. So very positive on companies like NMDC, Hindustan Copper, there's Lloyd Metal and other companies as well. And also now looking at all of these mineral or metal kind of services companies, companies benefit from increased mining activity or from increased, I would say, kind of exploratory activity. So that's also a good investment theme to kind of research further.
Okay, so you're saying miners over some of these companies, right? You rather go down with regard to Lloyd Metal and NMDC. Got that, Deepan, interesting thought process. Thanks a lot for joining in. Wishing you a good remainder of the day, and we catch up in the coming days. Well, let's welcome our technical experts, Sudarshan as well as Shilpa, join us on the show. Good morning, lady, as well as gentlemen. Thanks for joining in. Shilpa, let's come across to you first. The GIFT Nifty is suggesting a 200-point, 150, 200-point pullback. Would you be a buy into this dip?
Good morning, Nigel, and thank you for having me on the show. Talking about the setup, I feel that 23,600 is acting as a resistance and the support is at 23,200. So we are complete in the middle, and I feel that if there is some sort of retracement, we can be a buyer, and your stop loss should be 23,100, on a positional basis. For Bank Nifty, we see that 55,000 will act as a resistance, and the support is at 53,000 again in the middle of the trade. So little retracement towards 53,500 should be a more appropriate levels to go for a long.
Okay, got that. What about you, Sudarshan? We're pulled back in the last few days. Yesterday, there was a bit of a bounce from the day's low. Will you fancy your chances on this dip or will you stay away?
Hi, good morning. No, we'll stay away. Nigel, you know the intraday charts, how they are behaving. 200 points up and after half a day, 200 points down. So no one can predict how the markets will behave in 1 hour, 2 hours. What we can say is the choppiness is clear and visible. The reason I don't tell people to go short is very simple. That V-shaped rallies that come intraday are killing. So don't go short. This is not a market where you want to go long. We are falling consistently. So step aside. There are periods, it's not just about the Gulf War. Even earlier, there are periods when the markets simply become choppy for one reason or the other. The best trade is to do nothing.
Okay, do nothing. But there's something to do on individual stocks. You go first, Sudarshan. What's on your radar?
That's right. NMDC is a buy with a stop under 95. TMPV is a buy with a stop under 390. CAMS is a sell with a stop above 765. And Bajaj Finserv is a sell with a stop above 1770. But I also have a suggestion. Choppy markets, there are some stocks that do well, but keep your volumes low.
Okay, all right. Let's get the lady then in. Shilpa, what about you? Individual stock calls?
I have a buy on Axis Bank. Axis Bank is at a very good support levels. 1240 should act as a very good support. So that should be a stop loss, and look for levels of 1285 on first basis. If it crosses that, then 1300 to 1320 can definitely be seen. The other one would be a buy in Solar Industries. Solar Industries is also looking very, very strong. It has a good support boost at around 18,200. So that should be a stop loss, and you can go long and look for levels of 19,000 to 19,500. The third one would be a sell in KFintech. KFintech is looking weak. It has a resistance at around 880. That should be a stop loss, and look for levels of 780 to 750.
Okay, all right, got that. Shilpa, I wanted to ask you about some of these large names, the large cap names on the Nifty itself, HDFC Bank, Reliance Industries. They have seen a decent pullback, and if the markets need to turn, they'll be counting on one of these names. Any of them on your radar, or you want to look at the tech pack?
I would actually go for HDFC Bank. It is having a support around 730 zones on immediate basis. So as long as we are holding above that, I believe that 780 can definitely be seen. So among the large caps, I believe HDFC is better placed.
Any levels on HDFC Bank, Shilpa?
Yes, HDFC Bank.
Okay, got that.
Any levels?
Any levels for a trade? You said it's better placed.
Sorry, HDFC Bank, the support is at 730. That should be your stop loss. And if it sustains this levels, you will see levels of 780.
Okay. Sudarshan, on large cap IT names, what a fall yesterday. TCS was down 8.5%. And as Hormus was telling us, it fell on very large volumes. And this morning too, overnight, that IGV ETF, which is tracked very closely, sort of a proxy for the Indian IT names, was down 4.3%. Is there a trade on the Nifty IT or on individual IT names?
There is a trade. The Nifty IT is difficult to trade. You have to buy the ETF. It's easier to focus on the large caps right now. See, these declines are buying opportunities. When a market is building a base or bottoming out, we have these ups and downs repeatedly. The downside is a place where you want to buy, and also understand that the India theme will affect IT stocks also. If we are going to go down, they will not only outperform. They may not actually stay up, but still they are buying opportunities on every dip now.
Yeah, absolutely. Gentlemen, we'll chat again. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC TV 18. Well, let's keep it with the markets for the next 10 minutes or so. Rohit Srivastava is founder India Charts and Strike Money is with us. Rohit, good morning. Great to have you with us here. Thank you for joining us. The market is not breaking down, but it's kind of, maybe it's happening in slow burn. And every day it gives us hope with a bounce by the end of the day. But it's been making lower bottoms. Just look at the last 4-5 days or so, right? But there are the bounces, which gives you hope that maybe this is the point of maximum pessimism, maximum negativity, sentiment is poor. But near term, Rohit, what are the levels and how do you see this pan out?
So we're getting very, very close to what is a important retracement level, considering that the bottom was made in April, and this is a pullback. Then 61% retracement comes in at around 23,077 for the Nifty, and for the Bank Nifty it comes in at 52,687. So these become critical points close to which you do expect that the markets bottom out and reverse. Now we have taken support close to that, like probably 100-120 points away from that.
Rohit, repeat that level. Where do you expect the market to bounce from?
Yeah, 52,687 for the Bank Nifty and 23,077 for the Nifty. These are spot prices. They are not futures prices. and they involve the 61% retracement to the up move that we saw from the April bottom.
Okay.
So these become critical levels from where we can, continue to, go higher once we bottom out there. Now, do we actually exactly touch that? Well, we are close enough, within 100, 150 points of the Nifty, and, even Bank Nifty was even closer to that level. So we would start looking at, as we get closer to that you're at the final stage of this pullback. And at some point of time, you will see things turn to the better on the upside. What gives us more confidence on that is the strength that we see in the broad market. So if I look at, say, the mid-cap index, it's barely 1 to 2%, 2% probably away from the all-time high, whereas the Nifty is probably far, far away. So the broad market, when we actually study individual stocks, are showing a lot more strength than what we are really seeing in the main index. And that, I think, is the reason that it feels like a very, very weak market and not going anywhere. But if you're involved with stocks, you'll probably feel it's a very strong market. So that's the disparity. And I guess it will get resolved over time.
So you're saying that, strength in broader markets and a couple of other things gives you hope that this is the final phase of the downturn in that sense?
That's right. That's right.
Okay. Now, anything can happen, right? It's markets 23,077 on the Nifty. If we get a close below it, then we're looking at what?
Then we are looking at, probably 22,300, which is almost the retest of the April lows. There's no other way to think about it. Can we go below that? I think it's a very tough call because, sentiment, positioning, everything is already at a very, very extreme level. If we just look at, how, institutions or even retail investors are positioned in the futures market, we are seeing the same kind of, long short built up that we have seen at most of the, previous bottoms recently. So that is a reason to believe that it will probably not, continue. For example, the client positioning is long up to yesterday's data is an all-time high long. So this is a record reading of 196,000 contracts bullish. And so we haven't seen this kind of number. The last time we've seen a record long position, we've seen the market reverse from there in a matter of days and then, continue to make higher highs. So I think we are in the eye of the storm as far as this is concerned. And there's good reason that, something should trigger a turnaround. Of course, there are a couple of things that can happen. We'll see if they do, whether it's the trade deal, whether it's fresh measures on the currency side, which I think has been the main concern. But purely looking at the technical data and looking at the relative strength of the broad market, I think these are reasons that we should not break 23,077. While, like you said, anything's possible, we would work with the possibility that it's not happening.
Saying that, I think we should just change that flash. We should just say that 61%, what Rohit is saying is that we expects the market to bounce from the two levels, the Nifty and the Nifty Bank. So we'll just change that and make it clearer. Rohit, what you're saying is last time clients were so long. And when you say clients, what does it mean? This is local...
Yeah, the index futures positioning, which is reported by NSE under four categories, FII, DII, client, and pro.
Right.
So the prop desks are basically like brokers running their own, trading accounts.
Yeah.
And that leaves out HNIs, retail investors, corporates, all the other categories which are not included in the first three, which are domestic institutions or FIs. They all come under client category.
Okay.
So I presume a lot of the large money or large clients or big traders in the market would be in the client category.
Got it. Got it. Now, you have an eye on the macro-ish situation as well. And I suspect that is what is driving this negative sentiment, right? Even when you look at stocks, there are lots of pockets of stocks at all-time highs, right? A bunch of spaces. It doesn't feel bad, but it just feels bad because of the macro narrative. So tomorrow is the RBI policy, and I suspect it could be consequential. What's your view? You ask equity guys what RBI should do. This well, stay away from moving on rates. Fixed income guys, exactly the opposite view. Just quickly, Rohit, how to position?
So I look at bond yields. I think the top end of the yield chart shows me around 7.15. We are at around 7.0. and we've touched close to 15 twice now in the last month during the crisis. So my worst case scenario is we probably go and touch that again. I don't think yields will go above that. Will RBI try to align with the bond yield? I doubt it, because most of the central banks around the world are avoiding touching rates, given that the current situation around oil or Iran are expected to be temporary. So that is why nobody's really touching it and trying to play the game around inflation coming up and rates moving. They probably wait for the data to show up and deal with it accordingly. So I think right now, unlikely that you get a rate hike. Probably the RBI would take more measures on the liquidity side or somewhere which can actually help the market.
Oh.
Yeah.
So worst case on the 10-year bond yield to you is 7.15?
Yes.
Got it. Fair enough. Any way to put a number on oil? I mean, if not, we'll move on.
So oil, I thought it had peaked, 104, 103. Still, if we get further one upside, I'll say 101, 102. I don't think we go beyond that. And this I'm talking of light crude. On Brent, it would be a little higher than that. But sort of around 110, that's the upside. So on Brent, it may look a little further away, but 102 on WTI, 110 on Brent, I lost. The question is, are we going to even go that far? Maybe, maybe not, because sometimes you just get a retracement. See, we fell from 108 to 90. In a bounce, you may not really cross 100 on the Brent number. So you could again sell off from close to that.
Okay. Now, pockets of strength, to your mind, where would you look for things to go long on? And pockets of weaknesses, I mean, to your mind? Yeah.
So the obvious name is metals, because when you look at metal prices, despite whatever is happening, and there's the fear that the dollar goes up because of inflation, etc., the market is probably pricing that in, because you look at aluminium prices close to 52-week highs. You look at copper prices; they made an all-time high just a day ago, and that has been continuing. So you see it in nickel, you see it across the metal space, and so that means metal stocks which have been holding up much better than the rest of the market are likely to continue to do well. So the metal index would remain in focus as far as that is concerned. On the weak side, I would probably still avoid the tech stocks, the IT stocks, the Indian IT stocks. I know they've fallen a lot, and there's a lot of talk about value or them making a double bottom historically, etc. But I'm not very comfortable being on the tech side. So that's IT is one avoid. The other one, which looks good but may still underperform the market, is FMCG, because typically in a growth it tends to underperform other parts of the market. So this is typically not the decade for FMCG. The only other defensive area which could be good is pharma. Pharma index has already broken out in the last couple of weeks, and I think every dip will probably be a good buying opportunity on the pharma side.
Okay. Pharma is a good defensive area, so perhaps buy on dips. Although FMCG, you said, doesn't do well in great growth periods. But the great growth period is yet to arrive, Rohit. We're waiting. Hopefully it'll come. We are hitting market open, Rohit, so we'll say thank you. But this is a pretty useful conversation. And, we'll mark to market next time you're on with some of these levels and see how it's kind of played out. But I think gives you a framework to think about where we perhaps will go from here. So the first rates will come up in just a few minutes and a few seconds, beg your pardon, 5 seconds, and just counting down. And it's going to be 0.5% lower start. That's how the Nifty is left off. So we're 23,300. Yeah, 0.5% down, 23,280. The Nifty Bank is also down about 0.6. The mid cap index and the small cap indices are down 0.1. 0.15, so in that range at this stage. Advanced decline, 760 down, 570 higher. It's early. It's just, opening levels, and things will pick up pace as you go into the next few hours, but 140 down, settling down. The heat map on the Nifty in terms of how the 50 stocks are opening will give you a quick sense. So you got coal and Adani Enterprises and Grasim, which are higher, and everything else is down. Infi, HCL, Tech are some of the losers. So Cipla, iShares, and so on and so forth. Rima.
Well, not too many gainers, as you can see, just about 3 or 4, with Coal India, Adani Enterprises, Grasim, ONGC on the gainers list. But on the way down, while we've opened with a cut of about 0.5%, at least the Nifty for now is respecting some of the recent support levels. So we're trading at 23,275, a 130-point knock. Once again, it's IT on the back foot. Infosys, HCL Tech opened with a cut of 1.5%. TCS is also lower by 0.5%, so extending that 8% decline on very large volumes that we had yesterday. So IT is weak in trade. Pharma is not getting spared. So Cipla, Sun Pharma, Dr. Reddy's, all three large cap pharma names have a cut of more than 1%. And Autos too is weak in trade. And here the losses are led by Eicher Motors, but you've got softness even in an M&M. Large cap names like ICICI Bank or Reliance Industries, these two have opened up on the weaker side. HDFC Bank too lower by nearly 0.6%. So it's a clearly negative start. The advanced decline ratio currently in favor of the losing side. On BSC, advances stand at 837, declining stocks at 1100.
Well, that's right. I think some of these stocks like JBM Auto and Electra, Green Tech, both of them are flying away. Remember, they put on weight in the final hour of trade. The cabinet yesterday had announced a 9,500 crore scheme to replace old trucks as well as buses in Delhi NCR region. And the scheme targets around 2 lakh vehicles. Out of that, 1.9 lakh trucks and over 16,000 buses. So both these two stocks, they're up and about, building onto yesterday's gains. Ola Electric, a stock that's corrected big time from the peak. Yesterday it was I think it was up 9-10% or thereabouts, close to the QIP. And today as well, moving on very, very large volumes. So keep an eye out on that name. HFC, I'll just take a look at that stock. It was $100, I think, 2 months or so ago. That's doubled, in a matter of, I think, less than 50 trading sessions. A big move out there. As is the case with Sterlite Technologies as well. That stock continues to move from circuit to circuit. I think there is some supply that we're seeing at higher levels in today's trade. But that's clearly the one that, has been driving this. What a move. I think if you pull up a 1-month chart, it'll tell you stock from 300 has moved all the way to these levels. A few more notable movers. ITDC, very limited free float, keep in mind, but that stock's up. Savita Oil is up close to around 7% on the fairly large volumes as well, so good move out there. And Idea Forge, one of those blockbuster listings that corrected big time. And from the lows, the stock has doubled. Now it's up close to around 5% as we speak.
Okay, I think, it's stronger stocks, and this is what we were talking about, right, earlier. The broader Nifty index and generally the narrative, etc., the FI selling and everything, right? It all sounds and looks a little negative, but otherwise, you look at stocks and there's lots and lots of action and activity, lots of 52-week highs, all-time highs, and so on and so forth. Manishi Ray Chaudhary is with us, CEO, Emmer Capital Partners. Manishi, good to have you with us here. Thanks for joining in. So what's the advice? What's the recommendation, Manishi? Position yourself in those pockets. Metals is one, capital goods, power infra, grid infra. Those are defense perhaps, a few names there. You've got a few these optic fiber names, absolute rocketed up. They're easily spotted in that sense, the stronger names. What's your advice?
Right. So, the first thing to do about India and in the context of the rest of Asia is to take a 100,000-foot view. So all these issues that you talked about, that is lack of foreigners' interest, the continuous FII selling, weakness in the currency, they all emanate from one particular issue, and which is the lack of growth. And I'm talking about earnings growth here because it now looks like calendar 26 or fiscal 27 in the Indian context would be another year of single-digit earnings growth. It's possibly 3 years in running that we are going to see this. That doesn't quite sit well with, the rest of Asia, particularly North Asia, where we are seeing superlative growth. And it used to be only AI-driven tech companies till recently. But now, that is actually percolating down to the broader economies of Korea, Taiwan, where consumption is beginning to spike, where the earnings estimates of the banks are beginning to grow stupendously. Over the last 6 months, some of the Korean banks and Taiwanese banks' earnings estimates have grown anywhere between 20 to 40%. So obviously, Indian growth in single-digit earnings growth and couple that with about 19, 20 times one-year forward PE, that does not really inspire confidence. So it's this growth picture that has to change. Now, how would it change? One obvious way out of this is investments. So private capital investments and also getting foreign direct investment, net FDI, to increase significantly. There's a lot of work to be done in this respect. And, I think India needs to be a bit more, what should I say? A bit more ambitious about the quantum of FDI that it can get. But for the time being, if, the kind of situation that we're faced with, one would have to navigate the Indian market on a stock by stock, on a very close, stock selection basis. So some of these are the kind of sectors, some of these stocks are in the kind of sectors that you named, maybe capital goods, maybe defense. I would also look at some pockets within consumer discretionaries. One has to be a bit careful there on account of the valuations. And maybe metals, the basic materials, which is perhaps the only sector where there is a growth outlook, and at the same time, there are relatively modest valuations. So that is, possibly the only thing I would say about India, but for Indian investors, I think, and I'm repeating myself, I said this a couple of weeks ago on your channel, for Indian investors, looking outside, diversifying their portfolio outside India is absolutely essential.
So, Manishi, hi, morning, and thank you for joining in. So if I had to ask you one of your most high conviction buy ideas when it comes to India, from here on, incremental money, where would you put it? Because even if you put money in banks, so large cap banks is a safe space, valuations are comfortable relative to previous periods, but it's not yielding any return for investors. So what would your bet be right now?
If you look at the near term, maybe next 3 to 6 months, it is very difficult to, kind of answer that question because, we actually did this exercise recently. We looked at all across Asia. If you look at companies with market cap greater than 1 billion, there are about 4,800 companies in Asia ex-Japan. And we tried to identify companies which have earnings growth forecast of at least 10%, price to earnings growth, PEG multiple of less than 1.2 or so, decent balance sheets, which are, debt to equity ratio less than 1 times or so. There are hardly any companies in the large cap Indian space, more than 10 billion that actually show up. I think the only company that we were able to identify was Tata Steel. On the other hand, the companies in Korea and Taiwan, which have gone 10 times, like SK Hynix, like Samsung Electronics, they figure prominently in that kind of a screen because it's not just those stocks have moved up, but their earnings estimates have also moved up. And that is very difficult to find in India. We do have some, some Indian choices in the mid-cap spaces, and majority of them possibly come from, capital goods, industrials, and some of the consumer discretionary services spaces. So those are some of the opportunities that one has in India. If I have a longer term time horizon, maybe over the next 3 to 5 years, I would still hang my hat on the private sector banks. They're gaining market share. Their valuations are way cheaper than they used to be. I would also, certainly focus on the capital goods, the big frontline industrial companies. They also have some experience in the Middle Eastern region, which will have to be rebuilt. There are lots of transportation infrastructure, which will have to be rebuilt to de-risk the world. And so these are the things I would possibly focus on.
Hi, Manishi, you're sounding quite cautious on the Indian markets. Not too interested, it seems. Would that be fair? As at current reckoning, you're not that optimistic on the prospects?
the kind of fundamentals that India have unfortunately leaves me with no choice. And I just talked about it. If you look at the earnings growth for fiscal 27, it's again in single digits. It used to be in the mid-teens if you go back about 6 to 9 months, but consistent earnings estimate downgrades have now brought it in single digits. Next year, fiscal 28, we are possibly around 14 to 15%. But there again, the market, I don't think, believes that forecast right now. And the market believes that forecast can also be whittled down. On the other hand, Korea, Taiwan, and to a lesser extent onshore China, their earnings estimates are rising. And that contrast doesn't quite sit well with the foreign investor.
Okay, all right. Got that. But you said there could be pockets in the broader markets that you would be interested in. With due disclosures, if you could give us a couple of names that you like. I think capital goods is what you briefly mentioned. Would you look at some of these mid-cap IT companies? Some of them are half from the top.
Well, IT in general, and as you know, I've said this repeatedly on this show that I have actually avoided Indian IT for more than 1 year now. I have not had any Indian IT company in my model portfolio, and that has actually stood me in good stead. I mean, the large frontline companies have, some of them have halved over the last 1 year. The kind of screen that I talked about, there is somewhat curiously, one IT company actually came up on that, on that quantitative screen, and that was Tech Mahindra, which has strong earnings growth forecast at a relatively cheaper valuation, a good balance sheet. But there again, I mean, one doesn't know whether the macroeconomic backdrop and this whole AI-driven backdrop that we are seeing, whether that would lead to whittling down of those earnings estimates or not. So it's a sector that I would possibly remain cautious about for the time being.
Manishi, you were talking about and making comparisons with Korea, Taiwan, and the kind of earnings growth they offer. Would you be comfortable buying any of these AI players because they're now $1 trillion, $2 trillion companies in terms of valuations? Can you buy at current levels? And SK Hynix and the other TSMC, Micron?
Yes, and this is a point I would like to make. SK Hynix has gone 11 times over the last 1 year. If you compare it where it was around May, June last year, it's 11 times. And the stock is actually cheaper than it used to be. Remarkable as it may sound, because earnings estimates have shot up way higher than the stock price. Why? Because of this humongous demand for memory that we're seeing. Samsung is it's possibly not cheaper than it used to be, but there again, I mean, it's not really expensive. TSMC has shot up, but at the same time, it's possibly a little more expensive than it used to be. But there again, the future earnings growth certainly justify the current valuations. If I look at what's happening in that AI CapEx space, as we move from inference-based AI to agentic AI, the number of tokens that you would need would actually grow exponentially. And therefore, the demand for compute, the demand for memory is only going to go parabolic from here. Irrespective of which large language model wins, quote unquote, the demand for compute will have to go to TSMC. The demand for high bandwidth memory will have to go to that trio of Samsung, Hynix, and Micron. So this is a very sweet space. There's picks and shovels providers. They're either a monopoly or a very benign oligopoly and benefiting from very sharp rise in product prices. So at least, for the foreseeable time horizon, I would definitely still remain focused on those companies. And remember, these companies have moved up despite the fact that foreign investors have sold these companies. The biggest selling in Korea has actually come in Samsung and Hynix from the foreigners. The biggest selling in Taiwan has come in TSMC because of the benchmark rate related reasons. They have to rebalance their portfolio to manage risk. But fundamentally, I don't see any concern for the time being.
We'll leave it there. Thank you very much for joining us.
Thank you.
And, it's always a pleasure. Well, I just want to sort of tease out an important face that you will see on the channel today. At 12 noon today, you'll hear it from the global CEO, the global chief executive officer at Citigroup. Citi, of course, needs no introduction. Jane Fraser is the relatively, she's been, of course, in the hot seat for a while, and the stock's done well. The Citi stock in the US is up some 80% since Jane Fraser took over. She's made lots of changes, top-level changes as far as Citi is concerned. So this is a high-level view on what needs to be done, and we'll ask some of those macro-ish questions. And of course, global flows very much a part of that conversation.
Okay, let's move on and get in the first discussion on the show. Mahesh Babu, Managing Director, Ola Electric, is now joining in. Saurabh Agarwal, Partner, Automotive Tax Incentives Leader at EY India, is also here with us on the show. Mahesh, if I may just start with you, and before we get to the topic on hand in the Delhi NCR to replace the old trucks and buses, from an EV point of view, have we truly seen an inflection point right now? And do you think supply is a bit of a constraint? And then we'll get to the topic that we called you on.
Yeah, I think we'll have to look at what is announced yesterday as a policy to replace vehicles in the context of what Delhi EV policy announced, and also on the PME Drive, PME Seva, and the FAME2 schemes, which Government of India has been promoting for adopting electric vehicles. I think we all know that we have a challenge in Delhi in terms of pollution, and as a nation, we have a challenge in terms of fuel security, in terms of energy security. So EV is the best way to get converted. But while Delhi is the capital, let's say, on the buses, Delhi has electric buses, 4,000 plus electric buses. Similarly, Delhi policy adopts a lot of EV vehicles into the one. There is always a challenge of the old vehicles which are running before BS4. I think this new policy clearly promotes older vehicles to be replaced with either a EV or less polluting vehicles, which will give incentives. I think Government of India is giving about 5,000 crore and other tax incentives of about 1,600 crore, total of about 2 years. I think it's a very good period by which all customers and consumers in Delhi will be able to replace both trucks and buses in Delhi, which will really help in terms of pollution, as also in reduction in fuel consumption.
All right. Hi, Mr. Babu. Good to see you in, sir. So 16,000 buses is what the opportunity is. All of them will be electric, or will a proportion of that be electric?
I think most of the proportion should, I wish it is electric, because the policy says you can take newer emission vehicles as well as electric. Looking at the total cost of ownership and benefit, I would envisage most of the conversions will happen to electric now, because the future is electric, and that's what the policy of Delhi government and most of the state government, where the pollutions are higher, are taking a step towards reducing them through electric mobility.
Okay. Could you tell us what is the current capacity in the electric buses for the industry on the whole, for your company as well? If you could give us a brief idea, because will there be, what we're trying to understand is, you're indicating that there could be a shift, but is there adequate capacity available?
I think industry has enough capacity. It's a question of absorption. You know that EV needs ecosystem development, including charging, funding, and the route planning and everything. Right now, if you look at it, there is about 17,000 to 18,000 electric buses in the market from inception. I think last year about 5,400 was sold. I think industry has a capacity more than 10,000 plus. And we in one shift can produce about 2,500. And if on given a case, we can do 2 shifts and quickly come to 5,000 electric buses per annum. So I think when the demand comes, I think an industry is capable of delivering what it is.
Mahesh, hi, good morning. It's I think you've been in the hot seat at Electra for little less than a year now. So a little delayed, congratulations, but I think the street is hoping that, with you at the helm, the company does good things. Now, so just to kind of finish that last point, you said the total capacity at Electra for electric buses could be 5,000, right? That's what you're saying.
Please.
If you do 2 shifts, it could be 5,000. You can do it. You can do 5,000 with existing lines.
Yes, please.
Okay.
That's right.
Okay. So just 2 things. One is what is the order book right now, right? What is the visibility for future orders? And on the second part, we were picking up that maybe, in states, and Maharashtra came up as one example, that some payments were stuck. There were these schemes, etc., and that was a problem. That was an issue from a state government. Actually, that's true even for 2-wheelers on the electric side, because there were these specific schemes which later ran into some disputes. So just give us a clarity on both those, Mahesh.
So if you look at it, we have a order book of about 10,000 vehicles to be delivered in next 24 months. We are planning to do upward of 2,500 vehicles this year, and then get into much higher, doubling that in the next 3 years. That's what we are planning. As I said, the EV adoption is not only capacity. We need charging infra to be developed, power connection to be available, and absorption at the end at STUs and depots are important. So we are working on all this to make sure the adoption is higher. Not only us, the whole industry is trying to work on this to get this going. So even if we have to expand our capacity, we are happy. We have a facility of 150 acres. And in fact, within 6 months, we can build up the capacity to 10,000 vehicles if market can absorb. Regarding payment, I think government payments never defaults, but there are delays, there are procedures to be followed. All this are part of the business we know very well when we do STU business. And I don't think that's a big issue in terms of adoption.
What are the receivables right now? Outstanding receivables, and how many months old?
So we have about 3 to 4 months of receivable typically overall, average. And that's typically in the industry overall because we need to submit the bills and we get it. There are some challenges. However, it's continuously getting resolved by the state government. The intention of everybody, including the government, us, everybody, is to run electric vehicle because it gives a viability gap funding lower than the diesel, what prices are today. So everybody in the ecosystem wants to benefit out of it. But only scaling up needs all of us to work together and then scaling up. And I believe it will happen in the coming year.
One last question from my side. Which are the states to watch? I mean, who are far ahead in terms of ordering? And is there a cycle or is this kind of ad hoc? When orders come, you have 10,000 bus order. So is there a method to this? Or this is, each state comes up and then you got to work and... so just trying to understand that. And which are the top states?
If you look at number of electric buses, Delhi has the highest 4,300 buses. The next is Maharashtra. Then you have Karnataka. You will have UP. Every state now wants an electric bus. No one wants to be left out. I think that's the good news. So you will see hardly any state, Gujarat, Tamil Nadu, Kerala, everybody has an electric buses and electric vehicles adoption. So looking at electric buses, I think most of the states have it. We have a spread over Telangana, Maharashtra, Goa, Pondicherry, every place to be delivered. I think industry has pipeline of order of close to 25,000 vehicles, which will be delivered in next 2 years.
Saurabh, what is the cost differential when you go to replace between a BS6 compliant vehicle and the electric vehicle?
So it changes from model to model, and it can range somewhere between around, from an electric vehicle perspective, it can go as high as around 30% is the difference between, say, a ICE vehicle as well as a EV vehicle. And if you see BS4 to BS6, that differential should be in the range of around 10 to 15% depending upon model of each of the vehicle owners or the OEMs.
Okay, so but on an average, you would say it's 15-20%?
So on an average, yeah, 15-20% is the right average.
And other than cost, are there any factors that the state government will look at when choosing between a BS6 compliant vehicle and EV?
So, I think emission is one of the important area which the state government will look into when they are replacing a BS6 versus an electric vehicle. So from a Delhi perspective, if we look at, there has been a significant pollution which the Delhi citizens have been facing for long. So it's a right move by the government. Even on that 15-20% differential, I want to specifically highlight that some of the OEMs who are eligible for a automotive production linked incentive schemes, they are getting around 13% to 17% as a production linked incentive scheme from the central government over and above many of these state schemes or this recently announced scheme yesterday. So that particular bridge, I think depending on manufacturer to manufacturer, that differential will surely move to the market if OEM is eligible for such production linked incentive schemes. And that creates a disproportionate competition between a OEM who is eligible for a production linked incentive scheme vis-a-vis an OEM who is not eligible for a production linked incentive scheme.
So which are these OEMs which can get the PLI schemes, which makes them more competitive?
I think the scheme came out in 2021, and after that, the scheme hasn't got opened. If you talk from purely from a commercial segment, it is Tata, Eka Mobility. Those were the ones who are pioneers. Ashok Leyland, of course, they have not got their vehicle DV approved so far, But if you look at other side, there can be PMI, there can be JSW, and other OEMs who are now coming into the picture, Electro Green as well, where the production linked incentive scheme has not got eligible to them so far. So therefore, while the fund also, if you see, there's a lot of fund which is left out into the scheme. If you look into 26, 27 and 27, 28 numbers, broadly around, by the government estimates themselves, if you look at the budget, somewhere close to around 17,000 to 18,000 crore worth of incentive claims will still be left out for 26, 27 and 27, 28. I have always been advocating on various platforms that the government should open up the scheme once again to allow the other competes to enter into that particular scheme, which will ensure that from a consumer perspective, in the commercial segment, the buses and the trucks will become cheaper, and it will lead to better adoption as far as electric vehicle or electrification is concerned. But at the same time, it has been a really great initiative from the government of India, especially from Ministry of Heavy Industries, the way they have been actually running this particular scheme, ensuring a localization is happening at a grassroots level. So therefore, if that scheme opens up for other players as well who were not originally into the scheme, that will really help the cause of electrification.
Yeah, got it. Mahesh, just a couple of questions. So what is the batteries, right? Where do they come from for the buses?
The cells comes from China. All of us know it. They are the 80% manufacturer of cells across the globe. Not only India, everybody else buys from them. The battery pack is made in India.
Yeah, and what is the level of in value terms? What is the how much? What is localization?
In the battery pack, typically right now the cell cost around 60 to 70%, and remaining is the value add in the localization. But if you look at the whole bus, the localization is above more than 50%. It's close to 60, 70%.
I see. I see. And anything policy-wise, Mahesh, you are expecting from in terms of a big push to move towards EV in a more rapid pace, Mahesh?
No, I think government have done a lot of policies, FAME 2, PM E-Drive, PM E-Seva, now the Delhi policy, and also the new scheme to replace vehicle. But as rightly said by even ENY, I think the PLI scheme, all the new players are left out. I think most PLI is won by the big giants like Tata, Ashok Leyland. I think we are looking at the next phase of PLI in auto EV industry to be launched, where the new entrants and medium range players like us will play a role and benefit from PLI. So that's the only thing we are expecting. Otherwise, I would thank Government of India for doing multiple schemes. I think we have enough schemes for EV adoption today. But if at all they consider any new scheme, I would consider announcement of PLI for EV manufacturing for new mid-range players like us.
Okay, Mahesh and Saurabh, thanks very much for joining us. Great speaking to both of you, and we will continue having these conversations as this picks up. Thank you for being here. All right, well, you know, there's important news at the bottom of the screen. So what we are given to understand, and this is all, of course, source-based, that FI investment in government securities is likely to be exempt from all taxes. There's the withholding tax, there's the capital gains tax. Sapna is here with details. Sapna, take it away.
Absolutely, Prashant. You know, this is more or less kind of confirmed. We are aware of the fact that yesterday an important cabinet meeting has been held under the Prime Minister's leadership. So most likely, you know, in principle decisions have been taken, and now we have to wait for the implementation in the form of an ordinance, most likely, as these changes are going to require changes, rather modifications in the amendments to the IT law. Having said that, so this particularly the withholding tax, the 20% levy that is there at the moment, you know, there has been a big demand from FII since a pretty long time. So basically how it operates is like, you know, the earnings that you get on your investment in the shape of interest. You know, the entire portion is levied. I mean, the entire portion, 20% tax, which is pretty steep. 2023, this thing was taken away in the sense it had been reduced to 5-odd% and then brought back to 20-odd%. So there has been a big demand since quite some time that this should be at least reduced back to 5% or better still removed completely. That's one. And of course, on the capital gains tax, the 12.5% that we're talking about. But what I'm able to understand is that the withholding tax is a bigger issue with FII. So our understanding is that, yes, an in-principle call has been taken and we have to wait for the ordinance to come out and for this to get implemented. Of course, when the monsoon session comes up, I'm assuming that the government will, you know, bring the amendment in the parliament, and at that point in time, the ordinance can be taken back. It won't be required. So this is it. Two big things. The 20% withholding tax likely to be made zero, and also the cap gains tax of 12.5% on FI investments in GSEC to be removed. So basically, all their investments in the GSEC market, the Indian bond market, or rather GSEC, government securities, that is supposed to become zero.
Do we know what the size of holding that foreigners have? And this is obviously going to be prospective, right?
Yes, yes. I mean, as of now, most of the tax amendments are prospective in nature, so we'll have to wait for the rollout date. But you know, their presence has been quite sizable in the Indian market, and I think one of the why the demand has also been more vociferous in the last few months is because of our inclusion in the JP Morgan bond index and also the Bloomberg bond index that we've been talking about since quite some time. So I think basically to make all of that more attractive, this demand has come through. We are also given to understand that there were certain other measures, like for example, you know, making the fully accessible route for GSECs, you know, bringing in some long tenor bonds back again. Some discussions have happened on that front also, but we'll have to wait and watch, you know, what really transpires. I think taxation is a big demand, so we'll have to see, Prashant, how this gets, by when this gets implemented. I'm sorry, I really don't have the details of the exact exposure.
Oh, sure. No, that's fine. That's fine. We had, by the way, I put out a piece. Sometimes this is with regards to the inclusion in these global bond indices, etc. But it's small. I mean, compared to the size of the market, it is small. But we'll get those numbers later. Sapna, we don't want to speculate, but logically, this seems like maybe you know, and this is something which market participants are talking about, right? And it's been discussed by lots of people, a kind of a bond issuance, a foreign bond issuance or something. I mean, to basically make it attractive, right? Because at 20%, it'll be very difficult to attract money. So is this that kind of sequencing, anything you're picking up?
Not really, Prashant. I would like to stick to this withholding and cap gains tax, the discussion basically, and the in-principle approval for making it completely zero. I think that's where I believe.
That's it for now. Thank you very much, Sapna. Thank you for sort of running us through details, and we'll leave the other stuff to when it comes, and maybe get an exporter to talk about it and maybe get their views in. But that is the information that Sapna is picking up right now. FI investment in G6, not just the withholding tax, but the capital gains tax perhaps is going to be taken away. It's going to be done through an ordinance route. Let's just look at the rupee as well, if you can, at the dollar rupee. And there is, of course, the Nifty Bank, which you're seeing, which is recovered from the lows of the day. But the dollar rupee should also have picked up, has it? I think it has come off, right? 95.69 or so. We were at about 95.70, 70-ish kind of levels. So there's been a bit of a movement which has come through on the dollar rupee as well.
The hope is that it attracts some capital, right? I mean, that's the hope out there in terms of listed stocks, as we were talking about yesterday. The only one, because the PNB Gilts that has a bond portfolio, I guess that's the only one. Normally sentimental move out there. Yesterday as well, it perked up, then it didn't come about. The stock did correct. But today, we are seeing that react. Normally, intraday chart should come up for you from the time Sapna broke that story. A bit of a spike up on that particular name as well. Well, time to slip into a short break. On the other side, we'll get chatting with the management of CEAT. They'll tell us about the road ahead. Stay with us. Welcome back. Markets saw a bit of a recovery from the day's low. We're closer to around the 20,400 odd mark. Well, let's welcome Mr. Arnab Banerjee, the MD and CEO at CEAT, who joins us on the show. Hi, Mr. Banerjee. Thanks a lot for joining in. Always a pleasure to have you on the show. Morning. Well, before we come to you, just highlighting the top points we're going to be targeting in this particular interview. Integration roadmap for Camso, which has been the acquired entity, the impact of commodity price inflation, as well as the premiumization opportunity. What is it likely to throw up for a company like CEAT? Let's start off with the Camso first, Mr. Banerjee. When you all acquired it, I think it was doing around $150 million approximately. And earlier, it's even done around $200 million. So could you tell us, how do you see scaling up of this particular, acquisition? For your entity, that is CEAT. This year, what kind of revenues will you recognize, some part of it? And also for the next year, how do you see that ramping up? And when does it turn EPS accretive?
Right. So right now we are going into we are in the transition phase where we are trying to assimilate the whole value chain of Camso into the CEAT system. We closed the deal in September 25. And after that, we are in the process of acquiring the direct handling of customers across the world and in the front end. And also we have started off a project to set up the upstream equipments in the plant that we acquired in Sri Lanka. So when this whole thing comes together, we will start handling the entire value chain from raw material buying to finished goods selling, which should happen by end of this financial year, which is FY27. So going into next financial year, we'll actually handle the whole thing ourselves. The customer end transition will happen by September 26, and the project end will happen by March 27. Till that time, our turnover, which will reflect in our books, will be a transition turnover, which means we are selling to Michelin, and Michelin is selling to the customers. Likewise, we are buying from Michelin semi-finished goods and using it in our factory. So it is a much smaller turnover in that sense for this financial year. Scaling up in FY28, we expect to go past 150 million US dollar, and from there move progressively up to the full capacity of the plant, which is 225 to 230 million US dollar. But that's only the plant. We're also investing in areas which we have not acquired by way of manufacturing capacities. We are investing in product development and manufacturing, which we should be able to sell after September 28 when the brand comes to us. So this is the story. And to answer your question, when can we expect to be EPS accretive? I think by end of FY28 or FY29, definitely.
Okay, 28, 29, we've got that. And from 150 to around, to 200 million is gradually you'll start scaling up this business. Got it. Now, this gives you a good footprint in the OHT market, which is the off-highway tires. Could you tell us what is the margin profile of this acquired entity in comparison to what CEAT has currently in this vertical, OHT?
CEAT's OHT business, barring Camso, has two components, domestic and international. The international business margin profile is similar to Camso. It is slightly lower, but much ahead of overall CEAT margin profile, which in a normal period is 40 to 42%, as you would have noticed. So it is accretive on that, the CEAT business. And Camso is marginally higher than the CEAT specialty business at this point of time.
Okay, so it's relatively higher. Got that. Yes. So then we've got, I think, a fair detail with regard to Camso. Let's understand now how things are moving on ground. I was looking at a couple of reports and they indicated that your raw material basket could effectively move up by around 20% on a sequential basis. That is Q1 FY27 in comparison to Q4 FY26. You could correct me on that number, sir. First, with regard to the cost price increase, what kind of increase have we seen on a sequential basis? And part of that has been pushed through, I believe. 5 to 6% approximately, you all were attempting another 5 to 6%. So could you run us through both these numbers, raw material cost increase, and how much of it has been passed on?
So you're absolutely right. Raw material cost increase Q1 to Q4 has been around 20%, if not more. And it is going to stay elevated at that level or maybe go up by another few percentage points through Q2. That's the expectation. It needs, to pass it on, it needs a price hike of around 12%, 11 to 12%. So far, we have been able to pass on about 6 to 7% in domestic aftermarket, about 5-6% in international business. And the pass-through in OEM has been low because it's an indexed pricing. So the April 1 indexed increase has been low single digits. So we expect a very high adjustment in the OEM prices on July 1st. And we still have to do about 5 to 6% price hike in both domestic aftermarket and international business, which we expect to do through June and early July.
Got it. Okay. So margins in all probability will be lower in the first half of the year in comparison to what we saw in Q4 because of this raw material price increase. So you give us a rough number, what kind of a margin contraction could we see in the first half of the fiscal? And my other question to you, Mr. Banerjee, is since you're talking about a larger price increase, could it possibly hurt demand in the second quarter once the July 1st price revision takes place?
Yeah, on the margin contraction, I agree. We don't give an exact guidance, but there is an impact, significant impact, because there's a lag in the price increase, though we may end up increasing the price adequately, but there's always a lag. So that compresses the margin, especially in Q1 and to a certain extent in Q2 also. As far as demand is concerned, fortunately, post GST, we have seen a demand spike in Q3, Q4, and it continues in Q1. So we see robust demand across categories, whether it's truck bus radials, whether it's two-wheelers, and little less so in four-wheelers. But the delta in demand has not changed vis-a-vis Q3 and Q4. So that's robust. After 10 to 12% price hike in the second quarter of the year, we may see demand moderation because we fall off the onset of monsoon in the summer months, which is a seasonally good period for the tire industry. So we expect to see some demand moderation in Q2.
Okay, got it. Final question, sir. We'll just try to squeeze in another one. I think international business as a percentage of a mix is closer to around 20%. But your ambition is to take it higher. Could you tell us by when? I think you wanted to constitute around a third of your total mix. If you could help us out with regard to that. And in terms of your size, on the standalone basis, I believe you're number 3 in India. Help us out with that ranking as well. Where are y'all? Where were y'all? And where y'all headed?
So international business is margin accretive, which is why we are focusing on international business. And it's not just export what we make in India. It's, as I've been mentioning, it's ground up like we cater to domestic aftermarket. So that's in the same way we cater to domestic aftermarket in Germany or Italy or the US. So ground up product development, local sales team, moving now into gradually local warehousing, hopefully in the near future. So that's at 20%, you're right. And with the Camso acquisition, it will jump straight away to 23, 24%. And over a period of 3 to 5 years, we may look at an ambitious target of 1/3 of our entire turnover coming from international business. That's a consolidated turnover. And as far as rankings go, it really doesn't matter. We are focusing on our aftermarket market share. We have also started looking at market share in some key markets in Europe in specific categories where we have become significant. Significance means 1% of, let's say, 1.5% of Italy market in passenger or something like that. In domestic market, we are market leaders in two-wheeler. We aspire to be market leaders in four-wheeler in next 3 to 5 years. And we aspire to grow our share in truck bus radial, where we are number 4 at this point of time. So that's how we see it. Whether we are number 4, 3, or 2 is a consequence of that. And it may be transient, but it will push our ranking up naturally.
Oh, we appreciate you joining in, Mr. Banerjee, giving us fair color with regard to trends on ground, your ambitions as well. We wish you and the entire team at CEAT all the very best, and we'll keep tracking the numbers.
Pleasure.
Have a good day ahead. All right, let's focus then on the options data, particularly from on the Sensex, because today we have the weekly expiry that will be playing out as well. And we have seen a good recovery from the lows of the day. The 74,200 call, just take a look at the premium. It started the day close at around 390 rupees. So we should get that one up for you. That came down to, I think, 180 rupees approximately. But we have seen a bit of a recovery. But there's higher amount of writing at this particular strike. The day's low was around 180. Now it's at around 267 approximately. But you'll have to say the smarter money is writing this particular strike because they want to defend the higher levels. Even if you look at the 74,300 call, well, the premium came down from around 331 to around 150 rupees. Now, there is a bit of a pullback, some kind of call buying at lower levels is what we have seen. But the smarter money, you'll have to say again, is writing that particular strike, which tells you that on the upside, you put this 300-400 rupees to the strike that we're talking about on the call side, which is 74,200, 74,300. And you'll say just for the day, the bears believe they can defend the 74,300 or 74,700 odd mark. Beg your pardon, 74,700 on the upside, first level of resistance. Support will be closer to the lows that we saw yesterday, which is ballpark around 73,200. And if you look at the chart, if you can get past the 74,700, 75,000 odd mark, then you're hitting that crucial resistance, which is the 20 and 50 DMA put it together. So things will remain volatile for the time being. The bulls are fancying their chances. From the day's low, the Sensex has seen a good recovery. But given that it's weekly expiry, expect a fair bit of action. We're around 300 points away from that very, very crucial resistance mark. We'll slip into a short break, though. On the other side, Manisha Gupta is waiting for us. She'll tell us what's going on in the commodity markets. There's been a recovery in the Indian markets for now, but it's that part of the show when Manisha Gupta joins us to tell us what's going on in the commodities market. Manisha, take it away.
Thank you so much for that, Nigel. Well, I'm looking at rubber prices because this is where we've seen very constant gains come in for the last 6 or 7 months. Overnight, the futures have gained up by 2.5%. And with that, the global rubber prices are trading at January 2017 highs at this point in time. The year, if you look at the last 6 months and the last 12 months as well, has been very strong when it comes to rubber. And the last 3 months have only taken prices on the higher side. There is support because of the weather woes. There are supply shortages driven by weather disruption in the 2 major producing countries, both of them in Asia. One is Thailand, which is looking at very heavy rainfall. There are warnings of flash floods for this week as well. And this is where major tapping happens. This is the season for that as well. The other major producer is Indonesia, which is looking at dry weather, drought-like conditions, pretty much like what India does. And that below normal rainfall is what they're looking at in the month of June. Also expected to bring the rubber production on the lower side there. And then apart from weather, it also is about tension in the West Asia conflict. That is pushing the oil prices higher, which is used to make synthetic rubber, where the prices have surged up quite strongly, taking the natural rubber prices higher with it also. Remember, the crude oil prices have gained up by 30% since West Asia conflict, and it is up nearly 60% for the year 2026 till time here. So there is a global supply crunch that the markets are looking at. The strong raw material demand from the tire industry are a couple of factors which have been supporting the prices. All India Rubber Industry Association came out with a report. They're suggesting that the rubber production cost has gained up by 15% in matter of last just 3 months therein. When you look at the price increase in the Indian markets, and this is what you should be looking at, because the price increase had started way before the West Asia conflict, and the conflict just took the prices even more higher. So we started this year with 160 rupees a kg for the prices in the month of January. Feb was already high at 218, and then every single month there has been higher highs that rubber has been making. So from 162 to 218, by April it was already at 237, and the last couple of months have seen prices gain 10% on a month-on-month basis. So 253 in the month of May, and June already standing at 262, and we've just started this month right now. So very strong gains in the Indian rubber prices, as you can see on your screen. The synthetic rubber prices have gained even higher. This is natural rubber prices. So if this is up by 40% in this year, synthetic rubber prices have gained up by 70% in this year already. The Indian industry also is facing a 15% of synthetic rubber shortage right now. We are also looking at shortage in any case for natural rubber. India does import nearly 20% of its rubber requirement. And with the strong tire companies' demand that we are looking at, we have seen those prices gain up quite strongly. Synthetic rubber production is down 15%, so that demand also is not being able to met. Import is something that is very, very expensive. And as we have seen free duty imports being allowed for various other commodities, the Indian rubber industry is also asking for duty-free imports for the next 6 months. The current import duty stands at 25% or 30 rupees a kg, whichever is higher, is what is levied. And this is what the markets want to do away with for the next 6 months to ensure that there is better production and competitiveness as also in rubber industry.
Manisha, thank you very much for that. Well, interesting times and interesting price action coming there. We'll take a quick commercial break here. Lata speaks with economist Geeta Gopinath. Needs no introduction on India's current account deficit, pangs, the rupee, West Asia conflict and more coming up on the other side.
Welcome to Indianomics. I have among the best of guests from the City Conference. I have with me Geeta Gopinath, former chief economist with IMF, now with Harvard, and quite clearly one of the most followed economists in India. Geeta, thank you very much for this unscheduled stop at the CNBC booth.
Always a pleasure to speak to you, Lata.
Thank you. Thank you very much. Well, I heard you earlier today, and you were saying that the IMF has said this year's global growth can be 3.1% according to them, but there is a downside risk to it. How bad do you think it can get?
So right now we have two stories playing out in the world, which is one is what's happening in West Asia and the Hormuz and the fact that it's still closed, though there is optimism that there will be a deal soon. That's the negative side. But there is a positive story, which is coming from AI and the whole AI build out that's happening that is raising a lot of boats, including not just in the US, but also in like Korea and Taiwan. And depending upon where you are, you're getting affected differentially by these two major trends that we're seeing right now. So for the world economy, I expect that the IMF could, in all likelihood, reduce global growth projections, but somewhat modestly, not by a large amount, because of these two opposing forces. I mean, in the case of India, I think the challenge is that because of what's happening in West Asia and the impact on oil and on gas and so on, that is a negative impact on the Indian economy. It's also inflationary, as we would expect it to be. But then you also have that on AI, the story is not positive. And therefore, that is reducing the amount of interest in terms of foreign capital in India.
I take your point that there are downside risks. But the numbers that come out in terms of capex cycle, in the US, the investment, as you said in your speech, 800 billion only in AI from 4-5 top companies. And if you took the entire capex, along with data centers and everything, it's some 4 trillion in terms of capex that's going in. Taiwan and China and Korea are putting in their own capex cycle. And the stock market at all-time highs in Japan, Korea, Taiwan, China, not China maybe, US, also creates a wealth effect.
Right.
Can't this multiplier lift all boats? I mean, more export markets for India. You don't think that there is a positive spin-off to the capex?
No, for sure. When you have global growth increasing, which will be the case if you have a lot of investment happening in these different parts of the world, there is absolutely positive spillovers to the rest of the world, and that helps. That is a positive. But obviously, you're going to be better off if you are the country where all this enthusiasm and optimism is there, as opposed to if you're having more the second round effect of that spillover.
Fair point. I mean, at the moment, we are suffering the negative, so I'm trying to look for straws in the wind to see if there's anything positive. Then we come to the India part. Clearly, we are impacted by our current account deficit being higher than last year, and capital flows simply not enough to bridge the gap. You have earlier said that, let the rupee take the hit, or so to speak, let it be the balancing factor. It can also become self-fulfilling and start hurting other macros if it goes down more than already 3 standard deviations less than the long-term average in terms of real effective exchange rate. So do you think interest rates should be deployed to protect exchange rate, or are you the, faithful to the flexible inflation targeting?
So I'm actually somebody who believes that inflexible exchange rates, but I'm also very well aware of the risks associated with having the currency move around in, too volatile a fashion and an unexpected fashion. And so therefore, some of the work that I did at the IMF, including creating the integrated policy framework, was precisely for countries to know when to intervene and when not to intervene in currency markets. There are times when intervention is helpful when you see disorderly market conditions. And, yes, when there is a depreciation of the currency, there can be some piece that looks disorderly, and there is some intervention. I mean, the RBI is doing some small amounts of intervention. My basic point is that there is no argument for a whole scale, let's keep the rupee unchanged and unmoving at this moment, because this is a fundamental shock. and having the rupee depreciate will be supportive. If you don't, and you artificially prop the currency up, then actually it can be self-defeating, because foreign investors are also going to think, well, the currency is going to depreciate eventually, and they're just going to stay on the sidelines. So there's always that trade-off. You don't want anything terribly disorderly, but you do want the currency to react to fundamentals. At the current point, I would say that the fundamentals are an important part of the story, which is why letting the exchange rate play its role as a shock absorber is helpful.
Okay. But to the other point, there are the flexible inflation targeting theorists and purists who believe that you use interest rates to curb inflation and other steps for exchange rate. And there are countries like Indonesia which also use interest rate to protect the exchange rate. Do you think India should also think on those lines?
No, at this moment, I don't think there's a reason to raise interest rates to protect the exchange rate, for also the reason that given the negative impact that the war is having on production in India and in terms of demand in India, that opens up, makes the economy slow in terms of economic activity. I don't think there's an argument for the RBI to have to raise interest rates right now, because that would slow the economy even further. So just again, given what we're seeing in terms of the rupee and given the forces we're seeing playing out, the RBI can very much wait and see over time. If there is something showing up that makes you worried about core inflation going up in a dramatic fashion or inflation expectations de-anchoring, then certainly in that case you could use an interest rate instrument too.
Fair point. So use it for inflation. Let me come back to the way in which, as you said, some countries have the negative impact of the Hormuz trade closure rather than the positives of AI, and we are in that club. Our current account deficit at 2% is having a problem getting it filled. India went into marketized or market-driven exchange rates as recently as 1991, 1992. Since then, the world was also kind of, there were no industrial policies. You had China entering the WTO, and therefore the world markets were liberal. But therefore, we could always get money to fill our current account deficit. Now, do you think having a current account deficit itself is becoming a problem, because all countries are nearshoring, they're building up tariffs? So is it a time now to just go square on current account deficit? Those with current account surpluses have no problems. Those with deficits have.
Despite everything we've seen on tariffs, the world still remains very integrated. 75% of world trade is still being conducted according to WTO rules. The US is run one of the biggest trade deficits it's had, and so nothing's changed over there. China is running very big trade surpluses. So I don't think that that's the issue. In the case of India, again, a 2% current account deficit is not a big number. What has indeed changed is the ability to finance that deficit, and the fact that there's weakness in capital flows coming into India, either the short-term portfolio flows or FDI, is truly where policy action can be helpful, including in terms of, reinvigorating domestic private corporate investment in India. Again, continuing on the reform path, there should be a good story from AI in India, given India's has grown as a service sector, given the success it's had with its technology, with its highly skilled workforce, with the startup culture that it has, all of that. There has to be new products and new processes that are AI driven that then also provide a good story for why it's a good place to invest.
You've already answered what I was going to ask you. What is the recipe to solve the current account deficit in that case? What more would you say? I mean, we clearly have fallen back on the AI game. We are not up there along with the North Asian countries and China and the United States. What's your sense now? Is the AI story likely to be very negative for India? Or are people being unnecessarily pessimistic and that AI application will give us more jobs down the line?
I think there is lots of reasons why India should be on the positive cycle on AI. Yes, right now there is the concern that, especially with IT services exports, that this could be a negative. But things don't always play out as in a way you expect. For example, Philippines, which has a very big call centers, large number of people employed, you've actually seen that call center activity grow in the Philippines because they're using AI to reduce the cost of the service, and that has increased the demand for that service, and that's actually growing the industry, right? So similar positive dynamics can also play out in India. We're also now in a world where immigration is frowned upon in all of these countries, which means I think there's actually going to be more a demand for services outsourcing, including higher-end services outsourcing, and India can be a location for that too.
Okay. So what's your sense about India? Is it that the worst is priced in terms of crude and the negative sentiment around AI? Is the growth story still largely intact? Or is this going to be the year of reckoning?
I mean, this depends not just, unfortunately, on what India does, but it also depends on what's happening in the rest of the world. And I don't think we are completely out of the woods when it comes to the West Asia crisis. It's not been resolved. Hormuz is still closed. And so we could see things going much worse. So, the risk of volatility, the risk that there are further downsides very much is there, even setting aside what India does, just coming from the rest of the world. But I want to leave on a positive note, which is the fact that it's quite impressive how India has been able to manage its inflation, manage its fiscal deficit at the central government level over these last 5 to 6 years, despite all the shocks that have hit the country. And that's positive, and that is one of the reasons why India is an attractive country to invest in. You need to get the other aspects more, to go right, which is including on the AI front, a positive AI story. You have to make it easier to do business in India, deregulation, setting up factories, manufacturing. We're back to now another wave of industrialization in the world, thanks to all the geopolitics and geoeconomic fragmentation. I think this is an opportunity for India to be able to put the reforms, deregulate more, make it easier for people to do business, and I think that would be positive. I mean, that would help bring in capital flows.
That's a great wrap-up line. But like any market reporter, I want one more. Let me be Oliver Twist. What do you expect from the US Fed? Because this 4.5% risk-free return is also a danger to flows coming to emerging markets. I mean, for India, it's an added reason. Does it get worse? I mean, will rates rise in the US?
The 4.5% interest rates, and more generally the fact that interest rates are higher in the US, are a combination of things, including AI. Because all of these companies that are doing large amounts of AI investments are borrowing more on the capital markets. So there's an increase in demand for that capital that's coming from the private sector. US fiscal deficits are large. That's another source of demand for the capital. So both of those are keeping interest rates higher, including uncertainty around inflation.
And what El Erian pointed out, that this is the 63rd month, April, 3.8% inflation, 63rd month that it is above the 2% target.
Yes, there's also been several years of really one shock after another.
So good chance of, we cannot write off rising.
As of now, I think in the near immediate future, the Fed will probably stay on hold. But again, if this continues and the AI story is generating a lot of economic activity and the big concern is inflation, then we could see interest rates going up further.
Well, so long as the payoffs of growth are good enough, I guess India will be able to, withstand the interest rates as well. Thank you very much, Geeta Gopinath. I know it's an unscheduled stop, but it's really kind of you to spend time with us.
Thank you, Lata.
That's it on this very special Genomics. Thanks for watching.
Ceasefire between Israel and Lebanon fuels hopes of a broader deal to end the war between US and Iran. Market moves to the day's high after a flat start. Autos, upbeat, pharma and realty follow suit. Broader market stocks outperform.
And the centre clears the decks for a 2-year clean mobility scheme in the national capital, a 9,500 crore to replace old polluting trucks and buses with BS6 or electric vehicles. The management of Electra Green Tech is optimistic. Tells cnbc TV 18 that they expect the scheme to boost demand significantly. The peer, JBM Auto, is higher in trade as well.
Citi shares an optimistic view on power equipment players, calls power grid a key transition in bottleneck, believes India is well placed to benefit. Shares of GE Vernova, TND, CG Power and Siemens Energy upbeat on the back of Citi's bullish stance.
And the board of Idea Forge clears the plan to raise 500 crores via multiple routes. The stock hits 5% upper circuit on that announcement.
Market watchdog SEBI bars Rajesh Exports promoter Rajesh Mehta from accessing the security markets over allegations of financial misappropriation. SEBI also flags his substantial operational and financial control of the company and subsidiaries. Stock hits lower circuit.
Well, hello and welcome to Chartbusters. We're coming to you live from the cnbc TV 18 Motilal Oswal studio. I'm Nigel, and with me, my co-anchor today is Ekta Batra, who's back from a trip down south. Ekta, hope the trip was good. A lot of inputs from the pharma space, but markets as well trading more or less flattish as we speak.
Hi, Nigel. Yes, absolutely. The weather was definitely better than the city of Mumbai. But nonetheless, at least I've come back to maybe some amount of stability in the markets
and
at this point.
a little bit more colorful as well.
Yes, absolutely. So the mid-cap index right now is up around 0.6% as we speak. And on a week-to-date basis, we can do better. So let's see whether there's any kind of improvement on a week-to-date basis. So the mid-cap index week-to-date has lost around 1% and the Nifty is down around 0.5%. So let's see how we pan out for today's trading session and manage to close that loss. But let's welcome Sachidanand Utekar of Trade Bulls for a technical check on the markets this morning. Sachidanand, welcome to the show. Well, what's your take considering that the Nifty is managing to hold above 23,400 at this point and the mid-caps are doing better?
Good morning, Ekta. Good morning to Nigel. Clearly, I think the market is in a better mood. And going forward, even for the day, we expect this particular rally to extend towards 23,560, 23,600, thereabout. If you look at the overall construct, I think it is the Nifty Bank, which has been relatively better. Right now, it is challenging its 20-day exponential average resistance, which is placed somewhere close to around 54,300 or thereabout. But the way its constituents are placed, there's a good chance that we may see this particular rally getting extended towards 54,600 on an intraday basis, and probably we may see an extension towards 55,000 as well. So I think the texture of the market is clearly buy on decline. One should stay long, stay committed when it comes to Nifty and Nifty Bank as well. From a trading perspective, one can keep a stop loss at 23,240 on closing basis and expect a rally towards 23,560 followed by 23,640 during the day.
Okay, all right. 23,240, that's the important mark on the downside, right?
Yes, Nigel, good morning.
Got it. What about individual stocks, Sachi?
Nigel, yesterday in the afternoon show, we did recommend trade setup in ICICI Bank, and we've already seen a very strong rally getting built in there. But if you look at the data set, it is still, very confident. We are expecting this particular move to extend towards 1284, eventually, testing its 50-day exponential moving average resistance. So still, I think the reward to risk is better. One can create fresh long positions, keep a stop loss at 1242 on closing basis. From a trading momentum perspective, we may see a swing towards 1266, but positionally, we are expecting this particular rally to extend towards 1284. So a long call on ICICI Bank futures. The other stock on our radar, which has been BSC now, after a very severe correction, we have already seen a good comeback in yesterday's session. We saw a bullish hammer formation near its 20-day exponential moving average support. If you look at the overall construct, the 4,000 call writers may go on the back foot, and this is where we expect a very strong short covering move to unfold. So we are recommending building long positions in BSE. One can keep a stop loss at 39.80 on closing basis. From a trading momentum perspective, during the day, we may see a swing towards 4095, but eventually we see this particular move extending towards 40 to 30. Disclosure would be that we have recommended both these stocks to our clients.
Okay, all right. ICICI Bank as well as BSE on your list. Thanks very much for joining in and giving us all of that perspective. So that's the view coming in on the technicals of the market. Just want to point out that just keep your eye out on specific stocks such as Idea Forge, which is up another 5% today. And the reason I'm pointing this out is because now on a year-to-date basis and only 6 months of the year are over, it's gained around close to 92% in terms of its market cap. So that's the kind of outperformance that you've seen in a stock like this. But let's shift focus to our special segment where we will get you a few ideas for profit from Money Control Pro. Anand Chaudhary of moneycontrol.com joins in now to talk about the stock that he's tracking very closely today. Anand, over to you.
So today's stock is a leading consumer electronics and home appliances company, LG Electronics India. LG delivered a very strong operational recovery in Q4 FY26, where revenue grew by 8.1%, driven by healthy demand recovery across RAC, premium appliances, and large screen televisions. In home appliances, LG had more than 30% market share in washing machines and refrigerators. In premium refrigerators, it now commands over 43% share. It focuses on new launches like French door fridges, AI-enabled washing machines, which are seeing strong traction. In the home entertainment segment, LG continues to dominate in LEDs with a 63% share. TV industry growth remains steady, but the premium segment expanding faster than the entry-level models. Company is also setting up its third manufacturing facility at Sri City with a planned investment of 5,000 crore, of which 657 crore has already been invested till FY26. Compressor production is expected to begin in Q3, followed by RAC production in Q4 FY27, which should significantly reduce dependence on imported RAC compressors amid the tight import restrictions by the Government of India. Localization in manufacturing has improved to 55.2% in FY26, and the company aims to enhance it further by 1 to 2 percentage points annually. The company is targeting mid-teen revenue growth along with early teens EBITDA margins in FY27. Stock rates at 36 times on FY28 earnings appears reasonable to us.
Okay, thanks a lot for that, Anand. Well, time to slip into a short break. You come back, we'll continue to focus on markets and stocks that are moving around. Stay with us.
Welcome back. Well, you're still watching Chartbusters on CNBC TV 18. Well, on the sidelines of the City India Conference 2026, Lata Venkatesh caught up with Sue Lee, the head Markets Asia South, where she says India's growth story remains intact, but the narrative has taken a backseat. She also shares what foreign investors are looking at to make a comeback into India. Listen in to this exclusive conversation.
There is a sense of despondence here in India, more so than when I speak with foreign investors.
Oh, really?
I think it's a bit of the series of events or lack of good news or big good news that's happened for India at the moment. It seems that the long-term growth trajectory, which is intact, that's really become a back-ended narrative. And, that's why we're having this conference today. We're talking about the mid to long-term growth opportunities that foreign investors are not debating are there, and how we front-load this narrative again.
Yes, we do have to front-load the growth itself and not just the narrative. But so we are seeing foreign funds still exiting India. We get net sell figures every day. Is there any thought that, the rupee has fallen enough and stock valuations have fallen enough and a buy zone is nearby? Is that thought something that you hear at all?
So there are two big forces that are moving markets, right? There is the macro, there's the Middle East conflict, inflationary pressures, bond markets are reacting in a big way, currencies here are reacting in a big way. That's not just happening in India. Then there's the AI story and all the enthusiasm and capex going into that. And that's really driving global capital into narrow, selective equity markets. So both of these are negatively impacting India at this time. I think in terms of valuations, rupee, the valuations have come down significantly, and of course rupee has weakened. I think unless we are really finding the narrative about the AI story, a real big inflow here is from the FPI side is not, that's what they're waiting for. What I think are short-term catalysts that can revive that flow is the IPO pipeline.
Okay.
The IPO pipeline is, there's a very exciting pipeline. It has been delayed to give investors time to digest the conflict at this time. I think investors are accepting, issuers are accepting that this may be a longer drawn conflict here. And if these IPOs come to market and are well priced, that will bring inflow.
You think FPIs will subscribe to the IPOs even if they are exiting some of the secondary market stocks? You think there's appetite for the IPOs?
Oh, IPOs, for the new IPOs, yes, I think there's a lot of excitement, and there's lots of excitement and waiting to see that they will be well priced, to take in consideration of uncertainty in the markets at the moment. I think, let's not confuse the exit of FDI in sponsors exiting through IPOs as a negative.
Okay.
And I know that actually in India, we talk about the capital account and the net FDI being lower. Yes, it's a concern because the capital account is what is funding the current account, especially in India historically, right? But the net FDI is lower because FDI sponsors who have made multiple returns are able to exit, and Indian corporates, Indian multinationals are able to go outside to invest offshore. Both of these are good things. As a global market said, this is in global markets. These are good things. This is also adding to the long-term growth story of India and the depth of the market here.
Okay, let me come to the currency itself, since that's a big part of your job as well. There is this current account deficit issue. For Philippines, it is, current account deficit is 4% of their GDP. For us, it's not that big. It's less than 2%, but still we are not able to find enough capital flows. Do you think that if the oil prices continue where they are, we may see some kind of a currency crisis in Asia, some country doing really badly? Is that a likelihood?
I think that much of the Middle East conflict and the possibility of it becoming a long drawn-out conflict is priced in. As we have said in several of the conversations at our conference, financial markets globally being quite resilient has been a theme. So far, we've seen that it's been manageable with no panics about a impending threat or crash.
Let me come to FDI, since you referred to it. Do you still see India in the chatter in FDI conversations that you may be having with clients? At one point, we saw ourselves as receiving a lot of China +1 investments. Is only Vietnam and Malaysia in the conversation, or do you hear India enough in the conversation?
Absolutely. Last year, gross FDI is $90 billion. Yes. And there's continued investments coming into India in iPhone manufacturing, AI data center building, but also outside of that, GCCs are seeing continued interest and growth. Maybe the growth rate has slowed down, but you would expect that because this has been a growth story for several years now, right? So I think very positive on the FDI front because, again, there's no argument against the mid to long-term growth potential in India.
Okay, all right, time to slip into a short break. As we do that, here's a quick programming note. Stay tuned to CNBC TV 18 for those insightful conversations on markets, macros, commodities, all that coming from Citi India's Conference 2026. Catch the conversation with Citigroup CEO Jane Fraser at 12 noon today. Welcome back. Markets holding in the green, and one stock that's really bucking the trend right now is IIFL Finance. You know, it's moving higher today, but keep in mind it's a big underperformer. If you map the mid-cap index with as well as IIFL Finance, in the last 1 year or so, IIFL Finance is being a rank underperformer. But today it seems to have broken out because it's crossed that 200 DMA, and there appears there's some selling that's got absorbed as well. At some point of time, the stock that we're talking about, IIFL Finance, will come up for you on the screen. But let's focus on shares of power equipment makers, GE Vernova and T&D, as well as CG Power and Hitachi Energy. They're upbeat on the back of a bullish note that's come in from Citi. Vinny joins us to help us out with details on that one. Vinny, take it away.
Hi, good morning. So absolutely, the theme overall for transmission has been and focus has been at the center stage. Why? Energy transition, that's the play that's working out, right? Domestic demand, that's improving. Now, the Central Electricity Authority, a while back had spoken about around 7.9 trillion rupees transmission plan that they have for 900 gigawatt of renewable integration that they're planning by FY36. That means transmission players will do well. So that means we'll see multi-year demand for HV and HVDC products and infrastructure as well. So all these companies start benefiting. Now, apart from that, if HV and HVDC products are required, the infrastructure is required, then you require grid as well. That means that will drive the demand for T&D players, the T&D capex cycle. Everyone's spoken about investing in that as well, the up cycle that's going on. And there's an acceleration in renewable adoption, electrification, data center, all of that requires grids. And that's why a benefit that comes in for these T&D OEMs as well as key beneficiaries are Hitachi Energy, GE Vernova T&D, CG Power, Siemens Energy, all of these are beneficiaries. Now, Citi is highlighting that power T&D OEMs will, have already been re-rated. YTD, we've seen a run-up coming in as well. We've spoken about capex as well. But despite all of this, they believe that there is still some upside that is left, a higher upside that is left for all these players. Specifically for Hitachi Energy, HV and HVDC market leader, the companies. Now, they have a higher probability of more order wins that will come in here, expansion of capacity to capture market share. That's what they are working on as well. So, long-term growth story is quite visible over here. And that is why they are initiating coverage on this one with a buy rating target price of 46,700 rupees per share. GE Vernova T&D, strong HVDC company as well in terms of projects that they have. They have a global and export exposure that comes in here as well. So medium-term growth outlook is supported for this one. That's why initiating coverage on this one. Target price buy rating, target price of 6,200 rupees per share. CG Power also, they are initiating coverage with a buy rating, target price of 1,100 rupees per share. While in terms for Siemens Energy, they're initiating coverage with a neutral rating and target price is 4,000 rupees per share. So the preference for their stock is first is Hitachi Energy, then GE Vernova T&D, CG Power, and then Siemens Energy. The transmission story is here, the energy transition story is here, which will benefit these companies. We've already seen a run-up in the stock, but a further upside is expected from Citi.
Okay, all right. Thanks, Vinny, for that. So those are the power equipment companies that Citi is bullish on. But let's talk about autos now. Hero MotoCorp has launched the flex fuel versions of its largest selling models, the Splendor Plus and HF Deluxe. The newly launched models are compatible with blends ranging from E20 to E85 and are priced only slightly higher to the standard ICE models. Our colleague Abhimanyu spoke to Harshvardhan Chitale, the CEO of Hero Moto, on the new launches, the government's push for flex fuel, and how it contributes to the national energy security. Listen in.
Energy independence is a big crying national need. As we just heard the Honorable Minister, we import over 22 lakh crore worth of fuel. That's money that goes outside our country. 85% of fuel is imported. And our recent West Asian crisis has reminded us of need to be Atmanirbhar. When we talk of Atmanirbhar Bharat, to be Atmanirbhar also when it comes to fuel. There is no better way to do that than using our own agricultural economy. And hence government has been encouraging, pushing the entire industry, talking to the entire ecosystem to come up with vehicles that can work with higher and higher blends of ethanol.
With respect to the kind of concerns people have, and you have come across a lot of online chatter, a lot of offline chatter too, over the fact that use of ethanol is not really good for the life of vehicles, and also it leads to depletion of water. There are several concerns doing the rounds. How are you looking to address those? How are you looking to work more closely with the entire ecosystem and as well as with the government to address these?
No, great point. Hence these bikes are designed to work with different blends of ethanol. They are tested for that, they stand guarantee. And if you can see a company like Hero, where Splendor and HF are the largest selling models, we are putting flex fuel technology in them. So our crown jewels, we are making flex fuel ready. You can imagine what level of testing and reliability, because these bikes are known for reliability. So they are fully reliable. Coming to performance, our tests show that because ethanol has a higher octane number, actually they give you more power. The peak power is higher, the torque is higher. So you'll also get a good experience of it.
Knocking possibly.
Absolutely. So you actually get a better experience of using it.
My final question to you, while we say that the West Asia crisis is impacting energy imports, it's also impacting the entire supply chain, which also includes agricultural supply chains. So even if you are deriving alternate fuels from agricultural sources, even the price of that is possibly going to increase. How are you looking to absorb this price hike? Do you intend to increase prices for these variants? What is the current price differential which these variants have with the existing ones, and any policy asks you have from the government?
So coming to your last point about the price, what we have launched right now is at a price of about 4% more than the base E20 based vehicles. But to make them more attractive, for the first 1 month, we are going to give them in the same price. So consumer can get a future ready vehicle that can go all the way from E20 to whatever is the blend available. They can have that at the same price. Coming back to the wish list, government is aware how to promote this. One of the requests that industry as a whole has made to the government is if they can come up with an incentive, either by way of GST or any other incentive, that reduces this price differential. So the cost that is extra gets absorbed. And second most important one is we need to make fuel more competitively priced. And that's also something I know Ministry of Petroleum and Natural Gas is already actively working on.
Okay, all right. Well, on that note, though, we'll wrap up on this edition of Chartbusters. That's it from Ekta, myself, and the entire team that put the show together. You stay with us. The team of Trading By is waiting by. Stay tuned.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia, and since we are gearing up for the big day requires big people. Ritu Singh is right here with us. Ritu, good morning. Well, the markets are staging a bit of a recovery from the lows of the day, but then that elusive big move on the upside still remains missing.
Yes, and we hope to see that. A lot of it will depend on what comes out of the policy tomorrow. We've been reporting today that the government may reduce some taxation as far as foreign investors are concerned and their investments in government bonds. Whether that comes through or not, the markets are going to take that positively. And of course, the big cues will come from what happens in the RBI policy. Our poll is throwing up a status quo. With that said, for the frontline index, it's been flattish now, trading with gains of about 23 points. You have the advanced decline ratio that tells you that more than 2 stocks are advancing for every 1 stock that is declining on the National Stock Exchange. The Bank Nifty above the 54,300 mark, now trading with gains of about 190 points as we speak. And the broader markets as well, doing relatively better. So let's go across to Hormuz in just a bit. We'll get you the top stocks that are trading. Let's also, do one thing, tell you the sectors that are doing relatively better today. Among the top performers is the auto and the mid-select pack, and the weaker pack is, of course, IT. But for now, let's cut across to the Citi conference. Jane Fraser is speaking at the moment. Let's listen in.
That, he said everything is not rosy. Yeah. There are a few challenges. But then he had a very clear vision and thought in terms of what are the few priorities that the government is focused on. Yeah. You talked about energy security. Clearly, that is something that, the government is super focused on. You talked about digitization. That is something that is very core to his heart. Yeah. And the amount of work that the country has done on that front and the businesses that have been built on top of the India's stack and the way in which, these people have gone and raised money. This is all credit to the Prime Minister's vision in terms of putting the entire business in place.
He's pretty good at execution too.
Absolutely. And then also when you talked about your trip across Rajasthan several years back and the glass panes that you saw, and he said that, when he was a young kid, he was always thinking about how to, and he said in Hindi, how to convert Registan to a money-making proposition. And then he went on to explain in terms of how the renewable energy focuses and how that has basically made India self-sufficient from an energy perspective. Yeah. So I think I quite like the vision. I like the transparency.
But it's as you say, gritty and grounded, not highfalutin. That I think you should give everyone confidence and a lot of comfort. Certainly did for me. Yeah.
You've been traveling quite a bit, Jane. And I know that you were in France earlier this week. And I know that you met President Macron.
Yeah.
There is a G7 meeting that is happening later this month. And in fact, Prime Minister Modi mentioned that he's going to be part of that G7 meeting. Unfortunately, we are living in a very volatile world. There is a war happening in Europe. There is a war happening in Middle East. Tariff is still overhang that is yet not gone away. So from your perspective, based on your interaction with President Macron and other leaders, what are the big priorities that they are focused on? What are the few things that G7 is going to cover when they meet later in June?
I had the privilege of spending some time with President Macron. I asked him, what's he hoping to get? Because they're the president, they have presidency of the G7 summit. And of course, Prime Minister Modi and President Macron are pretty close. I think rightly he will focus the G7 on global imbalances. Right? There are a lot around the world at the moment, and talking about what are we going to do about it. The Middle East will come up within that. Some of the tariff situations, the dynamics between the US and China will be in there. But it's also that broader group of allies together, which I think will bring some balance to the discussion. It's not just the US-China discussions, but it's much more about what else is going on and what else is everyone doing about it. And we had our investor day recently, and I was telling the president one of the lines our head of markets had down is, in investing, the only free lunch is diversification. And I said it's not a free lunch, but it's a very important part of what everyone needs to be driving to. And the recent trade agreement between Europe and India may be a point of pride for India, but it's really important for Europe. And so there's a lot that can be done through diversification. And they'll be talking about how to try and make that real, as well as talking about how they try and get the upside from AI, not just the challenges.
All right, so that's Jane Fraser, the global CEO at Citi. We'll keep getting you excerpts from that interesting conference that's going on today. But for now, let's get back to the markets, which just slipped into the red. The frontline index now 23,389. It's trading with cuts of about 16 points as we speak. We'll go straight across to Hormaz, who's at the wall to tell us about the top movers and shakers.
No, the markets are choppy, yes, but I'll tell you the good part. Earlier this morning, we were mentioning the fact that the Nifty has a bit of a problem for the last 6 sessions. The index has been making lower lows every single day. Today, it's not the case. Today's low is around 23,250 odd. So we have managed to defend yesterday's low of 23,151. If that streak of lower lows gets broken today, that will be viewed as a positive for the market indeed. Even if we don't go anywhere significantly from these levels as well, the fact that we have stopped the lower lows, that can be viewed as a positive. Now, leading this recovery from the morning has been the Nifty Bank, although that too saw a majority of its move play out in yesterday's session itself. But today too has seen a bit of a 350-400 point recovery that you have seen from the lows of the morning, and now we are trading at around about 54,200. So we are holding on to the 53,500 support as well on the Nifty Bank this morning. So the VIX as well, the VIX was up around about in yesterday's session. Today, well, not doing much in today's session, still holding on to levels of around about 16. You take a look at the banking names also that have contributed to this recovery from the morning. We spoke about SBI yesterday in our deliveries segment in closing bell. Look at the stock is extending its gains now 1.25% higher. ICICI Bank too, after a positive note that came in from Motilal Oswal earlier in the morning, that's too is doing well today. IT, well, the expectation was that we might have another round of sell-off, but that's not the case. Even after the ADRs of Infosys and Wipro ended lower overnight, Oracle, Tech Mahindra and Coforge are all trading with gains, and no significant moves seen in Infosys and TCS as well on the downside. Look at the newsmakers in today's session. JBM Auto extending yesterday's gains, 5.5% higher on the stock. PNB Guilds too, a similar quantum, as is IIFL Finance. We'll hear from the management shortly as well on the show. And AC companies, Voltas, Blue Star, both of them doing well, but of course there is anticipation of the monsoon being declared as arrived in the country in about in today as during the course of the day. But metals as a segment is sulking. Nalco, SAIL, NMDC Steel. NMDC Steel of course is seeing some profit booking, but Nalco and SAIL seeing losses of anywhere between 3 to 5%. And lastly, stocks at 52-week highs. Well, there is no stopping HFCL. That stock is now at 207, another 4% added. There is no stopping Sterlite Tech either. From 170, the stock has now moved to 650. In the last 41 sessions, almost 20 of them have been upper circuits of 5%. And Laurus Labs too is now well over the mark of 1400, another 2% higher, another 52-week high for the stock.
And Laurus Lab up 22% in the last 1 month and 40% or so in the last 6 months. But let's shift focus to another stock, Idea Forge, which is surged higher trade, locked in a 5% upper circuit after the company's board has okayed fundraising plans. Let's go across to Ria for more details on this one. Ria, 500 crores and a 5% up move.
Well, yes, the stock has been locked in an upper circuit of 5% right since the start of this trading session, and the company has announced a fundraise of 500 crores. Now, they haven't disclosed the timeline of the fundraise, but they have said that this can be executed through various means, including preferential allotment, private placement, or a QIP, and could be done in one or more tranches. And further, they have not disclosed where the funds will be deployed, so that was something that will be watched closely going forward. And apart from this, there was also a report earlier today today that India is likely to order more than rupees 20,000 crores worth of military drones from domestic firms this year. So on the back of this, drone makers, including IdeaForge, are performing well in today's trading session. And earlier this month, the company had also reported a very strong set of numbers in Q4, and Q4 and FY26, in fact, marked a turnaround for the company in terms of profitability, and the outlook also remains quite strong for FY27. And the stock has been performing quite well. In fact, on a year-to-date basis, the stock has nearly doubled. And today as well, we are seeing a big move on the stock.
Well, 900 now on IdeaForge, back above its IPO price as well. So doing fairly well. Most of those gains, of course, have come in the last couple of months now from levels of 370. The stock is now at 900. Ria, thank you for that. Just before we move on, highlight PhysicsWallah as well. I had to highlight that in the stocks that are making news. That stock is now up over 10% as we speak. And that's, of course, the company made an announcement just a few minutes back that they are going to reverse their student lending program by doing it themselves. And instead, they will now partner with third-party NBFCs to carry out the same. And therefore, the stock is now reacting 10.5% higher on PhysicsWallah. Of course, below its issue price is 111. Of course, the stock was seeing some bit of selling pressure over the last couple of days, but now has seen a sharp reversal from those lows. Now, the market, of course, is awaiting some tax rule changes for foreign investors that are investing in government securities. This news has been going around for a while now. Let's go across to Sapna Das to tell us what she is picking up from her sources. Sapna, over to you.
Yeah, so basically this is, more or less widely expected, and most likely the important cabinet meeting held yesterday under the leadership of the Prime Minister, Mr. Modi. I think an in-principle decision has been taken to issue an ordinance to make some important key tax changes as far as the FI investments in government securities are concerned. So primarily, of course, a big ask has been this withholding tax, which was brought back to 20% after being cut to 5% in 20. I mean, that period was there till 2023. I think it was a 2-year, kind of a relief measure that had been given, and then it was rolled back at 20%. So my sense is that big demand that is coming in from market participants is the fact that, this is basically taxing your earnings, right? So whatever interest that they earn, 20% withholding tax is pretty steep. That has been the feedback. So most likely government has taken a decision to do away with that. Not just that, we also give to understand that the capital gains tax at 1.5% again, as far as FI investments in G-Secs are concerned. This is all to do with G-Secs specifically. That also will go away. So in a nutshell, if there is any other tax that is there as far as G-Secs are concerned regarding FI exposure, so all of that is going to be taken away, or rather has been agreed to be taken away. And we have to wait and watch and see. Most likely it's going to come through an ordinance because the parliament is not in session. And my reading is that once the session, of course, starts, the ordinance will be replaced by a proper amendment with the IT laws. So this is what it is. Of course, there has been a lot of talk on this one since the last few weeks. And it seems as if finally the government has taken an in-principle decision. Now we have to just wait for the dates to be announced as to when this actually rolls out and, take the impact from there on. Almost.
Okay. Thanks very much, Sapna. Important development there. The market's waiting for. We also have, of course, the RBI policy tomorrow, so we'll have to see if the Reserve Bank of India also steps in with some measures. But for now, we'll slip into a short break. Up next, we're going to focus on the bond markets with Manisha Gupta. back. Let's get you the macro signals for the day. For the markets, of course, they're trading with cuts of about 10 points. 23,395 is where you have the frontline index. Leading that fall is the IT pack, which was again under pressure yesterday, again down about 0.4%. The rupee is seeing a bit of a recovery today, very slight. 95.65 is where it's at. It's in line with the fall that we've seen in crude prices as well. But of course, overall, the pressure does remain from the foreign outflows that continue and oil prices that are still high. So that's why we've seen a 7% plus weakening since the start of the year. For the oil prices, they are retreating from the recent highs because tensions in West Asia are showing some signs of cooling. Brent crude currently trading at around $97 a barrel. That's down approximately 0.75%, while WTI crude has also dipped to about $95 a barrel. The 10-year benchmark yields, meanwhile, they're reacting to the news we've been telling you here on CNBC TV 18, potential measures from the government to ease taxes for foreign investors on government bonds. Yields are seeing some slight declines, also reacting to the shifting geopolitical and fiscal news. But of course, the big Q will come for tomorrow from the RBI policy, and traders are cautious ahead of that, where the RBI is expected to leave the repo rate unchanged, at least in this one. So we'll slip into a break on that note. But before we leave, here's a programming reminder. Stay tuned to us for insightful conversations on market macros, commodities from the Citi India Conference 2026. Catch that conversation with Citi Group CEO Jane Fraser coming up at noon today.
Welcome back. Shifting focus to the bond markets, then Manisha Gupta is here with the latest. Manisha.
Well, thank you so much for that. It's all, one thing that the street is watching for right now, and that is the RBI MPC meeting tomorrow, and to hear on what they have to say about inflation and various other West Asia conflict impacts as well. In the meanwhile, we've seen the government yields for 3 to 5 year kind of trade steady there. Remember, it's been the very near-term trade that we have seen most activity in. The longer-term scenario is still quite uncertain there. But then it is also about India looking to scrap capital gains tax in FPIs and government securities. I mean, that is something that the street is watching out for, has been reported via sources in various medias, including us as well. So that is what the street will want to watch out on, what really goes through that. At this point in time, we also are looking at rupee, which is down 5% in 2026. Crude oil prices, which have gained 30% since the West Asia conflict, also 60% up in this year till time. It also has to do with the foreign portfolio outflows in the equity markets that we have seen. So what the street is now looking at is the foreign investors, which are as of now subjected to long-term capital gain of 12.5% and withholding tax of around 20%. This is what the street believes will perhaps work its way out. If you look at the overall numbers therein, the Indian government debt, $1.4 billion of an inflow is what we've seen into that, but $20 billion of an outflow from the equity markets. So government in some sense, or RBI rather, trying to make a balance of these things here. There also are quite some private issuances in sense of bonds coming in today itself, and you have some big names therein. You have Bajaj Housing Finance, which is looking to raise nearly 20 billion rupees. They are doing this via reissuing of bonds maturing in 2029. And then you have Aditya Birla Housing Finance. They are looking to raise 10 billion rupees, doing it via 3 to 5 year bonds there. You also have Midland Microfin. They're looking to raise 500 million, and Akara Capital as well is in the market looking to raise 500 million. The bidding of all of these companies happens today.
All right, Manisha, thanks very much for joining in with that. Let's now go across to IIFL Finance that's raised $500 billion in an overseas bond sale. The issue is priced at 7.6%. That's the coupon rate, 3.25 year tenor. And remember, this comes after building an order book of about $2 billion from large institutional investors. It's also the first dollar bond issue out of India that we're seeing since January, because since then, with the West Asia conflict, yields have also been inching up. Let's get in Nirmal Jain, the founder and MD of IIFL Finance, for more on this. Mr. Jain, good morning. Thanks very much for joining us here on CNBC TV 18. Tell us about this bond issuance. Is it a one-off that you're looking to raise money overseas, or will we see you do more of this? And, how would the proceeds be used?
Okay. So this, I think we'll do, broadly we'll plan to do it once a year. And, as a strategy to diversify sources of fund, we have been reducing the relative share of banks and increasing non-bank exposure through bonds in local market as well as overseas market. So external commercial borrowings and dollar bonds together, we plan to have, say, 20% share of those in our resource mix. And these are social bonds. And probably would know that most of our customers are economically weaker section. Almost 87% of our customers are economically weaker section. Majority of our customers are also women borrowers in semi-urban and rural areas. So the proceeds will be used for lending to those, socially disadvantaged segments of societies, by way of gold loans, by way of MSME loans, including LAP, which is loan against property.
Okay, Mr. Jain, since we're speaking of bonds, very quickly, if I may address the news you might have seen on CNBC TV 18 that the government is considering, reducing the taxation, both withholding tax and the capital gains tax for foreign investors when it comes to investing in government securities as, one of the measures to shore up, the rupee position as well. What do you make of it? And, with more foreign money potentially coming into GSEC yields, do you expect borrowing costs, theoretically at least, to come down?
I think there's need of that because there has been significant outflow on capital account by way of equity and even FDI selling. So what maybe we need to do, we need to be competitive vis-a-vis other countries that are attracting foreign capital. And withholding tax will be removed not only in government securities, but also in corporate bonds. So currently corporate bonds, if they get listed in GIFT City, then maybe there's about 9% withholding tax on the interest. If we have to be competitive, we have to attract capital, which is required for the growth of this country, then I think these taxes should be removed. They are not... Here, what we have to look at is not vis-a-vis the domestic investor, but vis-a-vis the destination of for foreign capital, how other countries are attracting capital, how easy they made it. So I think this is need of the hour, and our government is doing the right thing at the right time.
Jain, in that case, there's a big RBI policy as well that's in the offing tomorrow. What are you anticipating from there on the reform side? There are multiple measures that the RBI has announced in the past as well. What are you expecting this time around?
So I think as far as the entire Middle East crisis is concerned, India has done well. Our government has been able to cushion it. Our headline inflation has not gone out of control. Growth imperatives are there. There are worries that monsoon may not be because of the El Nino factor, and there may be dry spell and monsoon may not be as good. In that context, my personal view is that RBI may not do rate hike tomorrow. And but at the same time, if you don't do rate hike, then there's a pressure on currency. So they will do certain balancing measures like, government and RBI put together which can be by way of, as far as government is concerned, they can, remove the withholding tax that we just spoke about. RBI can give a swap, which was done earlier at a concessional forward rate, or so they can try and encourage flow of, capital at this point in time. But India is an attractive and a very strong macroeconomic fundamentals that we have, and is a good, over long term, medium term, capital will come on its own. The short term measures can be by providing swap window. I think these are the measures that I would expect, and not interest hike at this point in time.
But Mr. Jain, apart from RBI, from the government itself, there is this talk of withholding tax being removed for foreign investors. Are there any other measures that you, as a banker, would recommend as well, would want to see?
I think, the long-term capital gain tax that, foreigners have to pay. There has been, discussion around this. This has been mooted that, that should be removed as it used to be a long back. And, maybe the time horizon can be increased from 1 year to 3 years. That will be very good, because equity investing is for long term. The long-term capital gains tax can be removed even for domestic investors. Many times people try to compare this with business income or salary income, but that's not a correct comparison. When we work and earn, then we pay our taxes by way of salaries or business income. But when our savings are compounding and to build wealth, then that get again taxed and at a very high rate. So that is not allowing capital formation to, be at a pace at where it can, it ought to be. So I think if we are really, government is serious about attracting long-term capital into equities, which is risk capital, then, they should do something about long-term capital gains tax.
Yeah, well, we'll see that. But Mr. Jain,
that makes our country competitive vis-a-vis many other economies that are also competing for foreign capital.
Yeah. We hope to hear something, from the government and, of course, the RBI soon. But Mr. Jain, back to your, social bond fundraise. You said part of the proceeds will also go towards, MSME lending. As far as the West Asia conflict is concerned, and we've been seeing an increased, offtake in ECLGS by, of course, banks. Are you seeing any kind of stress build up there? How's it looking? And, how much more are you looking to extend to this segment? And what proportion would be exposed of your borrowers to what's happening in West Asia?
So right now, we focus on your secured lending, which is loan against property for MSME at this point in time.
Okay.
I believe that, the impact as far as Indian MSME is concerned is almost negligible. There may be some segments that are impacted by supply chain disruption, some restaurants shut down or not operating at full capacity because of gas or some shortage of sulfur dioxide or some such material. But by and large, I think MSME is still doing well. In fact, even before war, when there was a tariff by US, sectors like textile, footwear, shrimps, or jewelry were impacted. So these are cyclical impact on a few sectors that we track very carefully. But I think the macro fundamentals are strong. Indian MSME has a long way to go and grow if they get capital. We should understand this, that our MSME contribution to GDP is just about 30%. If you look at China and South Korea, 60%. So, and this is the bottom of the pyramid where we need the credit to flow so that they can produce more and consume more. And that will be more equitable distribution of, income and wealth. So I think, this sector has a long way to grow, and, we are strategically positioned in this. So, I don't see any stress there, which is long-term or structural. There can be cyclical problems, but that is okay.
Mr. Jain, one final question very quickly. One of your key shareholders, the Small Cap World Fund, at December last year, they had around close to 7% holdings. In mid-May, it was around 1.8%. There has been significant increase in your volumes and on the stock as well over the last few days. Have you heard from them? Has the selling from them completed? Have they made an exit, or do they intend to sell their remaining stake?
No, it's very difficult for me to comment on the funds, because they take their decisions based on several factors, including the attractiveness of even other markets and or other sectors. So really, that I can't comment on portfolio investor and the fund managers or funds that how they buy and sell. So it's very difficult for me to do that.
Fair enough. Mr. Jain, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Nirmal Jain of IIFL Finance on the dollar bond issue and, of course, on a whole host of other subjects. Take a short break. On the other side, get to the management of Tata Capital. MD and CEO Rajiv Sabharwal joins in to discuss the road ahead for the company. Welcome back. Well, the markets continue to remain where they are and below the mark of 23,400 as we speak. You know, Physics Wala has just extended its gains now, 15.5% higher on the stock and very close now towards its IPO price, which is 111. So good moves on Physics Wala, the top gainer on the Nifty 500 today. What has also extended its gains is Zen Technologies, 11.5% higher on that stock as well. That has also moved to the highest point of the day. And one more that is coming onto the list of gainers today is Tejas Networks, and since the 26th of May when we reported about the Tata Sons board meeting and the fact that Tejas Networks was also part of that list, the stock is up 30% since then, is highlighted by our colleague Sudarshan from the newsroom. 8.5% higher on Tejas Networks as well. Good time to get in a quick chart check and some trading ideas from Ajit Mishra from Religare Broking. Ajit, good morning. Thank you for joining in. You know, the index continues to be very, very volatile, but the fact that it has managed to defend yesterday's low, at least for now, do you see that as a positive? And your call on the index then and your stock recommendations for the morning as well?
Yeah, good morning, Almas. So yes, in a way it is positive because at the same time, while the overall textures is bearish, means we are maintaining a lower highs, lower low structure when it comes to the index. Yesterday we filled the gap on the daily chart in the index around 23,150 and rebounded thereafter. Today also, despite the negative global clues, we are trading flat. So this clearly shows that at least some pockets, especially banking, in where we see some bit of strength re-emerging. But at the same time, the mixed trend within the heavyweights is capping the upside. So it's going to be more of consolidation bias continuing in the index within this 23,000, 23,500 range is what the price action is indicating. So in the interim, the focus should remain on the sectors and themes which are holding well. So from the banking basket, RBL Bank, wherein we have seen a fresh breakout from the consolidation range with immediate target at 370. One can accumulate at current level with 336 as a stop loss. And then we have from the pharma and healthcare basket, hospital stocks were buzzing in the last hour of the trade yesterday. And we anticipate this recovery to further strengthen. So Apollo Hospital can be a bet from that space where one can look for accumulation with 8090 as a stop and 8550 as a target area.
Ajit, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. The IMD has finally announced that the southwest monsoon has finally made its onset in Kerala. That is today, the 4th of June, and they have anticipated that, of course, over the next 10 days, it should make its mark ahead on the city of Mumbai as well. But Ritu, there are other corporate conversations lined up as well, Tata Capital, of course, being one of them.
Yes, and we do have Rajiv Sabharwal, the MD and CEO of Tata Capital, with us now. Mr. Sabharwal, pleasure to have you on the show here. You know, there's so much to talk about right now. The big one, of course, let me start with the RBI policy tomorrow. Banks are going to be happy if there's a hike. The expectation is a status quo policy. You, of course, are going to be happy that, the hike is not coming just yet. To begin with, what are you watching out for from the RBI policy tomorrow? Any specific measures, on the strengthening of the rupee, etc.? What will you be watching out for?
I think two things are important. One is their outlook of what they are going to talk about. I think my personal view is that they will probably play the status quo game, and which is probably appropriate also at this point of time on the repo rate. The other thing is going to be on the approach towards liquidity. RBI has always said that they will ensure there is sufficient liquidity. We did see some bit of liquidity going down in the recent past, but hopefully that should be banked with government spending coming back. So I think as long as there is sufficient liquidity and the repo rate remains where it is, I think we should see good growth coming in the market.
But no specific measures, for the rupee, for the, for the NBFC sector, anything in particular you'll be watching out for? We've also just heard from our colleague Sapna Das that the government may come back with, perhaps a cut in withholding tax and the capital gains tax for foreign investors in the GSEC market. What do you make of that as well?
So there is so much talk about it, and I do read about it. I think we should wait for what is going to happen. I think whatever they are thinking of should be positive for the market. And from our lending perspective, what is more important is what happens to rates and what happens to liquidity. Typically, though we are actually borrowing on one hand and lending on the other, we only try to ensure that our margins remain intact or move up. But sufficient liquidity ensures that the rates remain in check, which is good for the borrowers. And if something is good for the borrowers, it's good for us.
Right, Mr. Sabharwal, thank you for taking out time today. You've mentioned that you're planning on a 23 to 25% AUM CAGR going forward while maintaining your asset quality where it is currently. So what are the segments that you are looking to double down on in order to achieve this guidance over the next 3 years?
So if you've watched us, we are well spread across all segments of the business. We believe it's very important to be a part of the whole economy in all parts and have a bias towards retail and SME, and that is what our approach is. Retail and SME form about 86-87% of our total book. If I talk about the growth for the future, there are going to be certain areas which will grow faster than the others. One is housing. We've seen housing grow at close to 28 to 30% in the past, and we believe we should be able to replicate that in the future too. Similarly, we have seen secured retail also grow at a healthy clip of 28 to 30%, and that should also continue to grow. There was some amount of moderation which happened on retail unsecured, which seems to be coming back. We've seen growth coming back since the second half of last year, and that should continue during this year. So that is also positive. The other area where we believe there should be reasonable growth with the support of ECLGS also is on the SME side. So these are the sectors which we believe will be high growth sectors for us.
So when you say unsecured retail growth is coming back, it's already 10% of your AUM at the moment. How much more do you expect it to grow, especially in light of what's happening, in the MSME segment, for instance, with West Asia? In the fourth quarter, we were yet to see whether any stress build-up took place, but in the first quarter, in the days since, how has the book performed, and how much more do you expect unsecured in particular to grow?
So if you, look at our credit costs have only been getting better with every passing quarter. The credit quality on secured was always very good. Unsecured, which suffered in the past, has improved significantly, and we are on the right track to bring it to the levels which we are comfortable with. We've also seen growth coming back. As far as West Asia crisis is concerned, at this point of time, we've not seen any significant impact on either growth or asset quality. Going forward, depending on how it plays out, there will be certain segments in which one may want to be a little more careful. For example, the commercial vehicle sector or the construction equipment sector, which have a lot of dependence on fuel prices, or, for example, certain parts of SME, not the whole of SME. I think there could be some amount of conservative approach which we will adopt going forward. But SME is a very large segment. So while there may be certain segments where there may be some conservatism, there will be a lot of sectors where we will see good growth happening.
Mr. Sabharwal, one final question from my end at least. The turnaround of Tata Motors Finance has been the one that has been the big talking point, right? But what is the beyond this turnaround, what is the long-term role of this entity that you see in the entire Tata Capital ecosystem, and how much of the synergies are you aiming to capitalize on in terms of the return ratios for your company going forward?
So we've been on the journey to transform Tata Motor Finance, and we are, I'm saying, very happy with how things have progressed. In fact, in a lot of areas, we are better than what we had planned as far as Tata Motor Finance is concerned. We are a player which operates with multiple OEMs. So we've spread out 1/4 of our volumes comes from non-Tata vehicles today. We've been able to bring in more efficiency, embed technology, so cost to income is coming down. We have also seen our mix getting better because we want to be in segments which give us the right risk-return ratio. So our yields are moving up, and our presence in certain segments like mid and small vehicles, which was small, is moving up. Our presence in used commercial vehicle is moving up. So we are on track for that. I think what is more important at this point of time to watch out is how it will pan out on growth. While we are seeing some growth coming back because of the challenges on West Asia crisis, we will need to see how much do we want to push on growth as far as this sector is concerned.
Mr. Sabharwal, since you spoke about commercial vehicles, just a quick question on the Delhi, this policy that the cabinet has approved for old trucks being replaced in Delhi. Does that open up significantly, more financing opportunities for you, especially on the EV front, as these trucks transition?
Yeah, absolutely. I think the opportunities are emerging not only on EV trucks, on EV buses, which has been a good segment for the last few years. That is also growing at a much faster clip. So I do believe that there are certain tailwinds which are getting built up because of these changes. And the government is also helped in terms of being moderate in terms of passing on fuel price increases. So we had a good last year in commercial vehicle market. This year there are tailwinds, but we need to watch the impact of West Asia crisis.
Right.
Mr. Sabharwal, pleasure having you today. Thank you so much for sparing time and joining us. Wish you good luck for FY27 as well. Take a short break. Conversations on the markets with Ashi Anand of IME Capital on the other side. Stay tuned.
Welcome back. We have Ashi Anand from IME Capital joining us now to discuss market fundamentals and some of his sectoral picks. Ashi, always a pleasure to have you here. But before anything else, maybe a broader question on market sentiment, given this news around some of the measures that could come in from the government, perhaps even from the RBI later on, easing the taxation for foreign investors in India, if that lifts sentiments, and what you make of it.
Yeah, sure. So I think firstly, in terms of the long-term capital gains, I quite echo the sentiment of one of your previous guests that if you are kind of planning on taking away long-term capital gains for FIs, firstly, this is not known. It is a potential rumor. But if that were to happen, it would be very, very encouraging to see that also lifted for domestic investors. There's really no reason why domestic investors should not also participate to the same extent as your global FIs. But FIs have been kind of pulling out from the Indian markets quite consistently over the last 4 years. Any kind of improvement in the taxation structure could help alleviate some of that kind of pressure. But that said, I think it's not just taxation. It is important to understand why FIs are pulling out. And I think one of the primary reasons is that the whole AI trade is one of the most attractive investment themes globally over the last year and a half. And an economy like India is really not present in a large part of the value chain. So what you are seeing is FIs actually redeploying from traditional kind of India allocations towards Korea and Taiwan in particular have actually benefited quite significantly. Now, growth in India has also been a bit subdued. So while, yes, if there is some improvement in taxation, there should be some kind of a short-term boost in sentiment. What is very, very important to see is an overall growth revival, because as long as growth in India is muted and you're seeing superior growth in other markets, we don't necessarily see a reversal in FII flows.
Ashi, you know, the markets have not done much in the month of May, but have you made any changes to your portfolio? There has been a lot of sectoral churn that you continue to see all through last month.
Yes, so we have made, and we made quite significant changes. I think one key thing is that we have generated a certain amount of cash on the portfolio. There continues to be a lot of uncertainty around what's happening with the whole US, Iran, and the Middle East crisis. With oil kind of around $100 per barrel, you clearly have inflationary pressures, pressure on the rupee, etc. Until there's not clarity around some kind of a resolution towards this particular crisis, we probably want to stay a bit defensive, and that's kind of reflected in the fact that we currently hold about 7.5% to 8% cash in our portfolios. I think the other key, we have also moved sectors around a bit. We have largely gotten out of our exposures in both IT services and real estate. And one area that we have been quite increasingly deploying capital towards is capital goods companies that are part of the global electricity supply chain. There is going to be an explosion in demand for electricity because of new age AI data centers. And we're trying to kind of identify companies in India that are actually parts of the value chain of some of the major global MNCs, such the likes of GE Vernova's, the Hitachis, Mitsubishis, etc. So we're kind of trying to play that value chain. We've built up about 10% of our portfolio in such names. We're also building out certain exposures towards the whole GLP-1 theme, as well as selectively in certain parts of the consumer value chain.
Okay, consumer, pharma, capital goods is something you're putting money into and taking it out of IT and real estate. Ashi, almost 8% cash that you're sitting on, what will get you to deploy it? I mean, is it just the end of the war? Will that turn sentiments, or, what will really get you back on the table?
So just on a lighter note, Trump has kind of promised a deal by the weekend. So, but any kind of clarity on a deal, right? I think what is extremely important from our perspective is you need to have ships flowing through the Strait of Hormuz. If you don't have some kind of a let up in terms of allowing the passage of vehicles through that strait, I think you are going to see some further upsides on oil prices. And the problem is it's not just prices. You're also going to have availability related issues. If this crisis were to actually prolong, we would actually expect further downsides in the market. So until we don't see some clarity specifically on US-Iran, the Indian economy is quite exposed to oil prices. Every $10 increase has a 35 basis points impact on our trade deficit, about 25 basis points impact on inflation. We are already up $30 from where we were prior to the crisis. So we really need some resolution here. And until we are not getting a little more confident about some kind of a resolution that may last, we will probably maintain a defensive stance.
Ashi, pleasure having you today. Thank you so much for sparing time and joining us. Looking forward to the next conversation. From the sidelines of the City Conference, my colleague Yash caught up with the founder and chairman of Dixon Technologies, Sunil Vachani, and here's what he had to say on the potential JV with Vivo, the approval for which is awaited.
I don't want to talk about a specific case because this particular case is lying with the government, the central government. So, I won't want to get into the details. But I think in short, I would say that, we are told that, yes, this is under active consideration. And hopefully we should be getting some news on this very, very soon.
Just to close the loop on partnerships, as you mentioned, one thing as far as the partnership with Vivo itself is concerned, there were certain reports which suggested that the agreement time period expires in May, and if the government approval does not come by then a refiling or restarting of that approval process has to be done. If you could give some clarity on that, if it indeed is that process. And the second question, what are the new partnerships going forward in FY27 that you're looking to make, both on the international side as well as the domestic side?
So see, as I mentioned, I'm not going to comment on a specific case because, as I mentioned, this is already lying with the central government and we're hopeful of getting the approval soon. Talking about some other partnerships, I think what we're really we're excited about all our partnerships. But as I mentioned, the industry that we're also excited about, besides the other industries verticals we're already in, is the IT hardware space. And we have entered into a collaboration with one of the leading Taiwanese companies, which is the global leader in IT hardware as well as servicing the requirements of data centers. And this factory hopefully should be which is being set up in Chennai. This factory should be ready in the next 8 to 10 months. And we are hopeful that once this plant is operational, we'll be able to cater to the requirement of the data centers coming up into the country. And also, we would ensure that the products which are getting imported into the country, like laptops and AIs on desktops, those start getting manufactured in the country, and the value addition, which is very, very low, starts improving in the times to come.
All right, that's the Dixon chairman, hopeful of the JV with Vivo coming in soon. And on that note, Hormaz and I are going to take your leave here on Trading Hour, but stay with us. Halftime report will take all the action forward.
Stocks see a cautious trade as uncertainty over West Asia conflict lingers. Industrials and utilities eke out gains, while IT and metals drag.
The centre is likely to waive 20% withholding tax and 12.5% capital gains tax for foreign investments in India's government bonds. Sources tell CNBC TV 18 an ordinance may soon be issued on this to aid foreign inflows into government securities amid rupee weakness.
SEBI has issued an interim order against Rajesh Exporters and its promoter Rajesh Mehta for overstating revenues by 15 trillion rupees, falsifying accounts and diverting funds in what stands out as a classic case study in corporate fraud.
Harvard professor and former IMF chief economist Geeta Gopinath says that India is losing out on FPI investments as it lacks an AI story. She adds that propping the rupee can be self-defeating and there is no reason for RBI to hike rates.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Putra as well as Vinny Motiwala. Well, it is turning out to be a session where we are seeing some amount of consolidation in today's trading session for the frontline indices, but there is some amount of momentum for the broader markets. But let's see whether today is a day where we manage to sustain from the fresh intraday lows that we have been making in terms of the Nifty, at least for the past couple of trading sessions. To put it into perspective, the Nifty has formed a clear lower low pattern for the last 7 trading sessions, and the numbers should come up for you. For example, the intraday low on the 27th of May was around 23,858, and on June 3rd it stood at around 23,227. So that's the kind of pattern that we've been forming. June 2nd and June 3rd are lows that were almost identical, indicating that maybe that could be a key support level, which could be emerging at around 23,225. But what stands out today is that today's intraday low is 23,247 till now. So let's see whether we manage to stabilize at these levels and not make a fresh intraday low that we have been doing in the past couple of trading sessions. So let's see. As of now, it remains above that June 2nd and June 3rd intraday low levels. And maybe today could be a better day for us.
Let's see which way things go. As per the charts, 23,100, 150 continue to be very important support levels. We have recovered sharply from the lows of the day by around 180 points and then came off again from the highs of the day. But you know, when we've been seeing it since last 2 days, during halftime report around 12, we see that massive recovery.
Right, for the bulls to come in.
Exactly. So we'll have to see whether that happens today or not. We've already seen a recovery which is getting sold into. So continues to be very volatile, continues to be consolidating at the 23,400 mark, and today more gainers versus losers, at least if we talk about the sectoral moves.
Absolutely, more gainers versus losers in terms of the sectoral moves. So first up, talking about those gainers, energy pack, FMCG, autos are the top gainers, while in terms of the losers, we have IT and metal that are down and out in the trading session, 2/10 to 3/10% of decline for IT as well as metals. But we have a very exciting lineup for you all on the show today. First up, we'll get you an exclusive conversation with Jane Fraser of Citi from the sidelines of the Citi India conference. Also, we'll line up some excerpts from our interview with Geeta Gopinath and former MD as well as chief economist at IMF from the Citi India conference. In our commodities corner, we will have a conversation with Amina Bakar of Kepler joining us, and Catherine Chen of Binance will connect with us on the latest trends in the world of cryptocurrencies. So stay tuned in for that in our Crypto Corner segment. And in our Movers and Shakers segment, we will focus on Idea Forge, Hero Motor, JBM Auto and other big movers in trade as well. Now, that's what we have lined up for you all on the show. As of now, markets obviously have recovered from the day's low, but we'll see where that's going to be headed as well.
Yes, absolutely. So that's the texture of the market at this point in time. But the markets might be consolidating with a little bit of a positive bias. The broader markets might be doing better, but stocks continue to be in focus. And this is our Movers and Shakers segment, where we track a whole host of stocks which are buzzing in trade. And first up, Vinny, you're looking at the power equipment space. Citi's come out with an interesting note.
Absolutely. And they've initiated coverage on some of these names where you've seen such a good rally coming in. They've initiated coverage. They're still positive on some of the names. So first, what is the story behind this energy transition that's taking place, right? We had the CEA who's given a target also of that what they are focusing on in terms of the transmission plan is of around a 7.9 trillion rupees transmission plan that they have. That is around 900 gigawatt of a renewable integration. This is by FY36. That means multi-year orders that could come in or opportunities that could come in for HV and HVDC transmission infrastructure players. All of this, the whole chain, the whole value chain starts benefiting from this. Now, obviously, domestic demand focus on energy transition, that means grids are required. When grids are required means you'll see global T&D capex cycle that is also coming in for Indian players as well as global players, and that is positive for whether you look at the Hitachi Energy, Siemens Energy, GE Vernova T&D, CG Power. All these are the names that they've spoken about. Now, what does Citi like specifically? First, they like Hitachi Energy, GE Vernova T&D second, CG Power, and then Siemens Energy are in their list of focus areas. Specifically for Hitachi Energy, they said that obviously Hitachi Energy is that market leader in HVDC, HV projects, right? They have a high probability of winning more orders in the HVDC side because of this energy transition. They're expanding their capacity. They're looking at more market share as well. Significant in terms of long-term growth opportunity is what they're talking about. GE Vernova too has spoken about strong HVDC projects, export exposure. They have medium-term outlook is positive. That's why they like this one. They've initiated coverage with buy rating on both these stocks. Similarly for CG Power also, it's a buy rating. And you've seen for Siemens Energy, they're keeping a neutral rating as well, Sonal.
Okay, all right. So that's about the power equipment space. A lot of these broader market movers continue to be on our radar. And of course, we'll toss across to our colleague Lata in just a bit for that mega exclusive conversation from the Citi India conference. It'll be with Citi's chief, Jean Fraser. So just awaiting a word from them. But let's do one thing before we go to them. Okay, Lata, I'll just check with Lata if we can go across to her for this conversation. Lata, over to you. Okay, okay, all right. We'll go to Lata in just a bit. But before that, quickly taking a look at what the markets are doing at this point in time. We do have the energy space, which continues to do really well. So the Nifty Energy is up around 0.8%. The mid-cap index is where there's a lot of action and a lot of moving parts as well. So that one is in favor of advances as we speak. Idea Forge is one of the stocks which is in focus on the back of fundraise. But before we do that, let's go across to Lata for this conversation.
Welcome to this very important CNBC TV 18 conversation, perhaps the most important we have had in a long time. My guest is the Chair and CEO of Citi, Jane Fraser. Jane, thank you very much indeed for joining us.
It is an absolute privilege and joy to be back in India again.
Well, I should have introduced you as not just Chair and CEO of Citi. I should have said I'm speaking to the most powerful woman in business, voted by Fortune magazine. Many congratulations.
Oh, thank you very much indeed. That was certainly one for the team.
Okay, of course it's for the team, but I just wanted to ask you, let me start there. Do you owe this absolute honor to all the travails you went through, rising, breaking all glass ceilings, or do you owe it to what Citi has just, accomplished? Highest revenue growth in 10 years?
I think it's a combination of a journey which many of our colleagues have gone through around the world, including here in India, and then delivering the results from it. Although we're at a waypoint, we're not at the final destination as a firm. But I think it's a recognition that we now have a new Citi. We have transformed ourselves, but we're now demonstrating what we can do.
Okay, that's good to hear, and of course I'll have more questions on that. But you have an Indian audience listening to you. So, we are in a bit of a despondent situation now with 2 years of stock market index falling. So we are in correction territory. The currency has fallen for 2 years. What is your sense about what you're picking up from your corporate clients and investors about India? Is it time to join the crowd, to bung in? What are you listening?
What I see in India, there was a discussion I had with Prime Minister Modi yesterday when we met him for nearly an hour, is that the long-term story in India is intact. And I certainly saw as well in him commitment to reform agenda, very thoughtful around energy security, looking at driving digitization and the potential of AI for the country. So while there are headwinds, I'd note that the headwinds underlying some of the foreign exchange in the market are the same ones that the rest of the world is facing. They're not of India's doing. We're all facing some of these challenges. And I think for investors and for companies is play the long game, because that's where really the strong fundamentals lie.
Yes, there are some fund managers who are still sticking because they're playing the long game. But just any time now, it's possible that the Indian government will remove the taxes, withholding tax and capital gains tax on debt investments coming into India. You think these things will move the needle? And
look, I certainly think they will be helpful in easing some of the short-term headwinds that are being faced. But again, you look at the stock market here, a little bit of victim of one's own success. You know, the India stock market has been incredibly vibrant for a long time. The retail investors have been very active. You want the retail sector invested not in deposit accounts, but in the markets and investing for the long run. But the valuations are higher here than in some other countries. Some of the private investment has been lower on the FDI side, as well as lower on the private capital and the corporate side. So the growth drivers are a little less clear in the short term. The long-term ones, this train keeps on moving. I see it in Citi's own results. I mean, we've got tremendous growth here, connecting India, the world, and the world to India, and that's why you hear me convey such confidence about this long-term story is intact.
I will come to the Citi India questions as well, but sticking with markets, just the other day, Jamie Dimon was telling on CNBC that there is exuberance. Would you say US markets and some of the markets are in irrational exuberance terrain? Are they looking through too many of the red flags in terms of crude oil or possible, over-investment in AI? Do you worry over leverage of governments? Do you think they are not bubble terrain but irrational?
I think they're a tad optimistic, if I could use some British understatement there for the moment. I think there's a lot of money in the world. That money wants to go to work because it knows that creates value, it can drive growth. But, and there is a lot of transformation going on, so there is also a bit of a fear of missing out in a lot of what's going on. But I do feel as if the markets think everything that can go right will go right, and that companies who've done a fantastic job of being the source of resiliency, being so adaptable with everything that's been thrown at them in the last few years and have continued growing, there's a sense that just continues to happen. And at some point something gives. None of us know when, and anyone who said something was going to give 2 years ago got that wrong. At some point, inevitably, there'll be further bumps in the road and maybe some more dislocations. But again, I don't think the AI investment is overdone.
Oh, okay. I'll come back to that point as well. But speaking of AI, actually, there are programs or languages like Claude Mythos. Of course, you all have got an inside view, and now you're able to fix your bugs. But there will be zillions of your clients who won't get it. I mean, stock exchanges, shadow banks.
So that's actually
what happens?
That's actually not true. But what I'm seeing is the players that do have access to the model in the technology and in the different spaces. No one is competing on cyber. There is the different vulnerabilities that will be identified will then be patched for all. So the work that those who have access to the models is looking at identifying where they are, but the solutions will be available to all. So this notion of there's a zero-sum game here is wrong.
Okay. No, I agree. Yesterday, CrowdStrike also reported their numbers, and they are very confident of their cybersecurity answers too.
Yes, and the patches that will be delivered will be available to everybody, not just those with the model. So that I think is something people are missing.
No, I agree with you, but it's just a worry that some of us, even some of the Indian companies have got a look in with some Mythos being available to us. But there's just a worry that you may be lending money to people who perhaps are not up in the game, and the hackers get hold of Mythos before they get hold. Are these not worries? Or am I overstating them?
What we encourage everyone to do is to use the AI models that are available for everyone to make sure that you are not only looking at how do you make your customer service better, how do you make your growth potential there, product life cycles faster, make your company more efficient, but you also deploy it defensively to identify where there are potential vulnerabilities and get them fixed, and to do so with urgency. Yes.
Fair point. That's what they ought to do. But there's a word more on AI before I move on to other things, macro and banking. Would you worry that AI, because of its ability to increase productivity, may lead to a world where more and more work is done by fewer and fewer people, and it's an increasingly K-shaped economy? Are there worries about our macros being, global macros getting too unequal?
So let's look at India. When I think of what AI could do in terms of healthcare, very positive. When I look at what AI could do, particularly on the back of the payments network that is here in India, enabling the incredible craftsmanship that women have, or their cooking abilities or others, to unleash more women's potential into the workforce as entrepreneurs, and create a whole new raft of economic growth potential, or for the young, the great leveler. Because one thing I look at India, and what it will not do is sleepwalk into AI. Right? This country and the people in the country are going to look at entrepreneurship opportunities, and I look at it and say it will unleash new growth that we haven't thought of, new opportunities that I hope will be much deeper in the economy than just the large corporates that are there. And I don't pretend that there won't be dislocations. That obviously we're all going to have to adapt. But let's put a lot of energy into where the new growth potential can be to counteract the area, make sure there are plenty of puts for the takes. It's got the potential for that.
Well, since you are sticking to India, let me ask about City India.
Yes.
This year, not this year, over the past 5 years, as part of your reorganization, you have sold off the consumer banking divisions in India and 13 other countries.
Yes, everywhere outside the States.
How has City India done? Have you been able to make up those revenues? Yes. Or you're managing with lower revenues here?
So we closed that transaction in India in the summer of 23. By March 25, which is when we last reported our results, we have seen a 35% growth in net income versus where we were when we owned the consumer franchise. Our revenues have grown 30% and our balance sheet 25%. And I think this is something that for all of us is to take confidence in the power of focus. We focus a franchise on clients who have cross-border needs, need to tap into global markets, and we made sure that we are excellent and in investing behind that and delivering that. And we've seen tremendous growth in the franchise here. We are still the most profitable foreign bank in India from the last audited results. So that is an example. Again, as economies get larger, like here, there is a lot of value from scale, speed, and focus, rather than just too much breadth.
Since you're speaking about reorganization of Citi under you, I went through your investor presentations, very interesting presentations. You're speaking about flattening of the levels, and you have, of course, rationalization into 5 major verticals. You have new platforms, technology. To which one would you owe, maximum returns, maximum bang for the buck?
I think what we did when we reorganized was we moved from operating like a holding company into actually at the center running the different businesses, making sure that we had enforced standards consistently across the firm, and we simplified the running of the firm materially, made it faster, more agile. Thank goodness we did in this world with everything that is going on. But I think it's the combination of all of them that increased the speed, the agility of the firm, made it easier to connect, made it easier to run, and therefore we could drive the results for our clients and get the financial benefits of the back end. So it was the combination. I wish it was only one thing, because that would have made it much easier.
No, I agree with you. I mean, flattening. I was very impressed by the flattening of levels. Yeah. There are some new age companies which have even flatter, levels.
But don't operate in 180 countries, though.
That's true. That's true. Coming back to again the reorganization itself and your investor meet, your investor day. In your presentations, you said your ROTCE. I mean, for my viewers, return on tangible capital employed. You've reached 13% and you're promising 14 shortly. There is a view among the analysts that you're probably under-promising so that you will over-deliver. Is that fair? I mean, should we expect an upside surprise?
Well, the 13% we delivered was in the first quarter. That's always the best quarter of the year, and sadly, one quarter doth not the full year make. So we still are very focused on making sure we deliver the returns we promised this year for the full year, 10 to 11, and that we continue the journey. We're at a waypoint, we're not at a destination, and there is a lot of upside ahead. So we look at that. But at the same time, we want to make sure we're investing. So I want to make sure there is capacity in the results we deliver the shareholder, that I'm not cutting off my nose to spite my face, as it were, by hitting a number, but without doing the investments that will continue our growth trajectory in the medium and long term. So that's essentially the message that we were giving, is we will deliver what we need to deliver. We will improve our returns and continue steadily improving our performance, but we're also not going to sacrifice the long term for the short term. Citi's done that once before, it's not happening again.
Fair point. And it's really candid of you to say that the first quarter tends to be the best quarter.
Yes.
The other problems with the forthcoming quarters is also that the impact of the war is going to be felt in some of your major areas. For instance, in Asia itself. Would you say the returns would be lower because, countries like Philippines, India, we all are belaboring under higher current account deficits. Would you worry, or do you still think corporates there are still resilient, even if the countries are not, as you once put it?
Look, I think companies are very resilient, they're very adaptable, and that's why we've seen a lot of buffers in supply chains, energy storage, etc., to protect against disruptions. But I have a lot of concern and empathy for the countries that are, have more challenges and don't necessarily have the scale that an India has, and also the government here. I was very impressed with Prime Minister Modi yesterday, how thoughtful he is about energy, the actions the government will take. And has done already. I think similar to COVID, there's some confidence in that. But not every country will do so as effectively. So I worry about that for them. I don't worry about it for our bank, because we are the source of resiliency for those companies. We have a very strong balance sheet, strong capital, strong liquidity. We're there for them to provide financial resiliency, and we're there to provide operational resiliency, helping reconfigure supply chains, look how do they access what they need, onboarding new suppliers onto them and making sure their working capital and their hedging is there to protect them. No. So we not only like investing and helping our clients grow and succeed, but we also help make sure that they can do so when there are challenging times, and provide them the support that's required.
I'm asking you this question from a city.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is managing to hold on to 23,400 levels. Not much of an up move that we're seeing from when we started the show, but still holding on to 0.1% of the gains. IT still continues to be under pressure in today's trading session. Banks doing well. Nifty mid-cap also managing to hold on to gains. But on that note, let's also bring on board Nigel to take us through what's happening in the world of F&O. What are we keeping an eye out on? Afternoon, Nigel.
Afternoon. Well, we've seen a good bounce from the day's low, which is encouraging. And like we saw yesterday, the one that's really leading the fight back is the Nifty Bank. And it's reached a very, very crucial juncture. The 20 as well as the 50 DMA, they should come up for you in the screen. So after this big recovery, it's back in line with where that 20 and 50 DMA. In fact, in the last few minutes, I think it's just managed to conquer the 20 DMA. Can the Nifty Bank drive home the advantage? If that's the case, it'll help the Nifty's cause because that's clearly looking like the index that wants to bail out the bulls in yesterday's trading session as well as today. Looking at the options data, 23,400. That's the strike that's very, very active, both on the put as well as on the call side. And for today's trading session, there is a fair bit of writing on both those two strikes, which means writers of the 23,400 put as well as call, the premium on both of them are down. On the put side, the premium is down to around 130 bucks from around 150 bucks. And on the call side, from around 250 bucks yesterday, it's down to around 200 rupees or thereabouts. So writing on both sides, let's see which way the markets are going to swing. But for the timing, it appears we're in this 500 to 600 point range. And in terms of levels, today's low becomes a reference point just for today. Now, the 23,250 mark, very, very important. In the past, we've seen when the markets go to the vicinity of around this 23,200 to around 23,250, we have seen a bit of a bounce. However, resistance comes in at around the 24,600 mark, which is incidentally where that 50 DMA comes in at around 23,650 or thereabouts. Individual stocks that are coming up for you on the screen. There were shorts getting piled in into Inox Wind. That's coming for a nice short covering bounce in trade today. And Trent, the stock that has gradually been seeing some long build-up. There were a couple of upgrades that came in from Nuvama as well. Gradually, we are seeing some kind of unwinding of those long positions in trade today. And the stock that's really moving well is Nippon Life. Just take a look at that stock. Open interest up more than 10%, and you have the stock that's up close to 3%. Indications that there is fresh buying out there. It appears the structure is a little bit punctured, but the bulls are looking to fight back. I think the Nifty Bank, that's the one that takes home the advantage for the bulls if in case they need to fight back from here on. Back to you guys.
Okay, all right, Nigel, thanks very much for that. So that's the update coming in terms of the F&O setup. But we have Manish Hathiramani, who's joining in to discuss the technicals of the market this afternoon. Manish, hi, welcome to the show. Well, the Nifty is showing a good amount of resilience as compared to, the last few days where the intraday Nifty low had touched levels or even tested, 23,200 odd. So what is your sense in today's trading session? Would you take positions on the longer side?
Good afternoon, Ekta. Thank you so much for having me on the show. Well, 24,600 continues to be a stiff resistance on the upside, and we actually turned from that level. But we've not had a defined breakdown thereafter. It has been indefinite. There have been bouts of sideways movements. In the current scenario, if I was to speak, we have a support around 23,150 to be precise. And if we close below that level, we can slide further down to 22,800. Keeping that intact, the upside resistance continues to be capped at 24,600. If I was to look at the Bank Nifty, 52,700 is a good support for this index, which also coincides with the lows of 18th of May. The upside resistance is now capped at 56,150.
Okay, so important levels on the Nifty is at that 150 mark. We get that, Manish, in a market like that, what would your individual picks be? Is it again on the higher side? We are seeing one way up, one way down every day. What do you suggest here?
Sonal, because the upside is capped, I'm slightly biased to the downside currently because that seems to be more open for the time being. I'm working with two sell calls. My first sell is on Ultratech Cement, which is for a target of 10,850, stop loss of 11,800. This stock has broken the support of 11,500 on very high volumes. 10,850, 10,900, these are plausible targets on the downside. If we break 10,850 on a closing basis, we can even slide down to 10,650. Since risk-reward ratios are not favorable on this one, we can probably short if the price goes up higher. The second sell is on Reliance Industries for a target of 1280, stop loss of 1330. This stock has resisted at 1375 and then it resumed the downtrend again. Between 26th of May and 29th of May, we noticed some patches of high volume, which is also with a declining price action, and therefore that's a negative indication. The stock has also disrespected the intermediate lows of 1312, which was recorded on 20th of May.
Okay. Manish, we have a couple of queries that have come in as well. This first one is coming in from Boni Mahendru, who's writing to us from New Delhi. He's holding 100 shares of JBM Auto. This is at a price of 300 rupees per share. He's asking whether to hold or exit the stock. Obviously, they're making a profit on this one, but you heard the announcements that came in from the cabinet side as well. What is your thought on this one? It's holding on to gains today also of 5%. What should they be doing?
What is the entry price for this one?
The entry price is at around 300 rupees. So they're making a good amount of profit here. Stock is currently at 700.
Well, I would suggest that he should take partial profits at the current levels, and then he should probably keep a stop loss, give or take, at about 625 to 630, where we see the next bout of support.
Okay, so partial profits in this case. The other one that we have is from Utpal Srivastava, is writing to us from Chennai. He says he's holding some shares of Electra Green Tech and asks if he can add more shares. What do you suggest at these levels, 1346 on Electra? Can more shares be added? Not much detail on what price did he buy the older lot.
So we did have a resistance around 1295 and we have flown out of that on the back of good volumes. The stop loss can be kept below the levels of 1150.
Okay, all right. Any other stocks that you would quickly recommend? Just wanted your thoughts on a stock such as Idea Forge. They're considering fundraising. But the stock is risen around close to 90% or over that this year itself. Have you looked at it in terms of the technicals?
Yes, Ekta, there's been a fly-off all the way since we crossed the resistance levels of 400. Definitely not an entry at this point in time. If at all the stock is meant to move higher, I would be more comfortable buying when it claws back to supports closer to 700.
Okay, all right. Thank you, Manish, for joining us today. So that's all about the technicals and individual queries being answered as well. But it's time for a break now. On the other side, Manisha Gupta will join in with Amina Bakro of Kepler. Stay tuned for that conversation.
Welcome back, and joining us now on the show is Amina Bakri. She's head of Global Middle East and OPEC Plus Insights at Kepler. Amina, hi, thank you so much for joining in. As the days have passed and we still are reeling under that West Asia conflict, the markets does believe that there is a real and then there's a perceived disruption. How are you looking at both of these?
Well, I'm having a lot of doubts. I mean, we're seeing daily headlines suggest that a deal is within reach. The latest being that President Trump said that over this weekend, he expects a deal with Iran to materialize. But at the same time, I mean, we need a deal to materialize in reality and to have an actual impact on the reality that we're living. And that includes the reopening of the Strait of Hormuz. That includes a real stop to the attacks. As you saw yesterday, there were a number of attacks from Iran on Kuwait, Bahrain. So all of this is like on the ground, not translating. And the market seems to be still believing the headlines that a deal is within reach. Personally, I think we're still in a stalemate situation.
I mean, how are you also looking at the real-time shipping numbers therein? Because we still do understand that it is about 8 to 10% of before conflict numbers.
Yeah, and sometimes it's even lower than that. We're still, I mean, kind of the average on a daily basis, it's still in this kind of single digits here. We're not seeing a major pickup in traffic. Overall, I mean, we kind of had a look at the trend since the beginning of the conflict 3 months ago until now. About a third of the vessels that were kind of trapped in the Gulf managed to come out. But you would also need, I mean, these vessels to return back in and load. So I would say we are still very far away from a normalized scenario. There are still questions over whether or not there are mines in the strait and how long it would take to remove those mines, and questions over, I mean, Iran's intention to impose, they're not calling them tolls anymore. They're calling them an environmental fee, a security fee. And this is something, again, that's not accepted by national oil companies in this region, and it's not accepted by international companies to kind of interact with the IRGC.
Oh, absolutely. I mean, we've been talking to a lot of people who are giving us a best case scenario that if there was a deal tomorrow, it would still take 6 to 8 months for the markets to see some kind of a normalization, with the fact that there are mines that have been laid out by Iran as well. What is your best case and a worst case scenario with this West Asia conflict?
Well, I would say it's a kind of realistic scenario to assume. I mean, if there are indeed mines, and it's hard to understand where they're laid, how they're laid. According to at least the U.S. assessment of the situation, they said it would take around 6 months to remove these mines. And I think we need to return confidence back to vessel owners, and they need to, have the confidence that there are not going to be any kind of attacks. For now, they're saying, I mean, vessel owners that I've kind of asked are saying that they're not receiving threats through the radio from the IRGC. So this is one step. But still, I mean, having an active conflict means that their vessels and their crews are at risk. That's why they're not leaving. And I agree with the fact, I mean, a realistic scenario, let's say, if we do have a deal today, you need, first of all, to clear the number of vessels that have been blocked in the Gulf. They need to go out, they need to unload, and need to go back again. And then you need the restart of production from the Gulf states. And some of these countries, you need 3 to 4 months and even longer to reach pre-war levels. So we might be talking about a recovery that won't happen before next year, Q1 next year, or even Q2 next year.
Do we have a sense, Amina, of how many ships are still stranded at the Strait of Hormuz?
Well, I mean, if we had maybe like, we already said like around a third of them left, but still you have, I would guess like 100 plus. I haven't checked the exact numbers, but we do still have a large number of vessels still stuck. And I mean, loading activities obviously are not happening in the normal sense. We've seen some of the vessels that have been involved in exiting the strait have been kind of forced to go dark, meaning their AIS is off. Some ship-to-ship transfers of products have been happening. So I mean, we're not at a stage to say that we've resumed or even recovered from the war, from the conflict, or the restraints that Iran is putting on the strait.
Oh, I get that point. I mean, how are you also looking at the demand reversal is something that the street is working with right now, because the Chinese numbers have declined quite sharply. Is that what is, in some sense, balancing the global supply-demand situation right now?
It's absolutely balancing. I mean, if you look at an organization like OPEC, for example, who are traditionally known to balance supply, I think what China is doing here is trying to balance demand. And we have seen that Chinese imports have come down something like 3.5 million barrels a day year on year. And that's overall helping prices from kind of spiking above levels that we're seeing now and manage the overall demand. But that's not to say that the Chinese are not withdrawing from their SPR. They are still withdrawing from their SPR. So they're making up for some of those volumes. And whatever action that China can take is only a temporary measure, because after a while, I mean, you are going to be eating into those stocks. There is no reversal, no matter how much oil you're getting from alternative sources, either Venezuela or the US or Brazil or so on, that can make up for the shortage. So I think we have a kind of small window here where we're still talking about demand erosion and not demand destruction. But if we move past that 6 months of the strait being closed, we're in a territory where you are going to see demand destruction.
I mean, a final one. You have a sense on prices here? Is there a range you're looking at for crude?
Well, I still think that the market is underpricing, and the market is really considering that a deal isn't within reach. And that's why, partially also why we're seeing prices at that level. But given the fact that the strait is still closed and I don't see something in reach, and I'm still seeing, a delay in the normal supply coming back to the market, I do expect prices to remain definitely elevated for this year, but even going into next year, I wouldn't be surprised to see the kind of the 90s level being maintained.
Okay, take that point. Amina, thank you so much for joining us with those insights. As IEA chief also said, it's naive to believe that supply will come back the same way it was pre-war. So a lot happening here. Thank you, Manisha, for taking us through this important conversation. Time for a break now. On the other side, Manisha will join us back with Catherine Shen of Binance to put the spotlight on cryptocurrency. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Joining us now is Catherine Shen. She's head VIP and institutional at Binance. Catherine, hi. Thank you so much for joining in. You know, the institutional investors, which have been skeptical of crypto just a few years ago, are not so anymore. I mean, the last 1 year has seen US very strong numbers coming in there. What has really changed, and what are you seeing in terms of adoption coming in from institutions?
We are seeing the industry slowly maturing, and we are seeing much more diverse and much more traditional finance institutional investor slowly coming in from different aspects. Some might be for their own investment asset allocation. Some might be acting as a institutional intermediary that serve their end user, who all wanted to essentially participate in the asset class. In Binance, we are also seeing institutional users adoption continue to grow. The trading volume, obviously, Binance is an exchange. Trading volume is one of the very important thing that we look at when it comes to institutionals' activity level. Year on year, this number has grown by 21%. We are also seeing increase of institutional investors registration with our platform that is growing by double digit as well. On OTC side, and OTC is traditionally a service whereby it's generally used by institutional investor who expect high touch service and really execution services to help them with some of the more sensitive deal or larger transaction. On OTC side, we are also seeing the fiat transaction that has grown by 210% year on year, and all these really signal the fact that we are seeing an accelerated institutional participation.
Catherine, also, when you look at the Indian markets, we rank 1 in global in sense of adoption. That's largely retail driven. Why hasn't Indian institutions followed what would need to happen, for family offices, asset managers, corporate treasuries, all of that? When do you see their money getting deployed in crypto?
Yeah, so I think you're absolutely right. Indian retail market is absolutely the adoption is definitely rank amongst the top around the globe. I would say though, a very balanced framework really needs to address a few things in order to make sure that much more meaningful adoption, and this is especially relevant for institutional adoption, needs to happen. First and foremost is probably a more friendly tax framework, whereby it really look at much more of the realized capital gain and have the loss offset to ensure that the tax system is more sustainable and really makes sense for people to still make meaningful participation. Generally speaking, across the globe, this is one thing that we have seen with much clearer regulatory framework. Obviously, it's always good. However, it is also very, very important that the framework strike a balance such that it continue to encourage a variety and a range of activity across trading, across investing, and also, generally speaking, a clearer local regulatory framework that clearly lay out the licensing requirement, the AML reporting requirement, all these standards. If they are clearly set out, then it allows much more clarity for both, not just the crypto native providers such as ourselves, right? It would then finally allow the local market participant, crypto native or TradFi alike, to seriously consider an effort into essentially expanding into the asset class. If a regulatory framework is unfortunately not very friendly, or unfortunately, place a huge burden when it comes to tax duty on the institutional investor, then in the end, for many people, it is just a return on investment of their time, right, and effort into expanding into an asset class. So those are the few points that I feel very much important, right? I understand that the current framework, including the transaction level TDS, and also the limited loss set off, those were all things that are placing additional challenges for meaningful institutional participation.
All right. A final question then. And when you look at the next couple of years, Catherine, where do you see institutional crypto going? What should investors be watching out for as a signal in this very fast maturing market?
Number one, crypto as an asset class is maturing. Crypto exchanges such as ourselves, similarly, we are also going through this convergence phase. Most recently, obviously, Binance introduced a range of TradFi instrument, and very, very quickly, we are seeing the like of gold and silver that is available as a trading instrument under perpetual futures, very, very rapidly growing. Right. And so from my seat, I definitely see that the convergence will continue to happen. Crypto as an asset class come into cycles. Right now, we happen to be going through a cycle whereby traditional equities are going through extremely strong momentum. And as a very fast moving platform, we are obviously also very quick, thanks to the global license that we have, in essentially delivering much more offering to our users.
All right, Catherine, that's a long list of products that you're planning for with Binance globally and for Indian markets as well. Thank you so much for taking time with us today. And with that, let's go for a short break. More markets and stock specifics on the other side.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, Nifty continues to defend that 23,400 marks. It'll be important to watch out for this level today. A lot expected ahead of the RBI policy meet outcome tomorrow. A lot of commentary updates as well. So we'll keep tracking that for you. The mid-caps are outperforming, and so is the auto and royalty pack. But with that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.
Stocks continue to see cautious trades as uncertainty over the West Asia conflict continues to linger. Industrials and utilities eke out gains while IT and metals drag. The centre is likely to waive 20% withholding tax and 12.5% capital gains tax for foreign investments in India's government bonds, according to sources to CNBC TV 18. An ordinance may soon be issued on this to aid foreign inflows into government securities amidst the weakness in the currency. SEBI has issued an interim order against Rajesh Exports and its promoter Rajesh Mehta for overstating revenues by around 15 trillion rupees, falsifying accounts and diverting funds in what stands out as a classic case study in corporate fraud. Harvard professor and former IMF chief economist Geeta Gopinath says India is losing out on FPI investment as it lacks an AI story. She adds that propping the rupee can be self-defeating and there is no reason for the RBI to raise interest rates. And Citigroup CEO Jane Fraser says that AI investments are not overdone and she sees potential for its use in several spheres like healthcare and payments. She expects Indian entrepreneurs they will unleash the AI potential soon. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Fatakia, and unlike the last couple of days, there has been no significant action in the market at 12:30, and the index continues to remain in a very, very narrow range as we speak. Today, of course, being the Sensex weekly expiry as well, and it's been a 150 odd point range on which the index has managed to play itself in today's trading session. The good part, of course, is the fact that the streak of lower lows that the index had been making over the last 6 sessions, that has been arrested for now. We have managed to defend yesterday's low of 23,151. Today's intraday low is higher than yesterday's low, so we'll be making a higher low today, at least as of now, as we go into the last couple of hours of today's trading session. But well, the index, it's absolutely listless right at this point. ICICI Bank contributing to the gains, and all of those gains are being offset by Reliance Industries and Infosys. So if there is a gainer, there is an equal contributor on the downside as well, as you can see in this contributors list, be it ICICI Bank versus Reliance, M&M versus Infosys, SBI versus Bharti Airtel as well. So it remains to be seen whether there is any significant market moves as we go into the final hour of today's trade. But of course, the market is awaiting some tax rule changes for foreign investors investing in government securities. Let's go across to Sapna Das for what she is picking up from her sources. Sapna.
Well, surely, Hamas, as everybody has heard and widely expected, I think market participants have also had this demand for a pretty long time. So, given to understand that in yesterday's cabinet meeting under the leadership of the Prime Minister, Mr. Narendra Modi, I think some very significant decisions have been taken in principle. Basically, doing away with all taxes as far as FIIs are concerned and their investments in government securities. It's very specific government securities. So, basically, 2 aspects here. Number one, of course, is the withholding tax. And as I just said some time back, this demand has been there for a pretty long time that this 20% is extremely steep. Either it should be reduced considerably or it should be done away with. So, probably in principle, a decision has been taken to do away with that. That's one. Second, of course, would be the ITCT, 12.5% cap gains tax on their investments in G6. Given to understand that too is going. And apart from this, if there's any other taxation to do with FIIs regarding their investments in government securities, all of that is going to be zero. That has been we very clearly understand that for now. So just have to wait and watch and see how this really pans out. The implementation process, of course, there's every likelihood of an ordinance being issued. Down the line, when the monsoon session, the parliament meets, most likely the government will take back the ordinance and bring amendments to the IT law. But in the meanwhile, it can be done in this way. And we have to now just wait and watch and see when that ordinance comes and what is the implementation time.
Sapna, thank you for that update there. Earlier in the day, we spoke to Nirmal Jain of IIFL Finance, and he said that a reduction in the withholding tax is the need of the hour and the government is doing the right thing at the right time. Listen in.
I think there's need of the hour because there has been significant outflow on capital account by way of equity and even FDI selling. So what maybe we need to do, we need to be competitive vis-a-vis other countries that are attracting foreign capital. And withholding tax will be removed not only in government securities, but also in corporate bonds. So currently corporate bonds, if they get listed in GIFT City, then maybe there's about 9% withholding tax on the interest. If we have to be competitive, we have to attract capital, which is required for the growth of this country, then I think these taxes should be removed. They are not... Here, what we have to look at is not vis-a-vis the domestic investor, but vis-a-vis the destination of for foreign capital, how other countries are attracting capital, how easy they made it. So I think this is need of the hour, and our government is doing the right thing at the right time. I think the long-term capital gain tax that foreigners have to pay. There has been discussion around this. This has been mooted that that should be removed as it used to be a long back, and maybe the time horizon can be increased from 1 year to 3 years. That will be very good because equity investing is for long term. The long-term capital gains tax can be removed even for domestic investors.
Now, in a mega exclusive conversation with CNBC TV 18, Jane Fraser of Citi says that the long-term story of India remains intact. Speaking on AI, she also said that she is positive on what AI can do in the healthcare sector. Listen in.
The long-term story in India is intact. And I certainly saw as well in him commitment to reform agenda, very thoughtful around energy security, looking at driving digitization and the potential of AI for the country. So while there are headwinds, I'd note that the headwinds underlying some of the foreign exchange in the market are the same ones that the rest of the world is facing. They're not of India's doing. We're all facing some of these challenges. And I think for investors and for companies is play the long game, because that's where really the strong fundamentals lie. I don't think the AI investment is overdone. But let's look at India. When I think of what AI could do in terms of healthcare, very positive. When I look at what AI could do, particularly on the back of the payments network that is here in India, enabling the incredible craftsmanship that women have, or their cooking abilities or others, to unleash more women's potential into the workforce as entrepreneurs, and create a whole new raft of economic growth potential, all for the young. The great leveler, because one thing I look at India, and what it will not do is sleepwalk into AI. And I don't pretend that there won't be dislocations, that obviously we're all going to have to adapt. But let's put a lot of energy into where the new growth potential can be to counteract the area that make sure there are plenty of puts for the takes.
Now, Harvard professor and former IMF chief economist Geeta Gopinath says that India is losing out on FPI investment as it lacks an AI story. Listen to what she had to say.
In the case of India, I think the challenge is that because of what's happening in West Asia and the impact on oil and on gas and so on, that is a negative impact on the Indian economy. It's also inflationary, as we would expect it to be. But then you also have that on AI, the story is not positive. And therefore, that is reducing the amount of interest in terms of foreign capital in India.
Well, getting back to the markets then, is focus on Rajesh Exports. Market regulator SEBI has passed an interim order following its investigation on the company for a period of nearly 4 years. Yash is joining in with more on this. Yash, tell us more.
Well, this is quite a scathing order from market regulator SEBI, stretches across 109 pages. The two entities named in the order as notices are Rajesh Exports, the entity itself, and Rajesh Mehta, the promoter of Rajesh Exports. As far as the period of investigation is concerned, that's between April 2020 to March 2024. As I said, a 109-page order, about 14 to 15 different kind of allegations listed by market regulator SEBI, and substantiating all those allegations with large numbers in terms of misappropriation of funds and financials. But I would divide these large 14-15 allegations in 4 different areas. The first one, SEBI says that there's been a systemic failure on the part of Rajesh Exports to substantiate its financial figures. disclosures. Second one, non-availability of financials of Rajesh Exports subsidiaries and step-down subsidiaries. This is an important point because the subsidiaries and the step-down subsidiaries together contribute more than 95% of the consolidated revenue, and that's where misappropriation of financials seems to have happened as per SEBI's order. The third one, selective and incomplete disclosures by Rajesh Exports, and finally elimination of intra-group transactions to mask risk, entity-specific risks, cash flows and related party exposure. This is what market regulator SEBI has said. And just to give you one number, I mean the total consolidated revenue where there could have been some misappropriation of financials as per SEBI goes to as high as 15 lakh crore rupees between FY21 to FY25. So that's the extent that we're talking about. In terms of role of Rajesh Mishra, he's the promoter, executive chairman and director and the audit committee member, and SEBI says that the alleged violations could not have happened without his knowledge, consent and involvement of Rajesh Mehta. As far as the order is concerned, SEBI has barred Rajesh Mehta from buying, selling or dealing in securities of Rajesh Exports till further order, and Rajesh Exports will have to make a true and fair disclosure of its financial statements and related party transactions. This is an interim order because SEBI feels that the matter was very serious and some kind of stoppage had to put at this point. The investigations, of course, will continue and a final order will be awaited.
Yes, thank you for that update. And just as you were highlighting the details of the SEBI order, Rajesh Exports has put out a clarification as well, and they are mentioning that they are in receipt of the interim order from SEBI, and they have issued a 5-point clarification that this is an interim order and that there are no adverse conclusions. That's one. Their revenues declared by the company are correct, and that there is no overstating of revenues by them, and that there seems to be a communication gap and confusion between the SEBI and the company, and they are in the process of clarifying all aspects to the market regulator by submitting all the required and relevant documents, and they are confident that SEBI in its wisdom will clarify the situation and arrive at the correct conclusion based on the authenticated documents which the company is in the process of submitting. So there's a 5-point clarification that Rajesh Exports has issued, flashes at the bottom of your screens as well. You can find the entire story of what Yash just highlighted on our website as well on cnbctv18.com. It's a detailed explainer on what the SEBI order actually states. And Rajesh Exports, back in 2023, the stock price had made a record high of well over 1,000 rupees. Today, it finds itself at 100. Take a short break. More news and updates follow on the other side. Stay tuned. The market has taken a bit of a leg down while we were addressing the Rajesh Exports clarification before going into the break. The Nifty is now below the mark of 23,350 and there's been a 100-point fall from the highs of the day. At one point, the index had even dropped around about 80-90 points. So it's again starting to get a little choppy. Of course, today being expiry, that will definitely come into play as we wind down the trading session. But for now, the index is down around 60 points and it's the Nifty Bank that is yet again leading this leg down. 125 points lower now on the Nifty Bank. Still, of course, away from the lows of the day, but not at the highs of the day either. Now, on to updates then from West Asia. Iran's Foreign Minister Abbas Araghchi has said that no progress has been made in talks with the United States, although channels of communication remain open. Meanwhile, following Washington-mediated negotiations, the US says that Israel and Lebanon have agreed to a ceasefire. The deal requires Hezbollah to halt attacks and withdraw from southern Lebanon. CNBC's Dan Murphy joins in with the latest updates of the conflict.
Israel and Lebanon have agreed to implement a new ceasefire. The U.S. State Department issuing a statement after the trilateral meeting overnight, saying the ceasefire hinges upon a complete cessation of fire from Hezbollah and the group's evacuation from the South Litani sector in Lebanon. It comes nearly 2 months after both sides initially agreed to end hostilities, though both sides have exchanged fire since then. Just on Wednesday, Lebanon said Israeli drone strikes killed at least 6 people in southern Lebanon. And Iran has continued its strikes across the Gulf. Flights at Kuwait's International Airport were suspended for some time yesterday after an Iranian drone and missile attack. 1 person was killed and more than 60 people were injured. Iran's IRGC has denied the attack, saying it was actually caused by US Patriot systems. Kuwait Airways and Jazeera Airways have now since resumed flights. But the Israel-Lebanon ceasefire does remove a key hurdle in the Iran-US peace talks, and markets are now expecting more progress on that front. President Donald Trump spoke to press on Tuesday, dismissing the recent escalation between both sides and saying negotiations remain on track.
Because we took a strong action for a different reason. So they were reciprocating it.
Mr. President, can you explain why
the negotiation itself has gone very well, actually. Very well.
Mr. President,
it could happen. I mean, if it happens, and it might not happen, you know, who knows? But if it happens, it could happen like over the weekend.
President Trump also saying they are trying now to separate the Iran negotiations from Lebanon.
We're trying to separate it. I mean, you know, it's a very different kind of a thing. We actually spoke with Hezbollah for the first time ever. We didn't know they spoke. And they agreed yesterday they're not going to shoot. Israel's not going to shoot. We're just going to see. But I'd like to separate it. I'd like to have a separate thing because it is separate.
Take a short break then. More news and updates follow on the other side. Stay tuned. Welcome back. Now, the Monetary Policy Committee is set to announce its interest rate decision tomorrow, and a CNBC TV 18 poll shows that the street is expecting a status quo on that front. Ritu Singh is now here with more on to what to expect from the RBI tomorrow.
Well, the policy decision itself is unlikely to surprise. All of the respondents to the CNBC TV 18 poll expect the Monetary Policy Committee to leave the repo rate unchanged at 5.25%. Most believe RBI will continue to look through the first-round impact of the oil shock, but the bigger question is the signal that will accompany the decision. Now, 70% expect RBI to retain the neutral stance, but nearly a third are expecting a more hawkish tone as policymakers are grappling with a rapidly changing external environment. Now, since the April policy, crude oil prices have been well above the assumptions that were used by RBI in its forecast. At the same time, the rupee has weakened and global bond yields have also been inching up. And that is reflected in the expectations for the rest of the year. 7 in 10 now expect at least one rate hike in FY27, despite the current growth slowdown concerns. And that's a notable shift from the earlier expectation that RBI could remain on hold for an extended period. But that said, economists don't really expect any immediate action in June. Just 20% see a hike as early as August, while half believe any move will come only in October or later. They also expect RBI to acknowledge a weaker growth outlook. So 6 in 10 are expecting the central bank to lower the growth forecast from 6.9%. At the same time, economists also expect the inflation forecast will move up. 80% see the RBI raising it to between 4.7 to 4.9%, while the rest expect a revision above 5% as well. But the most striking finding from the poll is the shift in perceived priorities. Economists now see rupee stability and the external sector as one of RBI's topmost concerns. But despite this, they don't really expect RBI to tighten financial conditions immediately. 9 in 10 respondents believe the central bank will avoid signaling any withdrawal of liquidity at the moment and instead preserve flexibility because uncertainty is still high. Instead, they expect RBI to rely on targeted currency management tools. These could include foreign exchange swap auctions, measures to attract dollar inflows, support for hedging activity, and continued intervention in the money markets. But as for Governor Malhotra's commentary, economists expect a cautious tone overall, with emphasis on inflation risk, global uncertainty, and a data-dependent policy approach.
Ritu, thank you for setting that up for us. Now, former RBI Governor D. Subbarao believes that this time around the Reserve Bank should stay put on hold on rates, but hold a hawkish stance going forward. Speaking to CNBC, he said that a rate hike from the central bank is a possibility going forward. Take a look.
The Reserve Bank will have to do a very careful balancing act between checking inflation, supporting growth, and stabilizing the rupee. I would suggest that the Reserve Bank should be on a hawkish hold. The reason being that inflation today is still 4%. Yes, going forward there'll be pressure, but inflation today is still 4%. The playbook for central banks is to look through a supply shock. So RBI will keep waiting because even as I said earlier, the impact of higher oil prices is not passed through to growth. So RBI will be more data dependent. For now, they will pause, give a hawkish forward guidance that they're going to withdraw liquidity first before, and a possible rate hike is a possibility on the way forward.
And with that, we take a leave on this edition of Business Lunch. From me and the team, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, and with me today is Hormus Fatakia. Hormus, good afternoon. We recovered from the lows of the day, and again we're off the highs by around 100 points and below the 23,400 mark as well. We have been, at least the Nifty has been trying to defend that level, but that has not continued.
Not continued, and good afternoon to you as well, Sonal. You know, it's going nowhere, at least for now, for the markets, and that very famed 12:30 reversal that has happened over the last couple of days.
Can we take credit for that?
that's not happened today. Of course, the final hour of the final couple of hours actually of the weekly expiry today for the Sensex contracts, that will have part of its own as well. But before we move any further, here are the headlines that we are tracking at 1:30 this afternoon. Stocks see cautious trades as uncertainty over the West Asia conflict continues to linger. Industrials and utilities eke out gains while IT and metals drag. Broader markets outperform the benchmarks.
Board of Idea Forge clears plan to raise 500 crore rupees, that is via multiple routes. Stock hits 5% upper circuit.
The centre clears the decks for a 2-year clean mobility scheme in the national capital. A 9,500 crore rupee outlay to replace the old polluting trucks and buses with BS6 or electric vehicles. Beneficiaries JBM Auto gains. Class 8 truck orders post a steep rise following a 2-month decline. Shares of Bharat Forge also perk up as a result.
Market watchdog SEBI bars Rajesh Exports promoter Rajesh Mehta from accessing the securities market over allegations of financial misappropriation. SEBI also flags his substantial operational and financial control of company and subsidiaries. Stock hits lower circuit.
And Dixon Technology sounds optimistic over the potential joint venture with Vivo. Founder and chairman Sunil Vachani tells CNBC TV 18 that a favorable outcome is expected soon. Additionally, he says that the company will be able to cash in on the data center boom soon on account of its partnerships with the Taiwanese companies.
Okay, all right, those are the top headlines that we are tracking. Markets consolidating at the 23,400 mark. Mid-caps are outperforming in a market like today. So let's go across to our special segment, Mid-Cap Movers. Ria's here with us to take us through the mid-caps that are moving around in trade. Ria.
Well, yeah, starting off with the gainers first. Let's start off with the drone names. Paras Defense, Idea Forge, as well as Zen Technologies, all seeing a very big move in today's trading session after reports that India is likely to purchase roughly 20,000 crores worth of drones from domestic players this year. And on the back of this, all these drone-associated companies seeing a big move. And Idea Forge also on the back of the announcement of the 500 crore rupee fundraise. And apart from this, Physics Wala as well as Chem India projects also seeing very strong moves in today's trading session. Moving on to some of the stocks that have hit their 52-week high as well as their all-time high today. These include Chem India Projects, Minda Corporation, CG Power, Jindal Saw as well as Nam India. And on the flip side, if you look at some of the losers in today's trading session, there's Zensar Technologies, Misho, Newgen Software, Schneider Electric as well as Aether Energy, all trading with cuts of anywhere between 3 to 5%.
Misho is down for the 8th day in a row today. It's never seen that kind of a losing streak since its listing late last year. Ria, thank you for summarizing that for us. 254 was the post-listing high for Misho, now at around 168. Another 4% knocked off in today's session. Good time to get in Ruchit Jain from Motilal Oswal Financial Services for a quick chart check and some trading ideas as well. Ruchit, good afternoon. Thank you for joining in. Well, the index has managed to defend yesterday's low, at least if you could take that as a positive for now. But where does the index go from here? Do you still remain in the sell on rallies camp, and your stock recommendations as well for the afternoon?
Yeah, hi, very good afternoon. Well, the markets have seen a corrective phase from that high of 24,600, which was made on 21st of April. So 3 weeks of correction has been seen, but the good thing is that the major support, which is around 23,100, 23,000, is still intact in this correction. So now 23,100 is the 61.8% retracement of that entire move, which we witnessed from the bottom of 22,200. So it seems that price-wise downside would be limited from here on for the index as well. But yes, it needs to give a breakout for a resumption of the momentum, which is missing on the index, but not in stocks. You can clearly see that after making an all-time high in the Nifty Midcap 100 index, pullback towards 20 EMA was seen, and there we are clearly witnessing a good stock-specific buying interest. So I think that this is more of a time-wise correction on the index. 23,100 should act as a good support, and one can take some contra longs on some dip towards 23,200, 300. But your stock-specific mid-caps are likely to show a good outperformance.
Okay, so what are those stock bets for you?
Azad Engineering is one stock that we like and we have been recommending. The higher top, higher bottom structure is still there in the stock. In recent correction, the stock formed a support base around its 50 EMA and seems to have resumed its uptrend. So at current levels, short-term traders can go long on Azad Engineering with stop loss below 2080 for potential up move towards 2450 that we think. And second stock that we like from here on is Exide Industries. Recently, the stock has seen price up move supported by good volumes, and the bullish flag pattern breakout has been seen, which in technical analysis indicates an uptrend. So Exide Industries can be bought at current levels with stop loss below 385, potential up move towards 430 is seen.
Azad Engineering up 36% so far this year. The IPO price of 524, now well over 2,200 rupees. So one of the few successful IPOs of the last few years. Take a short break. On the other side, we'll be joined by Hetal Dalal to focus on Rajesh Exports on the other side. Stay tuned, and Ruchit, thank you for taking time out and joining in as well. Welcome back. The hot topic of the day has been the market regulator SEBI passing an interim order in the matter of Rajesh Exports on Wednesday following an investigation that lasted between the 1st of April 2020 and the 31st of March 2024. Now, the investigation was triggered after a shareholder complaint against alleged financial misrepresentations. Rajesh Exports reported consolidated revenues of around 15.45 lakh crore rupees between financial year 21 to 25. However, SEBI found that the key operating subsidiary Valkambi SA reported only a fraction of those revenues in its audited standalone accounts. The order has asked Rajesh Exports and its owner Rajesh Mehta to fully cooperate with the investigation procedure, produce documents and reply to explanations sought by the regulator within 30 days. Now, the company's promoter Rajesh Mehta has also been restrained from buying, selling or dealing in shares of the company directly or indirectly until further orders. Now, in a response to SEBI's order, the company has allayed concern saying that the revenue declared is not overstated. In fact, fact, the company has also said that there may have been some communication gap between the regulator and the company, but they will cooperate and turn in all relevant documents to SEBI as part of the probe. Now, of course, since this is not the first instance that something of this sort has happened, there are certain red flags that you can identify. Sonal, what are those red flags?
Well, the first one, of course, on the paper, profits will look like a lot. That happened in the case of Rajesh Exports, even the top line for that matter. But it's very important that you check for any mismatch between revenue growth and cash flow, because a company reporting massive revenues but poor or erratic cash generation is a classic fraud signal or a signal of the fact that their financial health is not in good shape. The other thing that happened with this particular company is that promoters' personal transactions were mixed with company accounts. You can definitely highlight that, read their balance sheet, because here personal trades or expenses were routed through companies' books without board approval. So whether those approvals are in place or not, all of these things have to be documented somewhere and to be submitted to the exchange as well. There was misclassification of income, and that happens because misclassification of any sort of account does inflate or deflate your income, right? Here, interest income or forex gains were being booked as operating revenue to inflate the top line numbers. They are not a part of your revenue because that is not the business that you're into. So that cannot be part of your P&L at that level. The other thing that one has to watch out for is auditor qualifications or frequent auditor changes. Auditors do qualify reports. They say that, okay, there is no problem with the P&L, or do they say, yes, there are certain qualifications, you need to talk about it, or you need to be aware about it. These are red flags if auditors flag concerns or are replaced often as well. When there are consolidated entities, so you get financials from your subsidiary as well, and consolidated P&L is put in front of you, or consolidated balance sheet is put in front of you. If it is not disclosed publicly, the subsidiary financials, it can get a problem in case if most of your revenues are coming in from your subsidiaries, which was the case in this particular company. Because if they do not regularly publish their standalone financials, that can be a warning sign. Here also what happened is revenue was concentrated in opaque overseas subsidiaries, especially in the case when a company has multiple subsidiaries and a lot of the revenues is coming in from there. Related party transactions, we keep seeing that it has to be at arm's length, it has to be in favor of shareholders, not the companies themselves. Here also that happened. Fund flow to promoter-linked entities happened. Now with this, also important to note that public held 45.45% of the stake in the company. LIC held 10.8%. We do have two more funds that had some stake here. So yes, there was substantial money which was being put. The stock came off sharply from the highs. It reached levels of 700, 800. Now is locked in lower circuit today. But these are some things which should be done before investing. Look at P&L, look at balance sheet, and most importantly, cash flows.
Indeed, plenty of red flags, as Sonal highlighted. In 2023, the stock was well over 1,000 rupees. As Rajesh Exports now at 100, still locked in lower circuit despite the company clarification. Now, joining us to discuss this subject further is Hetal Dalal, the President and CEO at the Institutional Investor Advisory Services. Hetal, good afternoon. Thank you for taking time out. Yes, every year over the last 3 years, we have seen an instance like this appear that dents a lot of this investor confidence, right? It was Brightcom in 2024, Gensol last year, and now we have something like this in Rajesh Exports. What as advisors you would tell investors, as Sonal also flagged off plenty of red flags that one should look at. What do you do in instances like these?
Sonal covered a lot of ground in terms of what are the red flags. Let me add maybe 2 or 3 things. One is when you need to look at aging profile of receivables and aging profile of payables. This is disclosure that you see in annual reports, and when you see that receivable positions are over 2 years or 3 years, and payable positions are over 2 years or 3 years, that's something you should certainly ask. I think the other piece is just look at the transparency in the annual report itself, right? When you look at Rajesh Exports annual report, for example, there's a single line item, revenue from operations. There's really no disclosure on what's really happened or what the breakups are. So you find some of these issues which you can get better clarity on tend to not be there in the annual reports where you're seeing some of these issues. I think more importantly, when you look at the assurance functions, right? There are 2 checks, and the checks and balances of the system are through 2 or 3 things. One is just having a strong internal audit, which should report to the audit committee. The second is to have an audit committee which actually has expertise Rajesh Exports Audit Committee comprises of people with jewel gems and jewelry expertise. It doesn't have anyone with any kind of financial expertise or accounting expertise. And the regulation today says financial literacy, which is a very vaguely defined term. And you have the promoter on the audit committee, which is a fundamental conflict of interest, right? So your internal audit hasn't functioned. It's reported the audit committee is already conflicted because the promoter is there and you have two other members who don't have any expertise per se in looking at some of these structures. And then you have the statutory auditor, which is the other function, right? Now, the statutory auditor, I mean, given the list of things that SEBI's passed out, and these are all 101, basic things that the statutory auditor should have picked up. So one of the things you need to then ask about is the quality of the statutory auditor in the first place. You have most of the operations coming out of, a global entity in Switzerland. The Indian entity has nothing. Now you have a firm which hasn't really audited too many listed companies and a joint statutory auditor, which is essentially a proprietorship. So the question you have to ask is, do they have the capacity to audit a company of this nature? The second question to ask is, what is their revenue dependence on the audit fees that Rajesh Exports is paying? This is something that we've been saying time and again in terms of just ensuring audit independence, that there has to be some better disclosures on how to assess audit independence, and the audit committee should be validating that on an annual basis that the auditors are indeed independent. In this particular instance, given all of you are saying, I fail to understand how the auditors didn't pick it in the first instance. You have a whole set of very, very obvious things which are violations which has been booked into the accounts, which is a problem. The other way, so that one is just to look at the company and some of the nuances in terms of governance structures, assurance functions, right? The other way to look at it is also comparables. Now, a company which is basically doing tolling, right, gold refining, is reporting a margin of 1% or less. Does that even fundamentally make sense? And if you look at other companies in similar lines of export, I think margins comparable. For a company which is, let's say, reporting margins which are significantly higher than peers and with similar line of exports, there has to be some magic sauce, and you've got to figure out what is it that they're doing differently vis-a-vis the other players because of which margins are higher. Similarly, margins are significantly lower. You have to wonder what is the kind of cost being booked for the margins to be basic, margins to have almost disappeared at less than 1% in terms of operating margins, right? So these are some of the issues in a very sort of brief nutshell that one can look at, but ideally you look at it from the company level and you have to look at it from a peer comparison level to get a broader picture. And then you have to what we call the smell test, right? There is the obvious smell test. You will see a lot of these red flags, some misses. The AGM last year was held in December. There are some filings which have not been done. So some of these things don't really smell right, and that's something you should worry about.
That's very important, whatever you mention, apart from some of the red flags, the point that AGM was delayed, filings are not done, look like small things, but they say a lot about where the company's focus is really, and most important on the auditor committee as well. Having the promoter on that independent committee really doesn't make it independent, right? So in that case, now things have happened. And the stock has come off from, say, 800 to 100. So, of course, some people are aware about it, but a lot of retail investors are still stuck in that. So what do these SEBI's interim orders really do? How do they really help retail investors? Because now it's in lower circuit, they can't really get out of it. So how is it helping them at all?
I think SEBI can only come in after the fact. There has to be an embezzlement for them to, or some of these deviations to happen for them to actually run an investigation. The interim order sort of stops this from continuing, and it puts everybody on guard. And I think that's an important piece. See, without the SEBI interim order, you may suspect that something's happening, but you don't really know the details. And to that extent, SEBI's interim order is actually quite speaking, in the sense that it tells you a lot of the details. And I would encourage all retail investors in the stock to actually read that order. It's very, very well written. It's come out with a lot of details. And most importantly, it's talking about the fact that the company has not been cooperating with the regulator, which you also see in terms of rating agencies, right? When you look at the outstanding rating on Rajesh Exports, the Brickworks rating of the rating agencies, that the company is not cooperating. These are all additional signs. But to come to your sort of point in terms of what SEBI does, I think it just prevents anything further from happening. The promoter is basically on guard, and it also creates more awareness from the investor point of view. But SEBI can't prevent stuff like this. SEBI can only come and create structures, create regulation to protect, but actual action you can't really do. You also have to understand when there's an issue of fraud happening, it is always happens in collusion. It doesn't happen with one single individual, and that is mindfully done, knowing the regulatory environment, knowing the systems and processes. So it's a bit hard to say that SEBI is going to prevent it, but the interim order does help bring out some of these issues.
So in that case, we spoke about the red flags that an investor can keep an eye out on. What SEBI can do, the interim order will allow at least no further investments till the time there is more clarity. In this case now, if there is a clarification which is coming from the management, where they are saying now they will cooperate with the agencies and the revenues are not inflated, they are all fine. Do they have a mechanism to do that? And I'm just trying to understand what next, what happens next for companies like this? What has been the past experiences?
So typically when SEBI comes out with an interim order, then they will run some further investigation and come out with a final order. So if the companies now decide to cooperate with the regulator, it's a good step, a little too late, but at least it's better late than never. And SEBI will come out with a final order, following which we'll see what happens, but SEBI will come out with directions at the final order as well. I'm actually surprised, even when you look at the interim order, that SEBI has not pulled up the board and the audit committee for some of these shenanigans which have happened. Yeah.
Indeed, plenty of other questions, Hetal, but running out of time. So thank you for sparing time and joining us today this afternoon on this very important subject. And of course, a lot of retail investor interest here as well. That was Hetal Dalal on the issue of Rajesh Exports. Now take a short break. Back with more on the other side. Welcome back. The index is still down around about 50 points, and Infosys and TCS have both slipped into the red now. Infosys is down close to 2%. TCS is down around 0.5%, extending its losses from yesterday's 9% drop. So at the day's low or near the day's low is Infosys, as is TCS. Of course, we're talking about a couple of large cap names first up. Trent, of course, ex-bonus from today. The stock is down around 3% in today's trading session. Trading today being the record date for the 1:2 bonus issue. Some of the broader market names then. Zensar has moved to the day's low. 5% lower on Zensar is the top loser on the Nifty 500. The other top loser, as Ria also highlighted in her list, is Meesho. So Zensar is in a 5% circuit. Oh, it's not a circuit technically, it's a 5% lower right now. It's continued to move at that level, and Meesho has moved to the lows of the day. So 5% lower on Meesho as well. Titan in its analyst day today, for FY30, growing India market share to 11% from the current 8.5% in India. That's their jewelry business target. The stock at one point had gone up to 3.5% as well. So the FY30 target of 2x of revenue of FY26 by FY30, growing at a 20% CAGR as well, growing to 1,400 stores from the current 800 as well. So some targets laid out by Titan for the jewelry business at its analyst meet. The stock, well, slightly coming off the highs of the day, but still holding on to gains of around 2.5%. SAIL, some of the metal names are not doing well today, a couple of them. Nalco is down around 4.5%. SAIL saw a big block deal earlier in the day. That's down 3% as well. And some profit booking coming in Aether Energy. The stock doing well for itself yesterday, but seeing some profit taking at higher levels. So take a leave on this edition of Mid Cap Radar from Sonal and me. Thank you for watching. MF Corner on the other side.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra. Sonal, good afternoon. And REITs, we've spoken about it. We know that it's come into that classification, but it's time to get more into details, right? It becomes an investable option now for PMS mutual funds and all of that.
It does, and we are seeing more interest come by from mutual funds as well since the time SEBI has classified it as an equity asset versus hybrid earlier. So we just thought let's do a deep dive on what REITs really mean as an asset class and what are the avenues for income for an investor as well. First up, the basics, of course, real estate investment trusts, a sort of a mutual fund where they acquire, own, manage or finance income generating real estate. What are the underlying here? You have offices, you have malls, you have warehouses. So whatever income they are earning comes back to the unit holders, and they are all covered under one real estate investment trust. Now, a lot changed for REITs. Since last 2 years, we've been hearing this word a lot because SEBI reclassified REITs as equities in 2025. This is in line with global practices. Now, remember, total allocation back in 2025 from mutual funds was just 23,000 crore rupees, and we are talking about an industry which has an AUM of 80 lakh crore rupees. So it's literally a drop in the ocean. They can invest up to 10% of their NAV in REITs. Currently, it's not even 1%. They are investing up to 10%, which would improve liquidity into REITs as well, which does not see a lot of institutional participation for now. Most of the investment right now is happening through, say, debt or hybrid categories in this particular asset class. In pure play equity funds, maximum allocation is not even 2% of in an AUM of the scheme. So that is what happened before it was actually classified as an equity. What do you really get from REIT as an income source? You get dividend, which is distributed by the REIT, interest income, which is the interest earned by the REIT from the entire structure. We'll of course understand it better. The capital appreciation, the properties which are the underlying, they also appreciate over time, right? So you will get that. A lot of these mutual funds do have some REIT exposure, PPFAS, AMC, you have ICICI Prudential, SBI AMC, but it is quite small as of now. So are mutual funds really looking at this piece? How do you understand REIT as an asset class? What do you really earn from it? How is it taxed? This and a lot more. To understand all of it, we have with us Nishant Agrawal, Senior Managing Partner at Ask Private Wealth, joining us now. Nishant, good afternoon. Thank you so much for joining in. Now that we've understood that, okay, these are 3 income streams or 4 income streams you would get from REIT, what are the biggest drivers of returns in a REIT? Is it the rental growth, the occupancy, asset appreciation, or acquisitions? How can one basically look at it fundamentally to understand whether they will get that growth back as their own income?
Great. Thanks for having me here. It's a very valid question and a very exciting asset classes which we are looking at in mutual funds. So let's first understand REIT. REIT are basically commercial properties, mostly residential, commercial properties which are rental yielding. And the income from this REIT comes from rental paid by the tenants. So the first source or the major source of income which any REIT gets comes from tenants paying income or the rentals for occupying that property. But there are various other levers which comes at play when an investor looks into a REIT. The rental for any commercial property or complex when you walk into not only comes from office spaces, but there are around 10% in some REITs rental, which is also coming from services which they supply to those tenants. These services can be power distribution. Some of these REITs own assets like hospitals inside them. Some of them provide services like signage, kiosk, or for parking areas. All of those adds to the rental income of the REIT. But for an investor, the growth of this rental income is also very important to see the appreciation in their investment. This growth comes from multiple factors. Think of this as any other office property. The first lever of growth in rental income comes by annual escalation. Typically in India, we see around 15% escalation over a 3-year cycle. So expect a 5% rental income, like any of the residences which we live in or the properties which we take for office. We pay 5% escalation on rental for the period we are renting the property. That's the first source of growth which comes from rental income. The second source of growth also comes from some part of property which is currently unoccupied at the time when you enter. And over a period of time, these properties and these empty spaces gets leased out and additional rental starts coming from those empty spaces. The third source of rental comes from addition of new properties. This can be from current development, which is under development and not fully leased out, or it can also happen by acquisition. So these REITs can raise more capital, they can raise more debt and increase the portfolio of properties which they run, which can additionally add to income growth over a period of time. Last source of income also comes from releasing or rents or properties which are expiring on the lease contract, and then they release them based on the new rental rates which agrees in the market. So there are 4 or 5 key drivers on the rental income growth. I just summarize. First is the contracted escalation. Second is the empty space getting leased out. Third is the expiry getting released at market rates. And fourth is the acquisition of new properties. In some cases also, an additional return can be expected if the REIT itself will add or even sell some of those properties, and hence there can be some capital gains which will come inside the REIT, which eventually goes as benefit to the investors.
Point taken there, Nishant. A lot of drivers in terms of returns, what come in from the REIT side, or what are the factors that drive these returns? Nishant, now what are the most important metrics that an investor actually should look at or track every quarter to judge the health of the REIT? So you know what you're aware of when you're investing here as well. And interest rates have a significant impact on REITs as well globally. Could you talk to us about both of these points?
So that's a very important point. In some way, REIT can be compared to a bond, and a bond which is a long-dated bond, where the sensitivity to the interest rate in the economy decides rental yield, which means that if interest rate in the economy is going up, let's say a normal FD or a bond, instead of paying 6% starts to pay 8%, typically the expectation for investors coming in will also be to generate 8% plus return from REITs and InvITs. And hence, the same investor would then, to generate 8% return without changing the rental, would have to buy the REIT at a lower price. And hence, the price of the REIT, as we say, is inversely proportional to movement on interest rate. If interest rate in the markets go up, expectation on REIT rentals go higher, the price of the REITs come lower, and vice versa, hence impacting significantly on the return expectation. So an inverse correlation between interest and REIT returns.
Okay, so it's an inverse correlation that you see between the two. Let's try and understand the other metrics. We spoke about occupancies aiding. We spoke about how acquisitions could aid as well. What are some of the other metrics, just following up on the question that Vinny asked as well? Is there anything else that an investor should be aware of? Maybe on the balance sheet side, you would have something on the net operating income that every quarter is reported, and hence some of the tweaks there that an investor can keep in mind.
No, absolutely. So on quarter, the metrics which an investor should look at, one is a clear distribution per unit, a term which is known as DPU. How is the growth expected in distribution per unit in the quarter and projected or guided by the management? This number is actually resulting from the underlying factors on how the rental growths are coming or occupancies are increasing. So that's one metric an investor should look at. The second metric an investor should also look at in terms of vacant capacity. Is there a lot of area which is still to be leased out or is currently lying empty? And the management of the REIT plans to kind of put it on rent and hence increase the rental collection from those units. The third point to capture for an investor is also to see what kind of debt levels are there in that REIT, because REITs are allowed to take up to 50% of debt to enhance the return for the investor. What rate is the company or the REIT borrowing at? What is the yield on the property? And hence what kind of leverage kicker can be added to the return using this borrowing. So third aspect is how much is the borrowing and at what cost is the REIT borrowing. Fourth is also about any new acquisition plan. If there are plans to kind of acquire new assets which will enhance my distribution is what is very important from a future growth perspective. Then comes the regular element of other cost in terms of managing the property, in terms of maintaining the properties, in terms of taxes, which goes away from the rental income before you arrive at distribution per unit. So those are the regular metric as well to be tracked to see what kind of interest expense, what kind of management expenses or costs are being added to the REIT. But I would think two very simple common metric to track is the growth in distribution per unit, as well as what kind of debt levels and new leasing is happening from rentals from either empty spaces or new acquisitions.
Nishant, you touched upon a point of when a REIT acquires new asset, right? So as an investor, how can they assess whether acquisition is genuinely value accretive or simply just adding scale?
Sure. No, there's a combination of both the factors. Very, very valid point. More often than not, the way to kind of look at it, what is my current distribution yield without these assets? at what price I am raising more capital, either as equity or debt in the REIT. And then the asset which I am adding will be adding net accretion in the distribution yield or my NAV. So NAV, as you know, will be the total value of the assets and number of, or the capital number of units. You have to see the net impact of new assets being value accretive based on the acquisition price which you paid. So let's say if I am holding most of my assets at 7 or 8% yield, and I'm willing to acquire something which can give me a 10% yield, both put together, my net yield goes higher for that REIT, and that becomes a value accretive asset. Also, qualitative factors are also equally important. You know, sometimes you have to look at what kind of diversification I am getting, what kind of future growth potential this new assets will bring me in future, either by new development potential or new kind of tenant mix in it. All those factors also help in future appreciation in REIT prices.
Makes sense, because a lot of these REITs, the listed ones at least, are growing via acquisitions recently. So that continues to be an important thing to track when it comes to looking at their financials. A very important conversation, but we have to slip into a quick break. On the other side, we'll continue our discussion and understand more about REITs and how big of a part of your portfolio this particular asset class should be.
Welcome back to MF Corner on CNBC TV 18. We still have with us Nishant Agarwal, Senior Managing Partner at Ask Private Wealth. And we're discussing on REITs, investments in REITs, and how EMCs, mutual funds, are looking at it as well. Nishant, you know, taking the conversation forward, for someone who's building a long-term portfolio today, where do REITs fit in alongside equities, fixed income, gold, physical real asset, on estate, that all of that you have?
Sure. So very honestly, REIT will not exactly fit into the allocation for neither equity nor for debt. And for reasons that debt definitely has this whole concept of capital protection and very, very low volatility on a week-on-week, day-on-day basis, and you get a defined return on what you contracted for. Equity, on the other hand, do not have a regular cash flow stream like what REIT offers of anywhere between 6 to 10%, depending on REIT to REIT. So I would place REIT somewhere as a fourth asset class, what I call as a hybrid asset class, along with equity, debt, gold, as well as REIT as the fourth asset class. This does great favor for investors' portfolio who expect regular cash flow. It is tax efficient because it is taxed like equity on capital gains. So after 1 year, you pay 12.5% long-term capital gains tax. And it gives consistent income quarter on quarter coming out from the REIT. So I would place it as a hybrid category outside of equity and debt along with gold. In terms of allocation, because there is very strict SEBI's directive and regulations around how much distributions can happen, what kind of underdevelopment property can happen, I personally would put that as a very conservative, safe asset class. And for very conservative investor, it can easily replace anywhere between 10 to 15% of their debt portfolio. What they keep in debt mutual funds, or they keep in safe bonds or government bonds, they can do 10 to 15% of their debt portfolio into REITs. For aggressive investors, it can even go up to 25 to 30% of their portfolio, who are looking for little more longer term and consistent cash flow and improved debt return. It can go up to 25% of debt portfolio.
Okay, all right.
So to me, the allocation is moving out from debt and not necessarily from equity, because it has very safe features and conservative features of cash flow and asset backed.
It's ironic, right? We call it a safe asset and still classified as equity. So it is going in different directions. But you mentioned, Nishant, 6 to 10% is what the return is. Does it include the capital appreciation as well? And if yes, what is the breakup of the outflow that an investor gets? Because they need to get a statement. It is taxed differently. If you can explain the taxation differential as well to us.
Right. So I think this will be applicable more for direct investors in REIT InvITs, because in mutual funds, they don't need to care about what kind of distributions are coming from direct holding of share. But for direct investors in REIT InvITs, the payments to them come from 4 different distribution categories. The first category is what is called interest, which comes from REIT directly through their underlying SPVs. This one is taxed at the maximum marginal tax slab for the investor. So every quarter when they get distribution, every year they have to pay the tax as per their income tax slab. The second distribution which comes is from dividends. Now dividends are of 2 categories, that's 2 and 3. Some of the dividends from REITs can be tax exempt, and some dividend from the REIT can be taxable in the hands of investor at full tax rate or marginal tax rate. This actually lot depends on how the REIT is structured and how the investment manager choose to take the tax structure under the underlying SPV. So there are 2 kinds of dividend. One dividend is what I call tax exempt dividend, and one which is taxed at full rate. The fourth distribution which comes from REIT is coming in the form of capital return. In this, there is no taxation, but the amount which is given as capital back will be reduced from your purchasing cost. So effectively, the distribution comes anywhere between 6 to 9% in a REIT. The tax rate, depending on REIT to REIT, will fall anywhere between 15 to 25%. Over and above the 6 to 8% rate, one can expect a 4 to 5% capital appreciation in REIT properties. This appreciation, the taxability will come only at the time when you sell the REIT, like when you sell the shares. In that case, the equity taxation will apply, which is less than 1 year. If you held the REIT units, the taxes will be at short-term capital gains. If you held the REIT units for more than 1 year, the taxation applies as a long-term capital gains of 12.5%.
Okay, point taken.
So
there.
4 regular distributions adding to 6 to 8, and 3 to 4% of capital gains, depending on how long you hold the REIT.
Okay, point taken there, Nishant, in terms of the taxation side as well. But what are some of the biggest misconceptions retail investors have about REITs, and what are the risks that do they often underestimate, and they should actually be looking at it also while investing in REITs?
That's also a very, very valid question. I think one of the challenges which we are also educating clients and people are now coming to know about is the difference between distribution coming out from the REIT as well as the yield or IRR of the REIT. What I mean by that is, if there is certain REIT which pays very high distribution, it may also be coming out from capital which is getting freed up, not necessarily from the rental income or income being generated from the REIT. So one has to keep an eye on saying what is the kind of breakup of the payout which comes, and that may not necessarily be the same as the return generated on the portfolio. Second point, which is also equally important to note from a distribution of income, is the kind of risk you have on the asset. What I look at in REIT properties is the mix wide enough in terms of cities, the mix in terms of sectors, the mix in terms of tenant profiles, which will ensure that if there is one particular segment which does bad and there is vacancies which comes in the REIT, I'm not very adversely impacted with that concentration. So 2 things: be a clear difference between what is the NAV or what is the yield versus distribution, and at what price do you buy in the market? The point I just mentioned about NAV also becomes important because there is an inherent value of the asset, but in the market it may trade because of various factors like liquidity at a premium or a discount to NAV. So all the REIT companies will be publishing in their quarterly reports what the NAV of their assets are, and then you have to take an informed call when you are entering because of various market factors. Are you paying too much of premium or buying it at a discount?
You know, when we talk about premiums and discounts, one part is we do only have listed REITs, right? And their stock price, people usually look at listed stocks because they want that appreciation there as well. REITs, they either trade at varying premiums or they look at discounts to NAV as well. How much importance should investors give to NAV, and what can cause a persistent discount despite strong operating performance? And just for the benefit of our viewers, if you can explain briefly where they can look at NAV, how do they go about analyzing that part of the business?
So this is a little more, I would say, a technical subject for a regular investor to kind of look, but a good factor of why a REIT can be traded at a premium or a discount is very similar to a stock in terms of what is the future prospect that particular REIT would have. Future prospect coming from the management, how well they are managing the asset. The future prospect can come from what is called as right of first refusal, where they can add more assets and they have visibility of what kind of future assets can be added in the REIT. Sometimes it's also about the pickup of investment activities or economic growth, and you expect that the leasing market will be very, very strong, and hence some of my empty area can be leased out, or some of these area which is coming for expiry, I have a potential to mark it up. So while NAV may have some of these factors, but a market will realize it a lot more real-time basis, and hence there can be a discount or premium to that. A lot of time, overall market sentiments and economy also may force investor for liquidity, and you may see price deviation from NAV by either being at premium or at discount. And the last factor which leads to a maximum difference between premium and discount could also be at times when the sponsor or a promoter are selling large blocks of their holding for their liquidity in REITs and InvITs in the market, and hence the supply is more than the demand and the price kind of eases out or corrects. So these are some of the factors which happen, but in their quarterly reports, on their websites, all of these REITs and InvITs have very detailed disclosures around their NAVs, around their income statement, and that's the first place to go to check what is the NAV versus where we are seeing it traded in the market.
Absolutely, point taken there, Nishant. It's such an important topic to understand REITs because the way it's picked up pace as well, and like we started the show. Nishant, thank you so much, for joining us this afternoon, explaining us investments in REITs, what mutual funds do, how the taxation comes in as well, what PMSs are doing. So thank you so much for that, Nishant. But with that, we're absolutely out of time in this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Asia has also opened up on the red start and red note today.
It's agreed that we will go in with them, we will get it, and we will destroy it.
So oil prices moved up 2% last night.
There are about 12 to 14 very, very serious allegations which SEBI's put forth in its order.
What gives us more confidence on that is the strength that we see in the broad market.
We're 23,300, yeah, 0.5% down.
Exactly, withholding tax is a bigger issue with FIIs.
In the case of India, again, a 2% current account deficit is not a big number.
There's no argument against the mid to long-term growth potential in India.
Well, the markets are staging a bit of a recovery from the lows of the day.
RBI may not do rate hike tomorrow.
Have entered into a collaboration with one of the leading Taiwanese companies.
What we encourage everyone to do is to use the AI models that are available for everyone.
We recovered from the lows of the day, and again we're off the highs by around 100 points.
Okay, it's absolutely flat. The 17-odd point change, 23,420 is where we read last hour coming up this Thursday afternoon. Coming to you from the CNBC TV 18 Motilal Oswal studios, I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, afternoon.
Hi, afternoon. It's good, right? That intraday pullback that we had yesterday, that's holding today. We've moved in about a 200-point range, but as we speak, it's a positive bias. 1 hour to go.
Well, that's right. And we had mentioned this earlier today that going by the kind of shorts you have in the system and going by the fight back that we saw yesterday, probably the bulls will fancy their chances, though we need to keep in mind that it's a Sensex weekly expiry as well. So that will play some kind of a role as well. But good to see some stability, and the broader markets are getting their mojo back. That's been the theme for the last 2 months. It was missing for the last few trading sessions. Number of stocks advancing, outweighing the number of stocks declining. You like what you see.
There is maybe a bit of a negative sentiment on macros, maybe on large caps. But otherwise, if you look at the broader market, I mean, it's an absolute, have to say bull market, right? Because mid cap, small cap indices, etc. I think Lawrence Belanco made that point as well. Others have as well, that it's not looking that this is a stressed market and out of ideas, etc., etc. Large caps, yes. I mean, that's largely where FIs are, and they've been selling non-stop. Well, just a sort of summary of what's coming up here over the next 60 minutes or so is, of course, markets, where we're headed. Titan is going to be, something we'll focus on. The stocks, I think, higher. Commentary from the investor day. We will talk about, the power sector. And Citi's got a note. I think they're initiating coverage now, names like GE and Siemens and CG, etc. So stocks are reacting. So that's coming up. Dixon, the management spoke with us on the sidelines of the Citi Investor Conference. So stocks still holding up at the day's highest point. And we'll sort of, get you some interesting sound bites from the management of Electra Green Tech. You don't see them very often. So they gave some idea about the overall business, order book, etc. So that's what's coming up here. Well, how should you position yourself? Ashish Kayal is with us with that answer. Ashish, good to have you with us here. It is absolutely flat for now. On the Nifty, what's the trade?
Hi, afternoon, Prashant, and all the viewers. See, if you look at Nifty over the past 5-6 days, we have not yet closed above the prior day high. I mean, there has been pullbacks, and that's a good sign. So we need to close above that the gap area of 23,460, 23,490. So once we close above that, it looks like achievable today. And we can say that there is a short-term low, and we can start seeing pullbacks towards 23,630, 23,700 levels. Having said that, what is very interesting is that, like you were also talking about, the mid-cap index is at the lifetime highs. Just about few days back, it touched lifetime high levels. CNX small cap index, if you look at it, it's hardly down 5% from the lifetime high levels. And if you do the ratio of these mid cap, small cap to Nifty, we can see a very, very strong uptick. That clearly shows that there is a bull run underlying in the stocks. And that's a sign of a stealth bull market is what I may say. The large cap has drastically underperformed, and the major reason everyone knows is the IT. That showed some kind of a green shoot 2 days back, but again started falling yesterday. So the overall undertone looks positive, and I think Nifty needs to take out that 23,630. Once that happens, we'll see some kind of a strong recovery on the upside.
23,630. So that's also close to where the 20 and 50-day moving average on the Nifty lie. So once we cross that, you see some upward momentum. But private sector banks are contributing to the last hour recovery that you can see. So ICICI Bank, Kotak Mahindra Bank. So ICICI is up 1.5%, while Kotak Mahindra Bank has gained close to about 0.5%. So any trades, Ashish, that you would recommend?
On the buy side, the first pick is going to be Anant Raj. We can clearly see the stock formed a good inverted accumulation pattern. From there, it has shown a very strong breakout on the upside, and we can expect it to move towards the level of around 640 higher. On the downside, one can maintain a stop loss in the stock at around 540 levels. And the next stock on the buy side is going to be Coal India. We can clearly see the energy space has been buzzing. The past 3 months have been spectacular for the energy and the power counters, and Coal India has also shown good recovery on the upside. We can expect the targets of around 505 here. Stop loss can be maintained at 467.
All right. Thank you very much for that. Titan is in focus today on the back of the Investor Day. They've laid out some ambitious targets. Vinny is now joining in with the key takeaways. Vinny.
Hi, afternoon. So for Titan, first let's talk about the biggest segment, right? Jewelry segment, which accounts for around 80% of the revenue. They're talking about a market share. Currently, they have a market share of around 8.5%. This was as of end of FY26. They want to take that market share to 11% by FY30. Now, apart from that, they've spoken about Mia, which is a brand of Tanishq as well. So it's a part of Tanishq that they said has moved on from 100 crores, which was pre-COVID their revenue, moved up to 2,000 crores. They have ambitions to grow that further as well. They're expecting doubling its FY26 market share in Maharashtra by FY30. That means a lot of these other demand trends that we've seen coming in from Maharashtra have been very strong, was what the company highlighted, and they're very positive in terms of growing the market share there. Apart from that, they've spoken about doubling its revenue by FY30. That's 20% CAGR growth in terms for the jewelry segment as well. And in terms of stores, they have currently 800 stores approximately. They want to take that count to 1,400 by FY30. Now, apart from that, Carrot Lane, what have they spoken about Carrot Lane? They are targeting a 2.3 times unit cost price increase coming in by FY30 from the current levels of FY26. Obviously, in terms of Damas also, they have said they're focusing on retail productivity as well as same-store sales growth. And what they see is a digital commerce part of the business becoming 10% of the total market, and that's where they're investing, and that's what they want to focus on as well. Watches segment. Currently, the company has around 27% market share in terms of the watches segment. Mainly, they're a large part and large market share they have in that 25,000 range of watches segment. Above that, they're still lower in terms of the market share there. They want to focus on increasing their market share. They have double-digit market share there, and that's what they're focusing on in terms of the premium side of the category, where they want to grow further. Currently, in the below, 1,000 rupees to 25,000 rupees, the market share is 50+%. So that's where they have the major leadership coming in. Lastly, eyewear segment also, they have an ambition of 2x market share by FY30, and quite positive in terms of the market share across the board, and that is why the stock started buzzing in trade as well.
Okay, thank you very much for that. So that's Titan reacting to their plans to double the revenues by FY30 and increase the market share to 11%. Compared to the current 8.5%. Devin, Kalyan Jewellers is also up. So one, of course, is the entire market expands. So Titan benefits from that, which is what explains the 20% CAGR growth. Maybe they're building in some gold price increase, which straightaway adds to the value growth. But they're also targeting market share expansion. So in that sense, is that negative for peers? What is the read on the jewelry business, the TAM and the growth?
Yeah, good afternoon, Rima. Well, I don't think it's negative for peers. I think the overall market fabric is quite healthy in a sense. I think each of the players are having the role to play. Some of them are pure position regional players too, where I think they are getting the larger amount of business, particularly in these times wherein the gold exchange business is now probably gaining larger traction. Most of these players are actually, I think, attracting more footfalls under this gold exchange program that they are basically carrying out, which is including Titan in particularly, I think, more in the urban market, which one has seen the traction. Valuation-wise, I think most of the things are in price. Unless we see some meaningful price correction, or maybe I think a longer time correction, then possibly I think one can see a fresh entry. But otherwise, as of now, I think the stocks are fairly priced in my viewpoint.
Okay, all right. Got that. Stay with us, Deven. Let's focus on power equipment makers. You have GE Vernova, CG Power, and Hitachi. All of them are upbeat. Post a bullish note coming in from Citi. But Vinny's here to tell us about what Citi has to say. Vinny, take it away.
Hi, afternoon. So this is an interesting note, right? At a time when we have seen these transmission and distribution players have already seen such a good run-up, Citi is still positive on the names and they still think that there's an upside coming in for these players. Now, why? Obviously, the energy transition story, that's the reason behind this as well. And if energy transition is taking place, the focus is coming in on renewable energy as well, then transmission and distribution is required. So domestic demand, obviously, that's increasing. CE has spoken about a 7.9 trillion transmission plan, and that's around 900 gigawatt of renewable integration by FY36. That means a multi-year opportunity that comes in for these high voltage direct current, transmissions as well as generator sets. All of that starts benefiting from this one, and it's a big opportunity that comes in for these players. Apart from that, what also does well? Grids. You require the grids. So that means the demand for grids will also start increasing, and global T&D spends, transmission and distribution spends, that also increases. There's a capex upcycle that's going on globally. Indian players are also investing big in this as well. A big opportunity that comes in terms of adoption for electrification as well as data center growth is happening. We're seeing adoption of renewable energy. So all this is supporting the growth. Now for Citi, what is the view? First, they like, in order of the preference that they have, Hitachi Energy is number 1 on their list. Then we have GE Vernova T&D, CG Power, and then Siemens Energy. Hitachi Energy, obviously they're the leaders in HVDC, and what they believe is that Hitachi Energy will actually benefit a lot more in terms of near-term order wins that will come in on this front. They already have a big capex plan as well. They are ready to capture in terms of the market because they have the capacity. So they'll benefit from this. GE Vernova also strong HVDC and export exposure they have. They have medium term growth support is also there for them. So they also will benefit from this. Third one is CG Power, diversified exposure to transmission. According to them, also the motor side of the business, that will also something that will support the growth for the company. So these are the top 3 where they've initiated coverage with a buy rating, and the other one is Siemens Energy, where they've initiated coverage with a neutral rating.
Thank you very much for that. Deven, we've spoken about this space in the past. Do you have a view on Hitachi, GE Vernova, which is best placed?
Well, actually, I think all of these companies have got the order book. In fact, in the last quarter results also, if you see for Hitachi Energy in particular, or even for that matter, GE Vernova, which has reported significantly large amount of inflow of new orders, giving them a visibility of around next 3 to 4 or even in some case 5 years. So that is quite reassuring. However, as I have said before also, the valuation wise today it is everything in price. But if you are willing to buy and wait for 2 years, probably I think you are likely to see at least a smarter jump from the current levels of at least 30 to 40%. So that's where we believe that I think opportunity is, because till 2030, at least I think the roadmap appears very clear. Though I would agree that I think this is a 10-year story which is unfolding for all the power utilities and including power finance companies, power generation, power utilities, power finance companies. Everywhere, probably I think you are likely to see a larger amount of growth in next 4 to 5 years from now.
Okay, all right, Deven, got that. Well, from the sidelines of the Citi conference, my colleague Yash Jain caught up with the founder and the chairman of Dixon Tech, Sunil Vachani, and here is what he had to say on the JV with Vivo, the approval for which is awaited. Let's listen in.
I don't want to talk about a specific case because this particular case is lying with the government, the central government. So, I won't want to get into the details. But I think in short, I would say that, we are told that, yes, this is under active consideration. And hopefully we should be getting some news on this very, very soon.
Just to close the loop on partnerships, as you mentioned, one thing as far as the partnership with Vivo itself is concerned, there were certain reports which suggested that the agreement time period expires in May, and if the government approval does not come by then a refiling or restarting of that approval process has to be done. If you could give some clarity on that, if it indeed is that process. And the second question, what are the new partnerships going forward in FY27 that you're looking to make, both on the international side as well as the domestic side?
So see, as I mentioned, I'm not going to comment on a specific case because, as I mentioned, this is already lying with the central government and we're hopeful of getting the approval soon. Talking about some other partnerships, I think what we're excited about all our partnerships. But as I mentioned, the industry that we're also excited about, besides the other industries verticals we're already in, is the IT hardware space. And we have entered into a collaboration with one of the leading Taiwanese companies, which is the global leader in IT hardware as well as servicing the requirements of data centers. And this factory hopefully should be which is being set up in Chennai. This factory should be ready in the next 8 to 10 months. And we are hopeful that once this plant is operational, we'll be able to cater to the requirement of the data centers coming up into the country. And also, we would ensure that the products which are getting imported into the country, like laptops and AIs on desktops, those start getting manufactured in the country, and the value addition, which is very, very low, starts improving in the times to come.
2.5% gain on Dixon. Deven, do you want to comment on what the management said?
Well, I like the way in which I think they are positioning the company in a systematic manner. The EMS company moving along with, I think, the equipments, they are now moving to the larger canvas, and that is where probably I think the data center kind of activity is playing a major role. I agreed that I think they operate on a thin margins, but at the same time, when they're putting in a significantly large amount of capex, same time I think the growth rate continues. So currently, whatever the corrected prices at which the stock is available from what it used to be, I believe that I think the downside is well protected. Maybe valuation still remains slightly at higher levels. In the corrective times, I think definitely this makes more sense to add them into the portfolio. Business-wise, I guess I think the roadmap is sounding absolutely clear and convincing. And at least around 30% CAGR kind of a growth is not ruled out in next 3 years' time for this company.
Got it. Another management we had in the morning was the management of Electra Green Tech. This was part of a discussion with regards to what the government yesterday announced with regards to the 2-year clean mobility scheme. But of course, I mean, we spoke about it, but we also used the opportunity to ask Electra about their own plans. What is order book looking like? What is the pipeline for new sort of bus orders? And that question of receivables from state governments as well. Take a listen.
We in one shift can produce about 2,500, and if on given a case, we can do 2 shifts and quickly come to 5,000 electric buses per annum. So if you look at it, we have a order book of about 10,000 vehicles to be delivered in next 24 months. We are planning to do upward of 2,500 vehicles this year, and then get into much higher, doubling that in the next 3 years. That's what we are planning. Even if we have to expand our capacity, we are happy. We have a facility of 150 acres, and in fact, within 6 months, we can build up the capacity to 10,000 vehicles if market can absorb. So we have about 3 to 4 months of receivable typically overall, average, and that's typically in the industry overall because we need to submit the bills and we get it. There are some challenges, however, it's continuously getting resolved by the state government. The intention of everybody, including the government, us, everybody, is to run electric vehicle because it gives a viability gap funding lower than the diesel, what prices are today. So everybody in the ecosystem wants to benefit out of it, but only scaling up needs all of us to work together and then scaling up. And I believe it will happen in the coming year.
Okay, well, it's in the right space. It's got that government tailwind, and perhaps Electra has now got the man for the job as well, a veteran from the industry, someone who's ran things at Ashok Leyland and I think with Mahindra earlier as well. Deven, any thoughts? Electra, this one?
Yes, Prashant. I believe that I think probably one of the best times that these companies are actually enjoying today. Given the kind of one state's, I think, move, I expect it to follow with the other states as far as I think the new order for electric vehicle or electric buses in this case I think is required. In my viewpoint, I think the major challenge for a company like Electra would be, I think, whether they could significantly ramp up the kind of delivery pressure that they would be experiencing, along with, I think, the receivable related situation, how they manage. If that does happen, then probably no looking back. At least I think next 5 years looks very, very promising in my viewpoint from the business perspective. Not sure about the valuation. Again, I think market is these days pricing everything in advance. And that's where probably I think you're not going to get anything cheap, even if I think such positive news comes. So we'll definitely have to wait for buying, which currently we are getting in some of the cases. But I think in such a case like Electra or others, I think one will have to little wait before buying into this particular stock.
Okay, all right. Devin, we'll leave it there. Thank you very much for that. Appreciate your time here. We come back in just a bit from now, and we'll have Ankit Jain of Mirae Asset on the other side for more on what to do and what he likes in this space.
Welcome back. Hormus is now joining in, and he's going to put the spotlight on some of the big movers that we're seeing in the market right now. Hormus.
The market may have not gone anywhere today, at least on the benchmarks, but there are enough and more stocks that are moving around in the broader markets today. Meesho is one of them, and it is the 8th straight day of losses for the stock. It's down now 5%. It's at the lowest point of the day, the longest losing streak that the stock has seen on record since its listing back in December of last year. And during this 8-day period, the stock is down almost 20%. So significant correction seen in Meesho from higher levels. But however, this correction has come on subpar volumes. Today's volumes are half of its 20-day average. 1 crore shares have been traded today. The 20-day average is 2 crore shares. So the stock has declined, yes, but it's declined on volumes that are below their 20-day average. The stock is now at its 100-day moving average, which is at 166. It is exactly at that level. And 52% of the shares traded today have been marked for delivery. So as a post-listing high that the stock had of around 254, the stock is down around 35% from those levels. PG Electroplast is another name. Of course, the AC manufacturers have done well in general in today's session, be it Blue Star, Voltas, even PG Electroplast. The stock has alternated between gains and losses this week. As the biggest single day intraday gain that the stock has seen in over 2 months now. Is almost 5% in today's session. The premiums on the 500 call option is up over 80%. As we speak, and the stock has gained on good volumes. 40 lakh shares have been traded today. The 20-day average is around 25 lakh shares, but still below key moving averages. The next important level on the upside for PG Electroplast is its 50-day moving average, which is at 504, and 38% of those shares traded so far have been marked for delivery. Now, there has been a recovery from lower levels. Yes, it's still down around 15% on a year-to-date basis. And lastly, the stock that has done well off late, Tejas Networks, one of the worst performing small cap stocks last year, was a fifth straight day of gains for the stock today. It's gained in 8 out of the last 9 trading sessions, and since the Tata Sons board meeting that took place on the 26th of last month, the stock is up over 30% since then itself. And in today's session as well, over 4 crore shares have been traded today. The 20-day average is 1 crore, so the 6.5% move coming on healthy volumes. The stock is now above all of its key moving averages, but only 13% of the shares that have been traded are marked for delivery in today's session. And considering this heightened trading activity, as of now, Tejas Networks is the most traded stock on the Nifty 500.
All right. Thanks very much for that. Tejas, of course, doing quite well. Let's welcome in Ankit Jain now, Senior Fund Manager, Mirae Asset Mutual Fund. Ankit, good afternoon. Great to have you with us in the program. Ankit manages the the multi-cap fund, the mid-cap fund, the direct blue chip equity fund as well at Mirae. The mid-cap space is what I guess is allowing you and your team, I guess, and everyone, all of us, I guess, to sleep better, right? Because large caps have been flat at best over the last year and a half, Ankit. So, and if you look at mid caps, pockets of strong bullish trends in many areas. I was looking at what you own in your portfolio. I mean, it's actually a fairly large mix, but it's not as if you are, you're big in terms of financials. I don't know the total weight for financials, but Indocent is one of the top holdings for you, Ankit. Is it a? I just wanted to ask you. I know you can't talk stocks. If you can, that'll be great. But is it a company call or is it a sector call?
Hi. Prashant, thanks. So clearly, I mean, mid-cap as a space has been relatively done well. I mean, there has been outperformance and actually rightly so. I mean, if you look into the earnings growth trajectory in this particular space has been much better, even for just the quarter gone by. While let's say aggregate Nifty 500 earning growth has been at around 15% within that mid-cap subsegment saw pretty good 30% plus sort of a earning growth. So clearly, I mean, I think underlying market returns are a function of the underlying earnings growth and actually for the mid-cap space, because of a variety of reasons across the sectors, actually earnings growth has been better. Within that, financials as a space, clearly, I mean, we have been positive, particularly large private sector banks, which is offering I think, decent margin of safety from the valuations as well as the earnings trajectory standpoint. I think credit growth is seeing an uptick from the lows of around 10.5% we have seen. Sometime last year. I mean, credit growth is now inching up 15% plus, and variety of factors driving that credit growth. Some bit of a shift from bond market to the bank side of it as the yields has hardened. That is one. Also, working capital demand is going up because of inflationary pressure being there. So all of those factors are driving good credit demand. That is one. And second, even the asset quality outcomes till now has been far better. I mean, if you look into as on fiscal year 26, and I mean, I think most of the banks are actually sitting at all-time high sort of a coverage ratios. So which is giving them enough shock absorbers in place in terms of balance sheet resilience, which can withstand them navigate even if in case of any sort of a tail risk going forward as a result of some of those geopolitical deadlock continuing.
Okay, all right, just hold on to that thought. We have some comments that are coming in there from Vedanta, which are, rather important, I think. So the street was a little bit fearful with regard to that raid, that investigation that was underway. Now, this is on the exchanges. They say that there's no penalty, restriction or impact on operation that have been imposed. The street was fearing because, what was earlier stated was that there could be a link with regard to the parent, that's Vedanta Resources as well. Now they're going on to say that the EDS concluded the FEMA-related search and operations at the company, and there's no big impact. So that's why, post that clarification that's come out there, the stock actually is perking up a little bit, because a couple of sessions ago it did see a sharp pullback from the top as well. So, just keeping an eye out on that particular name. But that's about Vedanta, explains why the stock has perked up. Hi Ankit, good to have you on the show. Ankit, what's your view on this entire metal basket? Has been a party going out. Vedanta, unlikely winner, in quite a bit. But the ferrous as well as non-ferrous themes, they've actually outperformed the market, which have been more or less range bound. How are you all placed on this theme?
Yeah, no, absolutely. No, metal as a space has done exceedingly well. Some part of it is also to do with the fact that globally economies are still holding up reasonably well. I mean, part of this also can be attributed to a bit of a front loading of AI capex and all. I mean, I think that is also helping in terms of global economies doing well, and typically metal demand is pretty much linked to the underlying economic growth. Second thing also has been on account of geopolitical disruption taking out some of the capacities temporarily, particularly onto the non-ferrous side of it. And I think that is why, I mean, if you look into spot spreads and all are looking exceedingly well. And third part has been that because of weaker currency from the India standpoint, some of these players do become a straight beneficiary from the earnings standpoint. So I think all of these factors are actually resulting in these companies to making supernormal margins at this point in time. On the ferrous side, because of the safeguard duty being in place, clearly, I mean, spreads from bottom sometime around, let's say, November, December actually has gone up meaningfully, and that is also helping in terms of better earnings outlook. So in that context, having said that, I think sector as a whole has done exceedingly well, and also we have to be a bit cautious in terms of extrapolating some of these spreads into the future and then try to assign the valuation multiple. Having said that, at this point in time, we are more like an equal weight onto the sector, with maybe more sort of a positive stance to the ferrous than actually non-ferrous.
Yeah. Point taken, Ankit. And metals, of course, as a theme, seems to find a fair bit of attraction across the board in that sense. Lots of other sort of, interesting names in the mid-cap, and that's the thing, right? When you look at some of these stocks, you realize that there have been big winners. I think Lotus has been a big winner for you guys. Oracle Financial Services recently has come up quite nicely. I'm just, of course, talking about just here and now. MCX, of course, continues to be a big winner in 2026 so far. These are all stocks as part of the mid-cap portfolio that Mirai has and the fund that Ankit runs. So there's a fair bit. You have a bunch of insurance companies as well. You got an insurance distribution player. You got an life insurance company. Ankit, any thoughts here, especially on the distribution side, if you have a view? I'm talking about the dominant name there, Policy Bazaar, PB Fintech.
Yeah. No, insurance as a space, we are fairly constructive at this point in time. I mean, sector haven't done as well because of concerns around some of the commission capping and some of those measures. So basically are actually anticipated, and I think market is a bit worried at this point in time that how the earnings impact will be there across the board because of that. But having said that, I mean, I think as a sector we are fairly constructive, because despite of all the past sort of measures being undertaken, be it in the form of GST impact and also there has been certain other measures in the past. growth for the sector has held up reasonably well for actually all the manufacturers as such. And within that, also onto the distribution side, I mean, this is actually on the merit of the business, because the common traits here has been that significant market leader out here in that particular space, and is actually having a pretty good sort of a bargaining power because of their sheer sort of a leadership being there. So I think this space as a top down looks very, very interesting across both life as well as non-life side of it, and has a very, very strong runway for growth. Yes, in between there will always be some sort of a concerns coming around in terms of commission capping and all, and which eventually, will actually further help in affordability and actually bringing in penetration game into the picture and even ensure higher sort of a growth going forward.
Thanks, Ankit, for joining in, giving us a quick take. We look forward to a longer chat with you in the coming days. Well, let's take a quick check then on the F&O market. The Nifty, the day's low is at around 23,247 approximately, and that seems to be the buy zone, around 23,150 to around 23,250, and that incidentally is the day's low as well. But there's a mix of activity, a little bit for the bulls, a little bit for the bears, a little bit for the call writers, a little bit for the put writers as well. And I say that because writers today are having a blast. 23,400 call. The start of today, the premium was $250. That's come down to around 207 rupees. So directionally, even when the market was up 30-40 points, you were not making any money on this strike, which is telling you there was writing at these levels. But on the 20,400 put as well, the markets were lower, still you're not making much money out there, because the start of today, the premium was $150. That's come down to around $118 approximately. So, that appears to be the case today. The writers are factoring in a bit of a range on the Nifty. And if we need to break out on the way up, then the Nifty Bank needs to perform. As we speak, it's up 100 points. If it can do 200-300 points or thereabouts, it'll take out the 200, the 20 as well as the 50 DMA, which it's very, very close to. As of now, it's trading a little bit over the 20 DMA. So, needs to get past that. Then it will have further ammunition to move higher. And that in turn could take the Nifty up as well. We'll have to wait for the RBI policy. I think the Nifty Bank is very, very ripe for a big move, in either direction. Individual stocks that are in focus, Eternal. That's a stock that's seen a big correction. Now, cash market, massive volumes out there. You're seeing a big amount of fresh buying as well in the F&O market. So that's a stock on our radar. BHEL, in the last 60 minutes, the stock has fallen off the cliff. It's down. There are massive shorts that are getting added out there. You pull up an intraday chart actually of BHEL. And sometimes what the street is fearing, if it doesn't come out, then in fact we could be bracing for a bit of a bounce, because it saw a sharp downtick. I don't know whether the street believes there's going to be fresh supply that's going to come in. In the coming days, we'll know. But if that's not the case, because the government of India sold stake in February itself, I'm not sure whether or not there'll be fresh supply that's coming in there. But the street is cautious on a couple of factors, and that's why there are fresh shorts in the system on that one. But Coal India, which the OFS was just done a week or so ago, base price of around 412 rupees, allocation price of around 447. You're making close to an 8 to 9%, on that particular stock just from the allocation price, because 447 was the cutoff. If you bought at the lows of the day, it was 425 as well. Fresh buying been seeing on that counter as the OFS overhang is out of the way. So explains why that stock is up and about. Time to slip into a short break. On the other side, Nimesh is back with us. He's going to tell us what he's picking up in Dealing Room Chatter. Stay tuned. Welcome back. Markets more or less flattish. The real action is in the broader markets. We're going to get Ashish Kayal in just a bit. But for the time being, let's hop across to Nimesh. He's been at a lot of conferences of late, looking nice. I think a peaches color today, glittering. Nimesh, what news do you have for us?
Well, Nigel, from a conference point of view, I can say this much, that the FI interest is still very low in terms of commitment of capital to India. Yes, there is a lot of interest to come and listen to the corporates, but at least from an investment point of view, they're still looking at other markets to invest. So that's overall feedback as far as conference is concerned from the FI perspective. In today's market, though, flattish day of trade, but I guess it's the Bank Nifty which is helping the bulls in the last couple of days. Of course, we head into a very crucial RBI policy meet tomorrow, so that's going to set the tone for the Nifty Bank and for the markets as well. From a flow perspective, a mixed day of trade. There is selling from the larger FIs, but also there is a small MOC sell in some select Nifty names in today's trade. So maybe some stock might get impacted in the last 30 minutes of trade. Broader markets, yes, you rightly pointed out, it's really outperforming to some extent. Some bit of pullback is back. The breadth is also strong in today's market, but it's pretty much mixed in terms of the broader market outperformance. But the key trigger seems to be the RBI policy tomorrow, and the fact that from there how the Bank Nifty responds is something to watch out for.
In terms of individual names, Nimesh, what's on the list?
So the first stock is IIFL Finance. Big move in that name in the last 2 days itself. And again, the volumes have picked up. My sense is that selling pressure from a leading long-only fund is largely over in IIFL Finance, and hence you've seen a big move in the last couple of days. The second stock is MK Global. Again, the stock locked at 20% upper circuit yesterday, up today as well. In fact, it's quickly moved from 200 back to 300 now. And I understand at least one large influential HNI investor has been accumulating MK Global at current levels. The third name is 5-Star Finance. Well, the stock has been consolidating. The city is anticipating a large block deal very soon. Remember, this is the trend now. With the earnings season getting over, you're going to see virtually every day blocks and QIPs getting launched. And the last is MV Photovoltaic. In that space, this is one stock which has outperformed largely on back of buying interest. I believe one of the domestic insurance company has been actively buying MV Photovoltaic at current levels.
Nimesh, heard anything on Tejas Networks?
Not really, Prashant. At least not in the last 2 days that I have heard anything in Tejas Network.
Chennai Petro, I think, was on your list, right? A couple of days back.
So there has been delivery-based buying happening in Chennai Petro, IOC, at least Oil India, Chennai Petro and MRPL. Those are names where there is a bit of institutional interest for sure in terms of buying from larger FIs.
And on this question of the taxation or relief, etc., you've been around town. I know across conferences, etc. Any strong opinions on it?
Well, I have been asking a lot of investors and at the conferences as well. They seem to be hoping that yes, something should come, and if that comes, maybe it's a sentiment positive. But only changes in taxation doesn't mean that the very first day FIs will come and start buying into India markets. That's not the feedback. But yeah, incremental is sentiment positive for sure if government does some tinkering in taxation.
Yeah, no, that is true. By the way, Nimesh, we highlighted, there's a flash at the bottom, and I thought Z is crossed 3 digits now, 100 plus.
But Prashant,
was also
it's had its own share of. No, so again, they've made the announcement that they have bagged the rights for the FIFA World Cup, so that's positive. There has been a chatter as well that maybe they'll look at some point in time do some monetization in the which is assumed the music business as well. So there is some anticipation that maybe the government, the company will do something in terms of monetizing their core assets. So maybe that's the reason why you're seeing a bit of action in Z of late.
Yeah, that's a sharp move, right?
Yeah.
I think, let me just see, it is up quite a bit. I mean, I think from about 70 to about 100, 70 to 100, right, this year. On Z, so that is what we are looking at. Nimesh, thanks very much for that. So sharp move. Well, Ashish Kayal is with us from Wave Strategy. Back with us, Ashish. Short-term trading ideas. What's on the list?
Hi, Prashant. See, the first stock is going to be Bank of Baroda. Ahead of the RBI policy, I think we can start seeing some kind of a positive traction again in the PSU banking space. That has been a laggard for over the past few weeks, but I think that should change now. Bank of Baroda formed a very good bottoming pattern around 260 as an important support, bounce back from there, and a follow-up action today also. The target can be 285 on the upside. Stop loss can be maintained at 262 levels. And the next stock on the buy side is going to be Data Patterns. Classic triangle pattern formation there, bouncing from that 20 DMA, and we can expect it to give a breakout on the upside for the target of 4,440, and stop loss can be 4,080 levels.
Yeah. Got it. Well, thanks, Ashish, for it. Those are some individual trades. Well, the market is, of course, as we were just discussing with Nimesh as well, awaiting some changes, right? Perhaps on the government securities side. Sapna is with us with what she's picking up from her sources. Sapna, take it away.
Well, surely, Hamas, as everybody has heard and widely expected, I think market participants have also had this demand for a pretty long time. So, given to understand that in yesterday's cabinet meeting under the leadership of the Prime Minister, Mr. Narendra Modi, I think some very significant decisions have been taken in principle. Basically, doing away with all taxes as far as FIIs are concerned and their investments in government securities. It's very specific government securities. So, basically, two aspects here. Number one, of course, is the withholding tax. And as I just said some time back, this demand has been there for a pretty long time, that this 20% is extremely steep. Either it should be reduced considerably or it should be done away with. So, probably in principle, a decision has been taken to do away with that. That's one. Second, of course, would be the 12.5% cap gains tax on their investments in G6. Given to understand that too is going. And apart from this, if there's any other taxation to do with FIIs regarding their investments in government securities, all of that is going to be zero. That has been we very clearly understand that for now. So just have to wait and watch and see how this really pans out. The implementation process, of course, there's every likelihood of an ordinance being issued. Down the line, when the monsoon session, the parliament meets, most likely the government will take back the ordinance and bring amendments to the IT law. But in the meanwhile, it can be done in this way. And we have to now just wait and watch and see when that ordinance comes and what is the implementation time.
Thanks a lot for that, Sapna. In fact, earlier today, we spoke to Nirmal Jain of IIFL Finance, and he said that a reduction in withholding tax is the need of the hour, and the government is doing the right thing at the right time. Let's listen in.
I think there's need of the hour because there has been significant outflow on capital account by way of equity and even FDI selling. So what maybe we need to do, we need to be competitive vis-a-vis other countries that are attracting foreign capital. And withholding tax will be removed not only in government securities, but also in corporate bonds. So currently corporate bonds, if they get listed in GIFT City, then maybe there's about 9% withholding tax on the interest. If we have to be competitive, we have to attract capital, which is required for the growth of this country, then I think these taxes should be removed. They are not here. What we have to look at is not vis-a-vis the domestic investor, but vis-a-vis the destination of for foreign capital, how other countries are attracting capital, how easy they made it. So I think this is need of the hour, and our government is doing the right thing at the right time.
Okay, let's welcome Sid Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services. Hi, Sid. Good to see you in this afternoon. Sid, what do you make of IIFL Finance? The stock has been a rank underperformer. We pull up a one-year chart, of IIFL Finance with either Manappuram, either Muthoot, or even the mid-cap index. It's corrected a great deal with good reason, right? There was that IT problem that they had, and the stock fell off one way. Now the argument is that valuations are come to an appropriate level, but the other trigger is also small cap fund, which is Capital. They had 6% stake in the company, which has come down to around 1.5%. And Nimesh just mentioned that a leading seller could be out of the way. What's your view at around 530 rupees? One would say it's recovered considerably from the recent low, but it's a far cry away from the highs that we saw, say, 6 or 7 months ago.
Yeah, good afternoon, Nigel. Good to be on the show in the afternoon. I think with regards to IIFL, at its lows, we were definitely turned positive with the valuations being comfortable. And more importantly, with the company kind of repositioning its franchisee away from the unsecured and fintech-led lending towards more of secured and granular retail platform, which was anchored around the gold loans as well as the affordable housing. And we have seen that last few months, with the gold price going up, the gold loan companies have seen a sharp rally with the underlying value going up. So that is something that has scaled up post the regulatory embargo that the company had some time back, and it has one of the best-in-class asset quality, strong operating leverage, and even in the gold financing business, the LTV remains pretty low, comfortable at about 61%. So I think there's a big business change that has happened now. Affordable and emerging housing segments are also expected to see a calibrated growth where the company has also positioned itself. So overall, we believe that now with the risk management, collections and compliance in place, the growth, which is now anchored through technology-led growth plus your verticalized growth systems, that is something which we believe will drive growth going forward. So overall, our expectation is that the AUM growth should be in excess of about 20%. Net profit should see a 30% compounding for the next 2-3 years. And as I said, valuations still look comfortable, and we have a positive view buy rating with a target price of 600.
600 is the target price on IIFL Finance. Siddharth, stay on. The RBI will announce its much-awaited policy tomorrow. The decision is at 10 o'clock. The CNBC TV 18 poll plus the Citizens MPC have voted overwhelmingly for no hike. Then what is it that we should look out for in the policy? Why is it important? Lata joins in with her editor's take. Lata.
The market is also going in with an expectation that there won't be a rate action, but no one tells you with 100% confidence. There is that small window that it is a possibility that the Reserve Bank hikes. They could make a very clear case by actually increasing the inflation forecast. Now stands at 4.6, but that was when crude prices were not expected to average $95 for the full year. But now what they had said in their study report, which they call MPR, that, you know, in the scenarios, the Reserve Bank had said if it goes to $95 on an average for the full year, then inflation can rise to 5%. That can be the actual forecast put into the statement, or even why not 5.1? And that could be reason enough to advance the hike to tomorrow itself. But everyone would tell you, no, they won't do that. The expectation is that, you're not attracting any investments by making interest rates higher, because bond investors anyway have not pulled out money. People who have pulled out money are equity and they want growth. So, and growth already has got a bit of a hit because of higher raw material costs and uncertainty of raw material availability. You don't want to impose yet another burden, and therefore chances are they will sound very hawkish. They will say that the inflation is high, and they will say they're ready to act, they're agile, they're watching out. Anything that can make you believe that a rate hike is round the corner but not there just yet. That is the mood with which the market is going in. But clearly that's not the place where the action is. The place where the action is in the currency. And over there, some statements are expected to boost morale. More important is whether the steps will be announced. There's a strong expectation that government will announce tax and RBI will announce something to make the package look attractive tomorrow. And that something could be that RBI will, bear the hedging cost when PSUs go out and raise bonds. Will they announce it in the policy? Will they just say that something is coming and announce it later on in the day in a press release? One doesn't know. Or just give the hint and announce it even 2 days later. All those options are available, but really walk and talk on the currency becomes very important. That's what everyone will peel their eyes and watch.
Yeah, no, it's a big one, right, Lata, tomorrow. And, RBI policy is always important, but I think
no action policy, it is going to be a big one.
Extra focus.
In a house, RBI governor will be on top of it.
Well,
in a group, someone's saying tomorrow's Lata Ji day. I'm serious, you're in the group. All right.
Okay, all right. Well, we will be on it from the beginning, of course, all the way till the policy is done and we are able to hear the governor reactions, etc. There's a full programming, of course, planned around it. Well, the street is divided on the prospects of, exactly that, right? What should happen on rates? If you ask fixed income sort of investors, they'd say, well, RBI should start hiking. If you ask equity guys, you get the opposite view. So, just want to play out two voices, Suyash Chaudhary from the fixed income side and Rhythm Desai on the equity side.
Given that average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter, they should start the rate hike cycle going. But at the same time, ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter.
Rate hike doesn't work.
Yeah.
Why? Because India is a growth market.
We're an equity market.
Yeah,
So
the minute you increase interest rates, growth will slow down, the relative growth picture will worsen, the selling will actually aggravate. We're not a yield market, so it's not going to help. And 25 basis points is not going to take you anywhere. So you'll have to be a far bigger rate hike, which is therefore far more punitive to growth.
Welcome back. Well, markets are holding actually with a gain of 35 points odd. The unlikely fight back today. We started off with a gap down 150, 180 points in the first few minutes. And the bulls say they're in with the fight. Let's see whether or not, we can pull back. Normally 23,250 has invited a 5 to around a 700 point pop-up. For the time being, we've got only 200 points. But the bulls will feel they're back in the game. Sid Kemka still with us. Sid, what do you like from the jewelry space? Titan today, they had given some very decent commentary from their investor meet. But take a look at some of the other stocks. I saw Kalyan Jewelers pop up, Thanga Jewelry as well. That one did pretty well. I think that one's up close to around 15%. And that's already a stock that's rallied big time. What do you like from here? Stick to the big name or flirt with those valuation opportunities?
Yeah. I think that's an interesting space overall. If you look at some of the other players are now vying for that market share of the organized players. So Kalyan has been consistently reporting strong numbers, but I think if you ask me, the preferred pick always remain with the market leader here, Titan, that continues to outperform, continues to deliver quarter after quarter. That is one large cap stock that looks steady to deliver a 24% earnings CAGR over the next 2-3 years. Even if you look at the last quarter numbers, pretty strong. The long-term growth trajectory built on Tanishq brand, that is pretty strong. We believe superior sourcing, the ratio between the gold, diamond, studded that is also pretty positive. And now they are investing in some of the youth-centric brands, sub-brands. They are also getting into the lab-grown diamonds into sub-brands. So the growth path remains pretty strong. So while the gold price stabilization, that will be a key positive for the entire jewelry sector, we believe that the Titan remains the bellwether of the Indian jewelry space, and we continue to like it. That is among our preferred pick within the jewelry space. Our target price is around 5,100. Still a decent, meaningful upside from current levels.
Got it. Okay, all right. Sid, we appreciate you joining in and giving us all of those cues with regard to the stocks that we just discussed. Well, it wasn't such a bad day, right? I mean, if you're going to say that we're going to start off closer to around 20,250 and end at around 20,450, the bulls will be pretty happy. 150 points higher on the Nifty Bank as well. So they'll be fairly content with today's performance. And the biggest positive, I think, was the number of stocks advancing. Again, they outweigh the number of stocks declining. Titan, their commentary in that investor meet was heartening, and the street latched on to that. Stock went home with a gain of around 4%. Eternal, sharp correction from the top, but that one bounced back as well, up close to around 3%. Coal India, that one has actually made money for those that applied in the OFS. And we had, highlighted the point that the government's picked a perfect time to come in there and sell one of these assets. And it seems, investors have made money who played it for a tactical trade. Tech, it stabilized today. So, you had a few of those names that did pretty well, though Infosys was down 1.5%. You had Tech Mahindra that was up and about in today's trading session. And TCS as well ended in the green. On the flip side, you had Bajaj Finserv as well as SBI, both of them, SBI Life that is, that ended with a bit of a cut. Broader market, some of the stocks that fell, they have bounced back. PG Electroplast was up 5%. Force Motors was up close to around 6%. And Voltas, it's getting very, very hot. Maybe we're bracing for a longer than expected summer. That one, in fact, did pretty well. Saman Capital, one of those re-rating candidates, change of the management control, ambitious plans in the next 5 years. Street is bidding that stock up 3.5% higher in trade today. On the flip side, you had Nalco that came in for profit taking, down close to around 5%. Remember, these are stocks that have run very, very hard, but that one was up 5%. BHL as well ends closer to the low point of the day. The street is sniffing some kind of negative news flow. We'll have to see whether it comes, because that one was down close to around 5%. And metals on the whole, they had a bit of an off day, because SAIL as well was down close to around 4%. Net, when you see the screen green, as you wind down markets after seeing a red screen in the first 15 minutes, you'll be pretty content. On that note, we'll wrap up on this edition of Closing Bell. Don't go anywhere. The team of Markets Forward comes up next.
welcome to the Editor's Playbook. I'm Shireen Bhan. Now, veteran banker Uday Kotak has stirred the hornet's nest again with his recent tweet. Referring to Google's massive capital raise of $80 billion, Kotak highlights that Google's market cap of $4.5 trillion is close to the total profits and market cap of all Indian listed companies. Now, Kotak calls this a wake-up call to all companies to invest into the future. Kotak is not the only one to raise concerns over poor private capex and innovation spends. Many believe India's growth story is being constrained by its inability to significantly boost investment in research and development. Now consider this, India spends less than 1% of its GDP on R&D, while not an entirely fair comparison given our per capita, but just for context. Not just the United States and China, but even countries like Korea and Taiwan spend significantly more on R&D. If you watched our previous episodes, then you would know that we talked about the concerns around the AI supercycle and why India finds itself on the margin currently, but with the chance to build its own niches over time. In an increasingly volatile environment, a current account deficit is not a problem to take lightly, and hence the urgent need to accelerate exports, move up the value chain and move beyond being just consumers to being IP creators. Which brings us to the question that we're asking today. Can India become an innovation superpower without significantly increasing its R&D spend? As India globalizes, will it be forced to innovate to compete or struggle for survival? And can the government really fix the R&D problem, or is it true unbridled competition that will be the real answer? And will new emerging sectors like biologics, renewable energy, defense, space give us confidence to break through into some sectors on the global map? Joining me to discuss all of this and more, Prashant Nair, Nimesh Shah, Rima Tendulkar and Sriram Iyer. Rima and gentlemen, many thanks for joining us here on what is going to be an exciting Editor's Playbook. Rima, to you first. Let's address the big elephant in the room. India has long had an R&D spend challenge. But the question that's being asked is this weakness becoming more visible today, particularly in the way that global capital is being allocated?
Absolutely, Shireen. So let's begin first with the problem and the numbers and the harsh reality. So India's spend on R&D as a percentage of its GDP is the lowest amongst developed nations. We stand at 0.65%. For comparison, Israel is at 6.5%, Korea is at 5%, Taiwan is at 4%, US 3.5%, China 2.6%. In absolute terms, US and China, both of them spend $1 trillion on R&D. India, by comparison, spends about $20 to $22 billion. And this is our entire national budget. We're talking about government, universities, and the private sector combined. And to put that number in perspective, right, that $22 billion, well, one company in America, Alphabet, spends 3 times that of that in 1 year alone. So last year, Alphabet spent about $65 billion on R&D. And the reason why India stands apart on the league table versus others is that in these developed economies, it's the private sector which does the heavy lifting. So 70 to 75% of the R&D spend comes from the private sector. In India, the number is inverted. It's the government which is driving the innovation engine, and they spend about 60 to 65%. So the private sector has been lagging in India with about 35% in terms of contribution. And just some more numbers, right? For India, this was not a problem till AI came along. So talking about the top tech companies, whether it's Korea, whether it's US, they spend on an average 10 to 30% of their annual revenues on R&D. For comparison, the Indian IT companies, Infy, TCS, HCL Tech, they're spending 1 to 1.5%. And if you look at the top 10 Indian companies, according to Bloomberg, we're spending an aggregate $3 billion. That's it. And once again, to put it in context, and Alphabet is at 65, Amazon is at more than $100 billion in terms of spend. So Shireen, I think that is the reality of where India stands on the R&D league table.
That's important, the context and the data that you put on the table. But, I want to pick up on that data point that you mentioned, Rima, that it's actually the government that is doing the heavy lifting on R&D spends in India and not the private sector, which is actually the case that you see in markets like the US and others. And I think that's the question that is often asked and left as the problem at the government's doorstep. But really, is that the right question to be asking? Is it the government's responsibility and the government's role to fix the R&D problem, or is it unbridled competition, capitalism at its very best, that will in fact address the problem of R&D. Prashant, I want to get you in on this because here's an interesting conversation that I had just earlier this afternoon. And the comment made was that, look, up until now, it's been largely a protected economy where domestic players have enjoyed protection. It is now in the wake of FTAs that India is signing with the world, from the US to the UK to the Gulf countries, etc., that India is going to truly start to be globalized. So Indian industry will no longer enjoy the protection, which is why it didn't feel the need to spend on R&D. Will it now be forced to spend on innovation, on R&D, because it has no choice, because it has to compete in a global arena? Is FTAs or globalization going to be the real game changer when we talk about R&D, Prashant?
Shireen, the context is important, right? And just think about it. It's always the case that it's like in markets when we're one market and our market is not doing anything and everybody else is not doing anything. You don't feel anything, right? I mean, we're in this boat together. But when other countries are doing much better, that is when it starts to pinch, hurt, and what are we doing and what are we missing? And in that one more context, I mean, it's actually and we did this show earlier as well, and I remember that we live in a time of absolutely radical innovation, right? And I think this has been true now more than any time in the past. And this is not about AI or anything, but across fields, across material sciences, medical breakthroughs, right? I mean, we're talking about not a cure, but I mean, some treatment available for, cancers, pancreatic cancer recently, right? I mean, so there is so much happening, and we talk about the obvious ones, which is large language models and space and, of course, advanced manufacturing. We'll talk more about that. But I think it is also that. And this is so different, right? Compared to where we were a few years back. I mean, I was just thinking, we're in little over a year of Trump 2.0. Just go back to the first year of Trump 1.0, right? Which is what, 2017. What were we talking about? We were talking about kind of secular stagnation, software had eaten the world, and not very much happening and not very much perhaps going to happen. And it was that, and it's completely changed, and I think that is the reason why this is now come to the forefront in such a big way. I'll just tell you, Shireen, one thing. I did a program, and this is some time back. It's been about 8-9 months, but I went back and looked at it as I was coming in. I did a show asking just that question, right? I mean, I think when Mr. Kotak started to put this question up the first time, and I had two Indians who were early. One built the backend for Facebook, and I had another gentleman who built important software for Google at that point in time, and both were in the Valley, and both, by the way, at one point were colleagues, and they're back in India now. And I did a 30-minute program on it, and I sort of went back and heard it on 2x speed, and I just came back with two things they said. They said of course, Silicon Valley and what's happening in the US is another level, because it's like, the ecosystem has been built for 50, 60 years, right? Yeah. So it's not new in that sense. That ecosystem is there. The second point they said is the strong relationship between academia and venture capital. I think that is much underappreciated. It is happening here as well. I mean, the acknowledgement is there. The IITs are doing it. Lots of unicorns out of some of these. And you, sort of, I guess, have sat down with more than anyone in that regard. And the third is just, what they said, which is, ambition. And their point was, and they're both now angel investors. And they both said when we sit down with founders looking for capital, etc., the mindset is serving domestic market. What can we do to solve problems in India? Whereas when companies are building in, Silicon Valley or wherever, I mean, in the US mostly, they're thinking of, sort of, in a way, global problems and what can we do for the world, and that's the market that they're targeting. So, I mean, just a bunch of things, but this is an important topic, absolutely, Shireen.
I think you had a list of the number of Indian origin billionaires that have been minted in the US on the back of patent filings and so on and so forth.
So this is interesting data. This is immigrant founders, right? US who've started US $1 billion startups. So this is not an exhaustive list of sort of, you know, founders, right? There could be more founders here because, I mean, 2 or 3 founders could have been responsible for one company. But and this is data from a not-for-profit, and this is as of April of 2026, right? India has 96 companies, 96 of these billion-dollar startups, and Israel is at number 2 with 60, UK at 47, China at 41. So it is obviously the case, and I don't think anyone is making that case, but I think the data just bears it out that you know, Indians have it. It is perhaps the environment, the ecosystem, the encouragement, and of course, you know, capital as well. And Shireen, that's the other point. We say there is enough capital, right? And yes, there is enough capital in India, but I think we'll have to look at this a little more carefully in terms of where what that capital is willing to bet. Is that capital willing to bet, you know, deep tech, or is it willing to bet more sort of, you know, consumer kind of businesses, etc.? And you know, the government is doing more, and I'll come back to that in a bit.
No, fair point. And, you know, this brings me to that point that Navneet Munot was making, Prashant, when you and I were chatting with him the other day. And Navneet's point was that, you know, forget all the other PLIs. We need a PLI for talent. And that really bolsters that graphic that you were showcasing just now, Prashant. I mean, you know, India has talent. Indians have gone on to become wealth creators and value creators in other parts of the world. What can we do to unleash that? As I said, and it's running on our screens there, forget the IPL. India needs an innovation league. The India Innovation League moment has to now be delivered on for India to take its growth story forward. But, you know, Nimesh, on this point about where money is going and what kind of business ideas are being backed, and again, this is split people. You know, there's people who believe that, you know, India is not focusing enough on deep tech. Indian entrepreneurs are taking low-risk businesses public and so on and so forth. They continue to be betting on the labor arbitrage as the core fundamental business model. But, you know, my point is, why should one be seen at the exclusion of the other? And are we creating value with those kinds of businesses as well?
Shireen, you know, before I give to that point of whether we are creating value in the other businesses, let me give a bit of a positive spin to whatever we've discussed with regards to India. You know, as Rima pointed out, the private you know, involvement in the R&D is very, very low. But you know, for the first time in many, many years, you're seeing some bit of fruits for R&D in the pharma space, right? Sun Pharma did it, and now Wockhardt did it. You know what this will mean is market will start giving value to them. And that is how, see, it's a capitalistic market, right? All the promoters wants to really make value. The value gets done in the US. They give a lot of value to this kind of R&D sort of businesses. For the first time in India, you're going to see markets giving value to these businesses as well. We saw a big rally in Wockhardt. We saw a big rally in Glenmark. And look at even Zomato. Okay, we can call it it's a labor incentive, but hats off to Zomato and hats off to some of the food delivery businesses. They've done a phenomenal job. I mean, this is something which even US has not been able to crack it, right? The kind of pin codes that India has done, it's fabulous. And today, Zomato has a market cap of 3 lakh crore. Can it go to 10 lakh crore? It can. I mean, it can be like a game where the winner takes it all. And Zomato could be one of that. So I guess there are some pockets where, you know, value is getting emerged. Businesses are getting valued in India as well. And if that has to happen, maybe you'll see, you know, further investments by corporates as well, and the private sector, you know, R&D also picking up as well, because ultimately they want value to be created, and if they see that market is giving value, they will start investing.
You know, just to add one point, Shireen, you know, up until now, the market never penalized any company for lack of innovation. So just look at the lens from IT. IT companies were rewarded when they were giving you dividends and doing buybacks. But had they, 10 years back, invested in a moonshot project, knowing what we did 10 years back, they would have faced the investors' ire. It's only now, when there is so much talk about deep tech and the fact that we missed out, that you realize that, oh, this is something we missed out on. And now if they start making investments in R&D...
It's awfully similar to the conversation we had on this last year on the same show, right? We lighting up how much they had given out in
we all talk about what we missed out, but we also, you know, should give the credit to the fact that today we've created the best ecosystem in the financial space, right? UPI has been the biggest success story of the last 10 years. And somebody was telling me if UPI gets listed, probably we'll have one of the biggest, you know, blockbuster IPOs like SpaceX.
But I think in the way that this conversation is going...
That's a good point to consider. But and again, I think the pushback, and this was the pushback again this afternoon, was that, why do we look at innovation only from the metric of R&D spend?
Exactly.
Let's take Indian Telecom as an example. And if you were to take a look at the amount of the quantum of actual R&D spend, it may not seem like a significant amount, but has there not been innovation that's been driven by the Indian Telecom story? So do we need to also change the manner, the metrics that we look at innovation, the lens that we look at innovation?
By the way, I have a...
Sriram, you wanted to make a point.
Yeah. So at the outset, the way this conversation is going, at the outset, I want to say that money doesn't innovate, people do. And I have a story of two people, Samar Kadri and Zubin Barucha. Let's say their job was to find precious stones, right? For 15, 16 years, they went around looking for precious stones. And they had a usual day at work. Sometimes they would find something nice, sometimes they wouldn't. More often than not, they wouldn't. But and their combined salary would be, say, anywhere between 3 to 5 crores a year. Could somebody have, in 2008, 2009, from then on to another 15 years, somebody foot that bill for them to find those stones, right? For 15 years, they didn't. Suddenly, in the 17th year, Samar finds something, the smallest stone that he's ever seen, right? And he's like, goes to Zubin and says, let's pay a couple of crores for this today because it might be worth a lot more in the near future. How many companies do we know where this will pass, right? Some consultant will come in and say, you know what, can we do this more efficiently? Can we, reduce the cost of it? Can somebody do this for cheaper? But Zubin backed Samar's gut because he knew what he was talking about. And he said, let's take the punt. And today what they have is what is likely to be India's biggest export for the next couple of years, if not longer. And our biggest soft power for the next couple of years, Vaibhav Suryavanshi. And when you wanted to talk about India innovation,
I was waiting. I said, this has got to be a story we know, right?
I know. I was fully invested in this story. I was not prepared for that.
Yeah, I told you I had a surprise.
For that, but yes, you clearly did. We need, and I think that there's an important point.
Not a surprise to our producer, Idia.
We need the Vaibhav Suryavanshis.
I had given Abhishek a heads
from tier
up.
2, tier 3, tier 4 towns to actually feel like they can take risks. They can, and again,
no, it's not just the player, right? Shireen. It's not just the player. It's Rajasthan Royals that paid the bill for a highly paid scout, director, Zubin. And somebody backed them until...
Let's be fair that every IPL team is doing. And this is exactly what, once you start paying and you get the reward, they will start investing more. Yeah. That's going to happen with the corporate world, corporate India as well. The more they get value from the market for the R&D spends, they will start investing more.
What, chicken
so that
and
ecosystem has to be created.
The money, you
I
get
think
the
it's
reward.
Getting created now.
But the point is that we've never had that. We've never had that culture of taking a big risk.
But that will change. That will change now.
But also to the point, Sriram, as was being made, by somebody in a conversation with me earlier this afternoon, that we didn't do it because we didn't feel the need to do it. Yeah. But now it is not a matter of should we, or it is a matter of you will absolutely have to if you want to compete in a global arena. And so to the point that perhaps the FTA will be the big R&D booster shot that that corporate India needs, because it's a matter of survival if you want to stay relevant. But coming back to the Vaibhav Suryavanshi point that you made, that we need talent to be unleashed from all parts of the country, from all walks of life. Let's look at the future bets. And Nimesh, you've been doing a lot of work around the defense sector. And again, we look at innovation from the lens now obsessively of AI and what Indian IT has done or failed to do. But let's also diversify. Let's look beyond that. In the defense space, in pharma, we've talked about what Wockhardt, Glenmark, and it's taken 20 plus years for them to get to the point that they have, but they stayed committed, made those bets, and those are starting to show some results. Biologics, space. We've just had a whole bunch of Indian space tech startups on Young Turks this week. And today we're talking about SpaceX and an IPO at a valuation of $1.75 trillion. And this could, in fact, be a race that India is not going to play catch up, but very much be part of the table. So, Nimesh, you know, the future bets and where India finds itself positioned.
So, you know, defense is one name, Shireen. But again, I wouldn't say in defense there is more of innovation. It's more about, you know, doing on our own. Like it's make in India, and that's helping a lot of defense companies to do well. They have started innovating and doing a bit of exports as well. But as you know, he pointed out about Suryavanshi, there is one more, from a market perspective, I'll give you one name. There is this company called Cedimac. Okay, it got listed just a couple of months back. It's basically founded by the MIT professor and the MIT students. Okay, TVS was the first company to fund them. They now 70% of the business comes from TVS, but every other OEM, two-wheeler OEM is now on the doorsteps to get the product from them. So I know, again, I'm saying the same thing. You know, as and when the corporates see the reward, the markets start rewarding, you will see more and more talent and more companies coming into R&D and spending. And actually, you know, in fact, the company that you interviewed, Shireen, a couple of days back, the first company to get into aerospace, right? I was just looking at some numbers, and they're talking about massive growth, 150 crore top line to some 18,000 crore top line by 2030 or by 2032. So again, you know, they just need that kind of visibility and funding, and I guess, and market is now trying to give that funding and give that valuation. So I think it's very important that, you know, India picks it up and actually delivers. There is a lot of money and talent now to back the R&D spends as well.
Shireen, I spoke to, I was at one of the conferences, it was yesterday, and it was a manager of a, you know, it's a fund, but they largely invest in deep tech now, and all kinds of companies. And I later looked at their portfolio companies, and they said, well, they work closely with IIT. They're based in the person is based in Chennai. So they work closely with IIT Madras. They said, well, most kids who are passing out of IITs now, I mean, the first choice is not to look for a job with Google or you know. They want to start something on their own because they think they have ideas which no one else has, right? And they are getting, I mean, they're getting not just from these kind of VCs, but we know for a fact, Nimesh.
No, Bajaj has announced, right? Bajaj Group.
Lots of individual large, you know, public equities only investors so this is, the money is there.
Let me spin it in another way. There is, see, the point that I would say is that I would be a little less generous and I say, you haven't done it so far. You guys are saying it looks like they will do now, right? But my point is that there is a reason why, like Bajaj has now invested in some IIT. They have committed some money to one of the IITs, right? And which I think is a great move. And there is a reason why we should do it. And let's look at India's ranking in the innovation index, right? So we are overall 38th, which has gone up from 48 to 38 in the last few years, which is a good thing because our patent filing process, etc., has improved. But what are we lagging behind on? We are ranked 116 in applied tariff. Rank 113 in tertiary inbound mobility. I'm not exactly sure. I'll concede that I don't know what it means. I'll figure it out. Rank 107 in net FDI inflows. Among 139 countries, we are 107th in FDI inflows. 101 in employing females with advanced degrees. Now, there are so many women who are doing such, I mean, they're academically brilliant, but they are either not part of the workforce or, you know, which is a wasted resource as far as what is spent on their education, as well as the ability that we could have, the value that we can unlock with that. And then rank 98 in teacher to pupil ratio. Now, some of this is not to be solved by the private sector. Some of this, not all of it has to be solved by the government. And the biggest reason why corporates should invest in R&D in India is because we give the best bang for the buck. So in this global innovation index, we are the best among all lower middle income countries in innovation to investment ratio. So we can send a Chandrayaan, a Mangalyaan at a fraction of a cost. So if you give them, if you put $100 on the table, you will be able to derive a lot more than Elon Musk can. Right? And therefore you should.
No, completely agree.
No, I think that is a very important and a very valid point that you make, that you get more bang for your buck. Primarily, of course, going back to the big advantage and the strength that we were talking about, which is Indian talent. But Rima and gentlemen, I think there is consensus that the time is now. There is a change in mindset. There is also a change in the ecosystem.
There is, Shireen, sorry, I know. I know you want to, I know we're out of time. Just one last thing, 30 seconds, right? The government's also got a funding. I mean, they've got a program going, right? Which I think we should, I didn't know about it. I mean, I was told by someone earlier this year, but it's been, I mean, it was formally cleared late last year. I mean, it's a pretty large fund. It's a 1 lakh crore fund, which the government's given to the Department of Science. It's a 50-year loan, interest-free loan. So it's not like a, it's, so in that sense, it's patient capital. And the only condition is just return the money after 50 years, right? That is the only condition. So it's very large. And it's not meant to be disbursed by bureaucrats, etc. I mean, it's going to be done by professionals and fund managers and people in the business, etc. So I think everybody, I think the bottom line is everybody should go and look for their Vaibhav Suryavanshi in their respective sectors. And it is people, it is not money that will do the innovation. Find the right people, trust their gut, trust their talent, and, you know, sit patiently, don't ask for ROI. That's why.
You do have to ask for ROI at some point, Sriram. There's never a free lunch in perpetuity, so you do have to ask the ROI question at some point, which is being asked of AI as well. But I think that kind of ties all of it together, that yes, progress has been made, but really this is the time, this is the opportunity for a lot more that needs to be done. And you cannot keep putting the basket at the doorstep of the government. Private sector needs to get up and do the heavy lifting as well. And we need to create global champions. We need to have global aspiration. We need to have global ambition if we want to be counted at the in a global innovation index as a global innovation superpower. Prashant, Nimesh, Reema, Sriram, as always, thanks very much for joining us on the Editor's Playbook. Tell us if you believe India needs an India Innovation League just like the IPL. Send us your comments. We always like to hear from you. From all of us here for now, goodbye. Thanks for watching.
Hello and welcome to Business 360. I'm Arundhati Ramanan and here are the headlines that we're tracking for you this evening. Crude oil prices ease after Israel and Lebanon agree to a new ceasefire, boosting hopes for a broader deal to end the war with Iran. But Israel carries out multiple drone strikes on Lebanon despite the ceasefire. Tehran says contact with the U.S. has not been cut off. President Trump hints at progress towards a deal as early as this weekend. Sensex and Nifty end with marginal gains after a volatile session. Mid-caps outperform the blue chips. Rupee remains closer to the 96 mark against the dollar. Government considers tax relief for foreign investments in sovereign bonds. Sources say 20% withholding tax and 12.5% capital gains tax likely to be waived. The decision could be implemented through an ordinance. The Reserve Bank's Monetary Policy Committee is expected to maintain status quo on rates tomorrow. 70% of market participants polled by CNBC TV 18 expect a rate hike this fiscal. Majority also expect the RBI to cut the growth estimate and raise the inflation forecast. The U.S. trade delegation set to wrap up the negotiations in New Delhi today. Both sides hope to finalize an interim deal soon. Sources say India has sought protection from additional duties like the proposed 12.5% tariff announced yesterday on India and other nations. India's long-term growth story remains intact, says Citigroup CEO Jane Fraser. She also believes global AI investments are not overdone and expects Indian entrepreneurs to unleash the AI potential. SEBI cracks down on the promoter of jewelry maker Rajesh Exports, says revenue worth over 15 lakh crore rupees was overstated. Rajesh Exports denies wrongdoing despite the damning findings. Stock hits lower circuit in trade. At least 4 people are dead and several injured after a fire broke out in the intensive care unit of a private hospital in Bihar's Muzaffarpur district. Preliminary reports suggest a short circuit may have triggered the fire. Prime Minister Modi hosts the new president of Venezuela, Delcy Rodriguez, in New Delhi. Both nations discuss expanding energy and trade relations. India is likely to increase the purchase of Venezuelan oil. Those were the headlines that we're tracking for you, but the top story this evening, crude oil prices ease after Israel and Lebanon agree to a new ceasefire, boosting hopes for a broader deal to end the war with Iran. Here are the latest developments. Israel continues multiple drone strikes on Lebanon despite the ceasefire. The two countries have agreed to implement the agreement, but say it would require a complete cessation of fire by Hezbollah. Defense Minister of Israel, Katz, said a ceasefire with Lebanon grants the military the freedom to strike the capital Beirut if Hezbollah attacks Israeli communities. Hezbollah drones reportedly hit IDF Northern Command Chief's vehicle in southern Lebanon soon after. But US and Iran continue to negotiate despite recent skirmishes. Iranian Foreign Minister Abbas Araghchi said Tehran's contacts with Washington have not been cut off. However, he maintained that no progress has been made in the negotiations. He said that both sides were studying the texts that were exchanged. In America, the U.S. House of Representatives has passed a measure that seeks to halt President Donald Trump from taking further military action in Iran. The largely symbolic vote was due to a resolution which requires Trump to seek congressional approval for the conflict. The White House has dismissed the merits of the resolution, saying it is an unconstitutional attempt to restrict presidential power. Meanwhile, President Trump remains ambivalent on negotiations with Iran. While telling reporters that the negotiation itself has gone very well, he added that a deal might not happen. And then soon after said that if it did happen, it could be finalized over the weekend. When asked how he would define a ceasefire, he said, and I quote, "In that part of the world, ceasefire is when you're shooting in a more moderate manner."
The negotiation itself has gone very well, actually. Very well.
Mr. President.
It could happen. I mean, if it happens, and it might not happen, you know, who knows? But if it happens, it could happen like over the weekend.
How do you define ceasefire?
How do you define
ceasefire?
Pretty much the way it is. It's a different part of the world. You know, I'd say in that part of the world, ceasefire is when you're shooting in a more moderate manner.
Let's talk about the call that you had with him this week, which is getting a lot of attention.
president confirmed that he said you're effing crazy. How did you react to that? What really happened in that call?
Well, I'm not going to get into details of our conversations. We've had thousands, well, a lot of them. And if you think this is a crisis, you should be in some other conversations. But we've always found a way. We have so many agreements. We agree on the main things. We want to get Iran, the nuclear program in Iran, finished. We want to make sure that Iran doesn't pose a threat to Israel, to the Middle East, to America, that it doesn't develop nuclear weapons and the means to deliver them, not only to Israel and to every capital in Europe, but to every city in the United States. That's our common goal. That's what we set out to do. And to expand the circle of peace, as the President and I did in the Abraham Accords together. So we have common goals. Sometimes we have, as in the best of families, you have these tactical disagreements. We always find a way to work them out. And we do so as great friends.
Russian authorities in Crimea say at least 4 people have been killed following a fresh wave of Ukrainian strikes on the peninsula. Meanwhile, U.S. Secretary of State Marco Rubio has warned that the risk of further escalation in the Russia-Ukraine conflict remains significant and is now higher than it was 2 years ago. And back home, onto the day's market action. Market closed in the green after a volatile session, with the Nifty ending above 23,400. Nifty's gains were supported by ICICI Bank, Titan, ITC and HDFC Bank. Broader markets outperformed and Nifty Bank ended higher for the 3rd straight session. India's Met Department has confirmed the onset of the southwest monsoon in Kerala. The rains have begun 3 days later than usual. The IMD issued orange alerts for 3 districts in the state after heavy rains in various parts. The department expects rainfall in India to be around 90% of the long period average this year. In a bid to boost foreign investor participation, sources have said that investments made by foreign institutional investors in government securities are likely to be exempt from taxes. Sapna Das joins us now with all of those details. Sapna, take us through the government's plan.
Well, surely, Hummus, as everybody has heard and widely expected, I think market participants have also had this demand for a pretty long time. So, given to understand that in yesterday's cabinet meeting under the leadership of the Prime Minister, Mr. Narendra Modi, I think some very significant decisions have been taken in principle. Basically, doing away with all taxes as far as FIIs are concerned and their investments in government securities. It's very specific government securities. So, basically, 2 aspects here. Number one, of course, is the withholding tax. And as I just said some time back, this demand has been there for a pretty long time, that this 20% is extremely steep. Either it should be reduced considerably or it should be done away with. So, probably in principle, a decision has been taken to do away with that. That's one. Second, of course, would be the ITC 12.5% cap gains tax on their investments in G-Sex. Given to understand that too is going. And apart from this, if there's any other taxation to do with FIIs regarding their investments in government securities, all of that is going to be zero. That has been we very clearly understand that for now. So just have to wait and watch and see how this really pans out. The implementation process, of course, there's every likelihood of an ordinance being issued. Down the line, when the monsoon session, the parliament meets, most likely the government will take back the ordinance and bring amendments to the IT law. But in the meanwhile, it can be done in this way. And we have to now just wait and watch and see when that ordinance comes and what is the implementation time.
All right, Sapna, many thanks for those details. Now, the RBI Monetary Policy Committee is set to announce its decision tomorrow. The CNBC TV 18 poll, plus our Citizens MPC, have voted overwhelmingly for no hike. So what can be expected from tomorrow's policy decision? Lata Venkatesh is here with what to watch out for. Lata?
As our polls and our Citizens MPC indicate, the market also is largely betting that there will be no action or no hike. But everyone believes that there is a small chance of a hike. It's not a 100% guarantee. So I wouldn't say it's a consensus no hike call. It's a majority no hike call. Most say they are not going to be surprised if there is a hike if the Reserve Bank, believes that, after all, there is a recency bias. Before you go into the policy, crude has been between $95 and $115 for a better part of 40 days. If you go with that recency bias, the expectation would be that this year's inflation will be 5% or more. And therefore, if you are going to hike later on in the month, why not now? That could be an argument that the Reserve Bank goes with, but that's not, as I said, the majority position. The majority position is they will say no hike, but they will go with a very hawkish stance. And that hawkish stance will reveal itself by a forecast which will be up from the last forecast of 4.6% inflation average for the full year. It would be raised to 5 or something like that. As well, it will be like, we are agile, we are watching, and we will move as soon as necessary to ensure that, inflation doesn't harm economic growth. The reason why people are not expecting the hike just now is it is not going to bring any added benefit in terms of foreign flows coming in, because anyway, debt flows into India have not stopped, nor have they become outflows. It's equity flows that are, hugely moving out. And if you make growth that much more difficult, those flows will leg it out even more. And therefore, even from a rupee point of view, the rate hike is not expected. But what the market will watch out for is not so much for this status quo policy, but for what the Reserve Bank governor says and does on the rupee. Some strong statements, confidence-boosting statements will be expected. As well, this much, reported project scheme that PSUs be allowed to borrow bonds abroad with Reserve Bank subsidizing the hedging cost, bearing part of the hedging cost. That's very much watched out for, whether it will be hinted at in the policy statement and announced later, whether the two will be bundled together along with, a tax, withholding tax being cut by the government. All those are up for, detailed discussions. But something on those lines is what the policy is expected to either hint or announce.
All right, so all eyes on that RBI monetary policy decision tomorrow, Lata. But hang on, the government will also announce the Q4 GDP and the full year FY26 GDP tomorrow, right? So take us through what the market will watch out for.
Well, our poll is what we are watching out for. The Q4 number, that is the most important, Jan-Feb-March number, is expected to come in at 7.3, fairly strong. Last year, that is the year ago, the base year was 7%. So compared to that, we will do better in spite of 1 month getting washed out because of the war. So that will be a good, commendable number, and that will give the full year average of 7.5% growth. Again, very good. The Reserve Bank's and the MOSPI's forecast was 7.6. So 7.5 is quite good. And the confidence for this comes from the lead indicators being excellent. See, Q4 corporate results were very good. PMI numbers have been good. And, even the IIP numbers, auto sales numbers, all that the lead indicators we get have been good for the first 3 months. So, no, the numbers itself will not be something that will surprise. Even if 7.3, 7.5 are very good numbers, 3 years in a row, 7%, that's not going to be enough for the market to start celebrating, because that is priced in. What the market wants to watch out for will be the FY27, and that we are not going to get from the Q4 and the full year FY26 numbers. Any base revisions will be looked at, but the Q4 FY26 and full year FY26 numbers are important to build on the FY27 numbers. There will, of course, be some detail about how much is consumption contributing, how much is capex contributing. Chances are both of them will grow above 7%. So it will be a pleasant set, but that doesn't take away the blues from FY27.
So it will be a pleasant set is what we're expecting tomorrow. All right, Lata, thank you so much for taking us through all of those details. Now, staying with the RBI, former Reserve Bank Governor D. Subbarao believes that the central bank must not hike rates. Speaking to CNBC TV 18, he said that the central bank should adopt a hawkish stance going forward.
The Reserve Bank will have to do a very careful balancing act between checking inflation, supporting growth, and stabilizing the rupee. I would suggest that the Reserve Bank should be on a hawkish hold. The reason being that inflation today is still 4%. Yes, going forward, there'll be pressure, but inflation today is still 4%. The playbook for central banks is to look through a supply shock. So RBI will keep waiting, because even as I said earlier, the impact of higher oil prices is not passed through to growth. So RBI will be more data dependent. For now, they will pause, give a hawkish forward guidance that they're going to withdraw liquidity first before, and a possible rate hike is a possibility on the way forward.
Onto a CNBC TV18 exclusive, Citi CEO Jane Fraser has bet on India's growth, adding that the long-term story of India is intact. Speaking to Lata Venkatesh, Fraser also weighed in on the controversy around Anthropic AI tool Mythos, adding that the tool can be used to solve vulnerabilities.
The long-term story in India is intact. And I certainly saw as well in him commitment to reform agenda, very thoughtful around energy security, looking at driving digitization and the potential of AI for the country. So while there are headwinds, I'd note that the headwinds underlying some of the foreign exchange in the market are the same ones that the rest of the world is facing. They're not of India's doing. We're all facing some of these challenges. And I think for investors and for companies is play the long game, because that's where really the strong fundamentals lie.
You know, speaking of AI, actually, there are programs or languages like Claude Mythos. Of course, you all have got an inside view, and now you're able to fix your bugs. But there will be zillions of your clients who won't get it. I mean, stock exchanges. Shadow banks.
So that's actually
what happens.
So that's actually not true. But what I'm seeing is the players that do have access to the model in the technology and in the different spaces. No one is competing on cyber. There is the different vulnerabilities that will be identified will then be patched for all. So the work that those who have access to the models is looking at identifying where they are, but the solutions will be available to all. So this notion of there's a zero-sum game here is wrong.
Shares of jewelry maker Rajesh Exports hit lower circuit in trade after SEBI found the company has misrepresented revenue by more than 15 lakh crore rupees. The market regulator has cracked the whip on promoter Rajesh Mehta. Despite the damning findings, the company is denying any wrongdoing. State-run insurer LIC owns more than 10% stake in Rajesh Exports. Yash Jain joins us now with all of those details. Yash, tell us more about the interim order by SEBI.
Well, this is quite a scathing order from market regulator SEBI, stretches across 109 pages. The two entities named in the order as notices are Rajesh Exports, the entity itself, and Rajesh Mehta, the promoter of Rajesh Exports. As far as the period of investigation is concerned, that's between April 2020 to March 2024. As I said, a 109-page order, about 14 to 15 different kind of allegations listed by market regulator SEBI, and substantiating all those allegations with large numbers in terms of misappropriation of funds and financials. But I would divide these large 14-15 allegations in 4 different areas. The first one, SEBI says that there's been a systemic failure on the part of Rajesh Exports to substantiate its financial figures. Second one, non-availability of financials of Rajesh Exports, subsidiaries and step-down subsidiaries. This is an important point because the subsidiaries and the step-down subsidiaries together contribute more than 95% of the consolidated revenue, and that's where misappropriation of financials seems to have happened as per SEBI's order. The third one, selective and incomplete disclosures by Rajesh Exports, and finally elimination of intra-group transactions to mask risk, entity-specific risks, cash flows and related party exposure. This is what market regulator SEBI has said. And just to give you one number, I mean the total consolidated revenue where there could have been some misappropriation of financials as per SEBI goes to as high as 15 lakh crore rupees between FY21 to FY25. So that's the extent that we're talking about. In terms of role of Rajesh Mishra, he's the promoter, executive chairman and director and the audit committee member, and SEBI says that the alleged violations could not have happened without his knowledge, consent and involvement of Rajesh Mehta. As far as the order is concerned, SEBI has barred Rajesh Mehta from buying, selling or dealing in securities of Rajesh Exports till further order, and Rajesh Exports will have to make a true and fair disclosure of its financial statements and related party transactions. This is an interim order because SEBI feels that the matter was very serious and some kind of stoppage had to put at this point. The investigations, of course, will continue and a final order will be awaited.
Your internal audit hasn't functioned. It's reported the audit committee is already conflicted because the promoter is there and you have 2 other members who don't have any expertise per se in looking at some of these structures. A company which is basically doing tolling, right, gold refining, is reporting a margin of 1% or less. Does that even fundamentally make sense? See a lot of these red flags, some misses. The AGM last year was held in December. There are some filings which have not been done. So some of these things don't really smell right, and that's something you should worry about.
On that note, it is time for us to head into a short break. But coming up next, at least 4 people are dead and several injured after a fire broke out in the intensive care unit of a private hospital in Bihar's Muzaffarpur district. That and more when we come back. Stay tuned. Welcome back. You're still with us on Business 360. At least 4 people have died and several others injured after a massive fire broke out at a private hospital in Bihar's Muzaffarpur. As per officials, the blaze erupted in the intensive care unit of Prasad Hospital, triggering a frantic rescue operation. Around 20 people were evacuated from the ICU and the remaining patients have been admitted to nearby hospitals. Preliminary reports suggest that a short circuit caused the fire. The death count is expected to rise as rescue efforts continue. The Delhi police have arrested florist stay B&B owner Lavkesh Bajaj and booked him for culpable homicide. This arrest has come a day after a devastating fire at the B&B in Delhi's Malviya Nagar claimed at least 21 lives and left dozens injured. Investigators alleged the guest house was operating beyond its approved capacity. Police also said Bajaj left the scene without assisting those trapped inside. Authorities are now examining possible safety violations. Amazon has unveiled the next generation of its autonomous warehouse robot named Proteus. This is a part of a broader €10 billion investment plan in Europe that is aimed at modernizing its fulfillment network and speeding up deliveries. Shivani Bazaz brings us more details. Shivani, take us through Amazon's plan.
Well, we are coming to you from London from Amazon's Delivering the Future event, where the e-commerce giant is laying out what it believes will define the next phase of shopping and logistics: quick commerce, AI-powered robotics, and faster deliveries. Now, top of the list is Amazon's quick commerce push, its ultra-fast delivery service, Amazon Now, which promises groceries and essentials in under 30 minutes or less, is now expanding internationally, with India and United Kingdoms among the focus markets. Here in the UK, the service is already live in parts of London and will soon expand to cities like Manchester and Birmingham. That's what Amazon has announced. Now, Amazon is also putting serious money behind the back end. Now, the company today has announced a more than £10 billion investment to expand and modernize its European fulfillment network, with robotics and artificial intelligence and automation at the core of it. And among the biggest reveals here in London today in the event is Amazon's next generation AI-powered Proteus robot, which can understand natural language commands from the employees and take over physically strenuous tasks inside the warehouses. Europe deployment is planned for the first half of 2027, which is next year. For India, where warehouse automation is becoming a bigger focus amid rising e-commerce demand, technologies like these could eventually find relevance as Amazon scales fulfillment capabilities. Now, other things at the same time, Amazon says it will add 25,000 jobs across Europe and invest $1 billion globally in employee upskilling by 2030. Back to you. This is Shivani Bazaz from the V&A Museum in London.
All right, Shivani, many thanks for those details. But with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
I have with me the chair and CEO of Citibank, Joe Fraser. This very important CNBC TV 18 conversation, perhaps the most important we have had. Jane, thank you very much indeed for joining us.
Well, it is an absolute privilege and joy to be back in India again.
Well, I should have introduced you as not just chair and CEO of Citi. I should have said, I'm speaking to the most powerful woman in business, voted by Fortune magazine. Many congratulations.
Oh, thank you very much indeed. That was certainly one for the team.
Okay, of course it's for the team, but I just wanted to ask you, let me start there. Do you owe this absolute honor to all the travails you went through, rising, breaking all glass ceilings? or do you owe it to what Citi has just, accomplished? Highest revenue growth in 10 years?
I think it's a combination of a journey which many of our colleagues have gone through around the world, including here in India, and then delivering the results from it. Although we're at a waypoint, we're not at the final destination as a firm. But I think it's a recognition that we now have a new Citi. We have transformed ourselves, but we're now demonstrating what we can do.
Okay, that's good to hear. And of course, I'll have have more questions on that. But you have an Indian audience listening to you. So, we are in a bit of a despondent situation now with 2 years of stock market index falling. So we are in correction territory. The currency has fallen for 2 years. What is your sense about what you're picking up from your corporate clients and investors about India? Is it time to join the crowd, to bung in? What are you listening?
What I see in India, there was a discussion I had with Prime Minister Modi yesterday when we met him for nearly an hour, is that the long-term story in India is intact. And I certainly saw as well in him commitment to reform agenda, very thoughtful around energy security, looking at driving digitization and the potential of AI for the country. So while there are headwinds, I'd note that the headwinds underlying some of the foreign exchange in the market are the same ones that the rest of the world is facing. They're not of India's doing. We're all facing some of these challenges. And I think for investors and for companies is play the long game, because that's where really the strong fundamentals lie.
Yes, there are some fund managers who are still sticking because they are playing the long game. But just anytime now, it's possible that the Indian government will remove the taxes, withholding tax and capital gains tax on debt investments coming into India. You think these things will move the needle? And
look, I certainly think they will be helpful in easing some of the short-term headwinds that are being faced. But again, you look at the stock market here, a little bit of victim of one's own success. The India stock market has been incredibly vibrant for a long time. The retail investors have been very active. You want the retail sector invested not in deposit accounts, but in the markets and investing for the long run. But the valuations are higher here than in some other countries. Some of the private investment has been lower on the FDI side, as well as lower on the private capital and the corporate side. So the growth drivers are a little less clear in the short term. The long-term ones, this train keeps on moving. I see it in Citi's own results. I mean, we've got tremendous growth here, connecting India, the world, and the world to India. And that's why you hear me convey such confidence about this long-term story is intact.
I will come to the Citi India questions as well. But, sticking with markets, just the other day, Jamie Dimon was telling on CNBC that there is exuberance. Would you say US markets and some of the markets are in irrational exuberance terrain? Are they looking through too many of the red flags in terms of crude oil or possible, overinvestment in AI? Do you worry over leverage of governments? Do you think they are not bubble terrain, but irrational?
I think they're a tad optimistic, if I could use some British understatement there for the moment. And I think there's a lot of money in the world. That money wants to go to work because it knows that creates value. It can drive growth. But and there is a lot of transformation going on. So there is also a bit of a fear of missing out in a lot of what's going on. But I do feel as if the markets think everything that can go right will go right, and that companies who've done a fantastic job of being the source of resiliency, being so adaptable with everything that's been thrown at them in the last few years and have continued growing, there's a sense that just continues to happen. And at some point, something gives. None of us know when, and anyone who said something was going to give 2 years ago got that wrong. at some point, inevitably, there'll be further bumps in the road and maybe some more dislocations. But again, I don't think the AI investment is overdone.
Oh, okay. I'll come back to that point as well. But you know, speaking of AI, actually, there are programs or you know, languages like Claude Mythos.
Yes.
Of course, you all have got an inside view, and now you're able to fix your bugs. But there will be zillions of your clients who won't get it. I mean, stock exchanges, you know, shadow banks.
So that's actually
what happens?
So that's actually not true. But what I'm seeing is the players that do have access to the model in the technology and in the different spaces. No one is competing on cyber. There is the different vulnerabilities that will be identified will then be patched for all. So the work that those who have access to the models is looking at identifying where they are, but the solutions will be available to all. So this notion of there's a zero-sum game here is wrong.
Okay. No, I agree. Yesterday, CrowdStrike also reported their numbers, and they are very confident of their cybersecurity answers to.
Yes, and the patches that will be delivered will be available to everybody, not just those with the model. So that I think is something people are missing.
No, I agree with you, but it's just a worry that some of us, even some of the Indian companies have got a look in with some Mythos being available to us. There's just a worry that you may be lending money to people who perhaps are not up in the game, and the hackers get hold of Mythos before they get hold. Are these not worries, or am I overstating them?
What we encourage everyone to do is to use the AI models that are available for everyone to make sure that you are not only looking at how do you make your customer service better, how do you make your growth potential there, product life cycles faster, make your company more efficient, but you also deploy it defensively to identify where there are potential vulnerabilities and get them fixed, and to do so with urgency. Yes.
Fair point. That's what they are.
Yes.
There's a word more on AI before I move on to other things, macro and banking. Would you worry that AI, because of its ability to increase productivity, may lead to a world where more and more work is done by fewer and fewer people, and it's an increasingly K-shaped economy? Are there worries about our macros being, global macros getting too unequal?
So let's look at India. When I think of what AI could do in terms of healthcare, very positive. When I look at what AI could do, particularly on the back of the payments network that is here in India, enabling the incredible craftsmanship that women have, or their cooking abilities or others, to unleash more women's potential into the workforce as entrepreneurs, and create a whole new raft of economic growth potential, all for the young. The great leveler, because one thing I look at India, and what it will not do is sleepwalk into AI. Right? This country and the people in the country are going to look at entrepreneurship opportunities, and I look at it, say it will unleash new growth that we haven't thought of, new opportunities that I hope will be much deeper in the in the economy than just the large corporates that are there. And I don't pretend that there won't be dislocations. There obviously will. We're all going to have to adapt. But let's put a lot of energy into where the new growth potential can be to counteract the area that make sure there are plenty of puts for the takes. It's got the potential for that.
Well, since you are sticking to India, let me ask about City India.
Yes.
This year, not this year, over the past 5 years, as part of your reorganization, you have sold off the consumer banking divisions in India and 13 other countries.
Yes, everywhere outside the States.
How has City India done? Have you been able to make up those revenues?
Yes.
Or you're managing with lower revenues here?
So we closed that transaction in India in the summer of 23. By March 25, which is when we last reported our results, we have seen a 35% growth in net income versus where we were when we owned the consumer franchise. Our revenues have grown 30% and our balance sheet 25%. And I think this is something that for all of us is to take confidence in the power of focus. We focus a franchise on clients who have cross-border needs, need to tap into global markets, and we made sure that we are excellent and in investing behind that and delivering that. And we've seen tremendous growth in the franchise here. We are still the most profitable foreign bank in India from the last audited results. So that is an example. Again, as economies get larger, like here, there is a lot of value from scale, speed, and focus, rather than just too much breadth.
Actually, since you're speaking about reorganization of Citi under you, I went through your investor presentations, very interesting presentations. You're speaking about flattening of the levels, and you have, of course, rationalization into 5 major verticals. You have new platforms, technology. To which one would you owe, maximum returns, maximum bang for the buck?
I think what we did when we reorganized was we moved from operating like a holding company into actually at the center, running the different businesses, making sure that we had enforced standards consistently across the firm. And we simplified the running of the firm materially, made it faster, more agile. Thank goodness we did in this world with everything that is going on. But I think it's the combination of all of them that increased the speed, the agility of the firm, made it easier to connect, made it easier to run, and therefore we could drive the results for our clients and get the financial benefits off the back end. So it was the combination. I wish it was only one thing, because that would have made it much easier.
No, I agree with you. I mean, flattening. I was very impressed by the flattening of levels.
Yeah.
There are some new age companies which have even flatter, levels.
They don't operate in 180 countries, though.
That's true. That's true. Coming back to, again, the reorganization itself and your investor meet, your investor day. In your presentations, you said your ROTCE, I mean, for my viewers, return on tangible capital employed, you've reached 13% and you're promising 14 shortly. There is a view among the analysts that you're probably under-promising so that you will over-deliver. Is that fair? I mean, should we expect an upside surprise?
Well, the 13% we delivered was in the first quarter. That's always the best quarter of the year. And sadly, one quarter doth not the full year make. So we still are very focused on making sure we deliver the returns we promised this year for the full year, 10 to 11, and that we continue the journey. We're at a waypoint. We're not at a destination. And there is a lot of upside ahead. So we look at that. But at the same time, we want to make sure we're investing. So I want to make sure there is capacity in the results we deliver the shareholder, that I'm not cutting off my nose to spite my face, as it were, by hitting a number, but without doing the investments that will continue our growth trajectory in the medium and long term. So that's essentially the message that we were giving is, we will deliver what we need to deliver. We will improve our returns and continue steadily improving our performance, but we're also not going to sacrifice the long term for the short term. Citi's done that once before. It's not happening again.
No, fair point. And it's really candid of you to say that the first quarter tends to be the best quarter.
Yes.
The other problems with the forthcoming quarters is also that the impact of the war is going to be felt in some of your major areas. For instance, in Asia itself, would you say the returns would be lower because, countries like Philippines, India, we all are belaboring under higher current account deficits. Would you worry, or do you still think corporates there are still resilient, even if the countries are not, as you once put it?
Look, I think companies are very resilient. They're very adaptable. And that's why we've seen a lot of buffers in supply chains, energy storage, etc., to protect against disruptions. But I have a lot of concern and empathy for the countries that are, have more challenges and don't necessarily have the scale that an India has. And also the government here. I was very impressed with Prime Minister Modi yesterday, how thoughtful he is about energy. the actions the government will take. And has done already. I think similar to COVID, there's some confidence in that. But not every country will do so as effectively. So I worry about that for them. I don't worry about it for our bank because we are the source of resiliency for those companies. We have a very strong balance sheet, strong capital, strong liquidity. We're there for them to provide financial resiliency, and we're there to provide operational resiliency, helping reconfigure supply chains, look how do they access what they need, onboarding new suppliers onto them and making sure their working capital and their hedging is there to protect them.
Yeah.
So we not only like investing in helping our clients grow and succeed, but we also help make sure that they can do so when there are challenging times and provide them the support that's required.
You know, I'm asking you this question from a Citi investor.
Yes.
Maybe in the
Yes.
United States and all over. Would you worry that your revenues from your own corporates and your constituencies may be impacted because of Middle East? I mean, Viz Raghavan was on CNBC TV 18 last year, and he was so optimistic on Middle East.
Yeah.
But now they're bound to be impacted because so much of their oil output has been hit. Would you worry, therefore, that Middle East will take time to come around and impact your revenues?
I don't worry about our revenues.
Okay.
Because when there are more challenges, clients also need us to be providing the support in terms of volatility, hedging, credit facilities, other elements. So that port in the storm generates revenues the same way as when the economy does well. We're also there with businesses in capital raising and acquisition finance, M&A advice, etc. And that's the benefit we have for our investors of a diversified revenue base that can, as we have done the last 4 or 5 years, rates can be, when things are going bad, rates do. Our rates business does well. M&A does well when there's transformation going on. So there is some balance in it for our investors.
Oh, that's a point, yeah. I mean, I guess more working capital, you may be actually giving out more loans.
Yes.
And even US companies, huge ones like Google are raising money. So probably you're not going to be in the money. My worries are misplaced.
Yeah.
But speaking of rates, since you kept speaking about that, do you think that the US rate is very important for us? It's the risk-free return for the world. the last rate is 4.5% for the 10-year benchmark.
Yes.
Do you think it can go even higher at the rate at which governments are over-leveraged, the rate at which large companies like Google are raising money? Should we be worried that the risk-free return, if anything, will be higher by the end of the year?
So in the shorter run, so over this year, I think we have to see what happens with the straits. It's obviously going on for longer than the market would like and companies and countries would like. How long that goes on has a material impact on what will happen to inflation for the rest of the year globally. And we've already seen inflation tick up. So the central bank job is not easy at the moment because they've got to try and balance the growth equation at the labor market equation in the States simultaneously with what happens with inflation. They can see through. We know why the core inflation has been lower. This will put it up, but at least the fundamentals are driving it lower down, which has been good. But the longer this goes on, the more likely it is that we'll have a different dynamic, not just in Europe, where they've been talking about rate hikes coming up, but potentially in the US. It's honestly, it's too early to tell yet. And I think we heard that loud and clear from the Fed as to exactly how this plays out. Getting it wrong, it's worth waiting a little bit longer, not waiting too long.
Yeah. No, it's just that, as Elarian was pointing out on our channel, 63rd month of inflation at 3.8 being higher than the 2% target.
Yes.
So that's a bit of a worry for those of us. All of us are benchmarked on the, risk-free return.
Indeed. So let's hope that this can get resolved in a reasonable manner, in an effective manner, so that we can come to a new normal.
Fair point. Jane Fraser, you have the year of everyone from President Trump to Modi to Xi to all the biggest corporates in the world and in Asia. Are you getting a sense that this China plus one story will play or is playing to India's advantage as well? I mean, right now, it has been more to the advantage of Vietnam and Malaysia. Are you seeing your corporates talking about more investments into India?
Yeah, what I hear everyone talking about is diversification. A recognition that you can't be too dependent on any one part of the world because you just never know. And therefore, continuing to drive. I always say India, if I think about it, India has created its own cake. The icing is the rest of the world's investment into it, because so much of the potential here has been generated by the country itself. And that should be a real point of pride of what has happened in the last few years. No one helped you. You did this yourself. But when we're thinking about the supply chain changes and dynamics that are going on, and we also think about foreign companies wanting to participate in India, and there is huge potential here. There is huge importance as one of the major global centers. India doesn't want to be overly dependent on the rest of the world. I think that's wise, but there'll be a balance there, and the rest of the world will want to be sufficiently invested in India. So I'm optimistic. I'm optimistic about this. And part of the optimism comes because this country is really got the bit between its teeth. And we can see it. Look at this conference, right? 1,600 people. We have 350 investors from all over the world that have come. We're showcasing 42 of India's top CEOs. That's over 40% of the market cap are here. And it's standing room only. Everyone wants to hear the India story. They may choose timing a little bit, but this is a good time to be an Indian. Just weather the headwinds, because the long-term story is a good one.
Thank you. Thank you for making us feel so good. Just a last sentence. What keeps up Jane Fraser at night? What worries you? Is it markets? Is it Bitcoin? Is it crypto? Is it AI?
Yeah.
What keeps you up?
Other than my family,
okay,
which I think as a mother will always have to be at the top of the list. It's cyber.
Okay.
It is cyber. And I think it would be the same. You ask any of the CEOs, we would have the same answer. So we all invest a lot in that. We help secure for our clients, make sure their assets and data is safe. we do it for our bank, we do it for our investors, we do it for the system. So cyber, I think, is a bigger threat, we will continue defending against it.
And a final question, as woman to woman, when will we have more people? I mean, just one woman in the top banking echelons, one woman to
but
say...
we have an Indian woman who is the other woman at US Bank. Yes. So Gunjan is extremely talented, and I'm delighted to see her there. But I look at the other women coming up in the ranks in the
What's
other
the
US firms.
to those who are looking at you as an icon?
Yeah, just wait and see what they can do.
Thank you very much, Jane. It's an absolute pleasure and a privilege having you with us.
Thank you very much. Thank you. Lovely to see you again.
Well, that's it on this excellent, wonderful conversation we have with one of the most powerful, not one of the most powerful women in business today, Jane Fraser.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, negotiations on an interim framework for a bilateral trade deal between India and the US are set to wrap up today. A delegation led by Assistant US Trade Representative and Chief Negotiator Brendan Lynch arrived in India earlier this week. US Ambassador to India Sergio Gore has said that 99% of the interim agreement was in place and that the latest talks were to focus on the remaining 1%. Both sides are hoping to finalize the interim deal soon. Amidst the talks, the US proposed fresh duties on 60 nations under Section 301 of the US Trade Act, which targets alleged unfair trade practices, and India is among the countries that are facing a higher 12.5% levy. The US report claimed that India failed to impose and enforce a forced labor import prohibition. Sources say India has sought protection from additional duties. Notably, this is just one of two ongoing investigations under Section 301. A separate one is looking at structural excess capacity. Now, as per a report by US-based think tank Atlantic Council, potential levies after both the probes could yield an additional revenue of about $12 billion from India. So that's the potential pain that India could be looking at. Now, this is based on an estimate that the next levy may likely be around 20%. On the energy front, U.S. Secretary of State Marco Rubio, ahead of the talks during his visit, insisted that Washington wants India to buy more U.S. oil and gas, and also suggested Venezuela as an additional energy option. The latest data from Kepler shows that India is buying more oil from the U.S. and Venezuela. As per Kepler, the U.S. emerged as India's largest LPG supplier in May, while crude shipments from the U.S. more than doubled. Venezuela emerged as the fourth largest oil supplier to India in the same month. But circling back to the issue of the all-important bilateral trade agreement interim framework, talks underway. Joining us now to discuss this further is with us Mark Linscott, former assistant U.S. trade representative. He's also the senior advisor for trade policy at the U.S.-India Strategic Partnership Forum and non-resident senior fellow at the Atlantic Council. Mr. Linscott, thank you so much for joining us. Let me begin by talking, of course, about the elephant in the room, Section 301. That's been the big talking point this week. Now, what Indian negotiators are scratching with, and of course this was also seconded by the Atlantic Council report that we were citing, that the pain that India could potentially be looking at is somewhere in the vicinity of $12 billion. Now, if that goes through, the Indian negotiators, I'm assuming, find themselves scratching their heads how to sign off on a deal when potential additional tariffs are looming large.
Yeah, thank you, Ashmit. It's a very good question. There's still a lack of clarity on exactly what's going to unfold, even over the next days or coming weeks under Section 301. We've got a clearer picture now with the announcement of the 301 proposed tariffs with respect to forced labor. But there is another pending 301 investigation that is on excess capacity. It involves 16 countries, including India. And once those findings are released, we'll probably have a much clearer picture, some real clarity on what the environment is like in the context of these negotiations on the interim agreement. I hope that progress is being made this week. I think it was very important that Brendan Lynch and his team is in Delhi. The timing is a little awkward in some respects because we did have this announcement. But as you cited, we've all been holding our breath. The world has been holding its breath, waiting for these 301 actions. So I think it, in some respects, provides some impetus to move forward. But again, we still don't have the full picture until we have the results of the investigation on excess capacity. There are still some question marks remaining.
Well, in lighter vein, if you were in the shoes of Brendan Lynch, what would you tell your Indian counterparts?
Well, frankly, it's difficult to put me in the shoes of Brendan Lynch. We did work very closely together when I was the assistant USTR. In fact, he was my deputy in Washington for a period of time, and he's a seasoned, very savvy negotiator. I think what he is likely saying to his Indian counterparts, this is with the Ministry of Commerce and Industry, is, we've had discussions about this over the last months. I think that there's been a very transparent discussion between the two sides on the 301 actions, what to expect. And I think also conveying the view that the sooner the better to get the interim agreement done. That was established at a rate of 18%. That's what Prime Minister Modi and President Trump agreed to on February 2nd. That's what was reflected on February 6th in the framework for the interim agreement. So, I think that he is saying, let's focus on that. Let's get it done. You will then have much more certainty on a specific rate at 18%.
I just have one more question on Section 301 investigations. How much wiggle room, how much flexibility does the USTR have with respect to these ongoing investigations? And is there scope for perhaps some kind of carve-out, some language in the deal itself, which protects countries such as India from any additional levies going forward?
Yeah, there's quite a bit of wiggle room. USTR has a lot of discretion under 301. 301 is a provision under the 1974 Trade Act. So it's been around for a long time. It's been used over and over again over the years. I think there have been roughly 200 301 actions since 1974, even predating the WTO. So, we've got a lot of experience under 301. USTR does have a lot of discretion. That's authority that is delegated to USTR by the president. And it can set rates to address essentially trade restrictions on the basis of findings. There has been a process. There is always a process under 301 of stakeholders being and foreign trading partners being able to make submissions to respond. There are hearings, and those have taken place. So there is a process, but USTR has lots of wiggle room, which I think is important in the context of negotiations. USTR can strike a deal and lower those rates as soon as a deal is struck.
And is there a provision, is there a precedent where a carve-out was given to a specific geography, a specific country, to shield that country, in this case India, from any additional tariffs going forward?
Well, I think that's a very difficult question. It's complicated, and I can certainly understand that the Indian side, the Modi administration, specifically the Ministry of Commerce and Industry, is pressing on that issue. What guarantees do we have in the future if we conclude this interim agreement and we have provisions on commitments that the Indian side is making, commitments that the United States side is making, an overall tariff rate by the United States of 18%, with transitions and exceptions. There will be plenty of exceptions to that. But what is the guarantee looking ahead to the future with respect to additional 301 actions? I mean, there was one that was just launched the other day against Vietnam on intellectual property rights. Might there be future threats of 301s? There are pending Section 232 actions that have still not been concluded. So I think the Indian side really wants some ironclad commitments on what does the future look like if we strike this agreement now.
Sure. Mr. Linscott, speaking previously to you, you've spoken about how there's a drop-dead date. You've identified that as July end. What happens if the two sides don't reach an interim deal by that time?
Yeah, July 24th is the drop-dead date in the sense that the temporary duties that are now in place at 10% across the board, involving essentially the world, that 10% duty will expire. And it's always been anticipated that Section 301 tariffs will replace that 10% duty that's in place. We now have one piece of the puzzle. That's the results on the forced labor 301, and that's 12.5% for 54 countries, I think, or 50 countries, 10% for a handful of others. So that's one piece of the puzzle. The other piece of the puzzle for 16 countries, including India, is the excess capacity 301. So if that rate is relatively high, we could have a situation in which under 301, with no interim agreement, India is facing a much higher tariff rate. And what really matters in the calculation of the pros and cons are what other countries are getting, what are competitor nations getting with respect to tariffs. Have they struck agreements? Do they have agreements on reciprocal trade in place that lower their tariffs? And might India have a higher tariff than the likes of Sri Lanka or Bangladesh or Vietnam or Malaysia, Indonesia. I mean, that is the big question. So we could have a situation if there is no interim agreement on July 24th, in which India is facing a much higher tariff than those other countries. But I'm bullish. I am quite hopeful, optimistic that they will strike this agreement well before that date.
Just have a couple more questions, Mr. Linscott. Agriculture has been a sticky point between the two sides. Now, in the days and the weeks building up to this latest delegation visit, we've seen a lot of bonhomie between the leaders of two sides, pleasant words being exchanged, pleasantries being exchanged between the two sides. We've seen also talks about greater alliances, greater overlaps when it comes to areas such as technology, semiconductor, nuclear, energy. Do you think all of that will offset any concerns that Washington might have had on agriculture?
First of all, I think that the two countries and the two leaders clearly want this agreement to get done. We had Secretary Rubio just there in India, a 4-day visit. I mean, that says a lot. That's quite unprecedented, and I think it set a very positive tenor to where the relationship is now, and it was made explicit that both sides want to get this agreement done. So that is, I think, real reason for optimism. This is the last stage of the negotiation for this interim agreement. It's always the hardest stage of a negotiation. Those last few issues that need to be resolved, gaps that need to be bridged, efforts at creativity and compromises to find solutions. I mean, that's always hard. Specifically on agriculture, I think that the United States, the U.S. delegation has a good appreciation of some of the sensitivities in India. I think they've taken off the table the most sensitive issues. I think those, the most sensitive agriculture issues are kicked down the road. Therefore a later stage of negotiation on bilateral trade agreements. So I think that there are only probably a couple of issues that need to be resolved, and I think that there are probably compromises that can be reached. Very technical compromises, things like tariff rate quotas that could resolve those last few agriculture issues.
And we're almost out of time, but one quick question to you. The two leaders, Donald Trump, Prime Minister Modi, seem to share a close bond, at least in terms of what they show publicly. What I want to ask is that to cross this one final percent, you mentioned it's the most difficult, challenging part of trade negotiations. Will it require intervention from the two leaders to cross this bridge, so to speak?
I don't know that it will require intervention. There are some reports that that the two are likely to meet on the margins of the G7 meeting in France in a short period of time. I expect the leaders are directing their negotiators to get it done. I doubt that the leaders need to get specifically involved in some of the mechanics, the details of the negotiations. They already did that back on February 2nd. I would not be surprised if the trade ministers need to engage directly. Jameson Greer on the U.S. side, Piyush Goyal on the Indian side, to address the last remaining hurdles. But I doubt that the leaders themselves will be negotiating on agriculture tariff rates and chapters on economic security. I think that's the negotiators are in a position to conclude those parts.
Right, Mr. Linscott, thank you so much for joining us. We're yet to get clarity from the Indian Commerce Ministry on what these talks have yielded and what the way ahead may look like. But of course, we'll come back to you as and when we get more details and insight from the Indian administration. But that's all time that we have. We're slipping into a very short break, but we continue this dialogue, this conversation on the India-US trade talks on the other side. Welcome back to News Center. We're now joined by former diplomat Mr. Anil Trigunath, as well as former ambassador to the WTO, joining us, Mr. Jayant Dasgupta, as well, to take this discussion ahead. Mr. Trigunath, let me come to you. We just heard from Mr. Linscott, Mark Linscott, who was talking about how the potential burden on India, should these 301 tariffs come into effect, could be as high as $12 billion. How do the Indian negotiators sign off on a deal with these tariffs looming large?
Well, I think that while the negotiations with the United States on the trade vertical have already been very comprehensive and extensive, because let us not forget the US is a highly legalistic society. Every agreement that they want to sign want to have some kind of a foolproof thing. So it's not always easy to sign an agreement with them. That's number one. Secondly, this trade vertical has been the most cantankerous in our relationship with the United States ever since Trump 2.0. And even during the Trump 1.0, we had seen that he took out India from the GSP preferences regime. So here, this time, there have been arbitrary tariffs, and then it was suggested that we should have a bilateral trade agreement. India has started as and when it felt comfortable. That is in February of this year. Although there is a desire to sign the agreement, because that is good for both the countries, it provides a certain clarity for the exporters, importers, and traders, as well as investors. So, but what is the thing is that in the past, that what one has seen is the unilateralism and arbitrariness that comes along with it. So therefore, signing an agreement when you have, as you mentioned, the Section 301 looming large, and only just 2 days ago, we have seen the 12.5% levy on extraneous investigations or charges has been levied on India. So it does not inspire a great confidence. And I think that's one of the most sticking point from the Indian side with regard to the ongoing negotiations. That's the reason we have not heard so far whether there is any clarity or not on this interim deal. But it is better not to have a bad deal than to wait for some more time and iron out those differences. And I'm quite sure that our negotiators are working on that. The US has used, as Mr. Linscott was saying, a large number of times with every country. I mean, this time they have brought about 60-odd countries into that remit. So that is a pressure tactics, frankly. And that's not a fair trade practice. And that's where and United States has actually been playing a victim very often in the trade deals and also market access issues. And President Trump's administration wants to leverage that to get better leverage with the countries that they are negotiating with. And we have seen that it is not that if you have signed an agreement that you are not subjected to more tariffs just because somebody gets angry in the White House.
Sure. Let me take that up with Mr. Dasgupta as well. Mr. Dasgupta, July 24th is when the 10% tariff, which has been levied by Washington, that's when it runs out. The fear is that post that, India could face much higher tariffs, even higher than its peers. So the question I want to ask is it better to have a bad agreement than no agreement?
I entirely agree with Ambassador Anil Trigunath. The way the US has been approaching this whole thing in the Trump 2.0 era is that I will keep twisting your arm and I will force you into an agreement which by no means is a reciprocal agreement. There is no reciprocity in this agreement because the US is not reducing its tariffs one bit on one item, not one. So there is no reciprocity. It is all one way, and it is constantly threatening India and the other partners that it will impose higher and higher tariffs. And this 301, 12.5% is, as is known, it is only on this labor, practices about forced labor producing something and that getting imported into India and 53 other countries. The other one is about structural excess capacity. So that is still hanging over our heads. If we sign an agreement and tomorrow the US says that you give us further concessions, otherwise you will be slapped with duties under this new 301 thing, which is yet to be decided. And the third day, they start investigation on some other 301. So there is no end to it. So I think we have to stand up and we have to fight for reciprocity. Fair and equitable and balanced is what we have been saying all these months. And that is what we need. If we don't get it, some of the sectors, like textiles and clothing, leather, gems and jewelry will suffer. They have already been suffering for the past year or so. So I think we will have to lump it, but we can't take this kind of unilateralism and arm twisting and browbeating, because this is, and mind you, all this may, get, removed after the midterm elections, because there is a threat that President Trump will then be subjected to a lot more scrutiny. In fact, there are rumors that he may even face an impeachment proceeding. As you know, the House of Representatives, with 4 Republicans voting in favor of the Democratic resolution, have said that the U.S. Should end the war with Iran. Of course, it is subject to the president's approval, so he may, reduce it to naught. But the point is that there are dissident voices which are getting raised and getting raised in large numbers. So President Trump may, try to show that he is all powerful and that India must succumb to his arm twisting tactics and sign a deal. But tomorrow we may start ruining the fact that we have been led to an unfair agreement which will bind us in perpetuity.
Sure. Ambassador Trigunath, let me come to you then. The situation that we have on our hands, is there a precedent where Washington has agreed to sign a deal with a special carve-out that, look, there will be no additional tariffs subject to 301, 302?
Well, even if not for 301, under the earlier Emergency Act, we have seen what happened in Japan, what happened to Korea, what happened to several other countries. He continued to, if he was not happy about certain items, he had imposed additional tariffs. So deal or no deal, there has been now, of course, the Supreme Court has set it aside. So they have just invoked this Section 301 or any other action. I mean, they can always bring about this in order to leverage that. So there is no dearth of precedents. You can find a umpteen number of them. In any case, I must tell you that the advanced countries have very often used the NTBs even when the WTO regime was fully enforced. So they were using these non-tariff barriers, the social and governance issues, the environmental issues, and then labor issues. This has been a history for a very long time. And now, under the garb of something like Section 301, they just invoke one by one. And as the Ambassador was saying, it is true that this can be invoked at any time. So therefore, the whole purpose of having an agreement is to have a certainty, both for the exporter-importer as well as for the governments. But if that is not going to be there, then once again you are coming into tremendous stress for whatever reason. Let us say tomorrow they say, no, don't buy any oil from here, but we'll supply you, which will be far more expensive for you, and or gas for that matter. We are as such buying it, but let's say that's the predicated condition for whatever reason. It has happened in the past. We have been imposed 50% duty. Then what do you do for that? I mean, those are the kinds of things where you need that, and or you need to have a deal with this kind of a thing. So it is something that India, I think, will have to be very carefully navigate at this stage. And I think that is the reason. And of course, the Americans also say that the Indian negotiators are quite good and strong. So I'm quite sure we are not going to give in onto that so easily.
Sure. We're running out of time. Ambassador Dasgupta, I'll come to you for a quick final thought. Do you see a deal happening? We're talking about the one final percent coming from both Ambassador Gore as well as from the Indian Commerce Minister Piyush Goyal, that we just have to cross that 1%. Do you see that happening before July 24th?
Very well take place, but I don't think it would be the interim agreement will cover everything that is on the table at the moment. There would be very large gaps on which I don't think there would be an agreement before July 24th. So that is my reading.
Right, so tough situation. You have any projections, Ambassador Trigunath? Do you see this happening, interim deal, before July 24th?
Well, it can as well happen, but for the optics. What I think is having a deal is something, but having it operationalized and smoothly is something I don't foresee, at least for the next few years.
That's a long timeline that we may have to work with. I'd like to thank both Ambassador Trigunath as well as Ambassador Dasgupta for sharing their insight with us, with our viewers as well. But that's all the time that we have. It's a wrap on this edition of News Center. We'll, of course, keep our ears close to the ground for the latest developments concerning the India-US trade deal. But for more news and updates, keep watching CNBC TV 18.
The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed up. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Lata, I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock. Both of these could be adverse and could push up headline inflation. But, you know, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? see, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, I think, MPC needs to conduct policy based on what is effective. In Indonesia's case, FX stability is part of the BIS mandate, but, the surprise 50 basis point hike actually did not help stabilize the IDR. And in Philippines, inflation is running above 7%. So compared to the upper bound of 4%. So the inflation picture in Philippines is very different to India. So we need to look at our own scenario. I think using the interest rate to defend the currency is inadvised for actually a number of reasons. First, we've spent more than a decade trying to anchor expectations in terms of the inflation targeting regime and what the monetary policy framework is about. The moment we start targeting FX to manage using rates, I think that essentially undoes a lot of the hard work that has been done to anchor expectations. Second, interest rate hikes to defend the currency are not effective, as seen in the case of Indonesia and also as seen in India's case back in 2013. And third, we need to do a cost-benefit analysis. The cost of doing a very aggressive rate hike in order to curb demand vis-a-vis, the benefit, we will end up in a situation where the growth damage is so substantial that we'll start worrying about the fiscal side and other consequences of weaker growth rather than on the balance of payment situation. And, as we've discussed in the past, India does get a lot more of growth capital. And finally, I think we have, a number of non-monetary measures on the current account, on the capital account, on the macroprudential toolkit that can be used to manage the currency. So I think, the market argument of using the interest rate to defend the currency, I think both from the currency side as well as, from the inflation side, it is not essential and not needed in my view.
Okay, I'm going to bounce the same thing to Samiran as well, because there is a lot of voices in the market which believe that the optics are that the Reserve Bank may be falling behind the curve. Both on inflation, but even on interest rates, the defense is being asked for by some quarters. Samiran.
Yeah, thanks, Lata. I guess Sajid and Sonal have very eloquently argued in favor of the view that why RBI can delay any rate hikes at this point of time. And it's also our view that that's probably likely in the June policy that RBI defers it. But it's interesting that there could be another way to play this also. First, we have to understand that the December rate cut actually did not have any intended effect on the transmission. So in our view, probably another 25, 50 basis point hike from here is simply normalization because we probably cut too much in the cutting cycle at that point of time. So it just creates a little bit buffer for RBI to work with. The second issue is that we all are forecasting that inflation in the latter part of the year is definitely going to go up. By how much, we probably don't know for sure. But that increasing trend of inflation, again, it's possible that the MPC decides to create a buffer now so that they don't have to scramble too much at the latter part of the year when there's a sudden spike in inflation, partly simply because of base effects. And the last point, which you also mentioned, which is about this whole perception about falling behind the curve. And there is a risk that if the markets feel that the RBI is falling behind the curve, then the exit route or the valve that the markets will try to play it through is likely the currency. And that's where the fear is that if RBI is seen not to be doing anything, then is that going to be some sort of an additional risk that the market will try to price in on the currency front? So we remain with the baseline view that probably not a hike in June, more likely in August, because RBI wants to give some guidance generally to the markets. But having said that, there is a we will not be surprised, at least, if the hike is advanced to June itself.
Okay, so the governor has, elbow room on both sides. Soumya Kanti, actually the bigger thing that the market is waiting for is what's the package for the rupee? If not rates, what? What do you think? They can, they just have to sound, the optics have to be pro-rupee. What will they announce?
Yeah, thank you, Lata. I think there are a couple of options on the RBI before the table. And in my sense, I think given the rapid and the unprecedented depreciation in the value of the rupee, which is, I think, has somehow been significantly higher compared to any other currencies, I think possibly and addressing the issue becomes more important at this point of time. There are various options. I think the first options, all the other members have already debated an interest rate hike. I am of the view that a policy rate hike may not be appropriate for this currency, the currency, because of the simple reason is that the more you try to hike the currency, the more the market will believe that the rupee could actually, it is being done to protect the rupee. And better way is basically to work on regulatory to other measures. For example, measures which attend to address the market microstructure, which raises the short-term rates and lowers the long-term rates, like Operation Twist, or even widening the corridor for a limited period, which was done in 2013. So that could be one of the options. Regarding the second option on the balance of payment, I think there are a couple of options, but the options are on an FCNRB window, like which we did in 2013, or even raising bonds at this point of time, would be a little defeatist because the cost of such mobilization could be in double digits. And I don't think at this point of time, for example, even if they give the options of an FCNRB deposit mobilization, the end use of that funds with an 10% upwards, I think nobody is going to willing to borrow. So an avalanche of liquidity in the system. Okay. Apart from this, there could be issues like capital controls. There could be also controls on the repatriation of funds from the NRI deposits. There could be some simplification of the tax structure on the portfolio outflows. And there could be also some measures which tries to addresses the LRS.
I take your point, Soumya, but much of this falls in the remit of the government. Not all of them fall like taxes or capital controls. Dr. Sen, as Sabinan also said, they first like to guide and then hike. What should the RBI's message be? Because this policy, more than any, is going to be a matter of optics. How should they sound?
Well, the point is that we are in a situation where the government or the RBI should make no effort at all into downplaying the seriousness of what we are facing. And the RBI needs to talk about it. I mean, it's not that people are insensitive, but the conditions that we are facing are really quite serious because, everybody's talked about the supply side shock, which is absolutely true, but there's a demand shock that's going on as well simultaneously. And so that puts us on a really serious tightrope walk at the moment. And this is something that the RBI has to make very clear, saying that things are in the process of development. We will watch and take appropriate action when the time is right. But a full description of the situation that we are facing upfront and clearly is what the RBI should be doing. And I agree with everybody else that this is a time to actually give them not necessarily a guidance, but at least give them the likely scenario that the RBI is visualizing.
Fair point.
Guidance may come, but it's not absolutely necessary. But people need to know where RBI stands, how RBI is analyzing the situation, and what its take is on the likely future.
Fair point. No pussyfooting on the difficult issues
No
is what you're saying.
at all.
Absolutely. Point taken. Actually, I want more of your views on what is in the, what are the options available for RBI and more on whether of the dangers of falling behind. Considering that growth is resilient, why not now? I want to ponder those questions more, but we have to take the first vote. So, gentlemen and Sonal, be ready. First question, what will RBI do on June 5th? I've more or less guessed, but Sonal, you go first.
On hold.
On hold on repo rate. Okay. Samiran, what will they do to the repo rate?
Hold.
Soumya?
Hold.
Sajid?
Hold.
Okay. Chairman, your role is easy. Would you agree?
Hold.
Yes, you sounded that way. Okay, it's a universal hold or unanimous hold. Let's see if the next question throws up a difference. Sonal, how many rate hikes do you think in this year, FY27?
None, and can't say right now.
Okay, can't say. Samiran?
We have penciled in 50 basis points.
Okay, 2 hikes. Soumya?
Can't say at this point.
Okay, playing it safe. Sajid?
As of now, none. Heightened uncertainty, but as of now, none.
Okay, this is a divided house. Dr. Sen, what would you say?
It's difficult to say, but at least one will have to come sooner or later.
Okay, that's a divided house on how many rate hikes in FY27. But I want to dig deeper into how many steps are available, options are available to shore up the rupee. Those questions coming up after the break. Well, welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC TV 18. I've been speaking with Chairman of our committee, Dr. Pranab Sen, and members Sonal Verma, Sajid Chinoy, Shaumika Ghosh, and Sajid Chinoy. Gentlemen and Sonal, thanks for your patience. Okay, now a little more on the issues we already discussed. What we didn't discuss was liquidity. Shaumya, you know, there are times when the collateral, the CBLO market or the tripartite repo has gone even below 5%. Right now, call is a little above 5.25 at 5.3. But this looks like hardly in sync with a country that is running towards 5% inflation. What are you expecting on the liquidity front?
liquidity front, I think the Reserve Bank would like to try to play it safe. I think recently they have just done a buy-sell swap. So it has to maintain a delicate balance of ensuring that the long-term rates doesn't go significantly higher, which is already at 7%. And given the borrowing program which the government and the states are running, I think to bring it below 7% will be a tad difficult. So from that perspective, I think the liquidity management liquidity has to be modulated a little bit at this point of time. So may not be aggressive OMO purchases which the central bank has done in the last year or so, injecting around 10 billion into the system, but some amount of modulation of the liquidity. But the point which I emphasized in the beginning, that the central bank needs to do some micro management measures. It needs to attend the market microstructure in terms of controlling the rates. For this, ensuring liquidity that is a little bit at the shorter end of the market should be a little squeezed, and at the long end of the market it should be more flexible, so that the overall term structure of the interest rate remains benign and not significantly increases at the cost, and which could actually hurt the cost of growth and borrowing at future.
No, to be fair, they don't usually speak too much about liquidity in the policy these days. They do say that it's delinked with their policy itself. But Samiran, you had a big report on the steps that Reserve Bank can take. Soumya narrated some of them. Much of them fell on the government's lap. What do you think of RBI can do? This is going to be the much-watched space.
So there are two broad approaches. One approach is that we are likely to have a BOP gap this year. We are expecting it to be as large as $50 billion. So the RBI can consider a large bazooka step to fill up that hole in the BOP. That's one approach.
How?
I'll come to it. But the second approach is to say that it's too early to go big and bold, because that can create some sense of panic in the system, also that we are getting into some sort of a crisis mode. So we go the other way in saying that in comparison of last 2 years BOP deficit of only $34 billion, the extent of rupee depreciation has been just too much. So some adjustments in administrative measures can affect the hedging / speculative behavior in the market, and to that extent can also have some control on the currency. So this has to be in two parts. RBI has to decide which one they want to sequence earlier. If we go by the first one, in our view, the best method is right now to allow the banks and financial institutions to issue dollar bonds abroad and swap them through a concessional facility and convert into INR. That kind of kills two birds with one stone. You address the USD INR problem as well as you address the credit spread problem. And on the side of trying to tweak with administrative measures to change hedging perception, one of the things could be you can have an asymmetric measure to increase the hedging cost for importers / FPIs. And second is that you could have some measures through which you can fast track the exporter hedging, which currently is very deferred. So these are the two broad approaches. The sequencing of it is a very difficult policy dilemma for RBI, because the first one is a more permanent solution. The second one is a more band-aid solution. But the first one creates sense of panic, whereas the second one, you can do it in a very quiet way.
Okay, fair enough. It's just that ECBs, even if all the banks were to raise, it doesn't, for me, it doesn't add up to 40-50 billion. But I could be wrong. It could still be an incremental positive step. Sajid, I want to pick your brains on this. What are the FPIs saying? Are they okay? They don't see comparing India with Philippines and Indonesia and seeing us as behind the curve. And more importantly, you ask a trader, they do tell you that when interest rates near-term, one-day money or money market rates are higher, the rupee premium goes up. It is attractive to stay in rupees rather than in dollars. To say that interest rate is completely unrelated is not something many treasury guys buy.
There are two different questions, both good questions. So let's take them. I think the situation in Indonesia and Philippines is very different. Philippines saw a huge spike both in headline inflation and core inflation. because A, there was a much larger increase in retail prices in that country, and B, it's a larger weight in the CPI. So the central bank, given what their mandate was, had to respond. Right?
Okay.
That's a very different situation for where India is, where you've seen a less pass-through, core inflation is lower, and even forecasting out, the RBI's inflation forecast is below the upper end of that band. So it's a very different situation.
Okay.
In the case of Indonesia, as Sonal mentioned, it's one where the mandate is, currency stability. India's mandate is not currency stability. Now, interest rates do matter for currencies. There's no doubt about that. But the question is that if you were to meaningfully want to change currency expectations, 25 basis points will not do it. You will need to move 100, 150 basis points. And I think this is where one has to understand that the situation is very different from 2013. In past episodes, whenever the rupee's been under pressure, it's been typically the current account widens sharply, and then capital flows are not enough to finance that. Yeah. And so you rely on some rupee depreciation. If that doesn't work, then you do expenditure compression. You tighten fiscal policy, you tighten monetary policy. This BOP situation is very different. The current account deficit over the last year, 25 calendar year, has been 0.5% of GDP. Yeah. Core inflation is running at 3%, and we're still awaiting a capex cycle. Yeah. So even though headline growth may be healthy, we have to be very clear here that this is very different from 2013. Expenditure compression, fiscal and monetary tightening need to be a last resort. We should start with the rupee being the shock absorber, A. B, if that leads to expectations getting unanchored, I agree with Shomaran, you require a circuit breaker in terms of capital flows to prevent this hedging behavior. And expenditure compression, I think, should be a last resort given these circumstances.
I'm sorry I'm rushing you because you're running out of time. Sonal, you have to keep it brief. How should the stance change, if it should?
Yeah, Lata, I think the stance should stay neutral. The challenge with changing the stance towards tightening is it gives a clear signal for markets that we are going to more likely than not hike rates in August. And given the uncertainty on whether this is morphing into a demand shock, uncertainty on how the deal and oil price plays out, I think better to keep the stance at neutral, but guide that policy is going to be agile, data dependent, and will ensure that inflation stays anchored to 4% over the medium term, and clearly specify the parameters that MPC will be watching to decide what will trigger a rate action.
Okay. Well, Dr. Sen, again, you'll have to keep it brief, sir. But, growth numbers so far are very good. Auto sales are really decent, if one is looking at it as a measure of demand. And also, there is a likelihood of inflation also because of the El Nino situation. So really, why are you guys resisting a rate hike, ahead of the curve rate hike?
Well, the main reason I think we are resisting it, and all of us are resisting it,
yes,
is the fact that if you give a rate hike today, you are giving the impression that all is well in terms of our growth trajectory. Okay. And that is in fact not true. If you look at for a fairly extended period of time, we are living off past capital. Okay. And nobody should be under any illusion that we are on a high growth trajectory for the foreseeable future. We are not. Okay. At some point, the question is going to arise. And by the way, the government's done a lot to revive investment. None of that has had much impact. We are going to have to start focusing on domestic demand, on domestic investment, on capacity creation. And this is not the time to upset that particular apple cart.
Got that.
So I would be very, very cautious. Okay. Because we are not in as sweet a situation as people believe we are.
Fair enough. I was under the impression that growth is more resilient. I take your cautionary words. I'm trying to squeeze in a last vote because it's nagging me and many in the market. Should the Reserve Bank use rates, interest rates, to control inflation? By which I mean policy rates to control exchange rate. Sonal?
No.
No, not use. Samiran?
No.
Okay. Shaumya?
not the policy rate.
Okay, yeah, I got that. You wanted other rates. Sajid?
No.
I'm not surprised. You are the one of the authors of the flexible inflation targeting. Dr. Sen, would you?
No.
Okay. So clearly, I see my small voice within me is a minority. Do not use interest rates to control the exchange rate. That's the word from the Citizens Monetary Policy Committee. Thank you very much, gentlemen and Sonal, for a very, very erudite and enlightening conversation. That's it on this discussion of the Citizens MPC.
Well, coming to you from the Morgan Stanley Investor Forum 2026, and as always, we're sitting down with the man who's got the pulse and who sort of helps puts this conference together for so many years now. Rhythm Desai is with me. Rhythm, great to have you with us here. Thank you very much for joining us.
Me.
And it's a day when we've got some showers, some rains in Mumbai, so hopefully it rains good news as well. But just start with the starting point, Rhythm. It's not very demanding. It's not as if this is a raging bull market. I'm just starting with sentiment is quite negative. There's a fair bit of self-loathing, I feel now, which is kind of, we don't have AI, we don't have this, we don't have that, and all kinds of things, right? So it's almost very tough to justify a kind of bullish view. So that is where sentiment is at. So just talk us through the conference and what you aim to get to your investors from the conference, the message straight up.
So see, the interest level in India is very low. That's the bottom line. And the reason is that on a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter. It's actually picked up a fair bit in the March quarter. Companies are quite positive and are guiding despite the global uncertainty, despite the conflict in the Middle East. But the growth elsewhere is very strong. So the earnings growth in Korea, Taiwan, Japan, the US, even parts of Europe are way above India's growth. And this is not like a 2-3% point thing. So if India is doing 12, 13, 14% earnings growth, these markets are experiencing 30, 40, 50, and Korea is, you know, in the hundreds. Yep. So that's where the thing stands. This thing with respect to foreign investors only flips when the growth flips or the growth expectations flip. It's not when the growth flips because that will be too late, but when the expectations flip. So something has to give, say in the memory cycle, for Korea's growth to go down. Something has to give in the compute cycle for Taiwan's growth to decelerate, and so on. So that's not something that's visible. In fact, the capex in the world has been very resilient, and it has not reacted to the uncertainty coming from the conflict, which is why markets elsewhere outside India are all putting up new highs, and just not a soft new high, really strong highs. I mean, Korea is up 60% from its March end low.
Yeah. No, it's up 60% this year. It was up 75%. Yeah. No, it's up 100% YTD, and it was up 75% last year. And of course, Taiwan has done what it has. Rhythm, the question is, so are you saying that for FII, especially FII flows to flip, how you put it, right? This memory trade in North Asia, or I mean, this entire AI capex frenzy has got to end because those are beneficiaries. That's where that money is going. So that needs to slow down a little bit for investors, foreign investors, to pay attention to India.
It's about expectations. The expectations have to pivot. The expectations that this is going to generate more and more growth has to change. And India's growth expectations have to accelerate. So
both have to happen.
Both are one. I mean, the relative growth picture has to change with respect to forward expectations.
Is there any signs of the former happening?
No,
because
not at all. I mean, if you look at Morgan Stanley estimates, we are only upping our capex forecast for AI. And a lot of this has to do with the AI supply chain. So there's no visible sign that this is about to slow down. That's not in the horizon.
If anything, I've seen numbers which say that it's going to accelerate all the way into 2028, maybe even beyond. I mean, and you're kind of sort of agreeing with that, right? That's your expectation, estimates as well.
28 is far away, but it's there for 27 at least. So if you're looking at from a near-term perspective, next 12 to 18 months, this capex cycle is pretty intact, and it is not seemingly going away.
It's not going away. So where does that leave us?
No, so India's growth is accelerating, and at some point in time, the valuations relative to growth opportunities do become attractive. And of course, see, there is a technical aspect to this. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown, but they put record inflows. And they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. So if that bid is on, then there has to be a seller. Now there can potentially be two sellers. There can be corporate issuances and there can be foreigners. So the other way that foreigners can become buyers is that corporate issuances resume. It's counterintuitive, but that will be good for
more supply, basically.
Exactly. That will be good for the overall bid on the market. It will be good for the BOP. It will be good. So it's counterintuitive. But issuances can make a difference here.
The foreigners can come back and participate in those issuances.
Because then they get space to come into the market. Otherwise, retail has just kind of taken them out.
I mean, that bid has been absolutely strong.
And I don't expect the retail bid to go away because that's a secular shift that's underway in India.
And you pointed it out.
We've been talking about for 11 years now. And now finally that skepticism is fading. But, people are waiting that, one day retail will panic. But retail has matured in this and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
You started by saying that sentiment, there is very low foreign interest in India at this point in time. I mean, you've done this conference, 20 plus years?
28 years.
28 years. And if we were to sort of plot a interest level, foreign investor level through those 28 conferences, where are we now? Are we pretty much at the lows?
No, we have been through these.
Okay.
Like 2011-12, I remember, was very bad.
Yeah.
But, frankly, I should have been ready with this data. I am not. We should see the data. But, when we were doing this conference in the early 2000s, like in 2003, we used to write a conference book. Now we don't do it.
Right.
So I used to write the preface.
Right.
You know, India's market cap in 2003 was $100 billion.
Wow.
Because I remember writing this, that 50% of India's market cap is going to be represented at our summit. $50 billion.
Was here.
Yeah, so we have come really long way, $100 billion. So it's difficult to make comparisons on the basis of numbers.
Yeah.
Because the market is now up 45x.
Yeah.
It's a much different, it's sized up.
Yeah.
It's a player in the global.
Sure, absolutely. I started in 2003 as well, so it was. Rhythm, so just to complete the foreigner point, right? This constant selling that we're seeing. I was speaking to somebody, and I was kind of surprised to hear it. That typically, and this was in response to what I asked. Is that typically we get asked whether foreigners are calling up and asking what should we buy. But the gentleman, again a foreign firm, said, I'm getting questions of what can we sell to increase allocation to these other markets that you were talking about as well. Is that something you pick up as well? Because that foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So let's not.
No, it's almost, but there it's more technical. The selling is,
but this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index in their position to match the index weight.
So the flow bit, it's not active discretionary kind of reallocation, that kind of thing, or that has already happened.
There is that also. But there's a fair bit of passive in this. So it has got a circularity to it. The opposite of this was happening in 2024, which is why India's valuations got stretched. And now it's going the other way, and that's why it's getting depressed. And these the passive thing has gained share globally in total assets under management, and is a dominant price mover, and is not actually going to react to valuations, is not going to react to relative growth opportunity.
Yeah.
It's in the active bit, but the active bit has lost share. So that is, I think, part of the problem. Just going back to the FPI question, of course, relative growth needs to get fixed. Or we can have corporate issuances. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate. And that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered. If I want to trade a US stock, I just have to go to one of the brokers' website, register myself, and I'm up for trading in 5 minutes. That ease of trading that market.
I thought that got. I remember at the CNBC TV 18 forum, the SEBI chairman was there, and I think you and others made that point to him, that the time to registration, the time when you come in, put the application in, and when you're able to participate, that was very, very long, and we got that feedback as well. But that is still an issue? That is still a niggle?
So, for example, in the budget, we increased the limit for non-residents, which includes non-Indians, to buy up to 24%. But they still have to go through a process which makes it rather hard for them to actually participate easily.
Sure.
It's not like a decision I make today, I want to buy Indian stocks and I'm up and ready for trading this morning. I can't take a decision at 8 o'clock in the morning to trade at 9:15 if I'm sitting outside India without an approval. And that, I think, can change, and it can become a lot easier. I know there are concerns around round tripping, etc. But I think there is room for us to make it easier. On the debt side, there's room for us to reconsider withholding tax, because debt investors don't do it.
Actively discussed, so perhaps.
And debt investors surprisingly have stood. They've not exited. They've actually been buying, and this is despite the losses they are suffering on the currency.
What about taxation, equities taxation?
So taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. It's not about the tax itself. And it reminds me of what my father told me in the 80s when I was first filing my tax returns for the first time. I was still a teenager filing my tax returns, and I was complaining to him, Dad, okay, I have to now pay tax. So he said, Beta, you made money, na? So that is why you're paying tax. So never be unhappy about paying tax. The fact is that, you know, a lot of foreigners who probably are not making money now and selling, and so they're not paying the tax, right? So I think tax is not such a burning issue. The administrative process around that could be, but I think easier access is probably the better thing. If you want to choose amongst policies, and I think that's the easier thing to fix. Also, capital gains tax, it can be a tricky thing. You can't do it retrospectively.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to zero, it's going to be a selling avalanche. Because now I can take all my gains without paying tax. Who knows
on
where
the stock of investments that you have?
Exactly. Who knows where the tax will be in 3-4 years? So it can't be done retrospectively. It can only be done prospectively, if at all. So that is, I think, not going to change
the sentiment here and now.
Well, it may, but the reason why it changes things is because then investors say, okay, I don't have to deal with the administrative process around tax. So now this it fits in the ease of doing business. So there are two parts to it. One is the process which I have to deal with on tax, and the other is the process that I have to deal on registration. And we could, you know, make these two simpler and therefore, you know, do make it a little bit more attractive.
Rhythm,
but ultimately, it only turns when the relative growth. So we could end up doing this and still not see FPI flows.
Rhythm, stay with us. Allow me to take a quick commercial break here. So take that break. See you on the other side at the Morgan Stanley Investor Forum 2026 with Rhythm Desai. Welcome back. We are coming to you from the Morgan Stanley Investor Forum 2026, sitting down with Rhythm Desai. You know, the dynamic that you put us up for was that other markets are doing very well. Here, relative growth perhaps is a little slow. AI, not AI, and that kind of thing, right? But the other variable is oil and what's happening with this geopolitical situation. You know, and there are you know, the Shell CEO is on record and other top energy firms, etc., saying, well, the world's not recognizing that oil inventories are at very, very low levels, and they need to, perhaps prices need to reprice to reflect the realities underlying. Do you think we need a bit of a firefighting here and now to defend? I mean, there's the rupee. There's a fair bit of talk around that as well. Do we need to do a debt issuance, a dollar bond, or all kinds of things, right? I mean, the last measure rate hike. The RBI meeting, by the way, is later this week. So, is there some firefighting required, or you think this will just fall in place over a period of time?
That's far too many questions into one.
No, do we need firefighting?
No, because you asked some very important things, so I need to address each one of them. So first of all, rate hike doesn't work.
Yeah.
Why? Because India is a growth market.
We're an equity market.
Yeah,
so
the minute you increase interest rates, growth will slow down, the relative growth picture will worsen, the selling will actually aggravate. We're not a yield market, so it's not going to help. And 25 basis points is not going to take you anywhere. So you'll have to be a far bigger rate hike, which is therefore far more punitive to growth. So that's one. The rate hike, if at all, is considered is only because inflation, prospective inflation is rising. So that's the only reason. Is that rising? Yes, it is. Because there is some impact of the currency depreciation, some impact of the increase in fuel cost, and there is also some potential impact of the El Nino and Indian Ocean dipole situation, which could result in a constrained food supply. So, if I look out 1 year, it does look like CPI headline is going to nudge past 4%, which is the RBI's target. Now, the RBI needs to decide, do I respond to it today, or do I respond to it once I have a little bit more data on the war, on the weather, etc., to therefore put that price in. So I think this is not the week in which a rate hike is relevant. The second thing is that rupee depreciation is not such a bad thing. The rupee is quite undervalued. If you go past the last 30 years, this is the most undervalued it has been, save for the global financial crisis in 2008 and 2013 when the Fed taper tantrum happened. So the rupee has got to that level. It's actually helping India's exports and it's helping India's growth. The collateral consequences, its impact on inflation, which is what we have to deal with. So per se, the rupee's depreciation was not something that the RBI would have resisted, because inflation was far too low 12 months ago, and therefore reflating the economy, the rupee depreciation is the best tool you have. So that's the bit on the, and then the third bit is on the sentiment impact. So that I think is quite contained. It doesn't look like that the currency is in a free fall, and it's quite contained. So I don't worry so much about it.
The reason I asked you that is because there is a messaging is important, right? Either you are at a time like this curbing money leaving, right? That is one way to do it. I mean, all kinds of talks that LRS limit perhaps reduce, all kinds of things, right? Which is basically keep dollars within the country, stop it from going out, right? And the other is, do a big push to get more dollars in. I mean, open up, right? So it's a pretty, they're two very distinct kind of ways to think about this.
If you take actions which prevent the dollar outflow, it will suggest that there is a problem, and it will actually result in counterproductive outcomes. So you will get the opposite outcomes. So you have to be careful about what you do and say with respect to, and you cannot assuage the market that things are fine, but we're doing this as a precautionary measure. The market is going to react. With respect to dollar inflows, I think if you look at gross FDI, it's actually doing quite fine. India is gaining share in global FDI. It's not losing share. The problem that we primarily face is that with respect to outflows. There are two parts to this outflow. One is the investments that Indian companies are making abroad. That number has doubled in the last 18 months. It's a good thing. Indian companies are finally looking out abroad, buying a manufacturing facility, buying a company here, setting up a factory there, and spreading their tentacles. It's something we've been wishing for many years. The second part of it is the profits that PEs or venture capital funds are taking. That's a good thing, because if they can't take the profits, they're not going to bring new money. And the fact that they have been able to take profits out is actually going to get more money back into the country. So it's a rather tactical situation, not a strategic problem for India. I mean, I would dare say here that net FDI is going to be much better in the next 12 months than it has been in the last 12 months. And the reason is because exits are going to be probably less. Gross FDI is likely to pass the 3-digit mark. So I don't think we need to react tactically. Strategically, completely different ball game. I mean, do you want to open yourself up for more dollar flows, which is what I talked about. How do you open up yourself for more dollar flows? You make it easier for investors to come in. So that can be done on all fronts. It can be done with respect to debt, so you water down the withholding tax. It can be done with respect to equities. You make the registration process easier. It can be done with respect to FDI, which is already happening. So I think that strategic approach is fine. Now the last point, bonds. Do you want to actually raise a bond? So if it's a tactical thing, I'm not very convinced that it's going to result in the outcome that we desire, which is you want the rupee to stabilize. For example, if that's the outcome you desire. Strategically, it's fine. I mean, Indian companies can always raise capital abroad and bring it to either fuel in their fund their investments abroad or at home.
Again. Rhythm, I have 2 more questions, and I think I have about 2 or 3 minutes left on this conversation. One is, later this year, we have these mega IPOs in the US. Is it going to be a seminal market-turning kind of an event? I think I've asked you that before, but now we're closer to it. I mean, there are already filings, etc., which are happening.
Not according to my equity strategist. So Mike Wilson remains very constructive on US equities because he's seeing a lot of tailwind of earnings growth.
So it's not going to tip over global markets in any way. The supply can be handled in that sense, right? That's the view. Okay, now to the Indian, just to sort of come back to what you like and how to position yourself, right? And we're going to be talking to your analysts through the course of the day. So I wanted to keep this more top-down, macro-ish in terms of just the view. But I was reading your report, and you prefer domestic cyclicals a lot more compared to export-faced sectors, etc. And you say IT can be a dark horse. So why don't you talk to us a little bit about that?
So I'll talk about the first part. So I think we are entering into a very strong capex cycle. Our view is that the investment rate by the turn of this decade will rise from the circa 31.5% today to 37.5%. That's a major boost for corporate profits. So corporate profit share in GDP is likely to go up. That's the 4-year view. And that's what investors should be focused on. It will unfold a lot of opportunities. It will create better loan growth. So the lending companies will do very well. Lending businesses will do well. Of course, industrials will do well. In some parts, the industrial valuations are a little bit crazy. So you have to be careful about the spots you pick. The consumer will do well. So this is, the domestic story. It is quite strong for India on a 3 to 4 year basis. IT services can be very tricky in the near term. The dust is still not settled down on the AI narrative, but my 2-line story is that AI is a great opportunity for new business, like cloud was 15 years ago. And a lot of people were skeptical about cloud. They've forgotten that. Indian IT companies went 2 notches higher. I think AI has the potential to take them 5 notches higher. Because what it does is that it brings down the price points of the engineering solutions that they offer to their potential customers, which means it increases TAM. And it doesn't take TAM up 1x, 2x, it takes TAM up 10x. Because at a lower price point, suddenly even the middle-sized company in America says, I want this solution in my business. So I think it's a great opportunity, but right now we're dealing with cyclical headwinds. We're dealing with uncertainty with respect to tech budgets, so that near term
We're
has
in that
to
flux right now.
Yeah, so it is all a function of how long your portfolio duration is, and the longer it is, the better you are in buying stuff which people are so super negative on, because in the long run that pays off well.
Play the long game. That's the message. And look through this noise, volatility, and you said this is not the worst we've been at. You've seen
Prashant,
worse
I tell
periods,
you, Indian retail investors are doing precisely that. They're just looking through all this and saying, we're staying there, and I think they'll get rewarded quite nicely over the next few quarters.
Well, we certainly hope so, and we'll be there to cover it. Thank you very much, Rhythm, for joining us. All the best.
Thank you.
And 28th conference, wishing you all the best. Thank you.
Thank you.
we built the rocket entirely with carbon fiber composite, which is super light. It's the lightest material to build anything which can go to space. Next 10, 20 years, I think space is going to transform like no other thing. And I always say that if steel built modern civilization, space will build future civilization. Getting an access to a rocket launch to launch a satellite to space has always been the toughest challenge, and it will remain the toughest challenge for the industry in the next 10 years. As a venture-backed company, we felt like this is a good niche to address, build smaller rockets. When we started in 2018, there was no policy for space, and we signed the first ever MOU with ISRO. Now we use ISRO's facilities. We're one of the largest users of ISRO's facilities.
There are no Indian billionaires in the space tech business. How do you explain that?
I think it's just lack of initiative, but now it's changing, right? So policies are opening up. There is capital, there is investment interest, all coming together now. So now is the time.
Let's talk about now this big launch.
We're going to start stacking the rocket on the launch pad and take off. It should be likely June, July launch. Literally a zillion things can go wrong in a rocket launch, and that's where it's a different rigor of engineering. The next rocket we are launching have parts from 400 suppliers, all from India. This launch is a tribute to Dr. Kim Sarabhai. Because if he has not started the space program in 1960s, we would not be in a position to be able to launch a rocket now.
India's chances of actually leapfrogging this race, you feel confident of that?
Absolutely, no doubt. Thousands of suppliers in India who can build a space-grade part or product. In the next 10 years, I think billions of people will be connected through space. Space is today a $500 billion industry, and by 2035, the World Economic Forum estimates it to become $1.8 trillion economy.
From made in India to launched from India, the country's private space race is entering a whole new orbit. And one startup wants to make rockets as accessible as booking a cab. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2018 by former ISRO scientists, Skyroot Aerospace is building India's first privately developed orbital launch vehicle for the fast-growing global satellite market. After scripting history with Vikram S in 2022, the first private Indian rocket to reach space, Skyroot is now preparing for the launch of Vikram 1, its maiden orbital class rocket built with all-carbon composite structures and powered by 3D printed engines. Vikram 1 is designed for rapid, low-cost and dedicated satellite launches, what the company calls the cab-to-space model. And the opportunity is massive, with satellite demand surging. Driven by broadband, Earth observation and defense applications, the race for faster and more flexible launch access is intensifying. Backed by investors including GIC, Temasek, BlackRock and Sherpalo Ventures, Skyroot recently became India's first space tech unicorn with a valuation of $1.1 billion. The company is now scaling manufacturing, expanding launch capabilities and aiming to become a leading global launch player by 2030. But beyond the valuations and the milestone lies a bigger question. Can India become a serious global launch powerhouse in the new commercial space economy? Joining me now is Pawan. It's great to have you joining us here on Young Turks Reloaded. Thanks very much for stopping by. Before we talk about all things rockets, let's talk about rocket science. The idiom, it's not as hard as rocket science. I mean, all of us have grown up with that. What made you want to do, which is often considered the pinnacle of engineering problems?
Yeah, so I always wanted to work on complicated stuff. That really excites me. And I studied engineering, and I thought the toughest...
From IIT Kharagpur.
From IIT Kharagpur. And as a mechanical engineer, I thought the biggest, toughest, most challenging machine ever built by human is a rocket, which can defy gravity and magically go to space. And that really excited me to get into the sector.
Yeah. So there was nothing about life outside of Earth, extraterrestrial sort of adventures. That wasn't really the motivation.
No, the engineering was my motivation. and also the fact that you can create science fiction into reality, with this.
You're living it. You're living it.
Living science fiction.
You are living science fiction.
Yeah.
But, for somebody who grew up in Vizag, you don't come from a family of entrepreneurs. Your father, in fact, shortly was an entrepreneur, and then you said that he went on to join the government.
Yeah.
But you
always wanted to be an entrepreneur.
Yes.
Where did that motivation come from?
So I used to watch around, and I used to feel that entrepreneurs are great wealth creators and great value adds to the society. I used to respect them a lot, especially like all the entrepreneurs coming from India, whether it is the Tatas or the Ambanis, and across the globe, whether it's the Musk or Bezos or Steve Jobs. Really, all of them inspired me a lot. And I thought I should also become an entrepreneur, and that really excited me because that's a calling which I had from childhood. And even in college, always, in fact, in the IITs, especially in IIT Kharagpur, during my time, there's a lot of entrepreneurial energy out there. Everybody wanted to build companies. So I think the startup sector is taking off. We had the Flipkarts and Mintras of the time.
Yeah.
They're all taking off, and that
all
really
young
inspired.
Turks also.
Yes. Yeah. I used to watch the show, your show from college days. So I think it's really exciting to see all that happening, and that really inspired me to wanting to start at some point of my life. It all happened, then I joined ISRO as a scientist.
Yeah, a quick detour to ISRO before you decided to start up. What was that like?
So in fact, straight out of college, I wanted to start a company, but I really didn't have an idea of what exactly I should do. I was not ready exactly. But then my passion was engineering, passion was rockets, science. So I thought and at that time ISRO came to campus, one of the very early times. And I thought I'll not join any other company. Let me join the space program because I'm really fascinated by it. And then I joined ISRO as a scientist.
That is where you found your co-founder.
Yeah. So 2012 is when I joined ISRO, and then I met Bharat. We both were flatmates for a long time. Like every day we used to have dinner together, and we were
plot
very
your
close
startup ambition.
Yeah, so finally it happened that we both started together. But yeah, we built a really great relationship. We had that intellectual sync really well, and really became very good friends. And the moment I got this idea to start the company, I pitched to him, and then he happened to come on board.
He was the first investor pitch that you made, in a sense, right?
Correct. That's right.
So what did you tell him?
I told him, I think this is something interesting. We should start a rocket company, because.
Did he look at you in shock and awe? Or?
Yeah. No, it surprised anybody, because it's literally, rocket science. And in fact, even when the thought came to me itself, I was a little bit shaken. But something in me said, this is something should be done, and that was more like a calling. And then, I took the leap of faith, and we both started the company.
From putting this thought out there in the universe, having the conversation about it, to actually getting started, putting pen to paper, and then looking for investors, looking for land, looking for how to get this going. I mean, what was that process like?
So in fact, we took it, I took it like a science or engineering problem, so it's like learned everything on the go. In fact, I remember Googling, how to raise capital, and I learned how people raise capital. I didn't even know what is equity, so nothing literally, so just want to start a company and make it as successful as possible and do everything possible to make it big. And I learned on the go, and typically didn't. In fact, what happens is the most technocrats, they think that, business is out of the league. I mean, it's not our DNA or our league. But I never felt that way. I thought it's still a problem to solve, like an engineering problem. And that's why you see, I think one of the most successful entrepreneurs are engineers, So it's we look at the problem, break down the problem, like solving a math puzzle, and learned everything on the go. And then I
want to address the premise of the company, which is really, the Uber for space, so to speak. How did that come about?
Yeah. So in fact, if you see today, if you want to launch a satellite, all the like our smartphones got smaller with time. Satellites are getting smaller with time, and more than 90% of the satellites are small satellites. Something below 500 kilograms, and then many of them actually need a unique ride. For example, if you want to go to our friend's house, we take an Uber. We don't take a train. So that was just evolving. Satellites are getting smaller, and the new niche orbits and constellations. Instead of building one big satellite, people were building smaller satellites in large numbers for better coverage. So as a venture-backed company, we felt like this is a good niche to address, build smaller rockets. And these smaller rockets actually are not small. These are like, for example, the rocket which we're going to launch now.
I was just going to ask you that. I mean, what does small really mean?
Yeah. So just the payload is small. That means like below 500 kilograms. But to launch a rocket, to launch a satellite below 500 kilograms, for example, our rocket is 7-story building tall. It's it's a pretty...
It's a 7-storied building, tall rocket.
Which needs to launch a less than 500 kilogram satellite, because that much energy is required to go out of Earth, lift off and go out of Earth's gravity well, which is so big, and then go to space and, put a satellite into orbit, which will rotate around Earth for several years.
Let's talk about what you've done differently. What are the key differentiations as far as the building part of the rocket itself is concerned? Going to the government and saying, hey, we want to be India's first company in the private sector that launches rockets. What was the response? What was the reaction? Did they sign off on the land immediately? Or did they look at you in disbelief?
So, in fact, when we started in 2018, there was no policy for space.
Yes.
And so there's no way we can work with the government at that point of time because there's no policy for space sector. And in fact, I thought it would take probably a decade for the policy to come. And then government announced the policy in 2 years.
Yes.
They said that, now
and
space
set
is
up
open.
In space.
Set up in space. And that was really a game changer for us. And then all support came in we became the beneficiary of the policy very early on. And we signed the first ever MOU with ISRO. Now we use ISRO's facilities. We're one of the largest users of ISRO's facilities outside of ISRO. And we get access to, multi-$100 million facilities, at the government, space agency. And that gave us access.
How long did it take to actually build the first rocket, which was suborbital?
Yeah.
What does it cost?
Yeah. Sure. So in fact, we launched Vikram as India's first private rocket to space in 2022, and that took 2 years. From design to launch in 2 years. We built the rocket entirely with carbon fiber composite, which is super light, the lightest material to build anything which can go to space. And we chose that, and it is a tough learning curve initially, but we mastered it, and we are pioneers in this particular technology right now.
What was the first check like? Getting the first check.
Yeah. So the only platform we knew was LinkedIn, and we were messaging everybody. And then my friend messaged Mukesh Bansal, at that time saying that, we're building a rocket company and, something
a man
exciting.
Far removed from the rocket world or the space world ended up being the first port of
investor.
Call.
Because he's very passionate with deep tech and he's been an engineer. He studied in, IIT Kanpur.
Yes.
And then I think he wanted to be an aerospace engineer at some point.
Yes.
He wrote the first check of 10 crores. And that, I think, gave us the first 3 years at Skyroot. Yeah.
From 10 crores, the first 3 years of Skyroot to today becoming India's first space tech unicorn. What has been the most challenging aspect of the journey so far?
So I always say, I think, raising capital is rocket science for us. So it's especially in deep tech, where, the gestation periods are very long. The tech is very difficult to understand and the risk is very difficult to gauge. I think the toughest journey for us is to break the glass ceiling for every round of capital. Every round of capital we raised, we were the highest, raised capital in this sector. Very new. In fact, so far, I think we have raised close to $160 million before getting commercial. So it's crazy. I mean, I don't know whether anything of that sort has happened in India before.
So again, and I want to understand from your point of view, as an investor, they're investing in deep tech, they're investing in this opportunity that they believe is likely to open up. What is the addressable market for a company like yours?
Very good question. And in fact, rocket business is the easiest business in terms of business, because it's more like a...
So that's not rocket science.
That's not rocket science. It's easy and it's very visible. For example, you build a rocket. Let's say you manage to build a rocket, which is the most difficult part. And there's only few companies doing it. And the space industry together today is $500 billion industry. People think that space industry is just government. It's a very big, commercial industry, and with very few rocket launch companies, because that's the central to space industry. You need to launch something to space to be able to do business from space, and that's a $500 billion business. And very few people are able to build rockets and launch to space, and always getting access to space. That means getting an access to a rocket launch to launch a satellite to space has always been the toughest challenge, and it will remain the toughest challenge for the industry in the next 10 years. And that's what. So you crack it. It's you launch a rocket, you get paid really well, and rocket industry like SpaceX approved, it's very profitable, venture if you crack it well. And very few players and huge barriers to entry. Building a rocket can take decades, sometimes extremely tough engineering. And that's what it is.
Why do you think that the Indian billionaires haven't taken to space in the way that we've seen global billionaires take to space?
So I think rocket science is a bit intimidating. It's like people think that's very
It's
tough.
not intimidating to you who grew up in Vizag and graduated from IIT Kharagpur, but it's intimidating to billionaires, you think?
Yeah, I know, because India is, building tech from India, if you see, like, it's very little, So if you see, like, deep tech, what is the largest deep tech company in India? So still, like, very early phase. And
again, why do you think that's the case? Because this is the big challenge.
Yes,
this is also the big debate. That what is holding India back from addressing large, complex problems? Are we going to be left behind? Is it going to largely be a race between US and China? How do you respond to that? And does this worry you?
Yeah. So I think, we have very strong foundational elements like the engineering talent. We are the largest home of engineers in the world. We produce 1.5 million engineers every year, largest in the world. So I think essential ingredients are very, very strong. I think it's just lack of initiative, but now it's changing. I think people want to do startups now. There's, in fact, the funding from the government coming in, with 1 lakh crores, RDIF, etc. So I think it's a enabling ecosystem started. Now policies have started. Just imagine, like, just a few years ago, the space policies opened up, right? So policies are opening up. There is capital, there is investment interest, all coming together now. So now is the time.
Today, as you look at people screaming about the valuation number and the fact that you've turned a unicorn, does that really matter to you?
Valuations are, it's a fleeting temporary number, as we all know, right? So it's really good to have a good value. So you're able to raise more capital by, shelling out less equity. So it's always good for an entrepreneur. But still, at the end of the day, I think, what value you're bringing in. At the end of the day, the rockets should work. It should become like, a good revenue generating profitable business. That's a core goal, and which is real rocket science. So always our focus is always there. And all these are good means to get there and get better. That's it. Yeah.
So let's talk about building the business case now. At this point in time, what does it cost in India for a company like yours to be able to put a rocket into orbit, which is the next target for you? And what do you believe that opens up by way of opportunities? What could revenue look like once you start to make revenues?
Yeah, sure. I think, like, as I mentioned, in fact, like, the world's most valued private company is a rocket company. You can just imagine the level of opportunity which exists if you execute really, really well. And we're in a very early phase, we're just like, not even 8 years old company, right? So I think it's just a very beginning phase for us. And if we do really well, I think, typically the rockets of the kinds which we build, you can get revenues as high as probably 10 million per launch. And we can do as many launches as you could, but it's a really tough challenge to be able to scale, rockets to very high production level.
So let's talk about now this big launch, which is going to be a global milestone, not just an Indian milestone, but a global milestone for you. Take us through the prep that's on and how soon can we expect this to now finally lift off?
Yeah. So in fact, the biggest milestone so far at Crude is building the entire rocket, orbital grade rocket, which can put a satellite into orbit, building hundreds and hundreds of systems, subsystems. We tested them over years, and then we integrated.
And this is all
sections,
designed and developed
everything, 100%,
and manufactured in India.
Yes, 100% designed and manufactured in India. And this deep tech as is building a rocket, 100% designed and manufactured in India. That's what we're doing. And yeah, so it's very exciting and fascinating to do what we're doing. And we build the rocket, the sections are made, it's assembled, and now it's at the spaceport, in Sriharikota, India's launch site. It's already there. Now we commenced integration operations there. And in the coming weeks, we're going to complete testing at the launch site, and we're going to start stacking the rocket on the launch pad and take off. It should be likely June, July launch.
Assuming that all falls into place and that happens, what next then? And where do you really see potential clients coming in for you?
Yeah, so even the first launch, we have some clients coming in. So in fact, they are like partially commercial missions. So because there's risk involved in the first few flights, and so typically from the third or fourth flights is when there'll be full commercial missions. At least after 1 or 2 successful flights is when it kicks in, and then the world needs more access to space. I mean, literally anywhere I go, the biggest discussion in the space industry is access to space. So there's no enough access to
space. To what end and for what purpose?
In the next 10 years, I think billions of people will be connected through space, internet from space, and that's what for example, Starlinks of the world are about. Thousands and thousands of satellites, and just there is not enough, satellites to give connectivity to billions of people, right? And that will be a very growth, phase where there will be, several constellations, each constellation being several thousands of them, all adding up to, several tens of thousands of them just for connectivity to Earth. And just imagine billions of people getting access to high-speed internet directly from space. And if you see in India,
the cost of that.
Yeah, so the cost will be into billions, but that's a very attractive industry to be in. It's like it's just literally a multi-billion-dollar industry. As I mentioned, space is today $500 billion industry, and by 2035, the World Economic Forum estimates it to become $1.8 trillion economy.
As we look at where India stands in the global space race, this is a sector where we actually do have a right to win. India's chances of actually leapfrogging this race, you feel confident of that?
Absolutely, no doubt. If you see the fundamentals are very, very strong. Like for example, as I told, we're the nation of engineers, so the best engineers. And then we have, for example, we're a launching nations, one among the only 7-8 nations in the world who have capability to build their own launch rockets and launch them, and build their own satellites and launch them. We are a very unique ecosystem. We're among the top 5 spacefaring nations in the world. And we have complete island dedicated for launching, huge island dedicated for launching, very close to the equator, geographically very good. And when you launch a rocket, you need very long sea. India has a very long coastline, and we have geographically, we are blessed. We have a lot of engineers. We are frugal
and now companies
mindset.
Like yours.
Yeah, so I think entrepreneurs coming up and doing things, investments are coming up now in a big way. So I think it's all the ecosystem, and then regulatory agencies so good, and I think they're super fast, working like a startup, enabling the sector, right? So I think it's a very unique place where India has a real chance to go big in the global sector, because all the ingredients are there. And one very unique ingredient is we have thousands of suppliers in India who can build a space grade part or product. In fact, the next rocket we are launching have parts from 400 suppliers, all from India. And then 100% of the rocket is designed and manufactured in India, and majority is sourced within India. So I think that's a very unique statement, of capability in this sector, which you cannot see in any other deep tech sector.
So it's almost close to 100% localization?
Yes, almost close to more than 90% localization. And then, in fact, most of the value is generated within India, and with very less dependency globally. It's the deepest of the deepest tech, like a rocket.
So we're truly Atmanirbhar.
Truly Atmanirbhar. Yeah. So that's where we are, and that's where I think space is a very unique sector where Indian companies can go to very large global space companies, and the competition is always global. So space is a global industry, and we can go heads on with the best in the world.
What has it been about the way that ISRO has functioned? within the public sector to be able to achieve what it has? Because as we talked about it, the perception is that the public sector can't deliver. The public sector is not efficient. The public sector is not capable of excellence. And sometimes it's these broad generalizations that actually do a disservice to the public sector as well. But what is it specifically about ISRO that's been able to create the magic?
I think ISRO, because I was part of ISRO, I've seen the culture there. I think there's a lot of a spirit, national spirit to do something really big. So that is shared across everybody. People don't work for a paycheck. People work for the nation. People work for building tech. Right? I think that culture at the government agency is really something which I really liked at while I worked at ISRO. That really makes it really stand out. And also the resources, right? We always had less resources and bigger ambitions, right? And so that really made it really well. Despite the lot of rules and regulations which needs to be followed, but still it's been very successful. It's just because of the spirit of the people and the culture from the veterans like Dr. Vikram Sarabhai or like Dr. APJ Abdul Kalam. They built a lot of values which even today they're visible. So that's just very important.
You said that they were driven by a sense of nation building, nationalistic fervor almost. What drives you? How much of that spirit drives you and what you're trying to do at Skyroot?
I think for me, I think definitely I think inspiration is to take India global as much as possible, through the global initiatives, because as I mentioned, like the business wise, it's a global industry, so and India has very strong foundations which can be taken global. So definitely that inspires to do things. And but also like I think as we say at Skyroot, our mission is to open space for all. So I think the bigger drive is that we are actually serving the future of humanity in a big way, because space is the future. Like you mentioned about data centers in space, so the lowest cost of compute is going to be space, and then you will have like large data centers in space, and that will drive AI. So I'm very clear that AI can drive as fast as all the space economy can grow. So there's a very strong relation. There's communication. Billions of people getting connectivity. In India, almost like 1 in 3 fishermen use data from satellite to find the right shoals of fish. Every year, billions of dollars get saved but through satellite, guiding the fishermen to find the right shoals of fish. Next 10-20 years, I think space is going to transform like no other thing. And I always say that if steel built modern civilization, space will build future civilization.
Well, we wish you the very best of luck with your plans for Skyroot. Best of luck for the launch. We look forward to speaking with you as and when that does happen. July is the scheduled sort of time that you are looking at. And thanks so much for explaining to us what the opportunities look like, but more importantly, what it actually takes to build a deep tech company here in India. 100% made in India for the world. Thanks very much, Pavan, for joining us on Young Turks Reloaded. Well, we are going to take a break. There's a lot more coming up. As always, we like to have our conversations with you, so do send us your feedback and tell us who you would like to see on the program next. From all of us here for now, thanks very much for watching.
Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed up. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Lata, I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock. Both of these could be adverse and could push up headline inflation. But, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? C, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember, back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, I think, MPC needs to conduct policy based on what is effective. In Indonesia's case, FX stability is part of the BIS mandate, but, the surprise 50 basis point hike actually did not help stabilize the IDR. And in Philippines, inflation is running above 7%. So compared to the upper bound of 4%. So the inflation picture in Philippines is very different to India. So we need to look at our own scenario. I think using the interest rate to defend the currency is inadvised for actually a number of reasons. First, we've spent more than a decade trying to anchor expectations in terms of the inflation targeting regime and what the monetary policy framework is about. The moment we start targeting FX to manage using rates, I think that essentially undoes a lot of the hard work that has been done to anchor expectations. Second, interest rate hikes to defend the currency are not effective, as seen in the case of Indonesia and also as seen in India's case back in 2013. And third, we need to do a cost-benefit analysis. The cost of doing a very aggressive rate hike in order to curb demand vis-a-vis, the benefit, we will end up in a situation where the growth damage is so substantial that we'll start worrying about the fiscal side and other consequences of weaker growth rather than on the balance of payment situation. And, as we've discussed in the past, India does get a lot more of growth capital. And finally, I think we have, a number of non-monetary measures on the current account, on the capital account, on the macroprudential toolkit that can be used to manage the currency. So I think, the market argument of using the interest rate to defend the currency, I think both from the currency side as well as, from the inflation side, it is not essential and not needed in my view.
Okay, I'm going to bounce the same thing to Samiran as well, because there is a lot of voices in the market which believe that the optics are that the Reserve Bank may be falling behind the curve, both on inflation, but even on interest rates. The defense is being asked for by some quarters. Samiran.
Yeah, thanks, Lata. I guess Sajid and Sonal have very eloquently argued in favor of the view that why RBI can delay any rate hikes at this point of time. And it's also our view that that's probably likely in the June policy that RBI defers it. But it's interesting that there could be another way to play this also. First, we have to understand that the December rate cut actually did not have any intended effect on the transmission. So in our view, probably another 25, 50 basis point hike from here is simply normalization because we probably cut too much in the cutting cycle at that point of time. So it just creates a little bit buffer for RBI to work with. The second issue is that we all are forecasting that inflation in the latter part of the year is definitely going to go up. By how much, we probably don't know for sure. But that increasing trend of inflation, again, it's possible that the MPC decides to create a buffer now so that they don't have to scramble too much at the latter part of the year when there's a sudden spike in inflation, partly simply because of base effects. And the last point, which you also mentioned, which is about this whole perception about falling behind the curve. And there is a risk that if the markets feel that the RBI is falling behind the curve, then the exit route or the valve that the markets will try to play it through is likely the currency. And that's where the fear is that if RBI is seen not to be doing anything, then is that going to be some sort of an additional risk that the market will try to price in on the currency front? So we remain with the baseline view that probably not a hike in June, more likely in August, because RBI wants to give some guidance generally to the markets. But having said that, there is a we will not be surprised, at least, if the hike is advanced to June itself.
Okay, so the governor has, elbow room on both sides. Soumyakanti, actually the bigger thing that the market is waiting for is what's the package for the rupee? If not rates, what? What do you think? They can, they just have to sound, the optics have to be pro-rupee. What will this announce?
Yeah, thank you, Lata. I think there are a couple of options on the RBI before the table. And in my sense, I think given the rapid and the unprecedented depreciation in the value of the rupee, which is, I think, has somehow been significantly higher compared to any other currencies, I think possibly and addressing the issue becomes more important at this point of time. There are various options. I think the first options, all the other members have already debated an interest rate hike. I am of the view that a policy rate hike may not be appropriate for this currency, the currency, because of the simple reason is that the more you try to hike the currency, the more the market will believe that the rupee could actually, it is being done to protect the rupee. And better way is basically to work on regulatory to other measures. For example, the measures which attend to address the market microstructure, which raises the short-term rates and lowers the long-term rates, like Operation Twist, or even widening the corridor for a limited period, which was done in 2013. So that could be one of the options. Regarding the second option on the balance of payment, I think there are a couple of options, but the options are of on an FCNRB window like which we did in 2013, or even raising bonds at this point of time would be a little defeatist, because the cost of such mobilization could be in double digits. And I don't think at this point of time, for example, even if give the options of an FCNRB deposit mobilization, the end use of that funds with a 10% upwards, I think nobody is going to willing to borrow. So there's an avalanche of liquidity in the system. Apart from this, there could be issues like capital controls. There could be also controls on the repatriation of funds from the NRI deposits. There could be some simplification of the tax structure on the portfolio outflows. And there could be also some measures which tries to addresses the LRS.
I take your point, Soumya, but much of this falls in the remit of the government. Not all of them fall like taxes or capital controls. Dr. Sen, as Samiran also said, they first like to guide and then hike. What should the RBI's message be? Because this policy, more than any, is going to be a matter of optics. How should they sound?
Well, the point is that we are in a situation where the government or the RBI should make no effort at all into downplaying the seriousness of what we are facing. And the RBI needs to talk about it. I mean, it's not that people are insensitive, but the conditions that we are facing are really quite serious, because everybody's talked about the supply side shock, which is absolutely true, but there's a demand shock that's going on as well simultaneously. And so that puts us on a really serious tightrope walk at the moment. And this is something that the RBI has to make very clear, saying that things are in the process of development. We will watch and take appropriate action when the time is right. But a full description of the situation that we are facing upfront and clearly is what the RBI should be doing. And I agree with everybody else that this is a time to actually give them not necessarily a guidance, but at least give them the likely scenario that the RBI is visualizing.
Fair point.
Guidance may come, but it's not absolutely necessary. But people need to know where RBI stands, how RBI is analyzing the situation, and what its take is on the likely future.
Fair point. No pussyfooting on the difficult issues, is what you're saying.
At all.
Absolutely. Point taken. Actually, I want more of your views on what is in the, what are the options available for RBI, and more on whether of the dangers of falling behind. Considering that growth is resilient, why not now? I want to ponder those questions more, but we have to take the first vote. So, gentlemen and Sonal, be ready. First question, what will RBI do on June 5th? I've more or less guessed, but Sonal, you go first.
On hold.
On hold on repo rate. Okay. Samiran, what will they do to the repo rate?
Hold.
Soumya?
Hold.
Sajid?
Hold.
Okay. Chairman, your role is easy. Would you agree?
Hold.
Yes, you sounded that way. Okay, it's a universal hold or unanimous hold. Let's see if the next question throws up a difference. Sonal, how many rate hikes do you think in this year, FY27?
None, and can't say right now.
Okay, can't say. Samiran?
We have penciled in 50 basis points.
Okay, 2 hikes. Soumya?
Can't say at this point.
Okay, playing it safe. Sajid?
As of now, none. I think uncertainty, but as of now, none.
Okay, this is a divided house. Dr. Sen, what would you say?
It's difficult to say, but at least one will have to come sooner or later.
Okay, that's a divided house on how many rate hikes in FY27. But I want to dig deeper into how many steps are available, options are available to shore up the rupee. Those questions coming up after the break. Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC TV 18. I've been speaking with Chairman of our committee, Dr. Pranab Sen, and members Sonal Verma, Sajid Chinoy, Shamika Ghosh, and Sajid Chinoy. Gentlemen and Sonal, thanks for your patience. Okay, now a little more on the issues we already discussed. What we didn't discuss was liquidity. Shaumya, there are times when the collateral, the CBLO market or the tripartite repo has gone even below 5%. Right now, call is a little above 5.25 at 5.3. But this looks like hardly in sync with a country that is running towards 5% inflation. What are you expecting on the liquidity front?
Liquidity front, I think the Reserve Bank would like to try to play it safe. I think recently they have just done a buy-sell swap. So it has to maintain a delicate balance of ensuring that the long-term rates doesn't go significantly higher, which is already at 7%. And given the borrowing program which the government and the states are running, I think to bring it below 7% will be a tad difficult. So from that perspective, I think the liquidity management has to be modulated a little bit at this point of time. So may not be aggressive OMO purchases which the central bank has done in the last year or so, injecting around 10 billion into the system, but some amount of modulation of the liquidity. But the point which I emphasized in the beginning, that the central bank needs to do some micro management measures. It needs to attend the market microstructure in terms of controlling the rates. For this, ensuring liquidity that is a little bit at the shorter end of the market should be a little squeezed, and at the long end of the market it should be more flexible, so that the overall term structure of the interest rate remains benign and not significantly increases at the cost, and which could actually hurt the cost of growth and borrowing at future.
No, to be fair, they don't usually speak too much about liquidity in the policy these days. They do say that it's delinked with their policy itself. But Samiran, you had a big report on the steps that Reserve Bank can take. Shaumya narrated some of them. Much of them fell on the government's lap. What do you think of RBI can do? This is going to be the much-watched space.
So there are two broad approaches. One approach is that we are likely to have a BOP gap this year. We are expecting it to be as large as $50 billion. So the RBI can consider a large bazooka step to fill up that hole in the BOP. That's one approach.
How?
I'll come to it. But the second approach is to say that it's too early to go big and bold, because that can create some sense of panic in the system, also that we are getting into some sort of a crisis mode. So we go the other way in saying that in comparison of last 2 years BOP deficit of only $34 billion, the extent of rupee depreciation has been just too much. So some adjustments in administrative measures can affect the hedging / speculative behavior in the market, and to that extent can also have some control on the currency. So this has to be in two parts. RBI has to decide which one they want to sequence earlier. If we go by the first one, in our view, the best method is right now to allow the banks and financial institutions to issue dollar bonds abroad and swap them through a concessional facility and convert into INR. That kind of kills two birds with one stone. You address the USD INR problem as well as you address the credit spread problem. And on the side of trying to tweak with administrative measures to change hedging perception, one of the things could be you can have an asymmetric measure to increase the hedging cost for importers / FPIs. And second is that you could have some measures through which you can fast track the exporter hedging, which currently is very deferred. So these are the two broad approaches. The sequencing of it is a very difficult policy dilemma for RBI, because the first one is a more permanent solution. The second one is a more band-aid solution. But the first one creates sense of panic, whereas the second one, you can do it in a very quiet way.
Okay, fair enough. It's just that ECBs, even if all the banks were to raise, it doesn't for me, it doesn't add up to 40, 50 billion. But I could be wrong. It could still be an incremental positive step. Sajid, I mean, I want to pick your brains on this. What are the FPI saying? Are they okay? They don't see comparing India with Philippines and Indonesia and seeing us as behind the curve. And more importantly, you ask a trader, they do tell you that when interest rates near-term, one-day money or money market rates are higher, the rupee premium goes up. It is attractive to stay in rupees rather than in dollars. To say that interest rate is completely unrelated is not something many treasury guys buy.
Two different questions, both good questions. So let's take them. I think the situation in Indonesia and Philippines is very different. Philippines saw a huge spike both in headline inflation and core inflation, because there was a much larger increase in retail prices in that country, and B, it's a larger weight in the CPI. So the central bank, given what their mandate was, had to respond. Right? Okay. That's a very different situation for where India is, where you've seen a less pass-through, core inflation is lower, and even forecasting out, the RBI's inflation forecast is below the upper end of that band. So it's a very different situation. Okay. In the case of Indonesia, as Sonal mentioned, it's one where the mandate is, currency stability. India's mandate is not currency stability. Now, interest rates do matter for currencies. There's no doubt about that. But the question is that if you were to meaningfully want to change currency expectations, 25 basis points will not do it. Okay. You will need to move 100, 150 basis points. And I think this is where one has to understand that the situation is very different from 2013. In past episodes, whenever the rupee's been under pressure, it's been typically the current account widens sharply, and then capital flows are not enough to finance that. Yeah. And so you rely on some rupee depreciation. If that doesn't work, then you do expenditure compression. You tighten fiscal policy, you tighten monetary policy. This BOP situation is very different. The current account deficit over the last year, 25 calendar year, has been 0.5% of GDP. Yeah. Core inflation is running at 3%, and we're still awaiting a capex cycle. Yeah. So even though headline growth may be healthy, we have to be very clear here that this is very different from 2013. Expenditure compression, fiscal and monetary tightening need to be a last resort. We should start with the rupee being the shock absorber, A. B, if that leads to expectations getting unanchored, I agree with Shomaran, you require a circuit breaker in terms of capital flows to prevent this hedging behavior. And expenditure compression, I think, should be a last resort given these circumstances.
I'm sorry I'm rushing you because you're running out of time. Sonal, you have to keep it brief. How should the stance change, if it should?
Yeah, Lata, I think the stance should stay neutral. The challenge with changing the stance towards tightening is it gives a clear signal for markets that we are going to more likely than not hike rates in August. And given the uncertainty on whether this is morphing into a demand shock, uncertainty on how the deal and oil price plays out, I think better to keep the stance at neutral, but guide that policy is going to be agile, data dependent, and will ensure that inflation stays anchored to 4% over the medium term, and clearly specify the parameters that MPC will be watching to decide what will trigger a rate action.
Okay. Well, Dr. Sen, again, you'll have to keep it brief, sir. But, growth numbers so far are very good. Auto sales are really decent, if one is looking at it as a measure of demand. And also, there is a likelihood of inflation also because of the El Nino situation. So really, why are you guys resisting a rate hike, ahead of the curve rate hike?
Well, the main reason I think we are resisting it, and all of us are resisting it,
yes,
is the fact that if you give a rate hike today, you are giving the impression that all is well in terms of our growth trajectory. Okay. And that is in fact not true. If you look at what has been happening to investments, it's been a fairly sad story for a fairly extended period of time. We are living off past capital. Okay. And nobody should be under any illusion that we are on a high growth trajectory for the foreseeable future. We are not.